Introduction. Thank you for choosing Kaplan for your educational needs, and welcome to the Series 65 License Exam Manual, L.E.M. We understand that you are trusting us to help you advance in your securities industry career. We have written this manual and any supplemental resources you may have purchased by first collecting and clarifying exam-related content. Exam content is provided for you in an adult learning framework that offers the tools you need to pass your exam on the first try. Some of these tools include exam-focused questions and content to maximize exam preparation, an interactive design that integrates content with questions to increase retention, and integrated Securities Pro QBank exam preparation tools to sharpen test-taking skills. Why do I need to pass the Series 65? Most states require those who give investment advice or perform related functions to pass a qualification exam. The North American Securities Administrators Association, NASA, created the Series 65 Uniform Investment Advisor Law Exam as one of the options that may be used to meet that requirement. Most students use this examination to qualify as an investment advisor representative, IAR, a supervised person of a registered investment advisor. Are there any prerequisites? There are no prerequisite exams to pass before sitting for the Series 65 exam. However, the exam assumes that you have a broad range of knowledge or experience with investments. Because many students don't yet have that background, this L.E.M. attempts to cover all of the basics as well as the more advanced material tested. Those of you with an SIE, Series 6, or Series 7 registration will find these basics to be a good review that will help set the stage for the more advanced learning required. Passing the Series 65 normally is a prerequisite to getting licensed as an investment advisor representative. However, most states will allow you to substitute one of the following certifications for passing the exam. CFP Certified Financial Planner, granted by the CFP Board of Standards. CIC Chartered Investment Counselor, granted by the Investment Advisor Association. CHFC Chartered Financial Consultant, granted by the American College of Financial Services. PFS Personal Financial Specialist, granted by the American Institute of Certified Public Accountants, and CFA Chartered Financial Analyst, granted by the Chartered Financial Analyst Institute. Applicants still have to meet other state licensing requirements, such as filing a Form U-4 or Form U-10 and paying fees. What is the Series 65 exam like? The exam is delivered on a computer at Prometric testing centers around the country. The session begins with a tutorial on how to take the exam. The Series 65 is a 180-minute, 130-question exam, plus 10 unscored questions prepared by NASA and administered by the Financial Industry Regulatory Authority, FINRA. The unscored questions are not differentiated from the other questions and are randomly distributed throughout the exam. There is no penalty for guessing, so you should attempt to answer all items. What score must I achieve to pass? You get a score of at least 72%, 94 questions correct of the 130 scored, on the Series 65 exam to pass and become eligible for registration as a registered investment advisor representative. After your exam, you will receive either a notification that you passed, but no score, or a failing score with a printout that identifies your performance in each function area. Which topics will I see on the exam? The questions you will see on the Series 65 exam do not appear in any particular order. The computer is programmed to select a new random set of questions for each exam taker according to the preset topic weighting of the exam. Each Series 65 candidate will see the same number of questions on each topic, but will see a different mix of questions. The Series 65 content outline is divided into 4 major function areas. Job Function 1. Economic Factors and Business Information. 20 questions, 15% of the exam. Job Function 2. Investment Vehicle Characteristics. 32 questions, 25% of the exam. Job Function 3. Client Investment Recommendations and Strategies. 39 questions, 30% of the exam. Job Function 4. Laws, Regulations, and Guidelines, including prohibitions on unethical business practices. 39 questions, 30% of the exam. How is this course structured? As professional educators, we have structured the material from the 4 job functions in the order that helps you best understand it. That means the program will diverge from the order listed in the previous table, but everything will be covered. The course consists of 24 units, each devoted to content that you will need to know to pass your exam. Each unit consists of one or more lessons. Each lesson corresponds to a specifically identified job function. These lessons are further divided into learning objectives, LOs, that help you focus on and retain a manageable portion of material. For students attending one of our classes, live or online, the class lecture will follow the sequence of these units. The following is a table showing how the material is organized by job function. Function 1, Economic Factors and Business Information. L.E.M Units 6, 7, 19, and 20 accept lessons 20.2 and 20.6. 20 questions or 15% of the test. Function 2, Investment Vehicle Characteristics. L.E.M Units 1 through 5 and 24, as well as lessons 20.2 and 20.6. 32 question or 25% of the test. Function 3, Client Investment Recommendations and Strategies. L.E.M Units 15 through 18 and 21 through 23. 39 questions or 30% of the test. Function 4, Laws, Regulations, and Guidelines, including prohibitions on unethical business practices. L.E.M Units 8 through 14. 39 questions or 30% of the test. Preparing for the exam. Using the study calendar. On your dashboard, you will have a study calendar that you can customize to your personal schedule. The study calendar helps you plan your use of all the other study tools you may have in your package, including the class. Set up your study calendar so that you will know what to do each day. The calendar gives you step-by-step details to optimize your learning experience. Think of it as a roadmap. If you don't take any detours or shortcuts, you will arrive safely at your destination, a passing score. Using the L.E.M. The License Exam Manual, L.E.M., is your textbook for this course. Reading the L.E.M. carefully will help you succeed. Reading material several times may be useful. Sometimes, out of necessity, a term or phrase is used prior to its formal introduction in the course. If needed, you can consult the glossary for the definition or the index to locate a more complete discussion of a term. You also may have access to a PDF copy of the L.E.M. If so, we strongly recommend that you download it because you can use the search function, Control F, to find specific terms quickly. In addition to the regular text, the L.E.M. also has some unique features designed to help with quick understanding of the material. When additional emphasis is valuable to your comprehension, the following distinctions are made. Take note. Each take note provides special information designed to amplify important points. Test topic alert. Each test topic alert reviews content that is especially likely to appear on the exam. Example. Examples provide practical applications of theory. They are quick, interactive, real-world illustrations of what you just read. Examples help ensure that you understand and retain material. Practice question. Within each learning objective, there may be one or more practice questions. We've designed these questions to help you see how the topic being discussed might be presented on the exam. Knowledge check. After each lesson, there is an opportunity for you to measure your comprehension. These short tests reinforce the essential material covered in that lesson. Answers are at the end of each unit. Complete the knowledge check and review explanations for all questions, whether you answered them right or wrong. Using additional study resources. To accompany and supplement your L.E.M., your study package may contain additional study resources. Be sure to spend some time on your dashboard, view the best practices PDF, and understand all that is available to help you study. Using the Securities Pro QBank. Coordinating with the L.E.M., the Securities Pro QBank includes a large number of questions that are similar in style and content to those on the exam. You may use the QBank to generate exams for a specific unit or combination of units. The study calendar will prompt you to do this. Carefully review all rationales. Use the learning objective number to locate additional or related information on the test topic in your L.E.M. if needed. Do one additional test of the suggested length on any topic on which you score under 60%. Do not become too overwhelmed or bogged down in any one unit. You don't want to lose sight of the finish line because you're having trouble with one hurdle. Keep moving forward. It's a steady pace that wins the race. View rationales after each question initially and spend time studying each rationale to learn the concepts. Later, you will want to create simulated exams in which scores and rationales should be viewed at the end of each exam. Perfection is not the goal during the early reading phase. While scores in the mid to high 60s are good initially, aim for at least 80% correct on simulated exams. You will also use the KeyBank to create weighted simulated exams that mimic the proportional composition of the real exam. The study calendar specifies the ideal number of tests, but there is no upper limit on how many you can create. One thing you should know about the KeyBank is that the answer choices are scrambled each time you take a test. That is, if the first time you saw a specific question the correct answer was choice A, that correct answer might be choice D the next time. Please keep this in mind if you need to contact us regarding a question. Using fixed exams. Checkpoint and midterm exams. Each unit is followed by a checkpoint exam, and at the approximate midpoint of your studies, there is a midterm exam. These are fixed, unchanging exams. That is, unlike KeyBank exams that include randomly selected questions, the checkpoints and midterm are the same for everyone. They are designed to check your progress before advancing to the next unit. Challenging questions have been specifically selected based on their topical coverage, and they tend to match the average difficulty of the real exam. Because they are fixed exams, they may be taken only once, but can be reviewed as often as desired. Be sure to take these when prompted by your study calendar. Practice and mastery exams. You may also have fixed practice and mastery exams. These exams are designed to closely replicate the true exam experience, both in the degree of difficulty and topical coverage. They provide a score, diagnostic feedback, correct answers, and answer rationales. The practice and mastery exams are sound indicators of potential actual exam scores. The better you do on these exams, the more likely you are to pass your actual exam. These exams may be taken just once and must be completed in one sitting. After completing the practice and mastery exams, be sure to review your performance tracker so you can identify areas of weakness. You can then create custom quizzes focused on topics as needed. Also, review your L.E.M and video library for additional help. We recommend taking the practice exam shortly after a scheduled class and the mastery exam 2 to 3 days before your exam date, as indicated in your study calendar. Using the video library. You may also have access to videos on various topics in our video library. These short, engaging videos cover key topics. If you have access to our video library, please review the topics as you complete your assignments in the study calendar. Because many of the videos are not exam-specific, you may encounter material that is not covered in your L.E.M. Just skip ahead until the slide shows something familiar. Updates/corrections link. Don't forget to regularly check the Updates/corrections icon located on your dashboard. Information about rule and regulation changes and new information regarding your exam will be posted there. Information about corrections to any errors in the text will be posted there as well. Try as we may, errors are difficult to avoid in a text this large. In addition, our questions are constantly updated to stay current with the content being tested. New topics covered in the content updates/corrections are added to the KeyBank and other exams. How much time should I spend studying? Plan to spend approximately 60 to 120 hours following the study calendar. Spread your study time over the 4 to 5 weeks before the date on which you are scheduled to take the actual exam. Your time may vary depending on your reading rate, comprehension, professional background, and study environment. Educational authorities recommend frequent study breaks. We have found that every 45 to 50 minutes is optimal. Stand up, stretch, walk around for about 10 to 15 minutes, and then get back to the task at hand. How well can I expect to do? The exams administered by NASA are not easy. You must display considerable understanding and knowledge of the topics presented in this course to pass the exam and qualify for registration. We carefully designed the questions in our KeyBank to simulate the actual exam. The wording of KeyBank and actual exam questions will vary. But if you understand the subject matter, you will be able to find the correct response when you sit for the exam. In addition, our questions are constantly updated to stay current with the content being tested. New topics covered in the content updates/corrections are added to the KeyBank and other exams. If you study diligently, complete all sections of the course by following your study calendar, and consistently score at least 80% on the simulated exams, you should be well prepared to pass the exam. However, it is important for you to realize that merely knowing the answers to our questions will not enable you to pass unless you also understand the essence of the information behind the questions. Test-taking tips. Passing the exam depends not only on how well you learn the subject matter, but also on how well you take exams. You can develop your test-taking skills and improve your score by learning a few test-taking techniques. Read the full question. Avoid jumping to conclusions by watching for hedge clauses. Interpret the unfamiliar question. Look for key words and phrases. Identify the intent of the question. Memorize key points. Use a calculator. Avoid changing answers. Pace yourself. Each of these techniques is explained here. Read the full question. You cannot expect to answer a question correctly if you do not know what it is asking. If you see a question that seems familiar and easy, you might anticipate the answer, mark it, and move on before you finish reading it. This is a serious mistake. Be sure to read the full question before answering it. Mistakes are often made when assuming too much or too little. Avoid jumping to conclusions by watching for hedge clauses. The questions on NASA exams are often embellished with deceptive distractors as choices. To avoid being misled by seemingly obvious answers, read each question and each answer twice before selecting your choice. Watch out for hedge clauses embedded in the question. Examples of hedge clauses include the terms if, not, all, none, and except. In the case of if statements, the question can be answered correctly only by taking into account the qualifier. If you ignore the qualifier, you will not answer correctly. Qualifiers are sometimes combined in a question. Some pairs that you will frequently see are all except and none except. In general, when a question starts with all or none and ends with except, you are looking for an answer that is opposite to what the question appears to be asking. Interpret the unfamiliar question. Do not be surprised if some questions on the exam seem unfamiliar at first. If you have studied your material, you will have the information to answer all the questions correctly. The challenge may be a matter of understanding what the question is asking. Very often, questions present information indirectly. You may have to interpret the meaning of certain elements before you can answer the question. Be aware that the exam will approach a concept from different angles. Look for keywords and phrases. Look for words that are tip-offs to the situation presented. For example, if you see the word prospectus in the question, you know the question is about a new issue. Sometimes a question will even supply you with the answer if you can recognize the keywords it contains. Few questions provide blatant clues, but many do offer keywords that can guide you to selecting the correct answer if you pay attention. Be sure to read all instructional phrases carefully. Take time to identify the keywords to answer this type of question correctly. Identify the intent of the question. Many questions on NASA exams supply so much information that you lose track of what is being asked. This is often the case in story problems. Learn to separate the story from the question. Take the time to isolate what the question is asking. Of course, your ability to do so assumes you have studied sufficiently. There is no method for correctly answering questions if you don't know the material. Memorize key points. Reasoning and logic will help you answer many questions, but you will have to memorize a good deal of information first. Some memorization will be automatic as you go over the material and answer questions. Some you will simply have to do systematically. Use a calculator. Any math required to answer a question will be simple. Add, subtract, multiply, and divide. We recommend using a calculator for math. You may ask for a calculator or ask if you can use your own. If using your own, only simple math functions are allowed: add, subtract, multiply, and divide. Avoid changing answers. If you are unsure of an answer, your first hunch is the one most likely to be correct. Do not change answers on the exam without good reason. In general, change an answer only if you discover that you did not read the question correctly, or find new or additional helpful information in another question. The exam. Pace yourself. Some people will finish the exam early, and some will not have time to finish all the questions. Watch the time remaining carefully. It will be displayed on your computer screen, and pace yourself through the exam. In most cases, the questions are delivered on a bell curve of difficulty. That means the test starts and ends with easy questions. The middle 50% or so of the test contains more difficult questions than the first 25% and last 25%. Do not waste time dwelling on a question if you simply do not know the answer. Make the best guess you can, mark the question for record for review, and return to the question if time allows. Make sure that you have time to read all the questions so that you can record the answers you do know. How do I enroll in the exam? To obtain admission to a NASA exam, you or your firm must electronically apply and pay a fee to FINRA through its Central Registration Depository, CRD, better known as the Web CRD. To take the exam, you must make an appointment with a testing center as far in advance as possible to get the date you would like to sit for the exam. Prometric Testing Centers proctor FINRA exams. woo.prometric.com or 800-578-6273. You may schedule your appointment 24 hours a day, 7 days a week on the Prometric website. You may also reschedule or cancel your exam, locate a test center, and get a printed confirmation of your appointment. You must have your CRD number available when scheduling your exam. This unique personal identification number should be provided to you by your employing member firm. On a cautionary note, failure to show up for an examination is recorded on your examination history on the web CRD. What should I take to the exam? Take one form of government-issued personal identification with your signature and photograph. No personal items, food, or drinks, including coffee and water, are permitted inside the testing room. Personal items include, but are not limited to, pens, pagers, cell phones, watches, hats, non-medical electronic devices, outerwear, purses, and wallets. Personal items must be kept in your assigned locker or returned to your car before the start of your exam. As the testing vendor is not responsible for any personal items, they encourage you to bring only your identification into the center. If you need additional noteboards or pens, please alert your proctor. The noteboards and pens must be returned at the end of your exam session. Bathroom breaks are permitted, but the clock will continue to run. Do not be surprised if a proctor accompanies you and sweeps the room clean before you enter. FINRA and NASA take test security seriously. If you need a calculator for your testing session, please see the test center administrator. You will be provided with a non-programmable, non-printing calculator. Exam results and reports. At the end of the exam, you will receive immediate notice of your success or failure. If your attempt was not successful, the feedback will let you know and your score will be displayed. Those passing the exam are not provided a score. Series 65 License Exam Manual, 12th edition. At press time, this edition contains the most complete and accurate information currently available. Owing to the nature of qualification examinations, however, information may have been added recently to the actual test that does not appear in this edition. Please contact the publisher to verify that you have the most current edition. This publication is designed to provide accurate and authoritative information in regard to the subject matter covered. It is sold with the understanding that the publisher is not engaged in rendering legal, accounting, or other professional services. If legal advice or other expert assistance is required, the services of a competent professional should be sought. Copyright 2023, Kaplan North America, LLC. The text of this publication or any part thereof may not be reproduced in any manner whatsoever without written permission from the publisher. If you find imperfections or incorrect information in this product, please visit www.kaplanfinancial.com and submit and errata report. Published in January 2023 by Kaplan Financial Education. Introduction. Thank you for choosing Kaplan for your educational needs, and welcome to the Series 65 License Exam Manual, L.E.M. We understand that you are trusting us to help you advance in your securities industry career. We have written this manual and any supplemental resources you may have purchased by first collecting and clarifying exam-related content. Exam content is provided for you in an adult learning framework that offers the tools you need to pass your exam on the first try. Some of these tools include exam-focused questions and content to maximize exam preparation, an interactive design that integrates content with questions to increase retention, and integrated Securities Pro QBank exam preparation tools to sharpen test-taking skills. Why do I need to pass the Series 65? Most states require those who give investment advice or perform related functions to pass a qualification exam. The North American Securities Administrators Association, NASA, created the Series 65 Uniform Investment Advisor Law Exam as one of the options that may be used to meet that requirement. Most students use this examination to qualify as an investment advisor representative, IAR, a supervised person of a registered investment advisor. Are there any prerequisites? There are no prerequisite exams to pass before sitting for the Series 65 exam. However, the exam assumes that you have a broad range of knowledge or experience with investments. Because many students don't yet have that background, this L.E.M attempts to cover all of the basics as well as the more advanced material tested. Those of you with an SIE, Series 6, or Series 7 registration will find these basics to be a good review that will help set the stage for the more advanced learning required. Passing the Series 65 normally is a prerequisite to getting licensed as an investment advisor representative. However, most states will allow you to substitute one of the following certifications for passing the exam. CFP Certified Financial Planner, granted by the CFP Board of Standards. CIC Chartered Investment Counselor, granted by the Investment Advisor Association. CHFC Chartered Financial Consultant, granted by the American College of Financial Services. PFS Personal Financial Specialist, granted by the American Institute of Certified Public Accountants, and CFA Chartered Financial Analyst, granted by the Chartered Financial Analyst Institute. Applicants still have to meet other state licensing requirements, such as filing a Form U-4 or Form U-10 and paying fees. What is the Series 65 exam like? The exam is delivered on a computer at Prometric testing centers around the country. The session begins with a tutorial on how to take the exam. The Series 65 is a 180-minute, 130-question exam, plus 10 unscored questions prepared by NASA and administered by the Financial Industry Regulatory Authority, FINRA. The unscored questions are not differentiated from the other questions and are randomly distributed throughout the exam. There is no penalty for guessing, so you should attempt to answer all items. What score must I achieve to pass? You get a score of at least 72%, 94 questions correct of the 130 scored, on the Series 65 exam to pass and become eligible for registration as a registered investment advisor representative. After your exam, you will receive either a notification that you passed, but no score, or a failing score with a printout that identifies your performance in each function area. Which topics will I see on the exam? The questions you will see on the Series 65 exam do not appear in any particular order. The computer is programmed to select a new random set of questions for each exam taker according to the preset topic weighting of the exam. Each Series 65 candidate will see the same number of questions on each topic, but will see a different mix of questions. The Series 65 content outline is divided into 4 major function areas. Job Function 1. Economic Factors and Business Information. 20 questions, 15% of the exam. Job Function 2. Investment Vehicle Characteristics. 32 questions, 25% of the exam. Job Function 3. Client Investment Recommendations and Strategies. 39 questions, 30% of the exam. Job Function 4. Laws, Regulations, and Guidelines, including prohibitions on unethical business practices. 39 questions, 30% of the exam. How is this course structured? As professional educators, we have structured the material from the 4 job functions in the order that helps you best understand it. That means the program will diverge from the order listed in the previous table, but everything will be covered. The course consists of 24 units, each devoted to content that you will need to know to pass your exam. Each unit consists of 1 or more lessons. Each lesson corresponds to a specifically identified job function. These lessons are further divided into learning objectives, LOs, that help you focus on and retain a manageable portion of material. For students attending one of our classes, live or online, the class lecture will follow the sequence of these units. The following is a table showing how the material is organized by job function. Function 1, Economic Factors and Business Information. L.E.M Units 6, 7, 19, and 20 accept lessons 20.2 and 20.6. 20 questions or 15% of the test. Function 2, Investment Vehicle Characteristics. L.E.M Units 1 through 5 and 24, as well as lessons 20.2 and 20.6. 32 question or 25% of the test. Function 3, Client Investment Recommendations and Strategies. L.E.M Units 15 through 18 and 21 through 23. 39 questions or 30% of the test. Function 4, Laws, Regulations, and Guidelines, including prohibitions on unethical business practices. L.E.M Units 8 through 14. 39 questions or 30% of the test. Preparing for the exam. Using the study calendar. On your dashboard, you will have a study calendar that you can customize to your personal schedule. The study calendar helps you plan your use of all the other study tools you may have in your package, including the class. Set up your study calendar so that you will know what to do each day. The calendar gives you step-by-step details to optimize your learning experience. Think of it as a roadmap. If you don't take any detours or shortcuts, you will arrive safely at your destination, a passing score. Using the L.E.M. The License Exam Manual, L.E.M., is your textbook for this course. Reading the L.E.M. carefully will help you succeed. Reading material several times may be useful. Sometimes, out of necessity, a term or phrase is used prior to its formal introduction in the course. If needed, you can consult the glossary for the definition or the index to locate a more complete discussion of a term. You also may have access to a PDF copy of the L.E.M. If so, we strongly recommend that you download it because you can use the search function, Control F, to find specific terms quickly. In addition to the regular text, the L.E.M. also has some unique features designed to help with quick understanding of the material. When additional emphasis is valuable to your comprehension, the following distinctions are made. Take note. Each take note provides special information designed to amplify important points. Test topic alert. Each test topic alert reviews content that is especially likely to appear on the exam. Example. Examples provide practical applications of theory. They are quick, interactive, real-world illustrations of what you just read. Examples help ensure that you understand and retain material. Practice question. Within each learning objective, there may be one or more practice questions. We've designed these questions to help you see how the topic being discussed might be presented on the exam. Knowledge check. After each lesson, there is an opportunity for you to measure your comprehension. These short tests reinforce the essential material covered in that lesson. Answers are at the end of each unit. Complete the knowledge check and review explanations for all questions, whether you answered them right or wrong. Using additional study resources. To accompany and supplement your L.E.M., your study package may contain additional study resources. Be sure to spend some time on your dashboard, view the best practices PDF, and understand all that is available to help you study. Using the Securities Pro QBank. Coordinating with the L.E.M., the Securities Pro QBank includes a large number of questions that are similar in style and content to those on the exam. You may use the QBank to generate exams for a specific unit or combination of units. The study calendar will prompt you to do this. Carefully review all rationales. Use the learning objective number to locate additional or related information on the test topic in your L.E.M. if needed. Do one additional test of the suggested length on any topic on which you score under 60%. Do not become too overwhelmed or bogged down in any one unit. You don't want to lose sight of the finish line because you're having trouble with one hurdle. Keep moving forward. It's a steady pace that wins the race. View rationales after each question initially, and spend time studying each rationale to learn the concepts. Later, you will want to create simulated exams in which scores and rationales should be viewed at the end of each exam. Perfection is not the goal during the early reading phase. While scores in the mid to high 60s are good initially, aim for at least 80% correct on simulated exams. You will also use the QBank to create weighted simulated exams that mimic the proportional composition of the real exam. The study calendar specifies the ideal number of tests, but there is no upper limit on how many you can create. One thing you should know about the QBank is that the answer choices are scrambled each time you take a test. That is, if the first time you saw a specific question the correct answer was choice A, that correct answer might be choice D the next time. Please keep this in mind if you need to contact us regarding a question. Using fixed exams. Checkpoint and midterm exams. Each unit is followed by a checkpoint exam, and at the approximate midpoint of your studies, there is a midterm exam. These are fixed, unchanging exams. That is, unlike QBank exams that include randomly selected questions, the checkpoints and midterm are the same for everyone. They are designed to check your progress before advancing to the next unit. Challenging questions have been specifically selected based on their topical coverage, and they tend to match the average difficulty of the real exam. Because they are fixed exams, they may be taken only once, but can be reviewed as often as desired. Be sure to take these when prompted by your study calendar. Practice and mastery exams. You may also have fixed practice and mastery exams. These exams are designed to closely replicate the true exam experience, both in the degree of difficulty and topical coverage. They provide a score, diagnostic feedback, correct answers, and answer rationales. The practice and mastery exams are sound indicators of potential actual exam scores. The better you do on these exams, the more likely you are to pass your actual exam. These exams may be taken just once and must be completed in one sitting. After completing the practice and mastery exams, be sure to review your performance tracker so you can identify areas of weakness. You can then create custom quizzes focused on topics as needed. Also, review your L.E.M and video library for additional help. We recommend taking the practice exam shortly after a scheduled class and the mastery exam 2 to 3 days before your exam date, as indicated in your study calendar. Using the video library. You may also have access to videos on various topics in our video library. These short, engaging videos cover key topics. If you have access to our video library, please review the topics as you complete your assignments in the study calendar. Because many of the videos are not exam-specific, you may encounter material that is not covered in your L.E.M. Just skip ahead until the slide shows something familiar. Updates/corrections link. Don't forget to regularly check the Updates/corrections icon located on your dashboard. Information about rule and regulation changes and new information regarding your exam will be posted there. Information about corrections to any errors in the text will be posted there as well. Try as we may, errors are difficult to avoid in a text this large. In addition, our questions are constantly updated to stay current with the content being tested. New topics covered in the content updates/corrections are added to the QBank and other exams. How much time should I spend studying? Plan to spend approximately 60 to 120 hours following the study calendar. Spread your study time over the 4 to 5 weeks before the date on which you are scheduled to take the actual exam. Your time may vary depending on your reading rate, comprehension, professional background, and study environment. Educational authorities recommend frequent study breaks. We have found that every 45 to 50 minutes is optimal. Stand up, stretch, walk around for about 10 to 15 minutes, and then get back to the task at hand. How well can I expect to do? The exams administered by NASA are not easy. You must display considerable understanding and knowledge of the topics presented in this course to pass the exam and qualify for registration. We carefully designed the questions in our KeyBank to simulate the actual exam. The wording of KeyBank and actual exam questions will vary. But if you understand the subject matter, you will be able to find the correct response when you sit for the exam. In addition, our questions are constantly updated to stay current with the content being tested. New topics covered in the content updates/corrections are added to the QBank and other exams. If you study diligently, complete all sections of the course by following your study calendar, and consistently score at least 80% on the simulated exams, you should be well prepared to pass the exam. However, it is important for you to realize that merely knowing the answers to our questions will not enable you to pass unless you also understand the essence of the information behind the questions. Test-taking tips. Passing the exam depends not only on how well you learn the subject matter, but also on how well you take exams. You can develop your test-taking skills and improve your score by learning a few test-taking techniques. Read the full question. Avoid jumping to conclusions by watching for hedge clauses. Interpret the unfamiliar question. Look for key words and phrases. Identify the intent of the question. Memorize key points. Use a calculator. Avoid changing answers. Pace yourself. Each of these techniques is explained here. Read the full question. You cannot expect to answer a question correctly if you do not know what it is asking. If you see a question that seems familiar and easy, you might anticipate the answer, mark it, and move on before you finish reading it. This is a serious mistake. Be sure to read the full question before answering it. Mistakes are often made when assuming too much or too little. Avoid jumping to conclusions by watching for hedge clauses. The questions on NASA exams are often embellished with deceptive distractors as choices. To avoid being misled by seemingly obvious answers, read each question and each answer twice before selecting your choice. Watch out for hedge clauses embedded in the question. Examples of hedge clauses include the terms if, not, all, none, and except. In the case of if statements, the question can be answered correctly only by taking into account the qualifier. If you ignore the qualifier, you will not answer correctly. Qualifiers are sometimes combined in a question. Some pairs that you will frequently see are all except and none except. In general, when a question starts with all or none and ends with except, you are looking for an answer that is opposite to what the question appears to be asking. Interpret the unfamiliar question. Do not be surprised if some questions on the exam seem unfamiliar at first. If you have studied your material, you will have the information to answer all the questions correctly. The challenge may be a matter of understanding what the question is asking. Very often, questions present information indirectly. You may have to interpret the meaning of certain elements before you can answer the question. Be aware that the exam will approach a concept from different angles. Look for keywords and phrases. Look for words that are tip-offs to the situation presented. For example, if you see the word prospectus in the question, you know the question is about a new issue. Sometimes a question will even supply you with the answer if you can recognize the keywords it contains. Few questions provide blatant clues, but many do offer keywords that can guide you to selecting the correct answer if you pay attention. Be sure to read all instructional phrases carefully. Take time to identify the keywords to answer this type of question correctly. Identify the intent of the question. Many questions on NASA exams supply so much information that you lose track of what is being asked. This is often the case in story problems. Learn to separate the story from the question. Take the time to isolate what the question is asking. Of course, your ability to do so assumes you have studied sufficiently. There is no method for correctly answering questions if you don't know the material. Memorize key points. Reasoning and logic will help you answer many questions, but you will have to memorize a good deal of information first. Some memorization will be automatic as you go over the material and answer questions. Some you will simply have to do systematically. Use a calculator. Any math required to answer a question will be simple. Add, subtract, multiply, and divide. We recommend using a calculator for math. You may ask for a calculator or ask if you can use your own. If using your own, only simple math functions are allowed: add, subtract, multiply, and divide. Avoid changing answers. If you are unsure of an answer, your first hunch is the one most likely to be correct. Do not change answers on the exam without good reason. In general, change an answer only if you discover that you did not read the question correctly, or find new or additional helpful information in another question. The exam. Pace yourself. Some people will finish the exam early, and some will not have time to finish all the questions. Watch the time remaining carefully. It will be displayed on your computer screen, and pace yourself through the exam. In most cases, the questions are delivered on a bell curve of difficulty. That means the test starts and ends with easy questions. The middle 50% or so of the test contains more difficult questions than the first 25% and last 25%. Do not waste time dwelling on a question if you simply do not know the answer. Make the best guess you can, mark the question for record for review, and return to the question if time allows. Make sure that you have time to read all the questions so that you can record the answers you do know. How do I enroll in the exam? To obtain admission to a NASA exam, you or your firm must electronically apply and pay a fee to FINRA through its Central Registration Depository, CRD, better known as the Web CRD. To take the exam, you must make an appointment with a testing center as far in advance as possible to get the date you would like to sit for the exam. Prometric Testing Centers proctor FINRA exams. woo.prometric.com or 800-578-6273. You may schedule your appointment 24 hours a day, 7 days a week, on the Prometric website. You may also reschedule or cancel your exam, locate a test center, and get a printed confirmation of your appointment. You must have your CRD number available when scheduling your exam. This unique personal identification number should be provided to you by your employing member firm. On a cautionary note, failure to show up for an examination is recorded on your examination history on the Web CRD. What should I take to the exam? Take one form of government-issued personal identification with your signature and photograph. No personal items, food, or drinks, including coffee and water, are permitted inside the testing room. Personal items include, but are not limited to, pens, pagers, cell phones, watches, hats, non-medical electronic devices, outerwear, purses, and wallets. Personal items must be kept in your assigned locker or returned to your car before the start of your exam. As the testing vendor is not responsible for any personal items, they encourage you to bring only your identification into the center. If you need additional noteboards or pens, please alert your proctor. The noteboards and pens must be returned at the end of your exam session. Bathroom breaks are permitted, but the clock will continue to run. Do not be surprised if a proctor accompanies you and sweeps the room clean before you enter. FINRA and NASA take test security seriously. If you need a calculator for your testing session, please see the test center administrator. You will be provided with a non-programmable, non-printing calculator. Exam results and reports. At the end of the exam, you will receive immediate notice of your success or failure. If your attempt was not successful, the feedback will let you know and your score will be displayed. Those passing the exam are not provided a score.
Unit 1. Types and characteristics of equity securities. Learning objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 1A. Describe the characteristics of equity securities. Learning Objective 1B. Identify the basic features of common stock. Learning Objective 1C. Recognize the different types of preferred stock. Learning Objective 1D. Describe how incentive stock options differ from non-qualified stock options. Learning Objective 1E. Contrast restricted stock and non-restricted stock. Learning Objective 1. Identify the unique features of American Depositary Receipts, ADRs, and the risks of investing in foreign securities. The Series 65 exam will include approximately 7 questions on the material presented in this unit. Introduction. Because equity is such an important capital market security, the fundamentals that you learn in this unit will lay the groundwork for your success in future units. This unit will cover common stock, preferred stock, and related equity securities. The investment world is divided between owners, stock or equity securities, and lenders, bonds or debt securities. Owning equity in a company is perhaps the most visible and accessible means by which wealth is created. Individual investors become owners of a publicly traded company by buying stock in that company. In so doing, they can participate in the company's growth over time and, in many cases, receive a share of the company's profits in the form of dividends. Lesson 1.1. Equities Securities. Learning Objective 1A. Describe the characteristics of equity securities. Characteristics of equity securities. In the simplest terms, a security is an investment that represents either an ownership stake or a debt stake. An investor becomes part owner in a corporation by buying shares of the company's stock. A debt security is usually acquired by buying an issuer's, a corporation or a government, bonds. A debt investment is a loan to the issuer in exchange for interest income, and the promise to repay the loan at a future maturity date. It does not confer ownership, equity, as does the purchase of stock. When investors become owners of a corporation by purchasing stock in that company, they can participate in the company's prosperity by sharing in earnings through the receipt of dividends, and, particularly in the case of common stock, benefit from an increase in the price of the shares. Common stock. Common stock is equity, ownership in a corporation. A company issues stock to raise capital, and investors who buy the stock are buying a share of ownership in the company. The exam will deal with stock that has been issued to the public. That process will be explained in Unit 8. In Unit 7, we will show you that whatever a business owns, its assets, less its creditors' claims, its liabilities, is the net worth of the enterprise and belongs to the owners, its stockholders. Each share of stock entitles its owner to a portion of the company's earnings and dividends and a proportionate vote in major management decisions. Most corporations are organized in such a way that their common stockholders regularly vote for and elect a few individuals to a board of directors to oversee company business. By electing a board of directors, these stockholders have a say in the company's management, but are not involved in the day-to-day details of its operations. Example. If a corporation issues 100 shares of stock, each share represents an identical 1/100, or 1%, ownership position in the company. An investor who owns 10 shares of stock would own 10% of the company. An investor who owns 50 shares of stock would own 50% of the company. Corporations may issue 2 types of stock, common and preferred. When speaking of stocks, people generally mean common stock. Preferred stock also represents equity, ownership, in a corporation but usually does not have the same voting rights or appreciation potential as common stock. Preferred stock normally pays a fixed dividend, usually quarterly, and has priority claims over common stock. That is, common stockholders cannot receive a dividend until the preferred shareholders have been paid theirs, and in the event the company goes bankrupt, preferred stockholders have a prior claim on any remaining assets. Preferred stock. Preferred stock is an equity security because it represents a class of ownership in the issuing corporation. However, it does share some characteristics with a debt security. As we will learn in the next unit, just as with debt securities, the rate of return on a preferred stock is fixed rather than subject to variation as with common stock. As a result, its price tends to fluctuate with changes in interest rates, rather than with the issuing company's business prospects unless, of course, dramatic changes occur in the company's ability to pay dividends. This concept, known as interest rate or money rate risk, will be covered in the next unit as well as Unit 19. Take note. Unlike common stock, most preferred stock is non-voting. Therefore, unless stated otherwise in a question, preferred stock doesn't have voting rights. Test topic alert. Like common stock, preferred stock represents ownership in a company, but its price reacts to the market more like a bond because, with its fixed dividend payment, it is price sensitive to interest rate changes. Practice question. Holders of each of the following are creditors except A. Investors owning preferred stock, B. Investment companies owning corporate bonds, C. Corporations owning municipal bonds, D. States owning U.S. government bonds. The answer is A. Remember, all stockholders, even preferred stockholders, not creditors, are owners of a corporation. When it comes to bonds, regardless of the nature of the owner, it is always a debt security, and that makes the owners creditors. Learning Objective 1B, identify the basic features of common stock. Common stock features. Growth, capital gains. An increase in the market price of securities is capital appreciation. Historically, owning common stock has provided investors with returns in excess of the inflation rate. For this reason, most investors with a long-term investment horizon have included common stock in their portfolios as a hedge against inflation. Of course, it must be mentioned that stock prices can decline, particularly over the short run. Example. An investor bought shares of RST for $60 per share on January 1, 2022. On December 31, 2022, the shares were worth $90, an increase of 50% in the market price. Income. Many corporations pay regular quarterly cash dividends to stockholders. A company's dividends, in the case of common stock, may increase over time as profitability increases. Dividends, which can be a significant source of income for investors, are a major reason many people invest in stocks. Because stock is an equity security, unlike interest payments on debt, dividends are not obligatory and are declared at the discretion of the company's board of directors. Issuers may also pay stock dividends in additional shares of common stock in the issuing company or property dividends, shares in a subsidiary company or in company products. Example. RST paid a dividend of $2 per share during 2022, which provided the investor with a dividend yield of 3.3%. $2 divided by $60 equals 3.33%. In addition to the $30 price appreciation. Take note. The increase in the price of RST stock in the example above is an unrealized gain until the stock is sold. When the stock is sold, the price increase becomes a realized gain. Capital gains are not taxed until they are realized. Under current tax law, most dividends and long-term capital gains are taxed at a rate not in excess of 15%. Taxation will be covered in more detail in Unit 15. Definition. Stock dividend. One option a corporation has is to pay common stockholders a dividend in additional shares of the stock. This saves the cash that would be used in a normal dividend, while giving stockholders something at no cost. For example, if an investor owned 100 shares of the stock and the company declared a 20% stock dividend, that investor would receive 20 additional shares, bringing the total holding up to 120 shares. There are two important facts to know. 1. As a result of the additional shares being distributed, where the company receives no new money, the price of the stock will drop so that the overall value remains the same. Using our numbers from above, if, prior to the distribution, the market price was $48 per share, the investor has $4,800 worth of stock. After the stock dividend is paid, the investor still has $4,800 of stock, but now owns 120 shares. That would make the current market price approximately $40 per share, $4,800 divided by 120. 2. Stock dividends are not taxed when received. As you will learn in Unit 15, they are not taxed until sold and have the effect of reducing the investor's cost basis per share. Do not confuse a stock dividend with a stock split. A split is an accounting process whereby the corporation exchanges new shares for old ones while changing the number of shares outstanding in the marketplace. For example, in a 2-for-1 stock split, the investor now owns twice as many shares worth half as much each. Conceptually, it is the same as changing large bills for small ones. If you had a $20 bill and changed it for two $10 bills, in essence, you've just had a 2-for-1 split. Do you have any more money? No, just 2 bills worth the same as the previous one. If you changed your $20 bill for 4 $5 bills, it would be the equivalent of a 4-for-1 split. Rights of stockholders. As mentioned earlier, common stockholders have the right to vote for the corporation's board of directors at the corporation's annual meeting. Stock, whether common or preferred, is freely transferable. Permission of the company is not required to anyone who wants to buy it or receive it as a gift. Without this feature, there would be no stock markets. The owner, or broker-dealer holding the stock, sends the stock certificate to the issuer's transfer agent with instructions to issue a certificate in the new owner's name. The concept is similar to transferring title when you sell a car. Because of the opportunities for fraud, transfer agents, usually large commercial banks, must be registered as such with the Securities and Exchange Commission, SEC, under the Securities Exchange Act of 1934. Shareholders also have the right to receive an audited set of financial statements of the company's performance each year, annual reports. Common but not preferred. Stockholders usually have the preemptive right to maintain their proportionate share of ownership in the corporation. The word preempt means to put oneself in front of another. We will have a further discussion on preemptive rights in Unit 4. Practice question. Which of the following statements regarding rights is true? A. Common stockholders would not generally receive preemptive rights. B. Preferred stockholders would not generally receive preemptive rights. C. Both common and preferred stockholders would generally receive preemptive rights. D. Neither common nor preferred stockholders would generally receive preemptive rights. The answer is B. Preferred stockholders have no right to maintain a percentage of ownership. When new shares are issued, no preemptive rights. However, they do receive preference in dividend payment and company liquidation. TST2PICA. Prior to a vote or a payment of dividend, the company establishes a record date. This is the date by which an investor must be an owner of record, shown as an owner on the company's records, in order to vote or receive the announced dividend. Limited liability. One of the most important features of equity ownership, common stock or preferred stock, is limited liability. In the event of the bankruptcy of a corporation, when corporate assets are not adequate to meet corporate obligations, the stockholder's personal assets are not at risk. One cannot be forced to sell any personal assets to help pay the debts of the business. An individual investing $5,000 in the stock, common or preferred, of a corporation that goes bankrupt may lose the entire $5,000 if the company is not salvaged, but will not be forced to pay out any more money to take care of the corporation's debts. That investor is personally at risk only for the amount that was invested. This is different from a business organized as a sole proprietorship or partnership, where the owner's personal assets are placed at risk should the business not be able to pay off its obligations. This concept will be discussed later in Unit 16. Liquidity. In almost all cases, shares of common and preferred stock are freely transferable. That means that shareholders do not need the permission of the issuer or anyone else in order to sell their stock in the open market. This is especially true in the case of shares traded on the major stock exchanges. One exception is restricted stock, covered shortly, where sales are contingent upon meeting the requirements of SEC Rule 144. Benefits and risks of owning common stock. Regardless of their expectations, investors have no assurances that they will receive the returns they expect from their investments, so the risks must be balanced against the rewards. Take note. In owning common equity, the investor stands to lose current income through dividend reduction or suspension, as well as capital loss, should the market price decline. In return, however, the shareholder has limited liability. That is, the liability is limited to the amount invested and theoretically unlimited potential for future price appreciation and / or dividend growth. In summation, why would you include common stock in a client's portfolio? Potential capital appreciation, income from dividends, and hedge against inflation. By including common stock in a portfolio, the client would be incurring the following risks. Market risk. The chance that a stock will decline in price is one risk of owning common stock, known as market risk. A stock's price fluctuates daily as perceptions of the company's business prospects change and influence the actions of buyers and sellers. Investors have no assurance whatsoever that they will be able to recoup the investment in a stock at any time. Business risk. A risk of common stock ownership is the possibility of a decline in the company's earnings. This could lead to a reduction or even elimination of the dividend. Low priority at dissolution. If a company enters bankruptcy, the holders of its bonds and preferred stock have priority over common stockholders. A company's debt and preferred shares are considered senior securities. Common stockholders have residual rights to corporate assets upon dissolution. Practice question. Limited liability regarding ownership in a U.S. corporation means all of the following except: A. Investors might lose more than the amount of their investment. B. Investors might lose their investment. C. Creditors of the corporation cannot seek relief from the shareholders. D. Investors are not liable to the full extent of their personal property. The answer is A. An advantage of owning stock is that an investor's liability is limited to the amount of money invested when the stock was purchased. Learning Objective 1C. Recognize the different types of preferred stock. There are several different types of preferred stock, starting with straight preferred, think of plain vanilla, and expanding depending on which and how many adjectives we use to describe the security. However, all maintain preference over common stock. Remember, preferred stock is an equity security, and, just as with common stock, dividends are paid at the discretion of the board of directors. Because, with one exception noted below, those dividends are fixed, many investment professionals consider this a fixed income investment for asset allocation purposes. Those dividends are either a stated amount, $6 preferred, or a percentage or par value, $100 par, 6% preferred. What is special about preferred stock is that a dividend can never be paid to the common stockholders unless the preferred is satisfied first. Preferred stock may have one or more of the following characteristics: straight, non-cumulative. Straight preferred stock has no special features beyond the stated dividend payment. Missed dividends are not paid to the stockholder. Cumulative preferred. Cumulative preferred stock accrues payments to its shareholders in the event dividends are reduced or suspended. Dividends due cumulative preferred stock accumulate on the company's books until the corporation's board of directors decides to pay them. When the company resumes dividend payments, cumulative preferred stockholders receive current dividends, plus the total accumulated dividends in arrears, before any dividends may be distributed to common stockholders. Example: in 2016, RST Corp. had both common stock and cumulative preferred stock outstanding. For the year, the common stock paid total dividends of $1, and the total preferred dividend was $2. Because of financial difficulties, the company stopped paying dividends after 2016. Having resolved its problems in 2021, the company resumed dividend payments and paid the cumulative preferred holders an $8 dividend for the arrearage in years 2017, 2018, 2019, and 2020 plus the current years, 2021, $2 dividend before paying any dividends to the common stockholders. Test topic alert. Because of this unique feature found only with cumulative preferred stock, an investor seeking steady income would find this to be the most suitable of the different types of preferred stock. Callable preferred. Corporations often issue callable or redeemable preferred stock, which a company can buy back from investors at a stated price after a specified date. The right to call the stock allows the company to replace a relatively high fixed dividend obligation with a lower one when the cost of money has gone down. This is similar to refinancing a mortgage. When a corporation calls a preferred stock, dividend payments cease on the call date. In return for the call privilege, the corporation may pay a premium exceeding the stock's par value at the call, such as $103 for a $100 par value stock. Issuing the call can create a problem for your client, who purchased callable preferred shares issued at a time when market conditions dictated relatively high dividend rates. If the cost of new money comes down, the company will call in the preferred and the investor will now have to reinvest the proceeds at a lower rate. This is an example of reinvestment risk. Having the call price at a premium over par is one way to compensate for this additional risk and inconvenience. Another is that the dividend rate on callable preferred stock is generally a bit higher than other preferred stock issued by the corporation. Convertible preferred. A preferred stock is convertible if the owner can exchange the shares for a fixed number of shares of common stock of the issuing corporation. Take note. Because the value of a convertible preferred stock is linked to the value of a common stock, the convertible's preferred price tends to fluctuate in line with that of the common. Convertible preferred is generally issued with a lower stated dividend rate than non-convertible preferred of the same quality, because the investor may have the opportunity to convert to common shares and enjoy greater capital gain potential. This feature can have the effect of reducing the interest rate risk. The concept of a convertible security will be discussed in greater detail later in the next unit when we cover convertible bonds. Adjustable rate preferred. Some preferred stocks are issued with adjustable or variable dividend rates. Such dividends are usually tied to the rates of other interest rate benchmarks, such as Treasury bills and money market rates, and can be adjusted as often as monthly. The decision as to the frequency of adjustment is that of the issuing corporation and is not a testable topic. Because the payment adjusts to current interest rates, the price of the stock remains relatively stable. This adjustability tends to reduce interest rate risk when compared to other preferred shares. Test topic alert. For investors looking for fixed income through preferred stocks, adjustable rate would be their least appropriate choice because the dividend will likely fluctuate. Take note. A preferred stock could be cumulative and callable and convertible, or any combination of these adjectives. If none are listed, it is just a straight preferred. Test topic alert. Because the primary objective met by investing in preferred stock is income, when analyzing a specific preferred stock, the most important determination should be the ability of the company to meet its dividend payments. Practice question. An investor who has purchased preferred stock with the goal of receiving steady quarterly income would be most interested in the A seniority of the stock compared to other securities. B ability of the company to continue paying the stated dividend. C voting power of the shares. D par value of the shares. The answer is B. Investors in preferred stock with the goal of income are most concerned that the company will be able to sustain the dividend, making choice B the correct answer. For exam purposes, all preferred stock is non-voting, and it makes no difference if the par value is $10, $25, or $100, because the dividend is fixed as a percentage return. The fact that the preferred stock has seniority over the common is important, but that concept is included in the ability of the company to pay its dividend. Benefits and risks of owning preferred stock. In summation, why would you include preferred stock in a client's portfolio? Fixed income from dividends, prior claim ahead of common stock, and convertible preferred sacrifices income in exchange for potential appreciation. When investing in preferred stock, the client would be incurring the following risks. Market risk. In an economic downturn, fear of an inability to maintain the dividend will cause the price to drop. Possible loss of purchasing power. Interest rate, money rate, risk, and business difficulties leading to possible reduction or elimination of the dividend, and even bankruptcy leading to loss of principal. Take note. Although it is generally regarded as a fixed income investment, preferred stock, unlike debt securities, usually has no preset date at which it matures and no scheduled redemption date. Preferred stock is thus a perpetual security. Knowledge check 1.1. Question 1. Owners of a corporation's equity securities. A. Are always assured dividends if the company is profitable. B. Are creditors of the corporation. C. Have limited liability. D. Have the right to vote their shares. The correct answer is C. One of the benefits of being an owner of a corporation's equity securities is limited liability. That means, no matter what happens to the company's fortunes, the investor can never lose more than the original investment. The company's creditors cannot come after the stockholders and make a claim. Although owners of common stock always have voting rights, owners of preferred stock, the other equity security, almost never do. Dividends are not guaranteed, and even if the company shows a large profit, there is no obligation to make a dividend payment. Remember, as holder of a company's equity securities, one is an owner, not a creditor. Question 2. Among the benefits of owning common stock are Roman numeral 1. Historical hedging against inflation. Roman numeral 2. Voting rights. Roman numeral 3. Access as owners to information about corporate earnings before the general public. Roman numeral 4. Dividends. A. 1 and 2. B. 1, 2, and 4. C. 2 and 4. D. 1, 2, 3, and 4. The correct answer is B. One does not have access to insider information solely by becoming a shareholder. Even if one did receive material non-public information, such as prior access to earnings, no benefit may be received from that information. All of the other choices are among the reasons to purchase common stock. Question 3. A company that has issued cumulative preferred stock. A. Pays past and current preferred dividends before paying dividends on common stock. B. pays the preferred dividend before paying the coupons due on its outstanding bonds. C. Pays the current dividends on the preferred, but not the past dividends on the preferred, before paying a dividend on the common. D. Forces conversion of the preferred that is trading at a discount to par, thereby eliminating the need to pay past due dividends. The correct answer is A. The concept behind cumulative preferred stock is that dividends in arrears accumulate and must be paid, along with the current year's dividend, before anything can be paid to common stockholders. Bond interest is always paid before dividends. Lesson 1.2. Special types of equity securities. Most of the questions on the exam deal with securities purchased by investors. There are, however, a few questions where stock in a corporation is purchased from the company by its employees through the granting of stock options. Learning Objective 1D. Describe how incentive stock options differ from non-qualified stock options. Employee stock options offer employees the right to purchase a specified number of shares of the common stock of their employer at a stated price over a stated time period. Unlike qualified retirement plans discussed in Unit 18, there are no non-discrimination requirements for these plans. For publicly traded stock, the strike price, also called the grant or exercise price, is usually the market price of the stock at the time the option is granted. In most cases, there is a minimum time the employee must remain with the company in order to be able to use the option, the vesting period. The hope of the employee is that the market price of the employer's stock will increase in value. Then, the employee will be able to purchase the stock by exercising the option, purchasing the stock, at the lower strike price, and then sell the stock at the current market price. There are two principal kinds of stock option programs, each with its own rules and tax consequences. Non-qualified stock options, NSOs or NQSOs, and incentive stock options, ISOs. Don't confuse these with publicly traded puts and calls described later in Unit 4. These are available only to employees of the issuing company. Most states require that the stock option plan be approved by the board of directors. Non-qualified stock options, NSOs. These are the more common of the two varieties of employee stock options. NSOs are basically treated as a form of compensation. When NSOs are exercised, the difference between the current market price at the time of exercise and the strike price, referred to as the bargain instead of capital gains treatment, the employee is taxed as ordinary income on that bargain element, while the company receives a tax deduction as salary expense for that same amount. Example: an employee exercises an NSO at $52 per share when the current fair value of the stock is $66.50. The bargain element is $14.50 per share, the difference between the exercise price of $52 and the fair value of $66.50. If the exercise was for 100 shares, this employee will report $1,450 as ordinary income for the year, and the corporation treats that as deductible salary expense. When that stock is sold, the employee's cost basis is the total of the exercise price plus the already taxed salary. Take note: because the spread between the market price and the strike price is considered salary, it is subject to payroll taxes as well as income tax. Incentive stock options, ISOs. Unlike the NSO, there are generally no tax consequences to the employer with an ISO, but if done properly, they can be more advantageous to the employee than NSOs. As mentioned above, the employee's profits from NSOs are taxed as ordinary income. However, as long as stock purchased through exercise of an ISO is held at least 2 years after the date of the grant and 1 year after the date of exercise, any profits are reported as long-term capital gains. If these time limits are broached, the ISO is taxed like an NSO. There is one other time stipulation: there is a maximum 10-year limit for exercise. But there is a catch. When an ISO is exercised, the difference between the market value at the time of purchase and the strike price is a preference item used in calculating the alternative minimum tax (AMT) covered in Unit 15. Incentive stock options, ISOs. No income recognized when option is granted. No tax due when option is exercised. Tax is due when stock is sold. Gain is capital long-term, if held at least 1 year and sold at least 2 years after grant. Otherwise, ordinary income. Difference between option price and the fair market value, FMV, on date of exercise is an add-back for AMT purposes. Example: Julie's employer grants her an incentive stock option, ISO, On January 1, 2012, with an exercise, strike price of $25 per share. Julie exercises the option on January 1, 2013, when the market price of the stock is $40 per share. Because this is an ISO and the stock has not yet been sold, there is no salary income or capital gains taxation. There is a $15 per share adjustment for purposes of computing the AMT, the bargain element difference between $25 and $40. But it is unlikely that the exam will ask anything beyond knowing that ISOs can be subject to AMT. Julie sells the stock 2 years later for $60 per share. Now that the sale has been recognized and Julie has followed the required holding periods, the $35 per share profit is taxed as a long-term capital gain. There will also be an adjustment to the AMT. Learning Objective 1E, contrast restricted stock and non-restricted stock. At the beginning of this unit, we stated that one of the characteristics of stock is that it is freely transferable. That is, once purchased, it may be sold or gifted at any time to anyone. As is the case with most of this course, there are exceptions. The two that are testable deal with the sale of stock that is restricted and the stock owned by control persons. In Unit 8 of this course, we will discuss the exemption from registration for securities sold as part of a private placement, the limited offering exemption. In general, retail investors cannot sell these securities until having held them for a certain period of time. They are restricted from immediate resale and therefore are referred to as restricted securities. The length of that restriction is generally 6 months, and there are volume restrictions as well that apply to those who are affiliates of the issuer. You probably will not be tested on those. Just know that restricted stock has a time limit for all investors, and may also have a volume limit for affiliates on the amount that may be resold. The other case is with control stock. Control stock is stock held by a control person. What makes it control stock is who owns it, not how it was acquired. For purposes of this discussion, a control person is a corporate director, an officer, a large stockholder, or the immediate family of any of the preceding residing in the same home. They are generally referred to as affiliates because of their unique status within the issuer. In general, purchases and sales of control stock must be reported to the SEC. Control stock always has volume limits. Those numbers are not tested. Take note. For testing purposes, assume that ownership consisting of 10% or more of the voting stock is considered control. The mechanism for reporting the sale of control stock, as well as the sale of restricted stock, is found in SEC Rule 144 of the Securities Act of 1933. SEC Rule 144 was created so that certain resales of already existing securities could be made without having to file a complete registration statement with the SEC. The time and money involved in having to file such a registration are usually so prohibitive as to make it uneconomical for the individual seller. In almost all cases, those who wish to sell control stock or restricted stock must do so by filing a Form 144. Practice question. An investor owns 15% of the stock of a publicly traded company. This investor's spouse owns 5% of the stock of the same company. If the spouse wishes to sell the shares representing that 5% ownership, which of the following statements are true? Roman numeral 1. Both the investor and the spouse are control persons. Roman numeral 2. The investor is a control person, while the spouse is not. Roman numeral 3. The spouse must file a Form 144. Roman numeral 4. The investor must file a Form 144. A. 1 and 3. B. 1 and 4. C. 2 and 3. D. 2 and 4. The answer is A. The investor's 15% ownership is control. Rule 144 includes in the definition of control person any relative or spouse of such person, or any relative of such spouse, any one of whom has the same home as such person. Unless stated to the contrary, the assumption on the exam is that spouses reside together, making both of them control persons. All sales of control stock, unless an exemption applies, must be accompanied by a Rule 144 filing on Form 144 by the selling party. Although both are control persons, the spouse is the only one selling, and therefore the one required to file. Knowledge Check 1.2. Question 1. 4 years ago, Susan was granted enough non-qualified stock options, NQSOs, to purchase 500 shares of her employer's stock at $20 per share. Assuming Susan exercises all of her options when the fair market value of the stock is $30 per share, and her ordinary income tax rate at the time is 28%, How much income tax will be due? A. $280. B. $1,400. C. $5,600. D. $8,400. The correct answer is B. The exercise cost of the NQSO is $10,000. 500 shares times $20 per share. She will have to pay ordinary income taxes of $1,400 on the bargain element, $30 FMV minus $20 exercise price, times 500 shares times 28%. In addition, that $10,000 will also be subject to the same taxes as a regular salary, for example, Social Security tax. Question 2. Which of the following statements about restricted stock is correct? A. It must be held a minimum of 1 year before resale. B. Sales must be accompanied by Form R. C. Volume limits generally apply to sales by control-affiliated persons. D. The restrictions apply only to those defined as control persons. The correct answer is C. All purchasers of restricted stock generally have a holding period requirement of 6 months, not 1 year. When reselling that stock, the sale must be accompanied by Form 144. Once the 6 months is over, non-affiliated persons have no further restrictions, while control affiliates generally have a volume limit. Lesson 1.3 Foreign Equity Securities. Learning Objective 1F. Identify the unique features of American Depositary Receipts, ADRs, and the risks of investing in foreign securities. American Depositary Receipts, ADRs. ADRs, also known as American Depositary Shares, ADSs, facilitate the trading of foreign stocks in U.S. markets because everything is done in English and in U.S. dollars. ADRs are bought and sold, traded in U.S. dollars, and dividends are paid out in U.S. dollars. An ADR is a negotiable security that represents a receipt for shares of stock in a non-U.S. corporation. ADRs are bought and sold in the U.S. securities markets like any domestic stock. An ADR may represent the underlying shares on a one-for-one basis, or may represent a fraction of a share or multiple shares. For example, for one company, an ADR may represent several shares of the underlying security, while for another company, an ADR may represent a fraction of the underlying security. The use of a ratio or participation rate allows ADRs to be priced at an amount more typical of U.S. market share prices. Example: at the time of this printing, $1 US dollar, USD, was worth about 5.5 Brazilian reals BRs. A Brazilian corporation's ADRs might be structured on a ratio of 1 to 5. That is, each ADR is equivalent to owning 5 shares of the underlying stock. Therefore, if the ADR was trading at $10, the investor would be paying approximately 55 BRs for 5 shares of the Brazilian stock. The math is not tested. Only the concept that ratios other than 1 to 1 exist with some ADRs is tested. Rights of ADR owners. Most of the rights that common stockholders normally hold, such as the right to receive dividends, also apply to ADR owners. In some, but not all cases, there are also voting rights. For purposes of the exam, ADRs never have preemptive rights. Risks of ADRs. In addition to the normal risks associated with stock ownership, ADR investors are also subject to currency risk. Currency risk is the possibility that an investment denominated in one currency, such as the Mexican peso, could decline if the value of that currency declines in its exchange rate with the US dollar. Because ADRs represent shares of stock in companies located in foreign countries, currency exchange rates are an important consideration. Take note. The banks collect the dividend payments, convert them into U.S. funds for U.S. owners, and withhold any required foreign tax payments. Owners of ADRs can claim a U.S. tax credit for these withholdings. Test topic alert. The exam will want you to know that ADRs are issued by domestic branches of U.S. banks, and that even though they are traded in U.S. dollars, they still bear currency risk. Investing in foreign markets. Although foreign securities offer investors the potential for substantial gains, they bear a variety of risks that are not present with domestic investments. There are 2 broad market classifications of foreign markets: emerging and developed. Emerging markets. Emerging markets are markets in less developed countries. They are generally associated with low levels of income, as measured by the country's gross domestic product, GDP. Low levels of equity capitalization, questionable market liquidity, potential restrictions on currency conversion, high volatility, prospects for economic growth and development. Stabilizing political and social institutions. High taxes and commission costs for foreign investors. Restrictions on foreign ownership and on foreign currency conversion, and lower regulatory standards resulting in a lack of transparency. Despite primitive market infrastructures, many emerging markets have rapid growth rates that make their securities attractive to foreign investors, whose local markets experience more modest growth. Take note. There is a term that has not yet appeared on the exam but may during the life of this edition. That term is frontier market. One could say that frontier markets are to emerging markets as emerging markets are to developed ones. The risks here are extremely high. Developed markets. Developed markets are those associated with countries that have highly developed economies with stable political and social institutions. These are characterized by large levels of equity capitalization, low commission rates, few, if any, currency conversion restrictions, highly liquid markets with many brokerage institutions and market makers, many large capitalization securities, and well-defined regulatory schemes leading to transparency similar to that enjoyed by those investing in U.S. securities. In summation, why would you include foreign securities in a client's portfolio? You have expanded the potential investment universe, leading to greater diversification. Foreign securities sometimes outperform domestic ones. Foreign securities are usually not highly correlated with domestic ones. Correlation will be covered in Unit 20, and as a result, the overall risk of the portfolio is reduced. Risks of investing in foreign markets. In doing so, whether investing in the securities of emerging or developed foreign markets, the investor faces, in addition to the normal risks involved in investing, the following risks not present in domestic investing: country risk, exchange controls, currency risk, and withholding taxes and fees. Country risk. Country risk is a composite of all the risks of investing in a particular country. These may include political risks, such as revolutions or military coups, and structural risks, such as confiscatory policies toward profits, capital gains, and dividends. Economic policies, interest rates, and inflation are also elements of risk of investing in emerging countries. Exchange controls. Foreign investors can also be subject to restrictions on currency conversion or movement. Withholding, fees, and taxes. Some foreign countries may withhold a portion of dividends and capital gains for taxes. Some also impose heavy fees and taxes on securities that the investor must bear in addition to generally higher brokerage commissions. Take note. We will return to some of these risks again in Unit 19. Knowledge Check 1.3. Question 1. ADRs are used to facilitate A. Foreign trading of domestic securities. B. Foreign trading of U.S. government securities. C. Domestic trading of U.S. government securities. D. Domestic trading of foreign securities. The correct answer is D, because everything is in U.S. dollars, and in English, ADRs make trading in foreign securities much easier for those who live here. Question 2. Which two of the following risks would be of greatest concern to the holder of an ADR? Roman numeral 1. Currency. Roman numeral 2. Liquidity. Roman numeral 3. Market. Roman numeral 4. Purchasing power. A. 1 and 2. B. 1 and 3. C. 2 and 4. D. 3 and 4. The correct answer is B. ADRs represent ownership in a foreign security, so there is always going to be currency risk. 1. These ADRs trade in the market and have market risk. 3. Because most ADRs are traded on the exchanges, there is little liquidity risk, and because they represent equity, they are usually a good hedge against inflation.
Unit 2. Types and characteristics of fixed income debt securities. Learning objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 2A. Recognize the characteristics common to most bonds. Learning Objective 2B. Identify the relevance of a bond's rating. Learning Objective 2C. Calculate the price of a bond. Learning Objective 2D. Calculate the parity price of a convertible bond. Learning Objective 2E. Compare current yield, yield to maturity, and yield to call. Learning Objective 2F. Recognize the unique features of U.S. government and agency issues. Learning Objective 2G. Differentiate between secured and unsecured corporate debt. Learning Objective 2H. Recall the unique features of municipal bonds, including the calculation of tax-equivalent yield. Learning Objective 2I. Identify the advantages and disadvantages of investing in foreign debt securities. Learning Objective 2J. Recall the methods of repayment of principal. Learning Objective 2K. Identify the special characteristics of money market instruments and the risks and benefits of adding them to a client's portfolio. Your exam will include approximately 5 questions from the topics covered in Unit 2. Introduction. In addition to raising capital through the issuance of equity securities, stock, many corporations fund their business efforts through borrowing by issuing debt securities. Long-term borrowing is usually in the form of bonds and unsecured debt instruments, debentures, covered at Learning Objective 2 grams, while cash equivalents, such as commercial paper and treasury bills, are the primary source of short-term financing for corporations and the U.S. government. Governmental bodies can only issue debt securities. You cannot buy stock in the U.S. Treasury or your state. Lesson 2.1. Bonds as fixed income securities. Debt capital represents money loaned to an issuer by investors purchasing that issuer's bonds. A bond represents the issuer's indebtedness. An investor purchasing a bond is lending the issuer money for a set period of time at a fixed annual interest rate. That rate is frequently referred to as the coupon rate because, years ago, bonds were issued with detachable coupons that were presented for collection of the interest. That is no longer the case, but the term coupon is still in common use. There are 3 major issuers of debt securities. The largest issuer of debt securities is the U.S. government. Corporations issue bonds to finance their operations, and substantial sums are also borrowed by state governments and those political entities that are subdivisions of a state, such as cities, counties, towns, and so forth. These issues from state and local political entities are called municipal bonds. Let us begin this adventure by explaining the characteristics common to most bonds. Learning Objective 2A. Recognize the characteristics common to most bonds. There is, in essence, a contract between the borrower, the issuer, and the lender, the investor. The terms of the loan are expressed in a document known as the bond's indenture. The indenture, sometimes also referred to as the deed of trust, states the issuer's obligation to pay back a specific amount of money on a specific date. The indenture also states the issuer's obligation to pay the investor a specific rate of interest for the use of the funds as well as any collateral pledged as security for the loan and all other pertinent details. It is important to understand that debt capital refers to long-term debt financing. Long-term debt is money borrowed for a minimum of 5 years, although more frequently the length of time is 10 to 30 years. Bond characteristics. Inverse relationship between interest rates and the price of debt securities. In the previous unit, we mentioned that the market price of preferred stock fluctuates inversely with current interest rates. Later on in this unit, when we discuss the math behind yields, this topic will be easier to follow. At this point, we want you to know that whenever interest rates in the market, the current cost of borrowing money, go up, the price of outstanding debt securities goes down. Likewise, if interest rates fall, the price of outstanding debt securities will rise. That is what interest rate risk is all about. Take note. Although the market price of the debt security will fluctuate, the interest payments stay the same. Structure. There are certain structural components common to most debt securities. Negotiability. Like stock, bonds are readily transferable. This enables investors to sell their bonds before maturity date. As just stated with interest rate risk, the price received may be more or less than the face value. Other factors can also come into play, such as a change in the safety of the bond. This will be covered when we get to ratings. Specified maturity date. Debt securities are redeemed, paid back, by the issuer on a specified maturity date. In the case of money market instruments, that can be as short as 1 day. It is never longer than 1 year. Bonds have longer maturities. As previously stated, those can be as short as 5 years, but more often are 10 to 30 years. Payment of interest. In the case of bonds, interest is generally paid semi-annually based on a stated coupon rate. Unlike dividends on stock, which are determined by the company's board of directors and can be skipped or reduced if financial conditions are unfavorable, interest on debt securities is an obligation. Failure to pay the interest or principal, as scheduled, could lead to foreclosure or bankruptcy proceedings. No company ever went bankrupt because it could not pay a dividend on its equity securities. Just like individuals, failure to meet your debt obligations can lead to real trouble. Another important fact about interest. In the case of corporate debt, it is a pre-tax expense, deductible from income like the interest on your home mortgage, unlike dividends, which are paid from net income after tax. In the case of money market instruments, they are issued at a discount to their face value with the difference paid at maturity representing the interest. In Lesson 2.7, we will get into more detail on this. Accrued interest. What happens to an investor who sells a bond before the semi-annual interest payment date? The buyer pays the seller the amount of interest that has accrued since the last interest payment. Then, on the next payment date, the new owner receives the full 6 months of interest. Most bonds trade an interest, meaning a buyer pays a seller a bond's market price plus any accrued interest since the last interest payment. The buyer receives the full amount of the next interest payment, including interest that accrued while the seller owned the bond. Learning Objective 2B. Identify the relevance of a bond's rating. Rating services. The purchase of a debt security is only as safe as the strength of the borrower. Also taken into account is the presence or absence of any collateral, just as when you want to borrow money. Because safety of the bond will frequently be a very important consideration for clients, most investors consult the rating services. The two primary rating organizations for debt securities are Standard & Poor's and Moody's. Both organizations have highly qualified personnel who the debt's quality, safety. The following chart should give you all the information you need for the exam. Standard & Poor's ratings. AAA bonds of highest quality. AA high-quality debt obligations. Single A bonds that have a strong capacity to pay interest and principal but may be susceptible to adverse effects. BBB bonds that have an adequate capacity to pay interest and principal but are more vulnerable to adverse economic conditions or changing circumstances. BB bonds of lower medium grade with few desirable investment characteristics. Single B primarily speculative bonds with great uncertainties and major risk if exposed to adverse conditions. CCC bonds in poor standing that may be defaulted. Single C income bonds on which no interest is being paid. D bonds in default. Note: for Standard & Poor's ratings, plus and minus are used to show relative strength within a rating category. Moody's ratings. AAA bonds of highest quality. AA bonds of high quality. Single A bonds whose security of principal and interest is considered adequate but may be impaired in the future. BAA bonds of medium grade that are neither highly protected nor poorly secured. BA bonds of speculative quality whose future cannot be considered well assured. B bonds that lack characteristics of a desirable investment. CAA bonds in poor standing that may be defaulted. CA speculative bonds that are often in default. C bonds with little probability of any investment value, lowest rating. Note: for Moody's ratings AA through B, 1 indicates the high end, 2 indicates the middle end, and 3 indicates the low end of the rating class. Investment grade debt. In the industry, bonds rated in the top 4 categories, BBB or BAA and higher, are referred to as investment grade. Investment grade bonds are generally the only quality eligible for purchase by institutions, for example, banks or insurance companies, and by fiduciaries, and therefore have greater liquidity than lower-grade instruments. High-yield bonds. Lower-grade bonds, known in the industry as junk bonds, are now more commonly called high-yield bonds. Because of their lower ratings, BB or BA or lower, an additional risk of default, high-yield bonds may be subject to substantial price erosion during slow economic times or when a bond issuer's creditworthiness is questioned. Their volatility is usually substantially higher than investment-grade bonds, but they may be suitable for sophisticated investors seeking higher returns and possible capital appreciation from speculative fixed-income investments. There is a critical relationship in all investments known as the risk-reward relationship. The more risk an investor takes, the greater must be the reward. The less creditworthy the borrower, the more risk to the lender, so the greater the reward the lender must receive to compensate for that risk. That is why lower-rated bonds carry higher rates of return. The higher the rating, the greater likelihood that interest and principal will be paid as scheduled. Lower ratings indicate the amount of default or credit risk being taken by the investor. Think of the ratings as reflecting the borrower's credit score, just like yours. For example, a AAA rating would be equivalent of a score in the 800s, while a BB or BA rating might be somewhat lower than 600. It is important to understand that when the raters evaluate a bond, they look at all the factors, including collateral. A mortgage bond is not necessarily safer than any debenture. Practice question. According to Standard & Poor's grading system, the 4 highest grades of bonds from best to lowest grade are A, triple A, double A, BAA, B, single A, double A, triple A, B, C, B, double A, triple A, D, triple A, double A, triple B. The answer is D. Choice A would be correct if the question referred to Moody's. Test topic alert. What does it mean when a bond's rating comes under review? This is essentially the same concept as a review of your personal credit rating. Sometimes it is just routine because the rating hasn't been reviewed in some time. More often, certain factors have arisen causing concern as to the ability of the issuer to perform. Knowledge Check 2.1. Question 1. Which of the following statements regarding bond interest is true? A. Bond prices have an inverse relationship to interest rates. B. Bond prices have a direct relationship to interest rates. C. The par value of a bond will increase as market interest rates fall. D. The par value of a bond will decrease as market interest rates fall. The correct answer is A. Bond prices have an inverse relationship to interest rates. If interest rates go up, prices for those bonds trading in the secondary markets will go down. Conversely, if interest rates decline, bond prices rise. Par value is a fixed number for the life of the bond. Question 2. A bond would be considered speculative below which of the following Moody's ratings? AA, B, BA, C, triple B, D, BA. The correct answer is B. A rating of BA is the lowest investment grade rating assigned by Moody's. Any rating beneath this is considered speculative. If the question asked about Standard & Poor's, then the correct choice would be triple B. Lesson 2.2. Bond du math. The securities industry is about numbers, and debt securities involve more than their share. You will need to know how to figure the price of a debt security. Following that, you will learn how to arrive at the parity price of a convertible security. The final math deals with determining yield based on that price and calculating the various yields used in the bond marketplace. Learning Objective 2C, calculate the price of a bond. It is important to understand how the market prices of bonds are quoted. Look at the following examples to see how corporate, municipal, and government bonds are quoted. Remember, par or face value is always $1,000. Pricing corporate and municipal bonds. Corporate and municipal bonds are quoted as a percentage of par. Each bond point, 1% of $1,000, represents $10 and the fractions are in eighths. Each eighth equals $1.25. A bond quoted at 90 1/4 equals $902.50. 90% times $1,000 equals $900 plus 1/4 times $10 or $2.50 equals $902.50. A bond quoted at 101 3/4 equals $1,017.50. 101% times $1,000 equals $1,010 plus 3/4 times $10 or $7.50 equals $1,017.50. Pricing Treasury securities. Government bonds are quoted as a percentage of par. Each point is $10 and each 0.01 represents 1/32 of $10 or $0.3125. A government bond quoted at 90.8 or 90.08 equals $902.50. That is 90% times $1,000 equals $900 plus 8/32, which is 1/4 times $10 or $2.50 equals $902.50. A government bond quoted at 101.24 equals $1,017.50 or 101% times $1,000 equals $1,010 plus 24/32, which is 3/4 times $10 or $7.50 equals $1,017.50. Take note. In recent years, some quote systems have added a 0 for prices between 0.1 and 0.9 to avoid confusion. Similar to the way you enter the expiration date for your credit card as 01/2024 instead of 1/2024. That is why, in the example above, we showed you both 90.8 and 90.08. They both mean 90 and 8/32. Example. When you see a corporate bond quoted at 103.5, it represents a market price of $1,035. The 103 is 103% of $1,000 or $1,030, and the 1/2 is half of a $10 point or $5. On a Treasury bond, that same price would be shown as 103.16, where the 0.16 is 16/32 or 1/2. Bond listings. If you were to look up a bond in the newspaper or some other source for a quote, you might see something like this. DEF 535 at 106. What does that mean? The DEF is the issuer, the 5 is the nominal or coupon rate, the 35 is the maturity date of 2035, and the 106 is the price, $1,060. So, what is the THES? It is nothing but a separation between the coupon and the maturity date. Learning Objective 2D, calculate the parity price of a convertible bond. Convertible debt securities. The exam deals with securities that have a convertible feature. Although there may be a question on a convertible preferred stock, most of the parity questions will deal with convertible debt. Convertible debt, most often debentures, is issued by corporations only. Because they may be converted or exchanged for the company's common stock, there are no convertible municipal or government bonds. The conversion privilege is exercised at the discretion of the investor. The ratio of conversion varies from one company's bond to another according to the terms set forth in the indenture at the time the bonds are issued. The exact number of shares or method of computing the number that a particular bond will be convertible into at any point is printed in the bond indenture at the time of issue. In many cases, the indenture merely tells you the number of shares into which the bond is convertible. For example, the bond may be convertible into 50 shares. Thus, it would have a conversion ratio of 50-1 or 50 shares for one bond. If a bond is convertible into 25 shares, it would have a conversion ratio of 25-1. Frequently, instead of telling the number of shares into which the bond is convertible, the indenture will give the conversion price. That conversion price is the price per share at which the corporation will sell their stock in exchange for the bond one is holding. Regardless of the current market price of the bond always represents a debt of the corporation of $1,000. Therefore, if the conversion price is given to compute the number of shares into which the bond is convertible, always divide the par value, $1,000, by the conversion price. For example, a bond convertible at $20 per share is convertible into 50 shares. $1,000 divided by $20 equals 50 shares. If the bond has a conversion price of $50, the conversion ratio is 20 shares. $1,000 divided by $50 equals 20 shares. If the JRP 6s of 41, currently selling at $120, were convertible at $40, how many shares would one get when one converted the bond? The answer is not 30. The current market has nothing to do with the computation. The bond conversion is fixed at issuance, and the market fluctuates all the time. The correct answer is 25 shares. $1,000 divided by $40 equals 25 shares. The comments we've made about convertible bonds, or convertible preferred, moving in relation to the underlying common stock is due to the concept of parity. According to the dictionary, when two things are at parity, they are equal. How does that work here? If you think about it, when holding a convertible security, we have a choice of two actions. We can either continue to hold the bond or preferred, or we can decide to convert it into the common. If the convertible security and the common stock we would get upon conversion are worth the same, we say they are at parity. Example. On the exam, there may be questions on parity. Here are two methods to help you solve the problem. RST debenture is convertible to common at $50. If an RST bond is currently trading for $1,200, what is the parity price of the common? Method 1. Parity means equal. Solve for the conversion ratio as follows. Par value, $1,000. Conversion price, $50. Conversion ratio, 20. The parity stock price is found by dividing $1,200 by 20. The parity price of the common is $60. That is, if one were to convert the bond when the 20 shares received have a market value of $60 each, the investor would have the same $1,200 as the market value of the bond. Method 2. If you prefer to think in percentages, identify that the current debenture's price of $1,200 is 20% greater than the original $1,000 price. To be an equivalence, the stock price must also increase by 20%. So add 20% to 50 and the problem is solved. 20% of 50 is 10. 10 plus 50 equals the parity price of $60. Here is another style of parity question. Our ST debenture is convertible to common at $50. If the common is trading for $45, what is the parity price of the debenture? Start by solving for the conversion ratio. Par value, $1,000. Conversion price, $50. Conversion ratio, 20. The debenture's parity price is found by multiplying 20 by $45, which is $900. Using the percentage method, you can determine that the market price of the common stock is 10% below that of the conversion price. 5 divided by 50 equals 10%. Reducing the debenture price of $1,000 by 10% results in a parity price of the debenture of $900. It is important to remember that parity is a theoretical concept. We're looking for the price that would make the bond and stock equal. As a practical matter, convertible securities, whether debentures or preferred stock, almost always have a market price that is somewhat above the parity price. Conversely, the test might ask you to know that the stock trades generally a bit below the parity price. Learning Objective 2E. Compare current yield, yield to maturity, and yield to call. The nature of fixed income, usually being debt rather than equity, involves somewhat different methodology in determining proper valuation. After all, in most cases, these securities are purchased for their income rather than future capital appreciation. The first things we will look at are the various yield computations that are applicable to debt securities. Yield computations. The interest rate will always be stated as a percentage of the par value. The interest stated on the face of the bond is called the nominal yield. Sometimes it is referred to as the coupon rate. To compute the annual interest payments in dollars, multiply this nominal yield by the face amount of the bond, $1,000 unless stated otherwise. A bond with a 5% coupon rate pays $50 per year. One with an 8% nominal yield pays $80 per year. One with a coupon of 13.5% pays $135 per year. Because on any particular bond, this interest payment is the same every year, it is referred to as a fixed charge. Test topic alert. When a question states that a bond pays interest at a rate of 6% semi-annually, it does not mean two payments of $60 per year. The interest rate is always stated on an annual basis, $60 per year, and it is paid twice per year or $30 every 6 months. Current yield, CY. Investors always want to know the return on their investment. The most straightforward way to do that is to place the return on the investment as follows. Return divided by investment. The return will always be the annual interest in dollars. If referring to a stock, the dividend in dollars, divided by the current market price, the amount of investment required to own the security. This calculation is called current yield or current return. For example, if the annual dividend is $3 and the stock's price is $60, the calculation is 3 divided by 5% equals $60. Although most bonds are issued with a face or par value of $1,000, bond prices do fluctuate in the market. As stated earlier, the interest a bond pays is called its coupon rate or nominal yield. Look at this example. The DBL tens of 39. DBL is the name of the issuer. Tens means the nominal yield is 10%, and 39 means that the bonds mature in 2039. The letter S is added because it is easier to say the tens than to say the 10. These bonds pay $100 a year, $50 semi-annually, for each $1,000 of face value. Regardless of what the market price of the bonds may be, the DBL Corporation has an obligation to pay annual interest of 10% of the $1,000 face it borrowed. If an investor were to buy these bonds for more than $1,000 or less than $1,000, the return on the investment would not be 10%. For example, if these bonds had a current market value of $800, their current yield would be 12.5%, $100 divided by $800. Similarly, someone paying $1,200 for the bonds will receive a current yield of 8.33%, $100 divided by $1,200. Please note that the $100 interest received is the same in all cases regardless of the current market price. Bond prices and yields move in opposite directions. As interest rates rise, bond prices fall and vice versa. When a bond trades at a discount, its current yield increases. When it trades at a premium, its current yield decreases. Discount and premium. When a bond is selling at a price above par or face, it is selling at a premium. When it is selling below par, it is selling at a discount. Two critical statements to remember are, if you pay more, you get less. If you pay less, you get more. Looking at the examples above, an investor buying a bond at a premium will always receive a rate of return less than the coupon or nominal yield stated on the face of the bond. 8.33% is less than 10%. Conversely, anytime an investor purchases a bond at a discount, the return will be more than the rate stated on the face of the bond. 12.5% is greater than 10%. In addition to being the dollar amount on which the annual interest is based, par value is also the dollar amount that will be returned to the investor at maturity. Therefore, an investor purchasing a bond at a discount knows that holding the bond until maturity date will result in a return of the par value, an amount which will be more than what was paid for the bond. That the par value received will be less than what was paid for the bond. To accurately reflect this gain or loss that an investor will have upon maturity, there is another yield to consider, the yield to maturity or true yield. Test topic alert. Another way you may be tested is by giving you a quoted yield and asking you for the price relative to par. For example, if a bond with a 5% coupon is currently yielding 6%, is it selling at a discount, a premium, or par? Well, anytime you are getting a yield higher than the coupon rate, the bond has to be selling at a discount from par. Conversely, if the bond had a 5% coupon, but the current return was 4%, the bond must be selling at a premium to par. You may also be asked to determine which is higher or lower, the current yield or the yield to maturity. Because yield to maturity, YTM, accentuates the return by adding a profit to a bond bought at a discount or subtracting the loss on a bond bought at a premium, the YTM on a discount bond will always be higher than that bond's current yield, and the reverse is true regarding a bond bought at a premium. Yield to maturity, YTM or basis. This measurement takes into account the gain or loss the investor will have when the bonds are redeemed at maturity. The person who buys the bonds mentioned above at $800 will get back $1,000 if the bonds are held to maturity, in addition to receiving $100 per year interest, a current yield of 12.5% on the $800 investment. Consequently, this investor will have a gain of $200 on top of the annual interest. The individual paying $1,200 for the bonds will have a $200 loss at maturity when receiving the face value for them at maturity. Whenever an investor pays less, buys at a discount, there will be a profit in addition to the annual interest. And whenever the investor pays more, buys at a premium, there will be a loss if held to maturity. Try to understand these key facts. A bond is issued at par, $1,000, because that is how much the issuer is borrowing. The interest paid on the bond is always fixed as a percentage of the par, face value. Regardless of changes in the market value of the bond, the interest checks remain the same. The current market price of a bond is determined by supply and demand. The current market price will fluctuate. The current market price may be at par, above par, or below par. A bond always matures at par. Purchasing a bond at par will always result in getting back the same as the original investment at maturity. Purchasing a bond at a discount, below par, will always result in getting back par, which means more, a profit, than the original investment. Purchasing a bond at a premium, above par, will always result in getting back par, which means less, a loss, than the original investment. Although you will probably not have to do a yield to maturity computation on the exam, some students find that seeing the numbers played out gives them a better understanding of the concept. Try to follow this example. Example: an investor who buys a 10% coupon bond at $1,050 per bond, with 10 years remaining to maturity, can expect $100 in interest per year. If he holds the bond to maturity, the bondholder loses $50, the amount of the premium. This loss is included in the YTM approximation. The actual YTM calculation for this premium bond is shown below. Annual interest less premium divided by years to maturity, all divided by the average price of the bond. 100 less 50 divided by 10, all divided by 1,025 equals 95 divided by 1,025 equals 0.93 or 9.3%. A bond's average price is the price paid plus the amount received at maturity, par, divided by 2. Alternatively, the average price is that price midway between the purchase price and par. The ITM of a bond bought at a premium is always lower than both the coupon rate, nominal yield, and the current yield. In this example, the nominal yield is 10%, and the current yield is 9.52%, 100 divided by 1,050. If an investor buys a 10-year bond with a 10% coupon for $950 per bond, he receives $100 per year in coupon interest payments and a gain of $50, the amount of the discount at maturity. This gain is included in the ITM approximation. The actual ITM calculation for this discount bond is shown below. Annual interest plus discount divided by years to maturity, all divided by the average price of the bond. 100 plus 50 divided by 10, all divided by 975 equals 105 divided by 975 equals 0.1077 or 10.77%. The ITM of a bond bought at a discount is always higher than both the coupon rate, nominal yield, and the current yield. In this example, the nominal yield is 10%, and the current yield is 10.53%, 100 divided by 950. If these calculations seem complicated, do not worry. You will have at most one question requiring a ITM calculation. Focus on the relationship between YTM and current yield, CY, based on the price of the bond. Take note. YTM is also called the market-driven yield because it reflects the internal rate of return, IRR, from the bond investment. Yield to call, YTC. A bond with a call feature may be redeemed before maturity at the issuer's option. Unless the bond was bought at par and is callable at par, yield to call, YTC, calculations reflect the early redemption date and consequent acceleration of the premium loss from the purchase price. A bond's yield to call, similar to ITM, is the rate of return the bond provides from the purchase date to the call date and price. This calculation generates a lower return than does the YTM and should be considered by investors when evaluating a callable bond trading at a premium. Test topic alert. The reason why we've only referred to a bond selling at a premium being called for redemption is because it is highly unlikely that an issuer would call in a bond that was available in the marketplace at a discount. If that were to happen, the yield to call would be higher than the yield to maturity because the profit resulting from the discount would be accelerated. The following example and chart will help you follow the discussion of the various bond yields. Example: current yield, yield to maturity, and yield to call. A chart showing three slopes representing bonds on a fulcrum. One is upward sloping, one is flat, and one is downward sloping. The fulcrum represents the coupon rate. The downward sloping bond's price is above par or a premium. The current yield is less than the coupon, the YTM is less than current yield, and the YTC is less than the YTM. The flat-sloped bond is trading at par where the coupon equals the current yield, YTM, and YTC. The upward-sloping bond is trading below par or at a discount. Its coupon is less than its current yield, which is less than the ITM, which is less than the YTC. 1. What is the current yield of a 6% bond trading for $800? Current yield equals annual income divided by current market price. Find the solution as follows. $60 divided by $800 equals 7.5%. This bond is trading at a discount. When prices fall, yields rise. The current yield is greater than the nominal yield when bonds are trading at a discount. 2. What is the current yield of a 6% bond trading for $120,200? Find the solution as follows. $60 divided by $1,200 equals 5%. This bond is trading at a premium. The price is up, so the yield is down. The current yield is less than the nominal yield when bonds are trading at a premium. It is critical to understand the inverse relationship between price and yield. An effective way to visualize it is through the chart. When bonds are at par, coupon and current yield are equal. When bonds are at a premium, the CY is less than the coupon. When bonds are at a discount, the CY is greater than the coupon. Current market value, CMV, of bond with 10 years to maturity. 3 charts each showing a slope to represent the bond on a fulcrum. The first is titled a premium bond and has a price of $1,200 with a downward slope indicating the current yield of 5% is less than the coupon of 6% on the fulcrum. The second is titled a par bond and has a price of $1,000 with a flat slope indicating the current yield of 6% is equal to the coupon of 6% on the fulcrum. The third is titled a discount bond and has a price of $800 with an upward slope indicating the current yield of 7.5% is greater than the coupon of 6% on the fulcrum. Take note. Know how to calculate the CY of a bond or a stock. Expect to see one question on the calculation of CY. The CY of common stock is calculated by dividing the current dividend by the current price of the stock. For instance, a stock with a $2 dividend trading on the market for $40 has a 5% CY. $2 divided by $40 equals 5%. Example. Answer the following questions with premium, par, or discount. A. If the bond has a WTC lower than its CY, it is trading at what? B. If the bond has a UTM and CY that are equal, the bond is trading at what? C. If the bond has a UTM less than its ITC, the bond is trading at what? D. If a bond has a UTM greater than its coupon, the bond is trading at what? The answers are 1. Premium, 2. Par, 3. Discount, 4. Discount. Test topic alert. Memorize the following chart for the exam. Ranking yields from lowest to highest. Discount bonds, nominal CY, YTM, YTC. Premium bonds, YTC, YTM, CY, nominal. Once you understand the yield ranking for discounts, the ranking for premium is easy. It is the exact opposite. Price-yield relationship. There are many reasons interest rates rise and fall. The main concern for the exam, at this point, is the effect that interest rates have on the price fluctuations of bonds. As a general rule, keep in mind that interest rates and bond prices move counter to each other. That is, when interest rates are going up, the price of older bonds will be going down. When interest rates are going down, the price of older bonds will be going up. When most people hear this for the first time, they have difficulty understanding it. Simply stated, when newly issued bonds are paying a higher rate of interest than ones currently in the marketplace, those older bonds are not as attractive. After all, if a new bond came out with a 6% coupon, your 4% or 5% bond would not be as valuable. This always assumes equal quality or rating. Conversely, if you were holding a bond with an 8% coupon and newly issued bonds were only offering 6%, your bond is more valuable. Practice question. When a bond with a 6% coupon is selling for 90, each of the following statements is correct except A. The current yield is approximately 6.67%. B. The bond is selling at a discount. C. The bondholder will receive 2 semi-annual interest payments of $27 each. D. The yield to maturity is slightly higher than the current yield. The answer is C. A bond with a 6% coupon is going to make 2 semi-annual interest payments of $30 each, regardless of the bond's market price. After all, the L.E.M was $1,000 at 6% interest, and that won't change. A price of 90 is 90% of the $1,000 par. Clearly a discount. The current yield is the $60 annual interest divided by the $900 price, or 6.67%. And that is a bit lower than the yield to maturity, because if we hold the bond to maturity, we're going to get back the full $1,000, which will represent a $100 profit. Please see the chart at the test topic alert above. Knowledge Check 2.2. Question 1. Disregarding commissions, an investor selling a U.S. Treasury bond for a price of $104.16 will receive A. $104.16. B. $104.50. C. $1,041.60. D. $1,045. The correct answer is D. Treasury bonds are quoted in 30 seconds and as a percentage of par. A quote of 104.16 is 104 and 16 30 seconds, or 104 and 1/2% of par. With par always being $1,000, the proceeds of the sale are $1,045. Question 2. A 4.67% convertible debenture is selling at $102. It is convertible into the common stock of the same corporation at $25. The common stock is currently trading at $23. If the stock were trading at parity with the debenture, the price of the stock would be A. $25, B. $25.25, C. $25.50, D. $44.35. The correct answer is C. To determine the parity price of the common, first find the number of shares the debenture is convertible into, conversion ratio, by dividing par value by the conversion price. $1,000 divided by $25 equals 40 shares. Next, divide the current price of the bond by the conversion ratio. The result is the parity price of the common stock. 1,020 divided by 40 equals $25.50. Question 3. 5% XYZ debentures are trading for $1,250. Other similarly rated bonds are being offered at 4.25%. What is the current yield on the 5% XYZ debentures? A. 1.5%. B. 4%. C. 5%. D. 6.25%. The correct answer is B. Current yield is defined as the annual income, or coupon rate, from a bond divided by the bond's current market price. Accordingly, $50 divided by $1,250 equals 0.04 times 100 equals 4%. The current yield will be lower than the coupon rate when the bond is trading at a premium. Please note that there is unnecessary information given in this question. You do not need to know anything about other bonds. Lesson 2.3. Corporate and Treasury Debt Securities. Previously, we stated that the three primary issuers of debt securities are the U.S. government and its agencies, municipal issuers, states, cities, counties, etc., and corporations. This lesson deals with two of those, with municipal issues being covered in Lesson 2.4. Learning Objective 2 recognized the unique features of U.S. government and agency issues. Whenever the word government is used in conjunction with a security on the exam, it means the federal government. U.S. government bonds are the safest of all. There are two primary types of backing: direct government backing or guarantee, as in the case of Treasury issues, and the moral guarantee, as in the case of federal agencies. Although most government issues trade in what is known as the capital market, that is, the market for long-term securities, stocks, and bonds, there are several issues that trade in the money market. The money market is where short-term instruments, those that mature in 1 year or less, are traded. The money market will be discussed later in this unit. No discussion of Treasury issues would be possible, however, without describing the widely held bellwether of the money market known as U.S. Treasury bills. Government and agency securities. U.S. Treasury bills. Treasury bills are direct, short-term debt obligations of the U.S. government. They are issued every week by using a competitive bidding process. Each week, T-bills, as they are known, with maturities of 4 weeks, 13 weeks, and 26 weeks, are issued, and once every 4 weeks, bills with a 52-week maturity are issued. Treasury bills pay no interest. They are issued at a discount from their par value. An investor might purchase a $10,000 26-week T-bill at a price of $9,800. No interest would be received, but at maturity, the Treasury would send the investor a check for $10,000. The difference between the $9,800 paid and the $10,000 received would be considered interest income even though a separate interest check was never received. Take note. Key points to remember regarding T-bills include: Treasury bills are always issued and traded at a discount. Treasury bills are the only Treasury security issued without a stated interest rate. Treasury bills are highly liquid, and 13-week, also referred to as 91-day, Treasury bills are used in market analysis as the stereotypical risk-free investment, especially in computations that refer to the risk-free rate. More about that in Unit 21. U.S. Treasury notes. U.S. Treasury notes are direct debt obligations of the U.S. Treasury with the following characteristics. They pay semi-annual interest as a percentage of the stated par value. They have intermediate maturities, 2, 3, 5, 7, and 10 years. They mature at par value. They are non-callable. U.S. Treasury bonds. U.S. Treasury bonds are direct debt obligations of the U.S. Treasury with the following characteristics. They pay semi-annual interest as a percentage of the stated par value. They have long-term maturities, generally 10 to 30 years. They are non-callable. They mature at par value. Take note. When doing any calculations relating to bonds on the exam, the par or face value will always be $1,000. This is true even though the above 3 Treasury issues are available in denominations as low as $100. Furthermore, all government securities are only available in book entry form. That means there are no certificates issued. Records of the investor's ownership are electronically on the books of the Treasury Department. Practice question. When Treasury bills are issued, they are quoted at A. A premium over par. B. 100% of the par value. C. Par value with interest coupons attached. D. A discount from principal with no coupons attached. The answer is D. Treasury bills are always issued at a discount. They pay no interest. The investor profits by receiving back par value and makes the difference between the discounted purchase price and the par received at maturity. All government bonds are now book entry, electronic record. There has not been a Treasury note or bond issued since July 1986 with interest coupons attached. Treasury inflation-protected securities, Type ES. A special type of Treasury issue, Treasury inflation-protected securities, Type ES, helps protect investors against purchasing power risk. These notes are issued with a fixed interest rate, but the principal amount is adjusted semi-annually by an amount equal to the change in the Consumer Price Index, CPI, the standard measurement of inflation. They are issued with maturities of 5, 10, and 30 years and are also available in denominations of $100 like the other treasuries we've covered. The interest payment the investor receives every 6 months is equal to the fixed interest rate times the newly adjusted principal. During times of inflation, the interest payments increase, while during times of deflation, the interest payments fall. These notes are sold at lower interest rates than conventional fixed-rate Treasury notes because of their adjustable nature. We will demonstrate the return of a Type ES bond in Unit 22. Like other Treasury securities, Type ES are exempt from state and local income taxes on the interest income generated but are subject to federal taxation. However, in any year when the principal is adjusted upward for inflation, that increase is considered reportable income for that year even though the increase will not be received until the note matures. Test topic alert. Interest payments from Treasury inflation-protected securities, Type ES, and increases in the principal of Type ES are subject to federal tax but exempt from state and local income taxes. Practice question. A customer wishes to buy a security providing periodic interest payments, safety of principal, and protection from purchasing power risk. The customer should purchase A. TIPS, B. Tigers, C. CMOs, D. Strips. The answer is A. TIPS offer inflation protection and safety of principal because they are backed by the U.S. government. Ginnie Mae Securities. There is one more security guaranteed by the full faith and credit of the U.S. government. The Government National Mortgage Association, Ginnie Mae or GNMA, is a wholly owned government corporation. The primary difference between Ginnie Mae Securities and the agency securities that we will cover next is the backing of the federal government. Ginnie Maes are known as modified pass-through certificates. They represent an interest in pools of FHA-insured mortgages or Veterans Administration guaranteed mortgages. The term pass-through is used because, as the homeowners make their monthly mortgage payments, those payments are collected in the pool and proportionately passed through to the investor. This payment received by the investor differs from most other securities in two respects. First, payments are received monthly because underlying the security is a pool of home mortgages which are paid for monthly. Second, each monthly payment the investor receives consists partly of interest and partly of principal. Because payments on home mortgages consist of interest and some principal, and because that money goes into the pool for all the principal and the balance of each payment represents interest. The portion of each monthly payment representing interest is subject to state and local taxation and, of course, federal income tax as well. Ginnie Maes carry a minimum denomination of $1,000 and then in $1 increments. U.S. Federal Agency Securities. In addition to those securities issued directly by the U.S. Treasury, the exam covers those issued by U.S. government agencies. These are known as government-sponsored enterprises, GSEs. These are quasi-governmental organizations with the power to raise funds by borrowing, which does not carry the full faith and credit of the federal government, or to guarantee the debt of others. Although there are a number of agencies authorized to issue securities, the exam is most likely to limit its coverage to those issuing mortgage-backed securities. Although the securities do not have direct Treasury backing, they are considered moral obligations of the U.S. government. As such, they are generally considered second only to government securities in terms of safety. Federal National Mortgage Association. The Federal National Mortgage Association, Fannie Mae, purchases and sells real estate mortgages, primarily those insured by the Federal Housing Administration, FHA, or guaranteed by the Veterans Administration, VA. Then, Fannie Mae issues bonds backed by those mortgages. They are issued at par and pay semi-annual interest. That interest is taxable at all levels: state, local, and federal. Like the other federal issues, they come out in book entry form. Stock in Fannie Mae is publicly traded. Whether a Ginnie Mae or a Fannie Mae, the debt obligation is backed by a pool of mortgages, and the interest and principal pass through to the investors. In reality, only a small percentage of mortgages last the full term. People move and sell their homes, or they may refinance the mortgages. Whatever the reason, most mortgages are paid off early. This leads to an unusual risk for those owning mortgage-backed securities prepayment risk. Why do people refinance their mortgage? Usually, it is because interest rates have fallen, and they can get a new mortgage with a lower interest cost. In that case, the investor receives back the principal ahead of schedule and now has to reinvest at the current lower rates available. Prepayment risk is a form of reinvestment risk. Benefits and risks of mortgage-backed securities. The primary advantage of investing in mortgage-backed securities is that, compared with other debt securities with similar ratings, they pay a higher rate of return. There are a number of risks faced by investors in these securities, being difficult to understand from being among the most complicated instruments. Prepayment risk due to mortgages being refinanced when rates drop. Default risk, particularly if the mortgages are subprime. Reinvestment risk and liquidity risk. Tennessee Valley Authority, TVA. One final agency that might be tested is the TVA. The Tennessee Valley Authority is the nation's largest public power provider and a corporation of the U.S. government. TVA bonds are not backed by the U.S. government. Instead, they're backed by the revenues generated by the agency's projects. However, credit rating agencies perceive that there is an implicit government guarantee of TVA bonds. If push came to shove, it's a good bet that Uncle Sam would make that guarantee explicit. Practice question. All of the following debt instruments pay interest semi-annually except: A. Ginnie Mae pass-through certificates. B. U.S. Treasury notes. C. U.S. Treasury bonds. D. TIPS. The answer is A. A unique feature of Ginnie Mae's is that they pay interest on a monthly basis, not semi-annually. In addition to the interest, investors receive their share of that portion of the mortgage payments that represented principal repayment. Learning Objective 2G. Differentiate between secured and unsecured corporate debt. Corporate debt securities, like any other loan, may be either secured or unsecured. Secured debt securities are backed by various kinds of assets of the issuing corporation, whereas unsecured debt securities are backed only by the reputation, credit record, and financial stability of the corporation. Regardless of whether secured or unsecured, the interest on debt securities is always paid before dividends on stock, preferred, and common. Secured debt. Mortgage bonds. Just as the owner of a home pledges a real asset, the home and land, as collateral for the mortgage, a corporation will borrow money backed by real estate and physical assets of the corporation. Just as a home ordinarily would have a market value greater than the principal amount of its mortgage, the value of the real assets pledged by the corporation will be in excess of the amount borrowed under that bond issue. If the corporation develops financial problems and is unable to pay the interest on the bonds, those real assets pledged as collateral are generally sold to pay off the mortgage bondholders. There may be a situation where foreclosing on the property results in a sale below the outstanding mortgage balance. In that case, the mortgage holder becomes a general creditor for the unsatisfied balance. Equipment trust certificates. Corporations, particularly railroads and airline companies, finance the acquisition of their rolling stock, locomotives, or airplanes by issuing an equipment trust certificate. The company makes a down payment, usually 20% of the cost of the rolling stock, and finances the balance over the course of time, for example, 15 years. Because the equipment does wear out, the railroad will pay off a portion of the loan on an annual basis. At no time, theoretically, is the value of the assets, the rolling stock, locomotives, or planes, worth less than the amount of the principal remaining on the loan. When the company has finished paying off the loan, it receives clear title to its equipment from the trustee. If the company does not make the payments, the lender repossesses the collateral and sells it for his benefit. If you would ever finance the purchase of a car, it is basically the same concept. Collateral trust bonds. Sometimes a corporation wants to borrow money and has neither real estate, for a mortgage, nor equipment, for an equipment trust, to use as collateral. Instead, it deposits securities it owns into a trust to serve as collateral for the lenders. The securities it deposits can be securities in that corporation or any other securities, as long as the securities are marketable, that is, readily liquidated. Obviously, the better the quality of the securities deposited as collateral, the better the quality and rating of the bond. You might see these called collateral trust certificates, unsecured debt, debentures. A debenture is a debt obligation of the corporation backed only by its word and general creditworthiness. Debentures are written promises of the corporation to pay the principal at its due date and interest on a regular basis. Although this promise is as binding as a promise for a mortgage bond, debentures are not secured by any pledge of property. They are sold on the general credit of the company. Their security depends on the assets and earnings of the corporation. Although debentures are unsecured, there are issuers whose credit standing is so good that their debentures are safer than mortgage bonds of less creditworthy companies. This is similar in concept to the extension of credit on your credit cards. The better your credit rating, the higher the limit and the lower the interest rate. Guaranteed bonds. A guaranteed bond is a bond that is guaranteed as to payment of interest, or both principal and interest, by a corporate entity other than the issuer. The value of the guarantee is only as good as the strength of the company making that guarantee. Guaranteed bonds were particularly popular in the railroad industry when a major railroad seeking to lease trackage rights from a short line would guarantee that smaller companies' debt. A more recent example is the ExxonMobil Corporation guaranteeing the debt issues of the Exxon Pipeline Company. Subordinated. The term subordinated means belonging to a lower or inferior class or rank, secondary. It is usually describing a debenture. A subordinated debenture has a claim that is behind, junior to, that of any other creditor. However, no matter how subordinated the debenture, it is still senior to any stockholder. Practice question. A debenture is issued based on A, the general credit of the corporation, B, a pledge of real estate, C, a pledge of equipment, D, the ability to levy taxes. The answer is A. There are no pledged assets behind a debenture, merely the credit standing of the corporation. It is a corporate IOU. Test topic alert. When examining the capital structure of a corporation, it is important to know the liquidation priority. Secured creditors, for example, mortgage bonds, equipment trust certificates, collateral trust bonds. Unsecured creditors, for example, general creditors including debenture holders. Subordinated debt holders. Preferred stockholders. Common stockholders. Senior security. Here is an exam-relevant example of the above liquidation priority. The word senior is used to describe the relative priority of claim of a security. Every preferred stock has a senior claim to common stock. Every debt security has a senior claim to preferred stock. Secured bonds have a senior claim to unsecured debt, such as debentures. The term senior securities means bonds and preferred stock, because they have a claim senior to common stock. If an exam question described a corporation as having issued senior bonds, the answer would have to state that there were mortgage bonds and / or collateral trust bonds and / or equipment trust certificates issued by that corporation with priority claim ahead of unsecured creditors. Features of various securities issues. Ownership and control of the firm. Common stock belongs to common stockholders through voting rights and residual claim to income. Preferred stock, limited rights. Bonds, limited rights under default in interest payments. Obligation to provide return. Common stock, none. Preferred stock must receive before common stockholder. Bonds, contractual obligation. Claim to assets in bankruptcy. Common stock, lowest claim of any security holder. Preferred stock, bondholders and creditors must be satisfied first. Bonds, highest claim. Risk-return trade-off. Common stock, higher risk, higher return. Preferred stock, moderate risk, moderate return. Dollar amount of dividend is known before stock purchase. Bonds, low risk, moderate return. Tax status of payment to recipient. Common stock, taxable as dividend in most cases. Preferred stock, taxable as dividend in most cases. Bonds, taxable as ordinary income in most cases. Knowledge Check 2.3. Question 1. If an investor watches the latest T-bill auction fall to 0.71% from 0.82%, the best interpretation is that A. Investors who purchased bills at this auction paid more for them than purchasers at last week's auction. B. Investors who purchased bills at this auction paid less for them than purchasers at last week's auction. C. Investors who purchased T-bills 12 weeks ago paid less than subsequent purchasers. D. These are 52-week T-bills. The correct answer is A. The rates on the T-bills fell, so prices rose, and the investor paid more for the bills this week than last week. The decline in yields indicates there was good demand for the securities because the price rose, driving the yields down. The question does not indicate the price of T-bills 12 weeks ago. It is unclear if the investor paid less for the T-bills then. The 52-week, 1 year, T-bills are the only ones auctioned monthly instead of weekly. Question 2. Which of the following corporate securities has a specific corporate asset pledged as security for the debt? A. A debenture. B. An equipment trust certificate. C. A guaranteed bond. D. A subordinated loan. The correct answer is B. There are 3 primary examples of secured corporate debt instruments on the exam. Those are equipment trust certificates secured by the pledged equipment, collateral trust bonds or certificates secured by the securities pledged, and mortgages bonds secured by real property pledged. A guaranteed bond is secured by a pledge made by a third party. No asset of the issuing corporation is pledged. Lesson 2.4 Municipal Bonds. Learning Objective 2H. Recall the unique features of municipal bonds, including the calculation of tax equivalent yield. Whenever the term municipal security is used on the exam, it is referring to a debt security issued by a state or political subdivision. For example, a city, county, or school district. Although there are short-term obligations, the exam will likely only deal with long-term debt bonds. Among the key investment features of municipal bonds are the tax treatment, the interest is generally free from federal income tax, covered shortly, and the safety. The record of safety of principal and interest payments of municipal bonds is second only to that of government issues. There is another unique feature of these securities. You can purchase municipal bonds where the scheduled payment of interest and repayment of the principal at maturity are ensured the issuer has taken out an insurance policy from one of several consortiums that offers this kind of protection. There are 2 basic types of municipal bonds. Types of municipal bonds. General obligation bonds, GOs. General obligation bonds are backed by a pledge of the issuer's full faith and credit for prompt payment of principal and interest. Most city, county, and school district bonds have the further distinction of being secured by a pledge of unlimited ad valorem, property, taxes to be levied against all taxable property. Because GOs are geared to tax resources, they are normally analyzed in terms of the size of the resources being taxed. They are generally very safe. Revenue bonds. Revenue bonds are payable from the earnings of a revenue-producing enterprise, such as a water, sewer, electric, or gas system, toll bridge, airport, college dormitory, or any other income-producing facility. Authorities and agencies are created by states or their subdivisions to perform specific functions, such as the operation of water, sewer, or electric systems, bridges, tunnels, or highways, and in some states, to construct schools or public facilities. In some cases, the authority has the right to levy fees and charges for its services. In other cases, it receives lease rentals, which may be payable from specific revenues or may be general obligations of the lessee. The yield, generally, is higher for this type of bond than for a GO. Taxes are more secure than revenues. Tax equivalent yield, TEY. One final factor to be considered in the analysis of debt securities is taxability. When it comes to taxation, the interest on corporate bonds is taxed as ordinary income on both state and federal tax returns, while the interest on Treasury debt is only taxable at the federal level. Municipal bonds have one important characteristic that sets them apart from all other securities. In most cases, interest received from municipal bonds is free of federal income tax, and if the investor resides in the issuer's state, it is generally free of state income tax as well. Assume an investor has $2,000 to invest. If he purchases at par one corporate or government bond of standard size, $1,000, with a 10% nominal coupon yield, he would receive $100 per year paid by 2 semi-annual interest checks of $50. For purposes of this example, assume that he is in the 28% federal income tax bracket. An individual in the 28% tax bracket pays tax on any additional income earned at a rate of 28%. Therefore, on the $100 in interest he received above, he would pay the IRS $28, 28%, and keep the other $72. The other $1,000 the investor had available to invest was used to purchase a $1,000 par value municipal bond with a 7.5% nominal yield. He would receive $75 annually on that bond paid by 2 semi-annual interest checks of $37.50. The 10% bonds, on which the interest is taxable, would net $72 per year after taxes. Of the $75 interest received for the 7.5% municipal, none of it is taxed. The whole amount is kept. Therefore, a client in the 28% bracket should purchase 7.5% municipals before 10% corporates. The taxable equivalent yield of a 7.5% tax-free bond for this investor in the 28% tax bracket would be the tax-free yield divided by its complement, 100% minus the tax bracket. In this case, 7.5 divided by 100 minus 28, or 0.72. That equals 10.42%, so it is obvious that the 7.5% municipal bond will provide a higher after-tax return. There are two ways to work with tax equivalent yield, TEY. The first we just done, that is, given the coupon on a municipal bond and the investor's tax bracket, divide that coupon by 100 minus the tax bracket to determine what a taxable security would have to pay to give the same after-tax return. Alternatively, we might know the taxable securities coupon and the investor's tax bracket, and we want to know what the tax-free bond must yield to give us an equivalent yield. For example, a taxable bond is paying 8% interest and the investor is in the 30% tax bracket. Therefore, the investor will pay taxes equal to 2.4%, 30% of the 8%. After paying taxes, the investor will keep the other 5.6%, 8% minus 2.4%. So, a tax-free bond paying 5.6% will offer a tax equivalent yield equal to the 8% one. Test topic alert. The tax equivalent yield for a municipal bond issued by an entity within a state with a state income tax will have a higher tax equivalent yield to a resident of that state due to the double tax exemption. The formula for computing tax equivalent yield, TEY, is municipal bond coupon divided by 100% minus the investor's tax bracket. Therefore, if the coupon rate, nominal yield of the municipal bond is 4.2% and the investor is in the 40% tax bracket, you would divide 4.2% by 100% minus 40%, or 4.2% by 60%, and arrive at a TEY of 7%. That is, in order to receive the same after-tax benefit, this investor would have to purchase a taxable bond, corporate or government, with a coupon of 7%. This can be easily proven by taking the 7% yield and reducing it by the 40% tax, which results in 7% minus 2.8% tax, or 4.2%. Practice question. If an investor in the 27% federal income tax bracket invests in municipal general obligation bonds selling at par with a coupon of 4.5%, what is the tax equivalent yield? A. 3.29%. B. 5.72%. C. 6.16%. D. 16.67%. The answer is C. The formula for computing tax equivalent yield is nominal, coupon, yield divided by 1 minus federal income tax rate, or 0.045 divided by 1 minus 0.27 equals 0.045 divided by 0.73 equals 6.16%. Knowledge check 2.4. Question 1. A bond indenture states that payment of interest and principal will come from the collection of ad valorem taxes. This is most likely A. A municipal general obligation bond. B. A municipal revenue bond. C. A U.S. Treasury bond. D. A corporate bond backed by property taxes. The correct answer is A. Ad valorem taxes. Most often taxes on real property are the backing for municipal go bonds. Corporations and the U.S. government do not collect property taxes. Question 2. Janice, who is in the 37% marginal income tax bracket, would like to purchase a bond for her investment portfolio. Assuming all the bonds are of similar investment quality, which would produce the highest after-tax yield? A. 2.25% U.S. Treasury note. B. 3.55% municipal bond. C. 3.75% U.S. Treasury bond. D. 5.25% corporate bond. The correct answer is B. Jennies should purchase the municipal bond based on the following after-tax yield calculations. U.S. Treasury bond 3.75% time 1 minus 0.37 equals 2.36%. Corporate bond 5.25% times 1 minus 0.37 equals 3.31%. Municipal bond, tax-free, equals 3.55%. U.S. Treasury note 2.25% times 1 minus 0.37 equals 1.46%. Lesson 2.5 Foreign Debt Securities. Learning Objective 2I. Identify the advantages and disadvantages of investing in foreign debt securities. Many investors choose to diversify their portfolios by investing in bonds issued by sovereign foreign governments. Some, such as the gilts, a gilt is a UK liability issued by the British Treasury and listed on the London Stock Exchange, are extremely safe. Others, especially those issued by countries with a less established financial structure, can be very risky and may even carry a rating equivalent to a junk bond. In addition, it is also possible to invest in corporate debt securities issued by foreign business entities. Once again, there is a great variation in risk. The advantages of investing in foreign bonds include potentially higher returns, diversification, and hedging against a drop in value of the U.S. dollar. Risks would include those found with all debt securities plus currency risk if the foreign currency falls in value against the dollar, potentially higher risk of default, generally less liquidity, and generally higher trading costs. In Unit 3, we will discuss how most investors use pooled investment vehicles, such as mutual funds, to invest in foreign debt securities. Eurobonds and Eurodollar bonds. A Eurobond is any long-term debt instrument issued and sold outside the country of the currency in which it is denominated. A U.S. dollar-denominated Eurobond or Eurodollar bond is a bond issued and sold outside the United States, but for which the principal and interest are stated and paid in U.S. dollars. Foreign corporations, foreign governments, domestic corporations, and domestic governments, including municipalities, can issue Eurodollar bonds. The U.S. government does not issue Eurodollar bonds. Test topic alert. Test questions sometimes ask you to contrast Eurobonds and Eurodollar bonds. The name of the instrument tells you how principal and interest are paid. Eurodollar bonds pay in U.S. dollars. Eurobonds pay in foreign currency. Note that these instruments must be issued outside of the United States. Test topic alert. What is a Yankee bond? There are a number of cute names given to bonds in an attempt to signify where they are issued, in what currency they are denominated, and by whom they are issued. The Yankee bond is a first cousin to the Eurodollar bond discussed above. Just as a Eurodollar bond is a U.S. dollar-denominated bond issued outside the United States, a Yankee bond is a U.S. dollar-denominated bond issued by a non-U.S. entity in the U.S. market. Another example of this is the Maple bond, a Canadian dollar-denominated bond issued by a non-Canadian entity in the Canadian market. Can you guess what a Matilda bond is? Clue: it takes its name from a song that had waltzing in the title. The answer will be found later in this course. The primary reason for issuing these bonds is that they are free from the requirement to register with the SEC, resulting in lower issuance costs. However, because the liquidity is not as great as with domestic issues, and because the political and country risks tend to be higher, yields are generally higher. Take note. If you purchase a bond issued in a foreign currency, you will receive your fixed rate of interest in that currency. However, when converting to U.S. dollars, you will be subject to currency risk. The same is true at maturity. For example, if you purchase 100,000 pounds of UK gilts, the term given to their government bonds with a 4% coupon, you would always receive 4,000 pounds per year in interest. At the exchange rate in effect when this is being written, £1 equals $1.41. The bonds would cost you $141,000, and you would be receiving the equivalent of $5,640 in interest. At maturity, you would receive 100,000 pounds, but if the value of the pound had fallen, say to $1.25, then the value of the matured bonds would be only $125,000. The same would be true about your interest payments if, during a holding period, the pound changed in value. Remember, currency values can fluctuate up or down. That is the nature of currency risk. Test topic alert. 3 advantages of Eurodollar bonds to investors are: Because they are U.S. dollar denominated, they bear no currency risk to U.S. investors. They are rated by U.S. rating agencies, so the risk is clear. They may offer higher yields than domestic bonds from the same issuer. Disadvantages of Eurodollar bonds, as with foreign bonds in general, are, because they are not registered with the SEC, there may be a lack of transparency. They have political and country risks taken into consideration by the rating agencies. They have less liquidity than domestic issues. They have currency risk if denominated in a currency other than one's home country. Brady bonds. Brady bonds were named after former U.S. Treasury Secretary Nicholas Brady initiated a plan in 1989 to exchange defaulted commercial bank loans issued in less developed countries, particularly in Latin America, with a security that could be carried on the bank's books as a performing asset. The first Brady agreement was reached with Mexico, and the bonds were first issued in March 1990. Partners in the program were the International Monetary Fund, IMF, and the World Bank. Most Brady bonds are denominated in U.S. dollars. Maturities range from 10 to 30 years and may be interest-bearing or discounted or even zero coupon. The safety of a Brady bond largely depends on the pledged collateral, frequently a U.S. Treasury zero-coupon bond. The Brady bond market was the largest and most actively traded emerging market asset class, but as most of the countries involved have matured, Brady bonds are only a small fraction today. Because of their relatively high safety, Brady bonds are generally more liquid than other debt issues from emerging markets. The Brady plan offered several important benefits. Those countries who participated were able to reduce their overall debt levels as well as the debt servicing cost. For the bank's portfolio, their sovereign risk was diversified. The plan encouraged emerging market countries to undertake economic reforms. With the added safety and promise of economic reforms, emerging market countries had a broader access to the financial markets. Test topic alert. No Brady bond carries a U.S. government guarantee. Practice question. Which of the following statements is not true? A. A country wishing to restructure its debt using Brady bonds would do so to save on debt servicing costs. B. One of the benefits of holding convertible debentures is the option to convert into the corporation's common stock. C. U.S. Treasury securities are backed by the full faith and credit of the United States of America. D. A resident of France purchasing Eurodollar bonds does not incur currency risk. The answer is D. As the name implies, Eurodollar bonds are denominated in U.S. dollars. That means that someone in France will have the risk that the euro, the home currency in France, will rise against the dollar, and as a result, interest payments will be worth less, as will the ultimate payback at maturity. Only U.S. residents have no currency risk with Eurodollar bonds. One of the benefits of Brady bonds is the ability of the sovereign government to borrow at a lower cost because of the collateral behind the bond. At least for exam purposes, there are no securities with a stronger guarantee of timely payment of interest and principal than those issued by the U.S. Treasury. Convertible debentures are convertible into the issuer's common stock, which is a benefit if the stock rises in price. Knowledge Check 2.5. Question 1. Advantages of Brady bonds to an American investor include all the following except A. Tax-free interest. B. Greater liquidity than found in most emerging market securities. C. Greater safety than most emerging market debt because of the collateral. D. Higher yields than on U.S. Treasury securities. The correct answer is A. The interest on Brady bonds is fully taxable to a U.S. investor. All of the other statements are true. Question 2. All of the following are advantages of Eurodollar bonds except A. Because they are U.S. dollar denominated, they bear no currency risk to U.S. investors. B. Greater transparency. C. They are rated by U.S. rating agencies, so the risk is clear. D. They may offer higher yields than domestic bonds from the same issuer. The correct answer is B. Eurodollar bonds are not registered with any regulatory agency. As a result, there is a certain lack of transparency. Lesson 2.6. Paying off the debt. Learning Objective 2J. Recall the methods of repayment of principal. As stated in the beginning of this unit, in addition to receiving regular income from the investment, the investor expects to receive a return of the loan principal. Normally, one expects to be paid off when the debt matures. However, there are cases when the issuer pays off the debt prior to maturity. Zero coupon bonds. The nominal coupon rate on a zero-coupon bond is 0. Zero-coupon bonds are issued at a substantial discount from par. They pay no interest, but the difference between the discounted price paid and the par value received at maturity makes up for the lack of a current interest coupon. For example, if an investor were to purchase a new zero-coupon bond for $500 that matured at par in 10 years, he would receive a profit of $500 in 10 years, or an average of $50 per year on an out-of-pocket expenditure of $500. Here are the key things to remember about zero-coupon bonds. They are always issued at a discount. There is no reinvestment risk because there are no interest payments to worry about reinvesting. They are more volatile than other bonds of similar quality. Even though no periodic interest payments are received, the IRS requires the issuer to send a Form 1099 OMS ID indicating the taxable interest to be reported each year. This is generally referred to as phantom income because you don't see it, but you pay tax on it. This investment is particularly useful when there is a target goal, such as a college education or a qualified retirement plan. This is particularly true because of the tax treatment mentioned above. Unless it is a large quantity, the child generally incurs little, if any, tax liability, and the earnings in the retirement plan are tax deferred. In the case of zero-coupon, corporate, or municipal securities, there is a somewhat higher level of credit risk. On a 20-year bond, the investor receives nothing until the maturity date, and if the issuer is insolvent at that time, the investor has received nothing during the entire 20 years. However, no credit risk exists in the case of zero-coupon treasuries, known as stripes for separate trading of registered interest and principal of securities, because the risk of default on a U.S. government security, at least for purposes of this exam, is non-existent. The major attraction of this type of investment is that it allows an investor to lock in a yield or rate of return for a predetermined, investor-selected time with no reinvestment risk. Because all zeros are sold at a discount and have no current return, there is a great deal of price volatility. This point will be reviewed again later in Unit 20 in the discussion on duration. Callable bonds. Most of the questions on the exam dealing with early payback of principal are about callable bonds. Bonds can be either callable or non-callable. The call feature permits the issuer to redeem its bonds, pay off the principal, before maturity if it so desires. The call feature is most often exercised when interest rates, borrowing costs, have declined. In this case, the issuer could take advantage of the lower cost of borrowing by issuing new bonds at the lower rate prevailing in the market and using those proceeds to call in the old bonds with their higher coupons. This is similar to refinancing a home mortgage, but in this business, we use the term refunding. In most cases, especially when the call takes place many years before the maturity date, the call price is at a premium to par. An issuer would not be interested in redeeming its bonds when interest rates have gone up and the bond prices have gone down. The cheapest way for the issuer to retire its debt is to buy it in the open market. Much of what we covered in Learning Objective 1C dealing with callable preferred stock applies here. Unless the call date is far in the future, the call price is usually at a premium to par. If the bond is called, the issuer announces the final date to tender, turn in, the bond. After that date, the bond no longer earns interest, and any special rights, such as the ability to convert, next topic, are gone. Call protection. Before purchasing a bond, determine the extent of its call protection. Call protection is the number of years into the issue before the issuer may exercise the call provision. The best call protection a bond may have is if a bond is non-callable. In other words, the issuer cannot call it early, and the investor has the best protection against a call. Practice question. A bond issue that may be retired in advance of maturity at the option of the issuer is said to have A. A callable feature, B. An optional reserve, C. A conversion feature, D. A cumulative feature. The answer is A. A bond that is callable has a provision that the issuer, at its option, may redeem that bond at a specified price known as the call or redemption price. As we will see below, the conversion feature may be exercised by the investor, not the issuer. Convertible debt. As covered in Learning Objective 2D, the exam also deals with debt securities paid off before maturity when investors exercise the convertible feature. Although the term convertible bonds is often used, in reality most are debentures rather than secured debt. For exam purposes, the distinction is not important. In addition to being able to understand and compute the parity price of a convertible security, the exam deals with suitability of this type of investment for advisory clients. It is important to view this as a sort of hybrid security. On the one hand, there is the fixed income security, the convertible. At the same time, there is the connection to the issuer's common stock. That is, once that stock's market price increases above the conversion price, the investor had the opportunity to sell the debt security for a premium over the par value. It is this duality that causes some who practice asset allocation, covered in Unit 21, to consider this an equity investment rather than fixed income. Advantages to investors. Downside protection. The investor is a creditor. If the company's business does not prosper and the stock does not go up or declines in value, the investor becomes, as a debenture holder, a creditor. Interest must be paid semi-annually, and the principal must be repaid at maturity. The investor has assured income as long as the company is solvent and has a bondholder's claim in the event of financial difficulty. Convertibles carry a lower interest rate than non-convertibles because of the added bonus of the convertibility factor. If the underlying common stock declines to a point where the convertibility factor is worth nothing, then the debenture will sell on the basis of its yield alone, like any other debt security. That is why the market price of convertibles tends to be less volatile than the underlying common stock. Upside potential. If the company's business prospers, the underlying stock will increase in market value. Because the bondholder can convert to stock, the market price of the bond will go up parallel to the increase in the common stock price. That can have the effect of mitigating the interest rate risk found in virtually all fixed income investments. A convertible bondholder, therefore, has all the upside potential of the common stockholder with less downside risk. Disadvantages to investors. Among the disadvantages to investors in convertible bonds are that they receive a lower interest rate than a non-convertible debt and, of course, the possibility that the convertible bond may be called away before one is ready to convert. Anti-dilutive protection. One of the concerns of any holder of a convertible security, bond or preferred stock, is protection against the potential dilution resulting from a stock split or a stock dividend. For example, if you owned a bond convertible into 20 shares and the issuer declared a 2-for-1 stock split, in order for you to have the same conversion powers, you would need to be able to convert into 40 shares. If the conversion privilege were expressed as a conversion price, the new price would now be half the former one, allowing you to convert into twice as many new shares. Knowledge Check 2.6. Question 1. If each of the following bonds matures in 10 years and has the same rating, which is the most volatile? A. Zero coupon bond with 6% yield. B. Zero coupon bond with 8% yield. C. Corporate bond priced at par with 6% yield. D. Corporate bond priced at par with 8% yield. The correct answer is A. Zero coupon bonds are more volatile than bonds with coupon payments. The most volatile bonds are the bonds with the lowest yield or coupon rate and the longest time to maturity. Because the bonds have the same maturity, the zero coupon bond with 6% yield will be the most volatile. Question 2. One of your customers is a new parent. The customer wishes to deposit a lump sum into an investment offering a guaranteed return in 18 years, just in time for college. Which of the following bonds maturing in 18 years would offer the greatest safety? A. A corporate zero coupon bond with a AAA rating. B. A municipal zero coupon bond with a AAA rating. C. An unrated treasury strip. D. A high-yield corporate bond. The correct answer is C. Treasury securities are not rated because the backing of the U.S. Treasury implies no default risk. Even with AAA ratings, a lot can happen to a corporation or a municipality in 18 years, making the stripe the best choice for safety. Lesson 2.7. Money Markets and Bank Accounts. Learning Objective 2K. Identify the special characteristics of money market instruments and the risks and benefits of adding them to a client's portfolio. As we will learn when discussing asset allocation programs later in this course, one important asset is cash. Now, we don't mean greenbacks buried in the mattress or the backyard. We're referring to places to keep funds that are in the bank or in securities that are considered to be the same as cash. When it comes to cash equivalents, the exam will include money market instruments with a maturity of up to 1 year. Money markets. The money market may be defined as the market for buying and selling short-term loanable funds in the form of securities and loans. It is called the money market because that is what is traded there, money, not cash. The buyer of a money market instrument is the lender of the money. The seller of a money market instrument is the entity borrowing the money. Although there are many different kinds of money market instruments, there are several common factors. For example, they all have a maturity date of 1 year or less. In fact, the majority of money market instruments mature in less than 6 months. Another factor that many, but not all, money market instruments share is that they are issued at a discount. They do not pay interest because debt securities generally pay interest semi-annually, and because most money market instruments have a maturity of 6 months or less, the administrative costs of paying out interest would be very high. Therefore, the solution is to issue the security at a discount with the investor being paid back par at maturity. The difference between the two is that the investor's income paid for the use of her money. Money market instruments are safe. Although some are not quite as safe as others, for example, commercial paper is not as safe as a treasury bill, they are all considered to be low-risk securities. Treasury securities. Because there is so much treasury debt outstanding, the level of activity in treasury bills and other short-term government issues is by far the highest and most carefully watched. Governments with short terms also refer to U.S. Treasury notes or U.S. Treasury bonds that are in their last year before maturity, because at that time they would trade like any other security with 1 year or less to maturity. Negotiable certificates of deposit, CDs. These CDs are unsecured time deposits. No asset of the bank is pledged as collateral, and the money is being loaned to the bank for a specified period of time. A negotiable CD allows the initial investor or any subsequent owner of the CD to sell the CD in the open market prior to maturity date. The bank that issues the CD redeems the CD at face value plus interest on maturity date. CDs are the only money market instrument that pays periodic interest, usually semi-annually. To be considered a negotiable CD, such CDs must have a face value of $100,000 or more, with $1 million or more being most common. Although maturities can run as long as 10 years, it is those with a maturity of 1 year or less that are considered money market instruments. Take note. In the industry, and sometimes on the exam, negotiable CDs are referred to as jumbo CDs. Although covered by FDIC insurance, these are not the CDs that you purchase at your local bank branch. We'll discuss them shortly. Test topic alert. Negotiable CDs do not have a prepayment penalty. FDIC insurance applies up to $250,000. Jumbo CDs pay interest semi-annually. They are the money market instrument that is always issued at par, not a discount. Commercial paper. Another money market instrument is commercial paper. This is short-term unsecured paper issued by corporations, especially finance companies, primarily to raise working capital, in other words, for current rather than long-term needs. As you saw when we covered securities exemptions in Part 1, commercial paper is exempt from registration on both the federal and state levels as long as the maximum maturity is 270 days. While negotiable CDs are interest-bearing and issued at face amount, commercial paper is generally issued at a discount instead of receiving interest. The investor receives the face amount at maturity. Eurodollars and foreign currency markets. As described in the previous learning objective, the cost of raising money and doing business is not restricted by national boundaries. International monetary factors, such as changes in foreign currency exchange rates, Eurodollars, or other Euro securities, can also affect U.S. money markets and businesses. Example: Euroyen are Japanese yen deposited in banks outside Japan. In other words, when a currency is preceded by the prefix euro, it refers to a bank deposit outside of the currency's home country. Eurodollar time deposits tend to be short-term, ranging from overnight to 180 days. European banks lend Eurodollars to other banks in much the same way that U.S. banks lend federal funds. The interest rate is usually based on the London Interbank Offered Rate, LIBOR. London Interbank Offered Rate, LIBOR. LIBOR, sometimes referred to as the ICE LIBOR, is derived from a survey of banks conducted each day in London, UK, on behalf of the Intercontinental Exchange, ICE. Lenders are asked how much it would cost them to borrow from each other for 15 different periods, from overnight to 1 year, in currencies including dollars, euros, yen, and Swiss francs. Rates are based on actual transactions for which records are kept. After a set number of quotes are excluded, those remaining are averaged and published for each currency by the ICE before noon. Take note. The exam may expect you to know that the LIBOR rate is the world's most widely used benchmark for short-term interest rates. Take note. Scandals in London have raised doubts about the future use of the LIBOR. Alternative measurements have been proposed, and it is likely by late 2022 or so that there will be a new tool. It appears that the final date for the LIBOR will be June 30, 2023. When that happens and the LIBOR is no longer the answer to the questions, our key bank will be updated and the new information will be posted to the content updates. At this time, one of the leading replacement candidates is the SOFR. The Secured Overnight Financing Rate, SOFR, is a broad measure of the cost of borrowing cash overnight collateralized by Treasury securities. If you should see this on your exam, please let us know. Practice question. The LIBOR rate is established on a daily basis in A. Liberia, B. Libya, C. London, D. New York. The answer is C. The LIBOR is the London Interbank Offered Rate. Technically the ICE LIBOR now, and, as shown, the L stands for London, UK. Practice question. A company realizes money from the sale of surplus equipment. It would like to invest this money, but will need it in 4 to 6 months and must take that into consideration when selecting an investment. You would recommend A. Preferred stock, B. Treasury bills, C. AAA rated bonds with long-term maturities, D. Common stock. The answer is B. For this client, the appropriate investment is a money market instrument, and nothing is safer than a T-bill. In summation, why would you place money market securities in a client's portfolio? Highly liquid, very safe, and the best place to store money that will be needed soon. In doing so, the client would be incurring the following risks. Because of their many advantages, the rate of return is quite low, so these are not suitable for long-term investors. Fluctuating income due to short-term maturities, principal is potentially being reinvested at a different rate each time the instrument matures. Bank accounts. As mentioned, when referring to cash as part of one's asset allocation, in addition to cash equivalents in the form of money market instruments, one might keep the proverbial cash in the bank. The term insured will frequently be used on the exam because, at least up to the legal limits, the funds involved are insured by the FDIC. There are several ways this may be done. Demand deposit. This is the legal term for a checking account. It is the favorite repository for funds that will be needed in the very near term. Test topic alert. What we normally refer to as cash in the bank is, in banking terms, known as a demand deposit. To bankers, the term demand deposit refers to a type of account, usually just shown by the initials DDA, held at banks and financial institutions that may be withdrawn at any time by the customer. Historically, the term referred only to checking accounts, but it now commonly includes savings accounts and money market accounts, not money market mutual funds. Those are not banking products. When analyzing a client's financial profile, it should be understood that these are considered short-term funds readily available and provide safe but low returns. Certificates of deposit, CDs, time deposit. In the money market segment a few pages ago, we introduced you to the jumbo, negotiable, redeem it at the bank certificate of deposit available at your local branch or online. These are typically available with a minimum deposit of as little as $500 and maturities of anywhere from 3 months to 5 years. In most cases, withdrawal prior to the maturity date will result in a penalty. Here are some key facts to remember for the exam. If capital preservation is the goal with no risk, the answer is an insured bank CD. Insured bank CDs have no interest rate risk. They don't fluctuate in value as interest rates change. Even with the potential early withdrawal penalty, these are considered liquid assets, but certainly not as liquid as a DDA. There are risks, however. As fixed income investments, they bear purchasing power, inflation risk. Yields tend to be quite low, so they should not be a major portion of a long-term investment. Practice question. One would expect to have checkbook access to a ACMO, B. DDA, C. Ginnie Mae, D. LIBOR. The answer is B. DDA stands for Demand Deposit Account, most often a checking account at a bank. Knowledge Check 2.7. Question 1. Which of the following statements about jumbo CDs is not correct? A. Negotiable CDs do not have a prepayment penalty. B. FDIC insurance applies up to $250,000. C. They are secured by pledged assets of the issuing bank. D. Jumbo CDs pay interest semi-annually. The correct answer is C. The jumbo, negotiable CDs traded in the money market are unsecured debt of the issuer. Question 2. Which of the following have no interest rate risk? A. Negotiable CDs. B. Commercial paper. C. U.S. Treasury bonds. D. Time deposits at your local bank. The correct answer is D. Time deposits, either in the form of a savings account or a certificate of deposit, have no interest rate risk. Because these do not trade in the market, the value is not subject to changes in market interest rates.
Unit 3. Pooled Investments. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 3A. Identify the legal requirements of investment companies. Learning Objective 3 Bits. Compare the method of capitalization and pricing of open-end investment companies and closed-end investment companies. Learning Objective 3C. Contrast the mutual fund share classes and relate them to the different types of loads charged to fund investors. Learning Objective 3. Identify the characteristics of private funds and venture capital funds. Learning Objective 3E. Identify the structure, compensation arrangements, and suitability requirements of a hedge fund. Learning Objective 3. Recall the special features of unit investment trusts. Learning Objective 3 Grams. Identify the distinguishing characteristics of exchange-traded funds, ETFs. Learning Objective 3 Hours. Identify the unique features of real estate investment trusts, REITs. Learning Objective 3I. Explain the benefits and risks of pooled investments in client portfolios. Your exam will include approximately 6 questions from the topics covered in Unit 3. Introduction. In addition to equity and debt, other investments related to stocks and bonds are available to investors. Such investment products include packaged products, such as mutual funds, exchange-traded funds, ETFs, variable contracts of insurance companies, variable annuities and variable life insurance, and real estate investment trusts, REITs. These packaged products are generally referred to as pooled investments because they represent a pool of funds contributed by a number of investors. Lesson 3.1. Investment Companies. Learning Objective 3A. Identify the legal requirements of investment companies. The first of the pooled investment vehicles we'll cover are investment companies. An investment company is a corporation or a trust through which investors may acquire an interest in large diversified portfolios of securities by pooling their funds with other investors' funds. People often invest in investment companies because they believe a professional money manager should be able to outperform the average investor in the market. As with all investments, there are benefits and risks. This unit will close with a discussion of the benefits and risks for most of the pooled investments covered. Investment companies raise capital by selling shares to the public. Investment companies must abide by similar registration and prospectus requirements imposed by the Securities Act of 1933 on most other issuers. Investment companies are also subject to regulations regarding how their shares are sold to the public. The Investment Company Act of 1940 provides for Securities and Exchange Commission, SEC, regulation of investment companies and their activities. Types of investment companies. The Investment Company Act of 1940 classifies investment companies into 3 broad types: face-amount certificate, FAC companies, management investment companies, and unit investment trusts, UITs, which will be covered a bit later in Learning Objective 3F. Face-amount certificate, FAC companies. A face-amount certificate, FAC, is a contract between an investor and an issuer in which the issuer guarantees payment of a stated or fixed sum to the investor at some set date in the future. In return for this future payment, the investor agrees to pay the issuer a set amount of money, either as a lump sum or in periodic installments. Take note. The only fact you need to know about this security is that it is one of the 3 types of investment companies listed in the Investment Company Act of 1940. Management investment companies. The most familiar type of investment company is the management investment company, which actively manages a securities portfolio to achieve a stated investment objective. A management investment company is either closed-end or open-end. Mutual funds are open-end investment companies. Initially, both closed-end and open-end companies sell shares to the public. The difference between them lies in the way they raise capital and how investors buy and sell their shares in the primary or secondary market. Take note. Open-end and closed-end investment companies have far more similarities than differences. One of these is the term net asset value per share, generally shown as NAV. This value is the result of the fund valuing all of its assets, the largest of which is the portfolio, subtracting its liabilities, and then dividing that by the number of shares outstanding. This NAV per share computation is critical to the purchase and sale of open-end companies, and, as we'll soon see, has little relationship to the buying and selling price of closed-end funds. It is important for you to know that the definition of investment company does not include holding companies. Board of Directors. In general, management investment companies, open-end and closed-end, cannot have a board of directors that consists of more than 60% of persons who meet the definition of interested persons of the investment company. Take note. Another way of stating that no more than 60% of the directors may be interested persons is to say that at least 40% must be non-interested, that is, outside directors. These are individuals who have no connection to the fund other than a position on the board, and may be owning some shares of the fund as would any other investor. Typically, outside directors are academics or prominent community members. Prohibited activities. Open-end investment companies are prohibited from engaging in several activities. Mutual funds may not purchase any security on margin, participate on a joint basis in any trading account in securities. An investment company cannot have a joint account with someone else, sell any security short, or acquire more than 3% of the outstanding voting securities of another investment company. Practice huestion. The Investment Company Act of 1940 prohibits registered open-end investment companies from engaging in any of the following practices except A. Issuing common stock, B. Selling short or purchasing securities to the company's portfolio on margin, C. Owning more than 3% of the outstanding voting securities of another investment company, D. Opening a joint account with another investment company. The answer is A. The one thing that all open-end investment companies must do is issue common stock. That is the form of ownership. All of the other activities are prohibited. Take note. Do not confuse the Investment Company Act prohibition against an investment company using margin for portfolio transactions with the Securities and Exchange Act of 1934 Section 11 on. That section, number not tested, states that it is unlawful for a broker-dealer to effect any transaction in connection where, directly or indirectly, he extends or maintains or arranges for the extension or maintenance of credit to, or for a customer on any security that was a part of a new issue in the distribution of which he participated. Because mutual funds are a continuous new issue, they cannot be purchased on margin. However, there is a special exemption for certain investment company securities, held by broker-dealers as collateral in margin accounts. Any securities issued by a registered open-end investment company or unit investment trust shall be exempt from the provisions of Section 11D1 when the broker-dealer extends credit on that security, provided the security has been owned by the person to whom credit would be provided for more than 30 days. More on this in Unit 23. Changes in investment policy. In order for an investment company's board to make fundamental investment policy changes, a majority vote of the outstanding voting stock is required. Examples of fundamental changes would include a change in subclassification, such as from an open-end to a closed-end company, or from a diversified to a non-diversified company. Deviation from any fundamental policy in its registration statement, including a change in investment objective, and changing the nature of its business so as to cease to be an investment company. In other words, because the investment company is supposed to function for the benefit of the shareholders, any of these changes would require the vote of a majority of the shareholders. Size of investment companies. No registered investment company is permitted to make a public offering of securities unless it has a net worth of at least $100,000. Investment advisory and underwriter contracts. A majority vote of the shareholders is required to approve the contract between the investment company and its investment advisor, and the contract with its principal underwriter. These contracts must be in writing and provide that the contract precisely describes all compensation to be paid, will be approved at least annually by the board of directors or by majority vote of the shareholders if it is to be renewed after the first 2 years, and may be terminated at any time, without penalty, by the board of directors or by majority vote of the shareholders on not more than 60 days written notice to the investment advisor. In addition, it is unlawful for any registered investment company to enter into or renew any contract with an investment advisor or principal underwriter, unless the terms have been approved by majority vote of directors, who are not parties to such contract as affiliated persons, I. Directors who are not affiliated with the advisor or the underwriter, and who in the aggregate must comprise at least 40% of the directors. Take note, the effect of this final paragraph is that no advisory contract, whether initial or renewal, may take effect without approval of the non-interested members of the board. Transactions of certain affiliated persons and underwriters. Those individuals who are affiliated with the investment company or its underwriter have certain restrictions when it comes to dealing with the fund. These individuals cannot sell any personally owned security to the fund, except redeeming personally owned shares of the fund, like any other investor. Borrow money from the fund, or purchase from that investment company any security other than the fund's shares. TST2PIST aliard. An affiliated person is defined as any person directly or indirectly owning, controlling, or holding, with power to vote, 5% or more of the outstanding shares of the investment company. An affiliated person also includes any person directly or indirectly controlling, controlled by, or under common control with the investment company, or any officer, director, partner, or employee of the investment company. However, while technically considered an affiliated person, no person is deemed to be an interested person for purposes of the maximum percentage of interested persons on the board solely by reason of being a member of the fund's board of directors or an owner of its securities. A person is deemed to be a control person when owning or controlling more than 25% of the outstanding shares. Custodian. Every registered investment company is required to keep its assets with a custodian. In the majority of cases, that custodian is a bank, hence the common use of the term custodian bank. Although the Act specifies certain financial requirements for that bank, it does not require that the bank have FDIC coverage. Alternatively, the investment company may use a broker-dealer that is a member firm of a national securities exchange. Redemption of shares of mutual funds. Upon request of the investor, the Investment Company Act of 1940 requires that the proceeds be sent in no more than 7 days. The investor receives the next computed NAV per share using the forward pricing principle, described at Learning Objective 3C. Periodic and other reports. All investment companies must file annual financial reports with the SEC. These reports contain an audited balance sheet and income statement. In addition, shareholders must be sent financial information semi-annually. Knowing what is prohibited and what is required is often tested on the exam. Here is an example expressing ideas that are likely to be tested. Practice question. A BC is an FINRA member broker-dealer. Among other functions, it serves as the principal underwriter of the XYZ mutual fund. Which of the following transactions of ABC would be prohibited? A. ABC tenders, from its investment account, 500 shares of the XYZ mutual fund for redemption. B. A BC purchases, for its investment account, 500 shares of XYZ mutual fund. C. A BC purchases some securities directly from XYZ's portfolio. D. All of these. The answer to C. It would be a violation of the Investment Company Act of 1940 for any affiliated person, such as the principal underwriter, to purchase any security from an investment company, other than shares of the fund itself. Investing in the fund's shares would be permitted, not prohibited. Knowledge Check 3.1. Question 1. Which of the following statements correctly expresses requirements under the Investment Company Act of 1940? Roman numeral 1. A registered open-end investment company using a bank as custodian must choose one that has FDIC coverage. Roman numeral 2. If an affiliated person of a registered investment company wishes to borrow money from the fund, there must be at least 300% asset coverage. Roman numeral 3. No investment advisory contract may be entered into that does not provide for termination with no more than 60 days' notice in writing. Roman numeral 4. No registered investment company may acquire more than 3% of the shares of another investment company. A. 1 and 2. B. 1 and 4. C. 2 and 3. D. 3 and 4. The answer is D. The Investment Company Act of 1940 requires that all advisory contracts contain a provision that the contract may be terminated upon no more than 60 days' notice in writing, choice II. The Act prohibits any registered investment company from owning more than 3% of the shares of another investment company, choice IV, making choice D the correct answer. There are no circumstances under which an affiliated person can borrow from the fund, and it is not a requirement that the custodian bank have FDIC insurance. Question 2. As described in the Investment Company Act of 1940, the term management investment company would include A. Face amount certificate companies, unit investment trusts, and open-end and closed-end investment companies. B. Unit investment trusts and open-end and closed-end investment companies. C. Open-end and closed-end investment companies. D. Growth funds and income funds. The answer to C. The Act describes 3 kinds of investment companies: Equities, UITs, and management companies. Management companies are divided into 2 types, open-end and closed-end. The definition in the Act does not list different objectives, such as growth and income. Lesson 3.2. Pricing of Fund Shares. Learning Objective 3 bits. Compare the method of capitalization and pricing of open-end investment companies and closed-end investment companies. Open-end investment companies' initial capitalization. An open-end investment company or mutual fund does not specify the exact number of shares it intends to issue. It registers an open offering with the SEC. The open-end investment company can raise an unlimited amount of investment capital by continuously issuing new shares. As a consequence, investors in mutual funds are always purchasing a new issue, a primary offering with the money going to the issuer, the mutual fund. One other point is that open-end companies can only issue common stock. The money raised from the issuance of that common stock is then used by the portfolio managers to invest in securities meeting that fund's objectives. For example, a mutual fund seeking income would likely invest a substantial portion of its capital into bonds and or preferred stock. Don't confuse the limitation on only issuing common stock to raise capital with what it can invest with that capital. Bond funds will use the proceeds from the sale of the common shares issued to buy bonds. Practice question. An investor is always purchasing newly issued shares of common stock when investing in A. a closed-end investment company, B. an open-end investment company, mutual fund, C. a unit investment trust, UIT, D. a holding company. The answer is B. A unique characteristic of mutual funds is that they are capitalized by a continuous offering of new shares. Whenever an investor adds to her portfolio, she is buying new shares of common stock issued by that fund. In a UIT, the investor is purchasing units, not shares. Test topic alert. Because mutual funds are a continuous new offering, the prospectus must be distributed to a prospective investor before or during any solicitation for sale. Closed-end investment companies' initial capitalization. As we stated, the primary difference between the 2 categories of management companies, closed-end and open-end, is the way in which they raise capital and subsequently trade. To raise capital, a closed-end investment company conducts a common stock offering. For the initial offering, the company registers a fixed number of shares with the SEC and offers them to the public for a limited time through an underwriting group in a manner the same as any corporate stock offering. The fund's capitalization is fixed unless an additional public offering is made at a later time. Closed-end investment companies can also issue bonds and preferred stock. Therefore, the capital structure of a closed-end company can resemble that of any other corporation: common stock, preferred stock, and bonds. Pricing of closed-end investment company shares. Closed-end investment companies are commonly known as publicly traded funds. After the stock is distributed, anyone can buy or sell shares in the secondary market, either on an exchange or over the counter, OTC. Supply and demand determine the bid price, price at which an investor can sell, and the ask price, price at which an investor can buy. Closed-end fund shares usually trade at a premium or discount to the share's net asset value, NAV. Test topic alert. Please remember the following points. Closed-end investment companies trade based upon supply and demand for their shares. As a result, their buying and selling price does not have a direct relationship to the NAV of the shares. But another way, the market price of a closed-end fund is independent of the fund's NAV. Country funds are funds that concentrate their investments in the securities of companies domiciled in foreign countries. Well-known examples are the Korea Fund, the New Germany Fund, and the Mexico Fund. These country funds are generally organized as closed-end, rather than open-end companies, because it is often difficult to liquidate foreign securities to get their value into the United States. Pricing of open-end investment company shares. When it comes to open-end investment companies, mutual funds, any person who wants to invest in the company buys shares directly from the company or its underwriters, or a broker-dealer with a selling agreement, at the public offering price, POP. A mutual fund SPOP is the net asset value per share, NAV, plus any applicable sales charges. A mutual fund's net assets are calculated daily by deducting the fund's liabilities from its total assets. NAV per share is calculated by dividing the fund's net assets by the number of shares outstanding. An open-end investment company sells redeemable securities. When an investor sells shares, the company redeems them at their NAV. For each share an investor redeems, the company sends the investor money for the investor's proportionate share of the company's net assets. Therefore, a mutual fund's capital shrinks when investors redeem shares. Each investor's share in the fund's performance is based on the number of shares owned. Mutual fund shares may be purchased in either full or fractional units, unlike stock, which may be purchased in full units only. Because mutual fund shares can be fractional, the investor can think in terms of dollars rather than number of shares owned. Because closed-end funds trade like any other corporate stock, fractional shares are not available. Chart of open and closed-end fund features. Capitalization. Open-end, unlimited, continuous offering of shares. Closed-end, fixed, single offering of shares. Issues. Open-end, common stock only, no debt securities. Closed-end, may issue common stock, preferred stock, debt securities. Shares. Open-end, full or fractional. Closed-end, full only. Offering and trading. Open-end, sold and redeemed by fund only. Continuous primary offering, must redeem shares. Closed-end, initial primary offering, secondary trading OTC or on an exchange, does not redeem shares. Pricing. Open-end, NAV plus sales charge. Selling price determined by formula in the prospectus. The price can never be below the NAV. Closed-end, current market value plus commission. Price determined by supply and demand, so it can be above, below, or the same as the NAV. Aliard. We said earlier that closed-end funds also compute NAV. However, because their price is determined by supply and demand, and, as a consequence, may be more than, the same as, or less than the NAV does not have the relevance that it does with open-end funds. Therefore, instead of daily computation, it is generally only done once per week. Forward pricing. Open-end investment companies, mutual funds, must compute their net asset value NAV per share at least once per day. Very few compute more than that, as of the close of the markets, generally 4 p.m. Eastern Time. Price determination for purchases and sales is based on the forward pricing principle. That is, whenever an order, whether to purchase or redeem shares, is received, the price is based on the next computed NAV per share. For example, any order received and time-stamped prior to 4 p.m. Eastern Time will be executed at the price computed as of that day's market close. If the order is received at 4 p.m. or later, it will be executed based on the NAV computed as of 4 p.m. the next business day. Example. If Navco mutual fund shares are $15 per share, a $100 investment buys 6.667 shares. $100 divided by $15 equals 6.667. An investment company's portfolio is elastic. Money is simultaneously invested into the fund and paid out when shares are redeemed. The mutual fund portfolio's value and holdings fluctuate as money is invested or shares are redeemed, and as the value of the securities held by the portfolio rises and falls. The investor's account value fluctuates proportionately with the mutual fund portfolio's value. Practice question. Daniela has a number of investment company products within her retirement portfolio. One of these investments trades on an exchange and may trade at a premium or discount to its net asset value. These features are most likely found in what type of investment? A. Closed-end investment company. B. Unit investment trust. C. Open-end investment company. D. Face amounts certificate company. The answer is A. A closed-end investment company, closed-end fund, or CEF, is a type of investment company whose shares trade in the secondary market. It is critical to remember for the exam that the price of the shares of a closed-end company is based on supply and demand, and therefore can sell at above or below the fund's net asset value. Learning Objective 3C. Contrast the mutual fund share classes and relate them to the different types of loads charged to fund investors. Open-end funds. FINRA prohibits its members who underwrite fund shares from assessing sales charges in excess of 8.5% of the POP on the purchase of open-end investment company shares. The actual schedule of sales charges is specified in the prospectus. Sales loads, management fees, and operating expenses reduce an investor's returns because they diminish the amount of money invested in a fund. Historically, mutual funds have charged front-end loads of up to 8.5% of the money invested, public offering price. Alternatively, funds may charge a back-end load when funds are withdrawn. Some funds charge ongoing fees under Section 12B, one of the Investment Company Act of 1940. These funds deduct annual fees to pay for marketing and distribution costs. A fund's expense ratio expresses the management fees and operating expenses as a percentage of the fund's net assets. All mutual funds, load and no load, have expense ratios. The expense ratio is calculated by dividing annual operating expenses by the average dollar value of the fund's assets under management. The sales charge is not considered an expense when calculating a fund's expense ratio. Example: an expense ratio of 1.72% means that the fund spends $1.72 per year for every $100 of invested assets. Typically, more aggressive funds have higher expense ratios. Example: an aggressive growth fund's expense ratio is usually higher than that of a fund invested in AAA-rated bonds because more trading occurs in the growth fund's portfolio. All sales commissions are paid from the sales charges collected. Sales charges include commissions for the managing underwriter and broker-dealers and their agents who sell the fund, as well as all expenses incurred in communications with the public. The sales charge of a mutual fund is stated as a percentage of the public offering price, POP, per share. Mutual fund distributors use 3 different methods to collect the fees for the sale of shares. Front-end loads, difference between POP and net NAV. Back-end loads, contingent deferred sales loads. 12B1 fees, asset-based fees, technically not a sales charge, but may be referred to as an asset-based sales charge on the exam. Sales loads, front-end loads. Front-end sales loads are reflected in a fund's public offering price. The charges are added to the NAV at the time an investor buys shares. They are frequently referred to as Class A shares and have lower operating expense ratios than other classes. Back-end loads. A back-end sales load, also called a contingent deferred sales charge or load, CDSC, is charged at the time an investor redeems mutual fund shares. The sales load, a declining percentage charge that is reduced annually, for instance, 8% the first year, 7% the second, 6% the third, and so forth, is applied to the proceeds of any shares sold in that year. The back-end load is usually structured so that it drops to 0 after 6 to 8 years, at which time the shares are converted to Class A with their lower operating expense ratios. They are frequently referred to as Class B shares. 12B1 asset-based fees. Mutual funds cannot act as distributors for their own fund shares except under Section 12B, one of the Investment Company Act of 1940. This provision permits a mutual fund to collect a fee for promotion or sales-related activities in connection with the distribution of its shares. The fee is determined as a percentage of the fund's average net assets during the year. The fee is disclosed in the fund's prospectus. The percentage of net assets charged must be reasonable, typically 0.5% of net assets. This annual fee cannot exceed 0.75% of net assets, and the fee must reflect the anticipated level of distribution services. If the fee exceeds 0.25%, the fund cannot use the term no load, no front-end or back-end load. In order to charge a 12B1 fee, there are several specific requirements in the law. There must be a written plan, and this written plan must meet the following requirements. The plan has been approved initially by a vote of at least a majority of the outstanding voting securities of the investment company. The plan, together with any related agreements, has been approved initially and reapproved at least annually by a vote of the board of directors of the company, and of the directors who are not interested persons of the company, the outside directors. The plan may be terminated at any time by a vote of the majority of the members of the board of directors of the company, who are not interested persons of the company, or by a vote of the majority of the shareholders of the company. Test topic alert. The 12B1 fee is used for marketing and distribution purposes only. None of that money is used to pay for the fund's portfolio management. Classes of fund shares. Mutual funds may offer several classes of shares to allow investors to select how they pay the sales charges. The following is a typical method by which firms may classify fund shares by fee type: Class A, B, and C shares. Class A shares, front-end load, investors pay the charge at the time of purchase. Class B shares, back-end load, declines over time so investors pay the charge at redemption. Class C shares, level load, no sales charge to purchase, generally a 1% CDST for 1 year, with a continuous 12B1 charge. The class of shares determines the type of sales charge as well as operating expenses, with Class A having lower costs, usually a low or no 12B1 fee, than Class B and Class C shares. All other rights associated with mutual fund ownership remain the same across each class. Take note. The authors of test questions are generally slow to react to industry developments. For example, this is what FINRA says about Class C shares. Class C shares typically impose higher asset-based sales charges than Class A shares, and because their shares generally do not convert into Class A shares, their asset-based sales charge will not be reduced over time. Those asset-based sales charges are the 12B1 fees. In recent years, there has been a growing trend for mutual fund sponsors to provide for conversion of C shares to A shares in a manner similar to B shares. The difference is that the time for conversion is generally 8 to 10 years, rather than the 6 to 8 years for Class B conversion to Class A shares. Until this becomes the industry standard for test purposes, Class C shares do not convert to Class A shares. Take note. In recent years, a number of other share classes have emerged, covering virtually the entire alphabet. As of the printing of this text, the only ones we are aware of possibly appearing on the exam are Class I shares, which would be sold only to institutional investors, hence the letter I, and usually have lower fees and expenses. Class R shares, which would be sold only to participants in retirement plans, such as a 401k, and have no front-end or back-end load, but may have a 12B1 fee that is lower than Class B and Class C shares, but higher than Class A shares. Reductions in sales charges. There are two ways that an investor can take advantage of reduced sales charges available on Class A shares for larger purchases. Breakpoints, a scale of declining sales charges based on the amount invested. Rights of accumulation permits an investor to aggregate shares owned in related accounts in some or all funds in the fund family to reach a breakpoint discount with no time limit. Breakpoints. The schedule of discounts in mutual fund offers is called the fund's breakpoints. Breakpoints are available to any person. For a breakpoint qualification, the term any person includes married couples, parents and their minor children, and corporations. Investment clubs or associations formed for the purpose of investing do not qualify for breakpoints. Sample breakpoint schedule. Purchase amount $0 through $24,999. Sales charge 6.5%. Purchase amount $25,000 through $49,999. Sales charge 5.5%. Purchase amount $50,000 through $99,999. Sales charge 5%. Purchase amount $100,000 through $249,999. Sales charge 3%. Purchase amount $250,000 through $499,999. Sales charge 2%. Purchase amount $500,000 through $999,999. Sales charge 1%. Purchase amount $1 million or more. Sales charge 0%. Breakpoint sales. Both state and federal regulators prohibit registered personnel from making higher commissions by selling investment company shares in a dollar amount just below the point at which the sales charge is reduced. This is known as a breakpoint sale, and this practice is considered contrary to just and equitable principles of trade. For example, using the above chart, if an order for $24,000 was taken without indicating to the investor that an additional $1,000 would save $250 in sales charges, 1% reduction on $25,000, it would likely be considered a violation. Take note. Although not specifically listed as a violation, regulators scrutinize large purchases of Class B shares. A purchase large enough to reach a significant Class A share breakpoint results in a low enough sales charge that, in just a few years, the lower operating expenses of the Class A shares will more than make up the difference in front-end cost. In practice, very few firms will accept an order for Class B shares in excess of $100,000, particularly if the investor intends to maintain the position for a number of years. Letter of intent, (LOI). A person who plans to invest more money with the same mutual fund company may decrease overall sales charges by signing a letter of intent, LOI. In the LOI, the investor informs the investment company that he intends to invest the additional funds necessary to reach the breakpoint within 13 months. The LOI is a one-sided contract binding on the fund only. The customer must complete the intended investment to qualify for the reduced sales charge. The fund holds the extra shares purchased as a result of the reduced sales charge in escrow. If the customer deposits sufficient money to complete the LOI, he receives the escrowed shares. Appreciation and reinvested dividends do not count toward the LOI. Example: using the sample breakpoint schedule displayed above, a customer investing $20,000 is under the $25,000 breakpoint. The customer might sign a letter of intent, promising an amount that will qualify for the breakpoint within 13 months from the date of the letter. An additional $5,000 invested in the fund within 13 months qualifies the customer for the reduced sales charge. Each deposit is charged the reduced sales charge at the time of purchase. If the customer has not completed the investment within 13 months, he will be given the choice of sending a check for the difference in sales charges or cashing in escrowed shares to pay the difference. A fund often permits a customer to sign an LOI as late as 90 days after an initial purchase. The LOI may be backdated by up to 90 days to include prior purchases, but may not cover more than 13 months in total. This means that if the customer signs the LOI after 60 days, he has 11 months to complete the letter. Rights of accumulation. Rights of accumulation allow an investor to combine previous investments in the fund with today's investment to determine today's sales charge. The primary ways in which rights of accumulation differ from a letter of intent are available for subsequent investments. The reduced sales charges will not apply to initial transactions. Do not require making a specific commitment for future investment. Allow the investor to use prior share appreciation to qualify for breakpoints, and do not impose time limits. The customer may qualify for reduced charges when the total value of shares previously purchased and shares currently being purchased exceed a specific breakpoint amount. For the purpose of qualifying customers for rights of accumulation, the mutual fund bases the quantity of securities owned on the higher of current NAV or the total of purchases made to date. Referring back to the sample breakpoint schedule, once an investor accumulates $100,000 in the fund by the greater of dollar amount of purchases or current value at NAV, each additional investment, no matter how small and with no time limit, qualifies for the breakpoint sales charge, in this case, 3%. Example: when discussing investment companies, the term sales load most commonly refers to A, the fund's sales charge, expressed as a percentage of the NAV. B, the fund's sales charge, expressed as a percentage of the public offering price. C, the commission earned by the broker-dealer making the sale. D, the 12b-1 fee. The answer is B. Class shares of an open-end investment company, mutual fund, have a front-end sales charge or sales load, which is computed as a percentage of the public offering price. That is, if the fund's POP is $10 and the NAV is $9.50, the 50-cent sales charge is 5% of the $10 offering price. In general, the majority of the sales load is paid to the broker-dealer making the sale as compensation. The 12b-1 fee is never referred to as a sales load because it is not related to the sale of shares. However, you will see the phrase asset-based sales charge. Practice question. Barbara wishes to invest in the KAPCO Growth Fund, an open-end investment company. She expects to hold the shares for at least 10 years. If she purchases KAPCO's class of shares, each of these would be a way for her to receive a reduction on the sales charge except A, a single investment that reaches a breakpoint. B, joining together with her sister to make a purchase at a breakpoint level. C, signing a letter of intent. D, benefiting from the right of accumulation. The answer is B. Reaching a breakpoint is the way in which investors can receive a break on the sales load charged when purchasing class of shares. Purchases may be combined with spouses and dependent children, but not other family members such as siblings, making the exception here. The three ways to reach a breakpoint are a lump sum purchase, using a letter of intent granting 13 months to reach the breakpoint, or taking advantage of rights of accumulation, no time limit. Knowledge check 3.2. Question 1. Which of the following types of investment company is permitted to capitalize with common stock and preferred stock? A, a balance fund. B, a unit investment trust. C, an open-end investment company. D, A closed-end investment company. The answer is D. One of the unique characteristics of closed-end companies, CESs, is that they can issue common stock, preferred stock, and debt securities. Note that this question is not asking about the portfolio contents. It is asking about the kinds of securities the company can issue to raise capital. Question 2. The GMCO Growth Fund, an open-end investment company, calculates its net asset value per share to be $9.15. Orders that were received prior to the cutoff time are executed at a public offering price of $10 per share. From this information, you know that the sales charge is A. 8.5%, B. 9.3%, C. in excess of the permitted maximum, D. based on the net asset value per share. The answer is A. The sales charge of a mutual fund is based on the public offering price, POP, not the NAV. In this case, it is the 85 cents difference between the POP and the NAV, $10 minus $9.15, divided by the POP of $10. That means the sales charge is 8.5%, the maximum allowable. Lesson 3.3, Private Funds. Learning Objective 3. Identify the characteristics of private funds and venture capital funds. Private funds, generally referred to as private equity funds, limit their ownership so as not to be considered investment companies. As long as there are no more than 100 investors, the law does not consider these investment companies requiring registration, that is the 3C1 fund exemption. There is another exemption without a limit on the number of investors. However, for this exemption, the 3C7 exemption, all investors must be qualified purchasers. Qualified purchasers are individuals with at least $5 million in investments or business entities with at least $25 million in investments. Most private funds are organized as partnerships rather than corporations. One special kind of private fund is the hedge fund, which will be covered shortly. One difference between hedge funds and other private funds is the anticipated holding period of the investments. Hedge funds tend to take a more active trading role where their positions are traded actively over a short time period. Conversely, private funds generally hold their investments for the long run. Private funds can be separated into two different categories: those that make direct investments and those that make portfolio investments. What is the difference? In the first case, the funds have a 10% or greater voting interest in an operating company, one that is actually in operation, with the goal of influencing management and operations. In the latter case, the fund does not acquire a control position and builds a portfolio that may be stocks, bonds, derivatives, or any combination of these. One specific type of private fund that is becoming increasingly more popular is the private liquidity fund. Private liquidity funds are defined by the SEC as any private fund that seeks to generate income by investing in a portfolio of short-term obligations in order to maintain a stable net asset value, NAV, per unit or minimize principal volatility for investors. If that sounds like a money market mutual fund, MMF, it should. In 2014, a number of restrictions, such as requiring a floating NAV, probably not tested, were placed on certain money market funds. In order to avoid those, the industry developed these private funds, which, being exempt from SEC registration, are also exempt from those restrictions. Because they are unregistered, less information is publicly available about these funds compared to a traditional MMF that reports its holdings on a monthly basis. Venture capital VC funds are also generally organized as limited partnerships, where the investment decisions are made by the general partner with the capital coming from the limited partners. Those LPs can be wealthy individuals, pension and endowment funds, and even hedge funds. VC funds look for young, up-and-coming companies with an expectation of high returns in exchange for the high risk. Unlike private equity funds, it is more typical that venture capital fund investments are made in businesses that are not yet fully operational. The funding, and sometimes management guidance, provided has the goal of developing an exit strategy in 10 years or less. One common characteristic of private equity and venture capital funds is the compensation to the fund manager. Typically, the annual management fee is 2% of committed capital, plus 20% of the profits when the business is sold. This is usually referred to as the carried interest. Practice question. One of your friends is an entrepreneur who is looking for a way to raise capital for her fledgling business. Because the enterprise has no operating history, it is most likely that her best bet would be to approach A. a hedge fund, B. a mutual fund, C. a private equity fund, D. a venture capital fund. The answer is D. When a business is in the pre-operating stage, it is of most interest to venture capitalists. Private equity funds, including hedge funds, invariably invest in going concerns, and mutual funds are almost always limited to purchasing securities that are marketable. Learning Objective 3E: Identify the structure, compensation arrangements, and suitability requirements of a hedge fund. Hedge funds. Hedge funds are a form of fund generally organized as a limited partnership with no more than 100 investors that does not have to register with the SEC, although the portfolio managers generally are required to register as investment advisors. Because there is no registration requirement, one of the differences between a mutual fund and a hedge fund is the hedge fund's lack of transparency. A mutual fund is offered via a prospectus filed with the SEC, while a hedge fund's prospectus is generally referred to as a private placement memorandum, containing significantly less information. Hedge funds are free to adopt far riskier investment policies than those permitted to open-end and closed-end funds, such as arbitrage strategies and massive short positions during bearish markets. In addition, they may use leverage, borrowed money, and derivatives such as options and futures. Even though these risky techniques are employed, the primary aim of most hedge funds is to reduce volatility and risk, while attempting to preserve capital and deliver positive returns under all market conditions. Another important factor is that management fees tend to be much higher than with other investments. Almost all hedge funds charge performance-based fees. The typical fee structure is known by the vernacular 2 and 20. Most funds take a 2% management fee and 20% of any profits. Fund compensation agreements may also contain a hurdle rate, where the incentive fee will only be paid if the fund return exceeds a set threshold return, for example, 4%. Many hedge funds also require that investors maintain the investment for a minimum length of time, for example 1 year, and to that extent, they can be considered illiquid. These requirements are known as lockup provisions. This provision provides that, during a certain initial period, an investor may not make a withdrawal from the fund the investor's capital is locked up. Generally recognized as one way the manager of the hedge fund portfolio can have capital retained in the fund, it is also seen to be another factor, adding to the unique risk of hedge funds in this case, shares being illiquid for that specified length of time. Therefore, because of the higher risk, investment in these vehicles is limited to institutional clients and wealthy individuals, known as accredited investors, defined in Unit 8. Test Topic Alert. Hedge funds have very high initial investment minimums, although there are some that will accept as little as $25,000, and more that will take $100,000. The general minimum ranges from $500,000 to $1 million. We've seen some with a minimum of $25 million. The exam will want you to know that the high minimum is a reason why these funds are suitable for only a small percentage of investors. Test Topic Alert. Most hedge funds are organized as limited partnerships, with the portfolio managers investing along with the investors. As they say in the industry, they have skin in the game, so they have a greater motivation to succeed. The partnership is the issuer of the ownership units. Practice question. Which type of investment company is most often organized as a limited partnership? A. Face amount certificate company. B. Exchange traded fund. C. Hedge fund. D. Unit investment trust. The answer is C. For various legal reasons, mostly related to the need to avoid registration with the SEC, hedge funds are generally structured as limited partnership entities, with the organizers invariably sinking their own funds into a few units. Fund of hedge funds. With minimum purchase requirements as low as $2,500, hedge funds are indirectly available to ordinary investors through funds of hedge funds. This offers the investor diversification because the fund of funds, FOF, will contain several different hedge funds. Because hedge funds themselves have limited liquidity, purchasing a FOF does not add significant liquidity for the investor. The 7-day redemption requirement is waived for these funds. Furthermore, in addition to the fees charged by the hedge funds in the portfolio, the FOF has expenses as well. Practice question. You may be required to know what hedge funds and mutual funds have in common. Which of the following would you choose? A. A high degree of transparency. B. Relatively low management costs. C. A pooled investment with other investors. D. High liquidity. The answer is C. From what we've covered, you should have seen that hedge funds do not offer the transparency of mutual funds. The key to getting that point is that they are not registered with the SEC, so the disclosures that must be made are limited. The management fees for hedge funds are much higher than mutual funds, and due to the lockup period, their liquidity is questionable. However, the common characteristic is that they are pooled investments. Knowledge check 3.3. Question 1. Which of the following would be most likely to invest in a company based on an idea rather than actual operating results? A. An aggressive mutual fund. B. A hedge fund. C. A private equity fund. D. A venture capital fund. The answer is D. It is the venture capital fund that tends to invest in startups before operations have begun. That is what venture funding is all about. Private equity tends to come in a bit later, when it can offer additional funding and management expertise. With rare exceptions, mutual funds do not invest in companies that are not publicly traded. It is possible a hedge fund might take a chance on a company like this, but it would be out of the ordinary. Question 2. The most common structure of a hedge fund is A. A closed-end investment management company. B. A corporation. C. An open-end investment management company. D. A partnership. The answer is D. For a number of reasons, mostly legal hedge funds are most commonly structured as partnerships. Lesson 3.4. Other pooled investments. Learning Objective 3. Recall the special features of unit investment trusts. Unit investment trusts, UITs. The third of the entities meeting the definition of an investment company under the Investment Company Act is the unit investment trust. A unit investment trust, UIT, is an unmanaged investment company organized under a trust indenture, UITs. Do not have boards of directors, do not employ an investment advisor, and do not actively manage their own portfolios, trade securities. A unit investment trust issues only redeemable securities, known as units or shares of beneficial interest, each of which represents an undivided interest in a portfolio of specified securities. The trustees use the investor's money to purchase securities designed to meet the UIT's stated objective. Without an investment advisor, management, once compiled, the portfolio remains fixed. An example of a UIT is one solely invested in municipal bonds where the trust liquidates after the final bond in the portfolio matures. There are also equity trusts where, because stock doesn't mature, the portfolio is liquidated at a predetermined date and the proceeds distributed to unit holders or reinvested into a new trust at the investor's option. Under the Investment Company Act of 1940, the trustees must maintain secondary markets in the units, thus allowing unit holders the ability to redeem their units at net asset value (NAV). Some exchange-traded funds, ETFs covered later in this unit, are organized as UITs in trade, as the name implies, on exchanges or NASDAQ. Take note. Know the following features of UITs. UITs are not actively managed. There is no board of directors, BOD, or investment advisor. UIT shares, units, must be redeemed by the trust. UITs are investment companies as defined under the Investment Company Act of 1940. Practice question. Lewis owns an investment that is an unmanaged portfolio, in which the money manager initially selects the securities to be included in the portfolio, and then holds those securities until they mature or the investment portfolio terminates. This statement best describes which type of investment? A. Closed-end investment company. B. Face amount certificate company. C. Open-end investment company. D. Unit investment trust. The answer is D. A unit investment trust, UIT, is a type of investment company which is generally unmanaged, as the money manager initially selects the securities to be included in the portfolio and then holds those securities until they mature or the UIT terminates. Learning Objective 3 grams. Identify the distinguishing characteristics of exchange-traded funds, ETFs. An exchange-traded fund, ETF, registers with the SEC under the Investment Company Act of 1940 either as a unit investment trust, a UIT ETF, or as an open-end management company, an open-end ETF. This type of fund generally invests in a specific index, such as the S&P 500. Any class of assets that has a published index around it and is liquid can be made into an ETF, so that there are ETFs for real estate and commodities as well as stocks and bonds. In this way, an ETF is similar to an index mutual fund. The difference is that the ETF trades like a stock on an exchange or NASDAQ, and in this way is similar to a closed-end investment company. The investor can take advantage of price changes that are due to the market, rather than just the underlying value of the stocks in the portfolio. Take note. Although, as stated, most ETFs are passive in that they are based on some index in recent years, there has been a growth in actively managed ETFs where, instead of attempting to mirror an index, the managers select individual assets based on expected performance. This concept will make more sense after you read Unit 21, which explains passive and active portfolio management styles. ETFs can be purchased on margin and sold short, covered in Unit 23, just like any other listed stock. This is another difference between ETFs and mutual funds. ETF expenses tend to be lower than those of mutual funds as well, because all the advisor has to do is match up to the specified index, so the fees are minimal. In addition, there can be tax advantages to owning ETFs. However, because there are brokerage commissions on each trade in and out, ETFs are generally not competitive with a no-load index fund for the small investor, making regular periodic investments, such as in a dollar cost averaging plan described in Unit 21. Take note. There are now some U.S.-listed ETFs available for commission-free trading on certain select platforms. These are typically proprietary funds. These products can be bought and sold without traditional brokerage commissions for investors with certain accounts and are subject to certain restrictions. Obviously, if there are no trading costs, the objection to using them in dollar cost averaging programs is eliminated. For exam purposes, these are the exceptions rather than the rule. Most ETFs are legally classified as open-end companies, although those cannot be referred to as mutual funds because shares are not redeemable, with the rest as unit investment trusts. Unlike the CEF, closed-end fund, where the market price will generally vary quite a bit from the NAV because those prices are determined by supply and demand, there are occasions where persistent small premiums and discounts arise in ETFs, but that is due to a structural inconsistency. Under normal circumstances, the premium and discount that arises between an ETF's NAV and its trading price at the end of the day is the result of late-in-the-day market activity and will narrow at the opening on the following trading day. Practice question. Which of the following is not touted as an advantage to purchasing ETFs instead of index mutual funds? A. Intraday trading. B. Typically lower expense ratios. C. Better general performance than the underlying index. D. Can be purchased on margin. The answer is C. One thing that neither of these products can claim is performance better than the underlying index. Think about it. The index has no management fees. Even though the management fees on index funds are very low, and those on ETFs generally lower than that, there are still expenses making it unlikely that their performance can beat that of the index. The fact that an investor can trade the ETF during the day instead of accepting whatever the next computed price is can be a benefit for those who are trying to time the market. And for those who wish to add the leverage of margin trading, explained more fully in Unit 23, that can only be done with ETFs, not index mutual funds. Learning objective 3 hours. Identify the unique features of real estate investment trusts, REITs. A real estate investment trust, REIT, is a company that manages a portfolio of real estate investments to earn profits and or income for its shareholders. Like many other pooled investment vehicles, REITs offer professional management and diversification. REITs are normally publicly traded and serve as a source of long-term financing for real estate projects. A REIT pools capital in a manner similar to an investment company. Shareholders receive dividends from investment income or capital gains distributions. In most cases, those dividends are taxed at ordinary income rates rather than as qualified dividends. Capital gains distributions are generally taxed at the favorable long-term capital gains rate. Please note that with the advent of the TCJ of 2017, the Tax Cuts and Jobs Act, there are some complex tax issues with REITs, and those are not likely to be tested. REITs normally own commercial property, equity REITs, own mortgages on commercial property, mortgage REITs, or do both, hybrid REITs. REITs are organized as trusts in which investors buy and sell shares either on stock exchanges or in the over-the-counter market. They are not redeemable, as is the case with mutual funds or UITs. REITs enjoy a unique hybrid status for federal income tax purposes. A REIT shareholder generally is taxed only on dividends paid by the REIT and on gains upon the disposition of REIT shares. A REIT is a corporation for U.S. tax purposes, but because it receives a dividends paid deduction, the REIT generally is not subject to corporate tax if it distributes to its shareholders substantially all of its taxable income for each year. How much is substantially all? Under the guidelines of Subchapter M of the Internal Revenue Code, a REIT can avoid being taxed as a corporation by receiving 75% or more of its income from real estate and distributing 90% or more of its taxable income to its shareholders. Take note. There are 3 numbers relating to REITs that might be tested. The REIT must invest at least 75% of its total assets in real estate assets and cash. Derive at least 75% of its gross income from real estate-related sources, including rents from real property and interest on mortgages financing real property, and distribute at least 90% of its taxable income to shareholders annually in the form of dividends. Test topic alert. 4 important points to remember about REITs follow. An owner of REITs holds an undivided interest in a pool of real estate investments. REITs are liquid because they trade on exchanges and over the counter. REITs are not investment companies, mutual funds. REITs offer dividends and gains to investors but do not flow through losses like limited partnerships, and therefore are not considered direct participation programs, DPPs Unit 5. Take note. In recent years, there has been substantial growth in the number of non-traded REITs, limited liquidity. However, for exam purposes, assume the REIT is publicly traded unless the question states otherwise. Knowledge check 3.4. Question 1. Which of the following statements regarding a unit investment trust is not true? A. Overall responsibility for the fund rests with the board of directors. B. It invests according to stated objectives. C. It charges no management fee. D. It is considered an investment company. The answer is A. A unit investment trust has no board of directors, rather it has a board of trustees. A UIT must follow a stated investment objective, as must any investment company, and does not charge a management fee because it is not a managed portfolio. Question 2. An investor wants to invest $200,000 in the banking industry sector. The investor would like to utilize leverage and do this purchase in a margin account. Additionally, she stresses wanting to avoid year-end tax statements showing capital gains liabilities. You would suggest which of the following is suitable given the investor's criteria. A. A bank sector exchange-traded fund, ETF. B. A money market fund holding short-term banknotes. C. Stocks in the 3 largest U.S. banks. D. A bank sector mutual fund. The answer is A. The investor's criteria eliminate mutual funds as being suitable. Mutual funds typically make annual capital gains distributions, for which the owner incurs a tax liability, and mutual funds cannot be purchased on margin. Conversely, an ETF will rarely make a capital gains distribution, and because they trade like all exchange-traded products, they can be purchased on margin, making them more suitable for this investor. Buying only a few select bank stocks is not a good representation of the entire sector. Question 3. One of the characteristics of real estate investment trusts, REITs, is that they generally A. Have a high degree of marketability. B. Reinvest most of their income. C. Offer new shares continually to investors. D. Pay federal income tax on their earnings. The answer is A. Most real estate investments are not readily marketable. Therefore, an investor in real estate can generally expect some difficulty in converting a property to cash if cash is needed quickly. However, a REIT securitizes real estate properties, thereby allowing REIT investors to easily sell REIT shares in the open market. For purposes of the exam, all REITs are publicly traded unless something in the question indicates otherwise. REITs must flow through at least 90% of their income to investors. Therefore, the investors and not the REITs pay tax on these distributions. Lesson 3.5. Benefits and Risks of Pooled Investments. Learning Objective 3I. Explain the benefits and risks of pooled investments in client portfolios. As you have seen, there are many different types of pooled investment vehicles. In general, they all share several important characteristics. Diversification. By pooling assets with many others, investors have the opportunity to own an interest in a far greater number and range of securities than available to almost any individual investor. Professional management. In almost all cases, someone with expertise, we hope, is minding the store. Even in the case of a UIT, where there is no ongoing management, the initial portfolio is constructed by experts. The exam tends to focus on the most popular investments, such as mutual funds, so we will start with those. Mutual funds. What are the benefits of including mutual funds in a client's portfolio? Diversification. The old saying, "Don't put all of your eggs in one basket," certainly applies to the benefits of diversifying one's portfolio assets. Mutual funds are probably the easiest way to accomplish this. Although diversification may help to reduce risk, it will never completely eliminate it. It is possible to lose all or part of your investment. Professional management. Those individuals in charge of managing a mutual funds portfolio must be registered as investment advisors with the SEC. The Investment Company Act of 1940 requires that they follow the stated objectives set forth in the prospectus. Taking into consideration prevailing market conditions and other factors, the mutual fund manager will decide when to buy or sell securities. Rare is the individual who has the time, knowledge, or resources to compete with these professionals. Choice of objectives. Whatever an investor's investment objectives are, there are mutual funds available to match. There are many shades of growth funds, from highly aggressive to very conservative, but all with the goal of growing the investment. The same is true with income funds, where the goal is to generate current income with varying degrees of risk from government bonds to high-yield bonds. If the objective is capital preservation, money market funds fit the bill, and then there are funds that combine objectives, such as growth and income funds. There are even specialized funds, sector funds, that concentrate at least 25% of their portfolio into specific industries or geographic areas, such as a biotech fund or a Southeast Asia fund. Convenience. With most mutual funds, buying and liquidating shares, changing reinvestment options, and get information can be accomplished conveniently by going online at the fund's website, by calling a toll-free phone number, or by mail. Although a fund shareholder is relieved of the day-to-day tasks involved in researching, buying, and selling securities, an investor will still need to evaluate a mutual fund on the basis of investment goals and risk tolerance before making a purchase decision. Investors should always read the prospectus carefully before investing in any mutual fund. Liquidity. The Investment Company Act of 1940 requires that an open-end investment company stand ready to redeem shares at the next computed NAV per share. Payment must be made within 7 days of the redemption request. Minimum initial investment. As mentioned previously, it doesn't take a great deal of wealth to get started investing in funds, and generally, once you are a shareholder, most funds permit additional investments of $100 or even less. Convenient tax information. Tax liabilities for an investor are simplified, because each year the fund distributes a 1099 form explaining taxability of distributions. Combination privilege. A mutual fund company frequently offers more than one fund and refers to these multiple offerings as its family of funds. An investor seeking a reduced sales charge may be allowed to combine separate investments in 2 or more funds within the same family to reach a breakpoint. Example: Joe Smith has invested $15,000 in the AC Growth Fund for retirement and $10,000 in the AC Income Fund for his children's education. The sponsor may view the 2 separate expenditures as one investment totaling $25,000 when calculating the sales charge. This combined dollar amount will generally reach a breakpoint. Exchanges within a family of funds. Many investment companies offer an exchange or conversion privilege within their families of funds. This feature allows an investor to convert an investment in one fund for an equal investment in another fund in the same family at net asset value without incurring an additional sales charge. For example, someone who started investing when in their 30s or 40s by placing their money into an aggressive growth fund might consider moving into something more conservative when they reach their 50s. Once they hit their 60s and 70s, they would want to have a greater percentage of their money in income funds. By staying in the same family of funds and using the exchange or conversion privilege, all of these changes could be made free of sales loads. Test topic alert. Any exchange of funds is considered a sale for tax purposes. Any gains or losses are fully reportable at the time of the exchange. Test topic alert. It is generally agreed that the number one advantage to investing in mutual funds is the diversification offered. By including mutual funds in a client's portfolio, the client would be incurring the following risks. Even with the benefits offered by diversification and professional management, market prices do fluctuate. Equity funds have market risk, whereas bond funds may be subject to interest rate risk. Unlike an individual bond that ultimately repays principal at maturity, a bond fund doesn't have a maturity date. The only mutual fund that generally does not fluctuate in price is the money market fund, but there is a trade-off in lack of growth and low income. Not only that, but the income of a money market fund will vary, unlike that of a bank CD, which is fixed and insured by the FDIC. Fees and expenses. One must carefully analyze all of the costs involved. These include sales charges, 12b1 fees, and possible redemption fees. Management fees, probably the largest expense on an ongoing basis. The investor has no control over the manager's timing of purchases and sales, so tax efficiency could become an issue. Prospectuses will not contain all the costs that affect the net return on the fund. This is why it is important to compare net returns after all expenses, including taxes, to the investor. Other factors: when comparing funds with similar objectives, the investor should review information regarding funds, services offered, costs, taxation, tenure of management, a qualitative rather than quantitative measure. Is the management team unproven or is there a long track record? And performance compared to an appropriate benchmark, see Unit 22. Net redemptions. It can sometimes happen, particularly during declining markets, that there is an excess of shareholder redemptions over new share purchases. This is known as net redemptions. When that occurs, the portfolio manager is put in the difficult position of having to decide which assets to liquidate when prices are falling. A fund suffering with net redemptions is probably not going to deliver your clients the performance they are seeking. Private funds. What are the benefits of including private funds in a client's portfolio? By investing before the company matures enough for a public offering, there is an opportunity for very large profits. Many private funds are structured so as to give the investors a say in the management and development of the company. And diversification, because these usually have a low correlation to the overall market. In doing so, the client would be incurring the following risks. Business risk. A high percentage of startups do not succeed, and the investors lose most or all of their investment. Liquidity risk. There is rarely an opportunity to find a secondary market, and even when the company has a public offering, these investors' shares are likely to be restricted. Lack of transparency. Being unregistered securities, no regulatory body has reviewed the offering documents. Hedge funds. What are the benefits of including hedge funds in a client's portfolio? The design strategy of many hedge funds is to generate positive returns in both rising and falling markets. With a large variety of available investment styles, investors have a plethora of choices to assist them in meeting their objectives. As part of an asset allocation class, hedge funds may reduce overall portfolio risk and volatility and increase returns. A proper selection of hedge funds can create uncorrelated returns, adding a level of diversification. In doing so, the client would be incurring the following risks. Expenses can be quite high. The risky strategies could backfire, leading to significant loss of capital. Liquidity risk. During the lockup period, the investor is locked into the investment. Furthermore, even after that period, there is no active secondary market for these unregistered securities. They are not listed on any exchanges. Finally, as is generally the case with limited partnership investments, the sale of partnership interests may require approval of the general partner. Practice question. Julia, an analyst for a large investment advisory firm, is analyzing various policies utilized by hedge funds recommended by her firm. Julia has summarized the policies as follows. Policy 1. During the fundraising period, each new investor must contribute a minimum of $500,000 to the fund. Policy 2. The hedge fund manager will return incentive fees to investors in the event that the minimum required return is not met. Policy 3. Investors must provide redemption requests to the hedge fund manager at least 60 days before the funds are to be withdrawn. Policy 4. New investors may not withdraw funds during the first 6 months that the funds are invested with the hedge fund manager. Which of the policies identified by Julia specifies a lockup period? A. Policy 1. B. Policy 2. C. Policy 3. D. Policy 4. The answer is D. A lockup period refers to a set period of time, such as 6 months, that an investor's funds must remain invested in the hedge fund. During that time period, withdrawal requests are not permitted. Practice question. One of your clients wishes to invest in a hedge fund. You should explain which of the following points. A. Shares of these funds are easy to redeem. B. The fund can be expected to generate a profit, whether the markets trend up or trend down. C. These funds purchase a large amount of preferred stock. D. Expenses for these funds tend to be higher than those for traditional mutual funds. The answer is D. Hedge funds typically use risky strategies to generate profit, regardless of market direction, but there is no assurance that the objective will be realized. Redemption may be difficult with these funds, and higher management fees make for higher expenses than traditional mutual funds. REITs. What are the benefits of including REITs in a client's portfolio? The opportunity to invest in real estate without the degree of liquidity risk found in direct ownership. Property selected by professionals with greater negotiating power than an individual. A negative correlation to the general stock market because real estate prices and the stock market frequently move in opposite directions. Reasonable income and or potential capital appreciation. By placing REITs in a client's portfolio, the client would be incurring the following risks. Lower control, because much of the risk in investing in REITs lies with the quality of the management. REITs generally have greater price volatility than direct ownership of real estate because they are influenced by stock market conditions. Dividends are not considered qualified for purposes of the 15% maximum tax rate and are taxed at full ordinary income rates. If a REIT is not publicly traded, liquidity is very limited. While a portion of total shares outstanding may be redeemable each year, subject to limitations, redemption offers may be priced below the purchase price or current price. As a result, there is the need for more stringent suitability standards, and the regulators give greater scrutiny to trades in unlisted REITs. Failure to meet the distribution rules could cause a REIT to be taxed. Review Learning Objective 3 hours. Problem loans in the portfolio could cause income and or capital to decrease. Practice question. In order for a REIT to avoid being taxed like a corporation, it must distribute at least A. 75% of its taxable income, B. 90% of its taxable income, C. 95% of its taxable income, D. 100% of its taxable income. The answer is B. In order to qualify under IRS regulations, REITs must distribute at least 90% of their taxable income in the form of dividends to shareholders. At least 75% of a REIT's income must come from real estate investments. Knowledge Check 3.5. Question 1. When discussing the advantages of mutual funds, it is permissible to point out that they offer A. Better performance than investing in individual securities. B. Tax advantages not available to the individual investor. C. Diversification and professional management. D. Lower expenses than do-it-yourself investing. The answer is C. The two primary advantages of mutual funds are diversification and professional management. If the investor in individual stocks happens to pick a few real winners, the performance will likely exceed that of a mutual fund. There is no general yes or no on that. Some would say that individual investments offer more tax advantages because the investor selects when and what to sell. Although the mutual fund will typically pay less in trading costs than an individual investor, the other expenses, especially the management fee, can make investing in mutual funds more expensive than selecting securities on your own. Question 2. A REIT can avoid being taxed as a corporation by A. Receiving 75% or more of its income from real estate and distributing 90% or more of its net investment income to its investors. B. Receiving 100% of its income from real estate and distributing 90% or more of its net investment income to its investors. C. Receiving less than 75% of its income from real estate and distributing 100% of its net investment income to its investors. D. Receiving less than 50% of its income from real estate and distributing 50% or more of its net investment income to its investors. The answer is A. Under the guidelines set by the Internal Revenue Code, a REIT can avoid being taxed as a corporation by receiving 75% or more of its income from real estate and distributing 90% or more of its net investment income to its investors. Question 3. Identify two trading strategies that a hedge fund can employ in its portfolio, but a mutual fund cannot. Roman numeral 1. Limiting investments to a narrow group of securities within one industry. Roman numeral 2. Trading on margin to purchase portfolio securities. Roman numeral 3. Purchasing speculative or low-rated securities. Roman numeral 4. Short selling of stock. A. 1 and 3. B. 1 and 4. C. 2 and 3. D. 2 and 4. The answer is D. While there can be limited and rare exceptions, mutual funds are prohibited from purchasing securities on margin and selling securities short. Both strategies, however, are commonly employed by hedge funds.
Unit 4. Types and characteristics of derivative securities. Learning objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 4a, recognize the common characteristics of all derivatives. Learning Objective 4 bits. Identify the difference between a put option and a call option and their strategies. Learning Objective 4c, contrast calls, rights, and warrants. Learning Objective 4d. Describe the difference between futures and forwards contracts. Learning Objective 4e, identify the costs, benefits, and risks of derivative securities. Your exam will include approximately 5 questions from the topics covered in Unit 4. Introduction. This unit discusses both securities and non-securities derivatives. The term derivative is used to describe investment vehicles that derive their value from an underlying asset, whether that asset be a security, such as a stock, or a physical commodity, such as wheat. Lesson 4.1. What are derivatives? Learning Objective 4a, recognize the common characteristics of all derivatives. Options are derivative securities. That means they derive their value from an underlying instrument, such as a stock, stock index, interest rate, or foreign currency. Option contracts offer investors a means to hedge or protect an investment's value or speculate on the price movement of individual securities, markets, foreign currencies, and other instruments. An option is a contract that establishes a price and time frame for the purchase or sale of a particular underlying instrument. 2 parties are involved in the contract. One party receives the right to exercise the contract to buy or sell the underlying asset. The other is obligated to fulfill the terms of the contract. In theory, options can be created on any item with a fluctuating market value. The most familiar options are those issued on common stocks. They are called equity options. The exam is going to deal solely with standardized options traded on an exchange, such as the Chicago Board Options Exchange, CBOE, or NASDAQ. These options are issued and guaranteed by the Options Clearing Corporation, OCC. They are called standardized options because each option contract has 3 standardized terms. The underlying asset, that is, all options on XYZ stock, are for 100 shares of the XYZ common stock. The expiration date, all options that expire in June or July or whatever month, have the same date and time of expiry. The exercise or strike prices are set at standardized intervals. It is this standardization that makes secondary trading in options possible. Practice question. Your customer is long 10 ABC July 50 calls at 4:50. How many shares of stock will change hands if the option is exercised? A. 10, B. 100, C. 1,000, D. 10,000. The answer is C. One of the 3 standardized terms of equity options is that each contract is for 100 shares. Therefore, the exercise of 10 calls, or puts, for that matter, will involve 10 by 100 or 1,000 shares. Later in this unit, we will discuss non-securities derivatives forwards and futures contracts. These derive their value from an asset that is not a security, most commonly a commodity. The concept is the same. There are 2 parties, a buyer and a seller, and they can be used by speculators or those who wish to protect, hedge their investment. The 2 most important factors influencing the price of a derivative are the price movement of the underlying asset and the length of time until the contract expires. The longer the time, the greater the time value. Knowledge Check 4.1. Question 1. The value of a derivative is based on A. The value of the underlying asset, B. The value set by the CBOE, C. The face amount of the derivative, D. The time until the underlying asset expires. The answer is A. The reason for the term derivative is because these securities derive their value from the underlying asset. In the case of equity options, the subject covered on the exam, it is the value of the stock that the options are based on. The CBOE is a primary regulator of the options market but has nothing to do with determining value. The term face amount is meaningless, and it is the option that expires, not the underlying corporation. Question 2. All of the following are standardized for equity options except A. The size of the contract, B. The expiration date, C. The maximum profit, D. The exercise or strike price. The answer is C. The 3 standardized features of listed equity options, the only ones covered on the exam, are the size of the contract on the underlying asset, that is, all options on XYZ stock are for 100 shares of the XYZ common stock. The expiration date, all options that expire in June or July or whatever month, have the same date and time of expiry. The exercise or strike prices are set at standardized intervals. The amount of profit or loss is not standardized. As we'll see later in this unit, there is potential for an unlimited profit or an unlimited loss. Lesson 4.2 Equity Derivatives. Learning Objective 4 bits. Identify the difference between a put option and a call option and their strategies. Calls and puts. There are two types of option contracts, calls and puts. A call option gives its holder the right to buy a stock for a specific price within a specified time frame. A call buyer buys the right to buy a specific stock, and a call seller takes on the obligation to sell the stock. A put option gives its holder the right to sell a stock for a specific price within a specified time frame. A put buyer buys the right to sell a specific stock, and a put seller takes on the obligation to buy the stock. Each stock option contract covers 100 shares, a round lot of stock. An option's cost is its premium. Premiums are quoted in dollars per share. Because a contract covers 100 shares, a premium of $3 means $3 for each share times 100 shares, which equals $300. Practice question. Which of the following statements regarding derivative securities is not true? A. Derivatives can be sold on securities and non-securities. B. An option contract is a derivative security because it has no value independent of the value of an underlying security. C. An option contract's price fluctuates in relationship to the time remaining to expiration as well as with the price movement of the underlying security. D. An owner of a put has the obligation to purchase securities at a designated price, the strike price, before a specified date, the expiration date. The answer is D. Although equity options are the most common derivative on the exam, derivatives can be sold on any asset. For example, there are options on foreign currency and commodity futures where the underlying asset is not a security. For this question, an owner of a put has the right, not the obligation, to sell, not purchase, a security at a designated price, the strike price, before a specified date, the expiration date. That makes choice D the untrue statement. It is only the seller of an option who has an obligation. Here is another way that question might be asked. Practice question. A customer has the right to sell 100 shares of MNO at 60 any time between July and October. Which term best describes this situation? A. Long call. B. Long put. C. Short call. D. Short put. The answer is B. The put buyer, long position, has the right to sell stock to a put writer who is obligated to buy that stock. Option transactions. Because two types of options, calls and puts, and two types of transactions, buying and selling, exist, four basic transactions are available to an option investor. Buy calls, buy puts, sell puts. Option buyers are long the positions, option sellers are short the positions. An option conveys rights and obligations for a limited time. Therefore, each transaction has a beginning and an end, an open and a close. For instance, an option position opened by an investor buying a call is closed when the call is exercised, is sold, or expires. An option position opened by an investor selling a call is closed when the call is exercised, is bought, or expires. The owner, long position, of a put or call option contract has three ways to close a position. Sell the option contract before the expiration date. Exercise the option to buy or sell the security specified in the contract, or let the option expire. The simplest and most common way to close an option position is entering the transaction opposite of the opening transaction. The following table summarizes potential opening and closing positions. Buy call to open, sell call to close. Sell call to open, buy call to close. Buy put to open, sell put to close. Sell put to open, buy put to close. Exercising an option. In some cases, the holder of the option, only owners can exercise it as one of their rights, will decide to exercise the option. Exercising a call means purchasing the underlying stock at the strike price. Exercising a put means selling the underlying stock at the strike price. For example, if you were long an ABC 50 call and the current market price of ABC is 60, you would be able to exercise and purchase stock worth $60 per share at the exercise price of $50. Or, if you were long an XYZ $45 put and the current market price of XYZ is $35, you might wish to purchase 100 shares of XYZ at $35 per share and then exercise your option to put the stock at $45. The test may ask you the difference between American and European style exercises. American style means the option can be exercised at any time the holder wishes up to the expiration date. European style options may only be exercised on the last trading day before the expiration date. Take note. A tool for remembering the difference between American and European exercises is to look at the first letter. A for American means anytime. E for European means expiration date. Test topic alert. Now that you have become so focused on the exercise date differences between American and European styles, be prepared for a question stem like a European option is a derivative because, and the first answer choice will probably be it can only be exercised on the expiration date. Although that is true about exercise, it has nothing to do with why options are derivatives. Please select an answer choice similar to its value is based on some underlying asset. Take note. Perhaps you noticed an inconsistency. First, we told you that European style means the option can only be exercised on the day prior to its expiration date. Then, we told you it is only exercised on its expiration date. In the industry, there seems to be much confusion about this, and for exam purposes, either statement is correct, and you won't have to choose between them. Length of an option contract. Options are available that are issued with an expiration date of as short as 1 week to as long as 3 years. The short-term ones are called weeklies, and the long-term ones are known as LEAPs, long-term equity anticipation securities. Most standard options are issued with an expiration length of a maximum of 9 months. Test topic alert. You must remember that all options, regardless of their length, are derivative securities. Options Greeks. Many of our students tell us that when it comes to understanding options, it is all Greek to me. Maybe that is why options strategists use a number of Greek letters to describe various properties of an option. There are 4 commonly used Greeks: delta, gamma, theta, and vega. It is highly unlikely that you will have to know anything about them, but we've given a short definition of each in the glossary. Option strategies. Option strategies are either bullish or bearish positions on the underlying stock. Bulls believe the price of a security will go up, and bears believe the price of a security will go down. The primary reasons for buying or selling options are to profit from or hedge, protect, against price movement in the underlying security. A bullish investor may buy calls seeking profit if the price of the underlying stock rises. A bearish investor buys puts seeking profit if the price of the underlying stock declines. Likewise, a bullish investor may sell puts, which will make money if the stock price is stable or rises, and a bearish investor may sell calls, which will make money if the stock price is stable or declines. Bullish and bearish options positions. Long calls, right to buy, bullish; long puts, right to sell, bearish; short calls, obligation to sell, bearish; short puts, obligation to buy, bullish. Take note. A phrase that is invaluable for figuring out options questions is call up and put down. That is, you would buy a call because you are hoping or are afraid the price of the stock will go up, and you would buy a put because you are hoping or are afraid the price of the stock will go down. Buying calls. Investors expecting a stock to increase in value speculate on that price increase by buying calls on the stock. By buying a call, an investor can profit from the increase in the stock's price while investing a relatively small amount of money. The most a call buyer can lose is the money paid for the option. The most a call buyer can gain is unlimited because there is no limit to how high the stock price can go. Owners of options, puts or calls, do not receive dividends on the underlying stock. As we will show you in Unit 21, buying calls is also a hedging, protection, strategy when the investor is afraid the stock price will rise. Test topic alert. Remember those employee stock options we discussed in Unit 1? No, they are not at all like these puts and calls, but the employer, the company issuing the stock, might want to use call options to protect against market risk. You see, when granting employees the option, the right, to buy shares at a set price, the company is obligated to deliver the shares at that agreed-upon price. What happens if the company's stock price soars? The employees exercise their options, and the company has to go out into the stock markets and buy stock at a price far in excess of what they're going to be selling it for. That hurts. One way to protect the company is to buy call options on the stock so that if this were to happen, they could use their options to buy the stock at whatever exercise price was part of the contract. Writing calls. A neutral or bearish investor can write, sell, a call, and collect the premium. An investor who believes a stock's price will stay the same or decline can write a call and can generate income from the option premium and partially protect, hedge, a long stock position by offsetting any loss on the sale of the stock by the premium amount, or receive an exercise notice if the stock price increases. A call option will generally be exercised anytime the underlying stock's price is above the strike price at expiration date. In addition to the premium received when the option was sold, the writer will be paid the strike price for the stock. If the option writer owns the stock on which the call is being written, it is known as a covered call, and the risk is limited because no matter how high the stock price rises, meaning the call will certainly be exercised. The writer merely uses the stock already owned, which has been deposited with the broker-dealer, to make delivery. However, if the writer does not own the stock, the option is uncovered, usually referred to as naked in the industry. That's when the risk is unlimited because the writer must pay the going market price, and there is theoretically no limit as to how high a stock's price can go to acquire the stock needed to fulfill the obligation to deliver. That is why naked call writing is the most risky option strategy. Buying puts. A bearish investor or one who believes a stock will decline in price can speculate on the price decline by buying puts. A put buyer acquires the right to sell 100 shares of the underlying stock at the strike price before the expiration date. Example. Here is how that might work. An investor following ABCD common stock believes that it is grossly overpriced at $75 per share, and when the next earnings report is released, the stock will drop at least 10 points. If the investor were to purchase an ABCD 75 put for a premium of $3 and was correct, once the stock was at $65, the 10-point drop, a purchase could be made at that price for $65 per share, and then the put could be exercised at the $75 per share strike price. This would give the investor a profit of $7 per share, the $10 difference between the cost of $65 and the sale at $75 minus the $3 premium paid. A $700 profit on a $300 investment is a very handsome percentage return on investment. As we will show you in Unit 21, buying puts is also a hedging, protection, strategy when the investor is afraid the stock price will fall. Writing puts. Generally, investors who write puts believe that the stock's price will rise or remain stable. A put writer, seller, is obligated to buy stock at the exercise price if the put buyer puts it to the put writer. If a stock's price is above the put strike price at expiration, the put expires unexercised, allowing the put writer to keep the premium. Just as with writing calls, receiving that premium is a source of income. Put writers will lose if the stock price falls, the buyer wins, but the loss is limited because the stock price can never fall below zero. Straddles. When an investor is not sure which direction the market will move but has a strong opinion that there will be dynamic movement, a strategy that might be employed is the purchase of a straddle. This is the combining of a put and a call on the same stock with the same exercise, price, and expiration date. If the stock moves up, a profit is made on the call. If it moves down, a profit is made on the put. Test topic alert. Those who buy a straddle will profit from volatility, while those who sell a straddle will profit if the market is stable because the options will expire unexercised. Learning Objective 4C. Contrast calls, rights, and warrants. Although generally treated as equity securities, in truth, rights and warrants are derivatives because their value is derived from the common stock, which they may acquire by exercising that right or warrant. Because rights and warrants give the holder the option, but not the obligation, to buy a stock at a specific price during a specific time period, they can be compared in most respects to a call option. There are some differences, however. Let's start with rights. Rights. A stock right, sometimes referred to as a preemptive right, is a privilege extended to existing holders of a company's common stock. When the company is going to issue additional shares of common stock in order to prevent dilution of ownership by the current owners, they are given the right to preempt, come ahead of, any members of the general public and have the first shot at the new stock. The right permits them to purchase enough shares to keep their proportionate interest in the company. Here is a very simple example. Steve has 100 shares of DEF Corporation common stock. DEF has 10,000 shares of stock outstanding. So it is clear that Steve owns 1% of the company. 100/10,000 equals 0.1. DEF wishes to raise additional capital by issuing 5,000 new shares of stock. Steve will receive rights to purchase how many of those 5,000 shares? In order to keep his 1% ownership, Steve will receive stock rights to purchase 50 shares of the new issue. As an incentive, rights offerings always have an exercise price slightly below the current market price of the existing stock. Also, because the company needs to raise the money, they limit the time in which you have to decide to exercise your right. Usually, no more than 45 to 60 days. If Steve decided he did not want to exercise his rights, he could sell them, and because the exercise price is below the market price, they would have a value. The key points to remember about rights are, they are given, not sold, to existing holders of the common stock. They are exercisable at a price below the current market. They have a short lifespan. They will expire in no more than 45 to 60 days, sometimes less. They can be sold, and then the buyer can exercise them. Although generally unwise to do, they can be left to expire. Warrants. Unlike rights, warrants have an exercise price above the current market price, and, unlike rights, they have no relationship to an existing stockholder's proportionate interest. Another difference is that warrants have a long expiration period, sometimes as much as 10 years. They are usually attached to a bond issue. Their attractiveness sweetens the issue, frequently allowing for a lower interest rate on the bond, or are attached to a new stock offering where the package is considered a unit, such as one share of stock with a warrant to purchase another share. In most cases, warrants can be detached and sold separately. The key points to remember about warrants are, they are exercisable at a price above the current market. Why would anyone be interested in that? Because you might have a 5-year expiration period and have the right to buy the stock at $45 when it is selling at $40 today. If you think there is a chance that the stock's price will move more than 5 points in 5 years, you can make money, sometimes lots of money, because of the leverage. Their life is considerably longer than rights and longer than call options as well. When detached, they can be traded like any other security. They are usually traded on the same exchange as the company's common stock. Most securities professionals view warrants as call options with a very long time to expiration. Warrants do not have voting rights, nor do they receive dividends the same as any other derivative. One major difference between call options and rights/warrants is that options originate on the exchange on which they are traded, whereas rights and warrants originate with the issuer of the stock. The effect of this is that new shares are issued when a warrant is exercised, while exercise of a call option requires the assigned seller to deliver existing shares. Practice question. GMCO Manufacturing Company, traded on the NYSE, has announced that it will be issuing 10 million new shares of common stock to raise new capital for the purchase of new equipment. Your client, owning 1,000 shares of GMCO common stock, would probably receive A. An advance invitation to purchase some of the new shares. B. Options to purchase some of the new shares. C. Preemptive rights to purchase some of the new shares. D. Warrants to purchase some of the new shares. The answer is C. Commonly, when a publicly traded company issues new shares of common stock, existing shareholders receive rights, sometimes called stock rights, enabling them to purchase shares in proportion to their current ownership, usually at a reduced price. These rights rarely last longer than 45 days and must be exercised or sold within that time, or they'll just expire worthless. Warrants are not sent to shareholders. They are either purchased in the open market or come attached to a new issue of securities as a sweetener. Knowledge Check 4.2. Question 1. Which of the following statements concerning put and call options is not correct? A. One call option is an option to buy 100 shares of a particular common stock at a specified price. B. A put option permits investors to speculate on a rise in the price of an underlying common stock without buying the stock itself, and a call option allows investors to speculate on a decline in the stock price without short selling the common stock any time prior to a specified expiration date. C. One put option gives the buyer the right to sell 100 shares of a particular common stock at a specified price prior to a specified expiration date. D. Options may be used as a hedge against a portfolio position by establishing an opposite position in the option contracts. The answer is B. It is the call option that permits investors to speculate on a rise in the price of the underlying common stock without buying the stock itself, and the put option that is the alternative to selling stock short. Question 2. All of the following statements describe preemptive rights except A. They are most commonly offered with debentures to make the offering more attractive. B. They are short-term instruments that become worthless after the expiration date. C. They are issued by a corporation. D. They are traded in the secondary market. The answer is A. A corporation issues rights to existing shareholders to allow them to purchase enough stock within a short period and at less than current market price to maintain their proportionate interest in the company. Rights need not be exercised but may be traded in the secondary market. Warrants, not rights, are often issued with debentures to sweeten the offering. Lesson 4.3. Futures and Forwards. Learning Objective 4D. Describe the difference between futures and forward contracts. Forward contracts. Forward contracts were developed as a means for commodity users and producers to arrange for the exchange of the commodity at a time agreeable to both. Used in Europe as early as the Middle Ages, typically for agricultural items, grains, and so forth, forward contracts evolved to eliminate the problem of finding a buyer or seller for an upcoming cash market transaction. They also reduce the price risk inherent in changing supply and demand relationships. How so? Because the seller knows exactly how much he will receive for his product. Of course, he may wind up contracting to sell too cheaply if market prices at delivery are much higher. But he is protected against receiving too little if the harvest is plentiful and prices plunge. A forward contract is a direct commitment between one buyer and one seller. If the position is held until the closing date, the forward seller is obligated to make delivery. The forward buyer is obligated to take delivery. A forward contract is non-standardized. Its unique terms are defined solely by the contract parties without third-party intervention. This arrangement ensures a ready market or supply source because it presumes delivery. Because forward contracts are direct obligations between a specific buyer and seller, the user and producer, they are not easily transferred and are considered illiquid. There is no secondary market for forward contracts. Further, each party risks the credit and trustworthiness of the other. This is known as counterparty risk. The 5 components of a typical forward contract are quantity of the commodity, quality of the commodity, time of delivery, place for delivery, and price to be paid at delivery. Futures. In contrast to forward contracts, futures contracts are exchange-traded obligations. The buyer or seller is contingently responsible for the full value of the contract. That is, unlike with forwards, obligations are created only when the contract is exercised. A buyer goes long or establishes a long position, and if the decision is made to exercise, is obligated to take delivery of the commodity on the future date specified. A seller goes short or establishes a short position, and if an exercise notice is tendered, is obligated to deliver the commodity on the specified future date. If the seller does not own the commodity, his potential loss is unlimited because he has promised delivery and must pay any price to acquire the commodity to deliver. This is the same concept as writing an uncovered call. As prices change, gains or losses are computed daily for all open futures positions on the basis of each day's settlement price. Gains are credited and losses are debited for each open position, long or short. All accounts for firms and traders must be settled before the opening of trading on the next trading day. Buyers and sellers benefit from organizations that act as clearinghouses for the contracts. Clearinghouses enable futures positions to be offset easily prior to delivery. To offset, close, or liquidate a futures position before delivery, an investor must complete a transaction opposite to the trade that opened the futures position. The offsetting transaction must occur in the same commodity, for the same delivery month, and on the same exchange. About 98% of futures contracts are offset before delivery. Futures may be highly leveraged. If, at expiration, the settlement price is higher than the delivery price, a long position results in a profit while a short position loses. Conversely, if the settlement price is lower than the delivery price, shorts profit and longs lose. Typically, there are 5 standardized parts to an exchange-traded futures contract. Quantity of the commodity, for example, 5,000 bushels of corn or 100 ounces of gold. Quality of the commodity, specific grade or range of grades may be acceptable for delivery, including price adjustments for different deliverable grades. Delivery price, similar to exercise or strike price with options. Time for delivery, for example, December wheat to be delivered. Location approved for delivery. Test topic alert. Futures are most commonly used by speculators, while forwards are used by producers. That explains why such a small percentage of futures contracts ever end with delivery. Practice question. Forwards are commonly used by producers, farmers, to hedge the risk of the price of the commodity falling before it is able to be harvested and sold. For example, if a farmer has planted soybeans and wishes to hedge against a possible decline in the spot or cash price at delivery, the farmer could A. Buy forward contracts in a size equal to the amount of the soybeans expected to be harvested. B. Buy futures contracts in a size equal to the amount of the soybeans expected to be harvested. C. Sell forward or futures contracts in a size equal to the amount of the soybeans expected to be harvested. D. Sell the soybeans for cash today. The answer is C. Hedging a commodity yet to be harvested is done by selling a forward or a futures contract on that commodity. Invariably, producers will use forward contracts but could also use a futures contract. In that way, the price is guaranteed in the event of a market decline. However, the producer is giving up any potential gain in the event the prices rise above the futures/forward agreed upon one. Regulation of futures and forwards. Because these are not securities, futures and forwards do not come under the jurisdiction of the SEC. The self-regulatory organization, SRO, that is in charge of regulating these markets and their participants is the Commodity Futures Trading Commission, CFTC. Test topic alert. As is the case, a clearing firm is the counterparty and guarantor of exchange-traded activity, acting as the buyer to all sellers and seller to all buyers. This eliminates counterparty risk when investing in futures contracts. Comparison: forward contracts and futures contracts. Forward contracts. Highly customizable contracts do not trade on an exchange. Hedgers use forward contracts. Counterparty default risk, low liquidity, not regulated, not actively traded, specific grade and customized amounts, and customized delivery and dates. Futures contracts. Standard contracts, trade on an exchange. Speculators use futures contracts without contract negotiations. Payment is guaranteed by the exchange clearinghouse. High liquidity, regulated, actively traded, range of grades and uniform amount, and standard delivery and dates regulated by exchange. Knowledge check 4.3. Question 1. An investor takes a long position in a commodity forward contract at a forward price of $105 when the spot price, current market price, is $102. 1 month later, the spot price has increased to $110. At that time, the forward price of the contract is A. less than $105, B. $105, C. between $105 and $110, D. greater than $110. The answer is B. The price of a forward contract is agreed upon between the buyer and seller at initiation. Remember, forward contracts are not standardized like futures contracts. The value of the contract may change during its life, but not the exercise price. Because forwards tend to be confusing, think of this in the manner of an equity call option. The customer buys a 105 call when the stock's price is $102. 1 month later, the market price of the stock has risen to $110. What is the strike price? It is still $105. Same concept here. Question 2. A commodities speculator purchases a 1,000 bushel wheat futures contract for 80 cents per bushel. At expiration, the settlement price is 70 cents per bushel. This individual, A, has a $100 gain. B has a $100 loss. C must make delivery of the wheat. D effectively hedged the long wheat position. The answer is B. The simple math is this. The individual bought at 80 cents and sold at 70 cents, losing 10 cents per bushel. Multiply 10 cents by 1,000 bushels, and the loss is $100. It is the seller who is obligated to deliver. The buyer of the contract must accept delivery, unless there was an offsetting transaction prior to expiration. This individual was long the futures contract, not long the owner of the wheat. Lesson 4.4. Benefits and risks of derivatives. Learning Objective 4E, identify the costs, benefits, and risks of derivative securities. Using derivatives can be a useful strategy for investors if the circumstances warrant it. There is no cost, per se, to open an options account, although, as we will learn in Unit 16, the account opening procedure is somewhat more involved than opening a regular account at a broker-dealer. For those who buy options, long position, the only cost is the premium to purchase the option plus whatever the brokerage firm charges in commissions. With a very limited, and probably not tested, exception, options cannot be purchased on margin, covered in Unit 23. So, without any borrowed money, there is no interest charged. Selling options, short position, brings in money from the sale, and the seller receives all of that premium, less the brokerage charges. If the call or put being written, sold, is uncovered, there is a margin requirement, but that is beyond the scope of the exam. The costs to carry forwards and futures are much more complicated, and we are not aware of the topic ever being tested. As with any investment, there are benefits and there are risks. We'll look at those most likely to be on your exam. Leverage. One of the key benefits to using derivatives is that of leveraging your investment. Because an options cost is normally much less than the underlying stock's cost, option contracts provide investors with leverage. Relatively little money allows an investor to control an investment that would otherwise require a much larger capital outlay. And if you purchase a call and guess right, the potential profit is unlimited. Theoretically, there is no limit as to how high the stock's price can go. Example. An investor can buy the common stock of RST Corporation for $58 per share, investing $5,800, or buy an RST 55 call for $6, an investment of $600. If RST's price increases to $70, the stock investor will see a 20.7% profit, $12 profit divided by $58 investment, whereas the option investor, with the call worth a minimum of $15, $70 minus $55, will have more than doubled the investment. $9 profit divided by $6 investment equals 150%. The opposite is also true. If RST trades below $55, say at $48 when the option expires, the stock investor has a modest loss, but the option investor loses the entire investment. What is the value of an option to buy stock at $55 per share when it is currently available to anyone at $48? Nothing. As you can see from the example, leverage works both ways great when the stock is going your way and a possible loss of everything when it doesn't. Of course, if, in the example below, RST had gone bankrupt, leaving the stock worthless, the investor holding 100 shares would have lost the entire $5,800, while the option investor's loss would have been limited to the $600 premium paid. Less risk. When used properly, options can actually lower an investor's risk. The classic example is the covered call where the investor owns the stock and then writes a call option on it. Realize that there are only 3 things that can happen after you purchase a stock. 1. The stock can increase in price. 2. The stock can remain stable. Or 3. The stock can decline in price. If you think about it, 2 of those possibilities are unfavorable. Certainly, you don't want the stock to fall in price. Even if the stock remains level, you've suffered from opportunity cost. You could have put it in the bank with no market risk and earned interest. Only if the stock increases by more than the risk-free rate do you emerge a winner. However, if you write a call on that stock, you wind up better for sure in cases 2 and 3, and perhaps even in case 1. Let's look at an example. Meredith purchases 100 shares of ABC at $50 per share. She then writes, sells, an ABC 50 call for a premium of $4,400. If the stock goes down to $47 by expiration date, the option she wrote will expire. Who is going to call on her to sell stock at $50 when it is available for $47 in the marketplace? In reality, though, she hasn't lost $300 because she received $400 when she sold the option. She is still $100 ahead of the game, even though the stock dropped in price. It isn't until the stock falls below $46 that she begins to lose money. But no matter how far it falls, she will still be $400 ahead of having just bought the stock without selling the option. If the stock price remains the same, the option will expire and she will still own the shares. But she will have $400 in her account from the sale of the option. Only in the first choice is it possible for her to be a loser, but even that wouldn't happen until the stock rose above $54 per share. How is that? If the stock is $53, yes, her option will be exercised and she will have to sell her stock at the strike price of $50. She paid $50 for it, but also received the $4 premium. So the total received on the sale of the stock plus the option is $54. Now, if the stock goes to $60, she would have been better off never writing the option. That is a risk you take in exchange for the chance that you'll win if the stock's price only rises a little, stays the same, or falls. Alternative to selling short. As we will learn in Unit 23, one way to make money when an investor is of the belief that a stock's price will decline is to sell that stock short. At this juncture, to keep things simple, selling stock short involves putting up a deposit in a margin account and borrowing stock to sell, and carries with it the possibility of an unlimited loss. When you buy a put, you benefit when the stock's price declines, but all you pay is the premium, and, if you guess wrong, that is all you can lose. Having just mentioned the possibility of an unlimited loss when an investor sells a stock short, we would be remiss if we didn't discuss the parallel situation with options. When an investor writes an uncovered, naked call option, the potential loss is unlimited. Here is how that works. With the market price of ABC at $50 per share, Manny writes a 50 call option for a premium of 3. Manny does not own any ABC, but as the seller of the call option, is obligated to deliver 100 shares of the ABC stock and receive $5,000 if the option is exercised. We use the phrase call up to help us remember our objective when we buy a call. If the price of ABC should go up, the option will be exercised, and Manny will have to buy it at its current market price and then deliver it. The question is, how high can it go? Theoretically, and that's the exam view, there is no limit it can rise to infinity. That leaves Manny having to pay an infinite amount to buy stock for which he receives only the $5,000 strike price plus the $300 premium. Just in case you want to say, but because he receives $5,300, his loss can't be unlimited. Remember, infinity minus any other number is still infinity. We know this is just theoretical, but if you've watched some of the better-known companies over the past few years, some of the price increases have been astronomical. Hedging. In the example of writing the covered call, we showed one example of hedging, protecting a position. In that case, the first 4 points of a market decline were absorbed by the premium received from the sale of the call. There is more to discuss on using options to hedge, and we're going to cover that in Unit 21. Time decay. Have you ever heard an investor say, "I'm going to hold this stock until it gets back to what I paid for it"? We're not going to debate the logic of that statement other than to say that doesn't work with options. They ultimately expire, and if the stock hasn't moved in the direction you're hoping for, you will run out of time. Time decay is the concept that as the time to expiration gets closer, the value of the option decreases. Taxation. In most cases, any profits realized from buying or selling options is considered a short-term capital gain. As we will learn in Unit 15, short-term gains are taxed as ordinary income, a much higher rate than long-term gains. Much of what we've shown you here applies to forwards and futures as well, but other than some very basic questions, we don't expect the kind of detail we've presented here for options. Practice question. Here is the type of question that is basically easy, but if you don't read carefully, you will waste time trying to figure it out. Among the purposes of purchasing derivatives would be all of the following except A. Hedging, B. Income, C. Profits, D. Speculation. The answer is B. Purchase of a derivative, whether an option, a forward, or a futures contract, never generates income. Selling one does, but the question refers to a purchaser, and that is why the correct answer is choice B. Knowledge Check 4.4. Question 1. The term derivative would not include A. Futures on commodities, B. Interest rate swaps, C. REITs, D. LEAPs. The answer is C. A derivative is something that derives its value from something else. REITs represent direct investment into real estate. The asset purchase is the actual asset. LEAPs are the options with long-term expiry. Never heard of interest rate swaps? Well, on the real exam, there will occasionally be an answer choice that you've never heard of, but it should not affect your ability to choose the correct one. Question 2. Writing options can be a useful method of generating a stream of income for your customer's portfolio. One issue to be considered is that A. The income is generally tax-free. B. The income is generally taxed as short-term gain. C. The income is generally taxed as long-term gain. D. The writer of the option controls whether or not the option is exercised. The answer is B. The nature of selling options is such that the IRS generally considers the income generated to be taxable as a short-term gain. Currently, the rate of tax on those gains is significantly higher than on long-term gains. It is the owner, holder of the option, not the writer, who has control over the decision to exercise. Note that for testing purposes, invariably when there are two choices that are mutually exclusive, tax short-term or tax long-term, one of those will be the correct answer.
Unit 5. Alternative Investments and Other Assets. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 5A. Identify the concept of flow-through of passive income and loss as it applies to DPPs. Learning Objective 5 bits. Differentiate between the roles of the general partners and the limited partners in a DPP. Learning Objective 5C. Recognize the characteristics of the pooled investment vehicles that are considered alternative investments. Learning Objective 5. Compare viaticals and life settlement policies. Learning Objective 5E. Contrast passive and active real estate investing. Learning Objective 5. Identify the different types of commodities and precious metals that are popular investments. Learning Objective 5 grams. Explain the benefits and risks of alternative investments in client portfolios. Your exam will include approximately 4 questions from the topics covered in Unit 5. Introduction. In the 1990s, financial advisors began introducing their wealthy clients to alternative investments, now generally referred to as alts. These included, among other products, ETNs, leveraged ETFs, and new, highly sophisticated financial derivatives. One thing that all of these had in common was that they were complex and not easy to understand for either the investor or the person recommending the investment. Although investing can be complex, standard investments are fairly easy to comprehend. Even new investors understand that stocks have more risk but hold out the chance of superior returns, while bonds generally have less risk with correspondingly lower returns. All investors dream of scoring a touchdown and not getting tackled for a loss. Alternative investments try to do just that. Some are successful, but many are not. Suitability determinations need to be made on a case-by-case basis, considering each customer's objectives, circumstances, and sophistication. Securities professionals must take special care in recommending these complex products to the sophisticated customer, and even more so to one with less financial acumen. In addition to alternative investments, the exam will test your knowledge on other more traditional assets, such as investment real estate and commodities, including precious metals. Lesson 5.1. Direct Participation Programs, DPPs. Learning Objective 5A. Identify the concept of flow-through of passive income and loss as it applies to DPPs. Direct Participation Programs, DPPs, are one class of alternative investment. DPPs, many of which are limited partnerships, allow the economic consequences of a business to flow through to investors. Any income or loss to the investor is considered passive because the investor does not take an active role in the management of the business. That is the role of the general partner, as you will learn shortly. Unlike corporations, limited partnerships pay no dividends. Rather, they pass income, gains, losses, deductions, and credits directly to investors. Limited partnerships offer investors limited liability. Similar to a stockholder in a corporation, creditors cannot generally come directly to limited partners to collect on defaulted debt. In general, the maximum potential loss to a limited partner is the amount already invested plus any funds committed for which have not yet been submitted. Take note. In Unit 15, the topic of partnership taxation will be covered in greater detail. But at this point, we want you to know that any income received by a partner is considered passive, and the same is true for losses. The effect of this is that any passive losses can only be deducted as losses against passive income. Learning Objective 5 bits. Differentiate between the roles of the general partners and the limited partners in a DPP. Investors in a limited partnership. It is important to understand that a direct participation program, DPP, is just a different way to invest in a business rather than buying the company's stock. There are certain tax advantages to being structured as a partnership, with the flow-through of income or loss being one of them. That aside, this is merely an investment in a business, whether it be a RELP, real estate limited partnership, an oil and gas drilling program, or a movie production company. Just like any other business, there are those who run the enterprise, management, and those who contribute the capital, investors. For DPPs, those roles are assumed by the general partners, usually referred to as GPS, and the limited partners, the LPs. From a legal standpoint, there must be at least one GP and one LP. Investing in a DPP requires analyzing the program, just as one would analyze a stock or bond investment, just with a few different parameters. An investor should choose to invest in a specific limited partnership because it is economically viable. The investor can make use of the potential tax benefits. The GPs have demonstrated management ability and expertise in running similar programs. The program's objectives match the investor's objectives, and do so within a time frame that meets the investor's needs. And the startup costs and projected revenues are in line with the startup costs and revenues of similar ventures. Promoters structure DPPs to meet various objectives. When a promoter's tax stance is too aggressive or is without economic purpose in the view of the IRS, the program is considered an abusive tax shelter. If the IRS judges the program to be abusive, it disallows deductions, assesses back taxes, interest, and penalties, and in some cases, charges the promoter with criminal intent to defraud. Investors should try to match their current and future objectives with the program's stated objectives. Example: a person seeking current taxable passive income should not invest in an oil and gas exploratory drilling program. Why not? Because these programs drill where oil or gas has never been found before, exploratory, and have a low success rate. Even when they do hit, it may take years before any income is generated. Take note: because the majority of these are privately placed, DPPs are considered illiquid, and investors must commit money for a long period of time. Even those that are publicly traded do not have the liquidity of other investments, frequently requiring authorization from the GP in order to be able to sell your units. General Partner, GP. The GPs are the active investors in a limited partnership and assume responsibility for all aspects of the partnership's operations. A general partner makes decisions that bind the partnership, buys and sells property for the partnership, manages the partnership property and money, supervises all aspects of the partnership's business, and maintains a minimum 1% financial interest in the partnership. Unlike limited partners who have limited liability, general partners assume unlimited liability and are therefore personally liable for all partnership business losses and debts. A partnership's creditors may seek repayment from the GPs and may go after their personal assets. A general partner has a fiduciary relationship to the LPs in that the GP has been entrusted with the LP's capital and is legally bound to use that capital in the investor's best interests. The GP must manage the business in the partnership's best interest and avoid the appearance of improper use of assets and conflicts of interest. The GP cannot borrow from the partnership, compete with the partnership, or commingle personal funds with partnership funds. Finally, GPs do not generally receive any distributions from profits until after a payment has been made to the LPs. Limited Partner, LP. LPs are passive investors with no management or day-to-day decision-making responsibilities. Therefore, they usually are not held personally responsible for the partnership's indebtedness. In fact, if an LP does take an active role, she faces the danger of losing a limitation on liability. LPs may receive cash distributions and capital gains from partnerships. The total yield of a partnership investment takes into account all potential rewards, tax deductions, cash distributions, and capital gains. Units of ownership in a partnership are called interests rather than shares. Practice question. In a direct participation program, liability for the debts of the business falls upon the A. General partners, B. Limited partners, C. Shareholders, D. Agents selling the program. The answer is A. DPPs consist of at least one GP and one LP. The liability of the limited partners is limited to their investment, including commitments made but not yet fulfilled. On the other hand, the general partners bear the liability for the debts of the entity. Issuing partnership investments. DPPs may be offered either as private placements, qualifying for an exemption from registration under state and federal law, as will be described in Unit 8, or publicly registered either with the SEC, the states, or both. In either case, specialized documentation known as a subscription agreement is required from investors. An investor who buys a limited partnership unit must complete and sign a subscription agreement, which includes a statement of the investor's net worth and annual income, and a power of attorney form appointing the GP as the agent of the partnership. The agent is responsible for making certain that the information the potential investor provides in the subscription agreement is complete and accurate. Knowledge Check 5.1. Question 1. One of the ways that investing in a real estate limited partnership, RELP, differs from investing in a REIT is that A. The DPP pays dividends, while the REIT does not. B. The REIT passes through at least 90% of its taxable income, while the DPP retains the income. C. The DPP is a pass-through vehicle for both income and loss, while the REIT does not pass through losses. D. DPPs generally have greater liquidity than REITs. The correct answer is C. DPPs are pass-through entities. All of the tax considerations, income or loss, flow through to the investors. REITs will distribute at least 90% of their taxable income as dividends, but if there is a loss, none of that benefits the investors. One risk found in the DPP that is not in the REIT is the lack of liquidity. Question 2. A direct participation program is a form of business entity. It may purchase real estate, drill for oil or gas, or engage in a number of other business activities. Which of the following statements is true? A. Management of the enterprise is generally in the hands of a committee formed by the largest investors. B. Management of the enterprise is always in the hands of the general partners. C. Management of the enterprise is under the control of a committee consisting of limited and general partners. D. Limited partners may not participate in management affairs until at least 1 year has passed since the offering is completed. The correct answer is B. Management of a DPP is solely the province of the general partners. In fact, any limited partner assuming a management role is in danger of forfeiting their status as a limited partner. This is one of the rare cases where always is a correct statement. There are so many exceptions to the rules. Lesson 5.2. Alternative Pooled Investments. Learning Objective 5C. Recognize the characteristics of the pooled investment vehicles that are considered alternative investments. The category of alts also includes a number of pooled investment vehicles. Probably the best known is the hedge fund, covered in Unit 3, but there are a number of others. The following is a description of the pooled investment vehicles considered alternative investments that are most likely to appear on the exam. Exchange-traded notes, ETNs. Although similar in some regards, don't confuse ETFs with ETNs. It could be said that ETNs are cousins of ETFs. That said, just as with family members, there are some important differences. Most obvious is the difference in their basic structure. While ETNs register under the Securities Act of 1933, ETFs register under the Investment Company Act of 1940. Basically, this means that ETNs are made as debt instruments, while ETFs are looked at as investment companies. ETNs are a type of exchange-traded debt security offering a return linked to a market index or other benchmark, rather than periodic interest payments, as is the case with traditional debt securities. These are sometimes referred to as equity-linked notes, ELNs, which is a real misnomer because they are debt securities. Issuers of ETNs issue and redeem notes as a means to keep the ETN's price in line with the calculated value, called the indicative value or closing indicative value for ETNs. This value is calculated and published at the end of each day by the ETN issuer. When an ETN is trading at a premium above the indicative value, issuing more notes to the market can bring the price down. Similarly, if an ETN is trading at a discount, redemption of notes by the issuer reduces the number of notes available in the market, which tends to raise the price. ETN issuers have primary control over the issuance and redemption processes, which can become a conflict of interest. Unlike ETFs, they do not buy or hold the assets replicating the performance of the underlying index. Some of the indexes and investment strategies used by ETNs can be sophisticated and very complex, carrying many different risks. They should be offered only to people who are knowledgeable and comfortable with the risks. Those risks in part include credit risk. ETNs are unsecured debt obligations. Market risk. Liquidity risk. Although exchange-traded, a trading market may not develop. Call, early redemption, and acceleration risk. ETNs may be called at the issuer's discretion. And conflicts of interest. The issuer may engage in trading activities that are at odds with note holders, shorting for instance. Leveraged ETFs. These funds attempt to deliver a multiple of the return of the benchmark index they are designated to track. For instance, a 2 times leveraged fund would try to deliver 2 times the return of whatever index it is tracking. With leveraged funds, there are no limits by rule or regulation as to the amount of leverage that could be applied to a portfolio. Currently, there are numerous 2x and 3x leveraged funds available to investors. The risk associated with leverage is that it is always a double-edged sword. Volatility is magnified. Therefore, the risk to be recognized regarding this fund strategy is that if the benchmark index is falling, then the fund's returns will beat, in theory, the designated leverage amount, perhaps 2 or 3 times the loss. In addition, most of these funds use derivative products, such as options, futures, and swaps, to enable them to achieve the stated goal. Because these derivative products are not suitable for all investors, so too can it be said of the leveraged fund portfolio containing them. Ultimately, as always, suitability becomes an issue when recommending these products. Inverse, short, or bear funds. Inverse funds, sometimes referred to as bear or short funds, attempt to deliver returns that are the opposite of the benchmark index they are tracking. For example, if the benchmark is down 2%, the fund's goal is to be up 2%. In addition, inverse funds can also be leveraged funds or, said another way, 2 or 3 times the opposite of the indice's return. You won't find investors looking for a bull inverse fund. That would be one where if the index goes up, the value of your investment goes down. Not an attractive strategy. Test topic alert. Leveraged and inverse ETFs use options and other derivatives to achieve their goals. Example. A simple example of this would be an inverse fund tracking the S&P 500. If the index were to drop by 1%, the value of the inverse fund would rise by 1%. If this were a 3 times inverse fund, then the fund's value would rise by 3%. Of course, if the index were to rise, the performance of the inverse fund would suffer, especially if it was leveraged. Test topic alert. FINRA warns investors that most leveraged and inverse ETFs reset daily, meaning that they are designed to achieve their stated objectives on a daily basis. Their performance over longer periods of time over weeks or months or years can differ significantly from the performance or inverse of the performance of their underlying index or benchmark during the same period of time. Therefore, in most cases, these would not be suitable investments for buy and hold investors or those with other than a very short time horizon. For the TVIX, Velocity shares daily 2 times VIX STETN. One of the risk disclosures, page 28, PS 28, reads like this. The long-term expected value of your ETNs is 0. If you hold your ETNs as a long-term investment, it is likely that you will lose all or a substantial portion of your investment. Take note. Both leveraged and inverse index funds, leveraged or not, can be traded on an exchange. When they are known as exchange-traded funds, ETFs. If the shares are exchange-traded, they are priced by supply and demand, can be purchased on margin, and are bought and sold throughout the trading day, like all exchange-traded products. For those that are not exchange-traded, for example, inverse mutual funds, they would be priced, purchased, and redeemed like all investment company shares. Neither of these fund types carry any guarantee that they will achieve the stated goals or objectives. Structured products. When you need something that doesn't yet exist, what do? You build it. That is the concept behind structured products. They are built, structured, to meet specific needs. In many cases, they involve structuring a debt issue in such a fashion as to provide lower borrowing costs to the issuer, while increasing potential returns to the lender. The goal is to give investors more reasons to accept a lower interest rate on debt in exchange for certain features. In other examples, options and other derivatives are used to provide possible principal protection or other goals. Needless to say, for the most part, these are highly complex products and should be limited to those investors who have the necessary financial sophistication to be able to understand the potential risks. When used properly, they can be useful tools to increase portfolio diversification. Structured notes with principal protection. FINRA defines the term structured note with principal protection as any structured product that combines a bond with a derivative component and offers a full or partial return of principal at maturity. Structured notes with principal protection typically reflect the combination of a zero-coupon bond, which pays no interest until the bond matures, with an option or other derivative product whose payoff is linked to an underlying asset, index, or benchmark. These notes are promises to pay made by the product issuers. That is why any guarantee that the principal will be protected, whether in whole or in part, is only as good as the financial strength of the company that makes that promise. For those who can remember, this is what happened to investors who purchased structured notes with principal protection issued by Lehman Brothers Holdings, which declared bankruptcy in September 2008. Knowledge Check 5.2. Question 1. Inverse ETFs are least suitable for investors. A. With a long time horizon. B. Who are bearish on the market's future. C. Wishing to take higher than normal risk. D. Who follow an active investment strategy. The correct answer is A. Inverse and leveraged ETFs are structured in such a manner that holding them for more than a few days or a week becomes unattractive. They are for bearish investors, which is why they are often referred to as short funds. They are purchased for short-term capital gains. There is no income. Short-term investors are following an active strategy. Question 2. All of the following are characteristics associated with equity-linked notes, ELNs, except A. They are equity securities. B. They are considered an alternative pooled investment. C. They have final payments at maturity linked to the return of an underlying stock or basket of stocks. The correct answer is A. Despite their name, equity-linked notes, ELNs, are debt instruments, not equity instruments. They have a partial fixed return, as well as a final payment linked to the performance of a single stock or equity index. Some are exchange-traded, while others trade OTC. FINRA, which considers ELNs to be non-conventional structured investments, has expressed concerns that investors might not fully understand ELNs or the risks associated with them. Lesson 5.3. Other alternative investments. Learning Objective 5D. Compare viaticals and life settlement policies. The terms viatical and life settlement are often used interchangeably, but they are technically not quite the same. The most significant and testable difference is that viaticals apply to those with a terminal illness and a life expectancy of 24 months or less regardless of their age, while life settlements apply to those who, although generally at least 65 years old, are in decent health with a life expectancy of at least 2 years that can run 10 years or longer. Health and life expectancy aside, the concepts are the same for both. In general, almost any kind of life insurance policy can be sold, although most companies will not purchase a straight, non-convertible term life policy. Viatical settlements emerged in the early 1990s in response to the AIDS crisis to create opportunities for terminally ill patients to receive money by selling their life insurance death benefits for much more than the cash surrender value available, but less than the death benefit from insurance companies. The idea is that the money the person gets from the settlement is to go toward paying for medical expenses during this 2-year period. Interests in the settled insurance policies are then sold to investors, with the promise of returns in the form of the death benefit, an amount higher than the purchase price, to be paid upon the death of the insured. As the market has expanded, viatical settlement providers have turned to new classes of viators, those selling their life insurance policies, including the elderly and the chronically ill. Selling a life insurance policy, or the right to receive the death benefit, to any person other than the insurance company that issued the policy is a transaction known as a viatical or life settlement. NASA concludes that these settlements, regardless of the health status or age of the insured, are securities. All persons involved in the offer and or sale of viatical or life settlements should be aware of the nature and extent of the registration and anti-fraud provisions of state securities laws, as well as the applicability of these provisions to every offer and or sale of a security. Because licensing is done on a state-by-state basis, there is little uniformity. Some states require just a life insurance license, some require both a life insurance and a life settlement license, and some require either or both of these and being licensed as a securities agent. As with so much else, the regulators are concerned about suitability and disclosure. When a life insurance policy is sold to an investor, the buyer is acquiring a financial interest in the insured's death. In addition to paying a lump sum, the purchaser agrees to pay any premiums that are necessary to support the cost of the policy for as long as the insured lives. In exchange, the buyer will receive the death benefit upon death of the insured. It is important to be aware of the risks involved in this activity. Because there is no active secondary market for these policies, it is difficult to arrive at a fair evaluation, and the investor may wind up paying too much for the policy. The chance that the insured will live longer than anticipated the more the insured's life exceeds the projected expectancy, the lower the return to the investor. The possibility, remote as it is, that the insurance company will not be financially able to honor the claim, and the intangible moral issue of the investor, knowing that the sooner the insured dies, the greater the return. Learning Objective 5E. Contrast passive and active real estate investing. We have already discussed two methods of passive real estate investing, that is, investing in real estate where all of the work is done for the investor. That is the case with the REIT and the Real Estate Limited Partnership Investment, DPP. Investing in real estate, whether it be single-family homes to flip or to rent or commercial property, involves work on the part of the investor. Whether it is collection of rents, finding tenants, or doing repairs, the investor is responsible for doing the work or hiring someone to do it. One of the other differences is taxation. As a passive investor, the income to an owner of a real estate limited partnership DPP is considered passive income, taxed as ordinary income, while losses are passive losses and can be deducted, but only from passive income. For active investors, it can get quite complicated and beyond the scope of the exam. However, you should know that there are cases where the activity level is such that the investor is deemed to be buying and selling real estate, such as flipping homes, as a business, not as an investment. That could lead to losses being deducted from regular income, rather than passive income as ordinary loss. Learning Objective 5. Identify the different types of commodities and precious metals that are popular investments. In the previous unit, we discussed futures. They are one of the methods by which individual investors can invest directly in commodities. Forwards are used primarily by producers and industrial consumers. One can also invest indirectly through ETPs, exchange-traded products, such as ETFs, that follow a commodity index, or mutual funds that invest in commodity-related businesses. For instance, an oil and gas fund would own stocks issued by companies involved in energy exploration, refining, storage, and distribution. Historically, most commodity trading was of agricultural products. We were an agrarian society, and these commodities such as corn, wheat, oats, and soybeans are still actively traded. There are also animal-based commodities such as beef, pork, and eggs. Today, the most commonly traded commodity is crude oil, with coffee often claimed to be in second place. And of course, for all of you Eddie Murphy fans, remember the movie Trading Places. There are frozen orange juice futures. Active trading also takes place in industrial metals such as aluminum, nickel, copper, and lead. These are not considered precious metals. Speaking of metals, it is hard to turn on the TV today without seeing a commercial for gold or silver investments. Whether you agree or not with the ads, for millennia, individuals and governments have stored their wealth in precious metals. Knowledge Check 5.3. 1. Your customer, age 68, is in reasonably good health. After the sale of her business, the need for maintaining a $1 million whole life insurance policy is questionable. Which of the following would be a reasonable recommendation if the decision were made that the policy is no longer needed? A. Engage in a life settlement sale. B. Engage in a via TICAL sale. C. Borrow the maximum cash value and invest it in an index ETF. D. Terminate the policy, take the cash value proceeds, and begin writing. The correct answer is A. For individuals at least 65 years of age, in reasonably good but not excellent health, the life settlement is potentially a suitable recommendation. Why not a via TICAL? Although the effects are basically the same, viaticals are for those with a terminal condition and a life expectancy of up to 24 months. Borrowing out the cash value means keeping the policy when the decision was made to terminate the coverage. Surrendering the policy for its cash value will never realize as much as the sale, and in any event, recommending the use of the proceeds to write uncovered call options is likely much too speculative. 2. All of the following would be considered passive real estate investing except A. Buying homes and managing the rental of them. B. Investing in mortgage REITs. C. Real estate limited partnerships, RELPs. D. Owning shares of the common stock of Better Home Builders. The correct answer is A. Real estate investing, where the investor works with the property, is active rather than passive. In a passive real estate investment, as with any other passive investment, the work is done by others, not the investor. Examples are REITs and stock and real estate companies, such as those who build homes. 3. Many investors look at precious metals as a hedge against inflation. Those investors would be most likely to own A. Uranium, B. Cadmium, C. Lead, D. Platinum. The correct answer is D. We like to think of a precious metal as something you'd find in a jewelry store. The primary choices on the exam will be silver, gold, and platinum. Some of our students remember precious metals by thinking about the credit cards or travel status they have. I have never been on a flight where they praise their lead-level flyers, but silver, gold, and platinum seem to get priority over the rest of the bunch. I'm not sure a good friend would appreciate a uranium bar as a gift. Lesson 5.4. Benefits and Risks of Alternative Investments. Learning Objective 5 grams. Describe the benefits and risks of alternative investments in client portfolios. Most alternative investments share similar benefits and risks. Usually, these investments offer low or even negative correlation to the stock market, resulting in greater diversification of the portfolio. This can lead to greater overall long-term returns with reduced risk. In some cases, there are opportunities for abnormal returns high and low. As was done with pooled investment vehicles in Unit 3, we'll take these one at a time. DPPs. The DPP investor enjoys several advantages, including an investment managed by others, flow-through of income and certain expenses, and limited liability. The most the investors can lose is the amount of their investment plus any funds committed for, but not yet remitted. The exam will probably give more attention to the following disadvantages. Liquidity risk. The greatest disadvantage is lack of liquidity. Because the secondary market for DPPs is limited, investors who want to sell their interests frequently cannot locate buyers. Legislative risk. When Congress changes tax laws, new rules can cause substantial damage to LPs, who may be locked into illiquid investments that lose previously assumed tax advantages. Risk of audit. Statistics from the IRS indicate that reporting ownership of a DPP results in a significantly higher percentage of returns selected for audit. Depreciation recapture. One of the tax benefits is the ability to depreciate most fixed assets, especially when that depreciation can be accelerated. The effect of the depreciation deduction is to lower the tax basis of the asset. If that asset is then sold for more than that basis, the excess is recaptured and subject to tax, possibly at ordinary income tax rates. You won't need to know anything more than the concept. Practice question. Benefits of investing in a DPP would include Roman numeral 1, high liquidity. Roman numeral 2, flow-through of operating losses. Roman numeral 3, limited liability. Roman numeral 4, immunization against tax audit. A. 1 and 2. B. 1 and 4. C. 2 and 3. D. 3 and 4. The answer is C. DPPs are structured as flow-through entities, giving their investors opportunity to receive income without the partnership being taxed first. In addition, if there are losses, they get the opportunity to write off those losses against passive income from other DPPs. As limited partnership vehicles, they offer their investors liability limited to their investment. They generally have very low liquidity, and instead of reducing the tax audit risk, they actually increase it. Real estate. Real estate investing offers several benefits. Historically, real estate has been a hedge against inflation. It provides rental income, cash flow, a portion of which may be tax-advantaged due to depreciation and interest deductions. It offers high leverage. Real estate loans generally require a relatively small down payment. Investment real estate is not generally correlated with stock market returns. Investors should also be aware of some of the risks. In general, a lack of liquidity, certainly when compared to stocks, bonds, or mutual funds, is a risk. If purchased for rental, each month that the property is not rented is money lost. High leverage can work against the investor in a down market. The individual just might not have the skills necessary to manage the property, and hiring someone else could eliminate or greatly reduce the profits. Any good asset allocation program should have real estate, but other than owning your own home, at least for most investors, REITs are probably the preferred option. Practice question. Among the reasons for investors to consider investing in real estate would be all of the following except A. The ability to increase returns through leverage. B. A high correlation with stock market returns. C. Possible tax advantages. D. Potential appreciation. The answer is B. One of the investment advantages of real estate is that returns are generally negatively correlated with those of the stock market. Risks of structured products. There are several risks involved with structured products. First, because of the customized nature of these products, there is little or no liquidity. Second, in most cases, these are structured so that the returns are not fully realized until maturity. As a result, these should appeal to buy and hold investors rather than short-term traders. There is also the matter of credit risk, so it is important to know the strength of the financial institution who is the issuer. Finally, as with most alternative investments, there is a lack of efficient pricing. That is, the actual market price does not necessarily reflect the real value. This can lead to abnormal returns, good and bad. Knowledge Check 5.4. Question 1. Although there can be many benefits to investing in an oil and gas limited partnership drilling program, risks include A. Limited liquidity, B. Potential for a tax audit, C. Drilling a dry hole, D. All of the above. The correct answer is D. These are just some of the risks in an oil and gas drilling DPP. Obviously, the dry hole would not apply to real estate or equipment leasing programs, but they have their unique issues. Question 2. Among the reasons for investors to consider investing in real estate would be all of the following except A. The ability to increase returns through leverage, B. A high correlation with stock market returns, C. Possible tax advantages, D. Potential appreciation. The correct answer is B. One of the investment advantages of real estate is that returns on real estate generally have a low correlation to stock market returns. That low correlation increases the diversification, lowering the overall risk and likely increasing overall return. Question 3. Although it is widely agreed that adding precious metals to a portfolio can potentially increase returns, doing so is not without risk. Risks that investors face with this asset class include A. Storage cost, B. Lack of income, C. Larger spreads when buying and selling than are found with most equities, D. All of the above. The correct answer is D. Most investors in precious metals pay to have the asset in safe storage. This is an ongoing cost, and it cannot be offset by income, as would be the case with owning bonds or dividend-paying stock. The nature of this business is such that spreads between the buy and sell price are typically significantly higher than when trading securities.
Unit 6. Basic Economic Concepts. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 6A. Analyze the 4 stages of the business cycle. Learning Objective 6 bits. Identify the 3 types of yield curves and how they reflect interest rates. Learning Objective 6C. Identify fundamental economic principles, including the difference between monetary and fiscal policy. Learning Objective 6. Differentiate between inflation and deflation and how they are affected by the major economic indicators. Your exam will include approximately 6 questions from the topics covered in Unit 6. Introduction. Investment decisions are made within the context of the general economic climate and are based on the specific merits of the selected investments. This unit will deal with basic economic concepts such as monetary and fiscal policy, the business cycle, yield curves, and measuring inflation. Lesson 6.1. Economic Theories. Learning Objective 6A. Analyze the 4 stages of the business cycle. Business cycles. Business cycles reflect fluctuations in economic activity as measured by the level of activity in such variables as the rate of unemployment and the GDP. Periods of economic expansion have been followed by periods of contraction in a pattern called the business cycle. Business cycles go through 4 stages: expansion, peak, contraction, and trough. Definition: Gross Domestic Product, GDP. GDP is the market value of all final goods and services produced within a country in a given period of time. To account for inflation, GDP in the United States is based on a constant dollar, currently the value in 2012. Expansion or recovery is characterized by increasing business activity in sales, manufacturing, and wages throughout the economy. When GDP increases rapidly and businesses reach their productive capacity, the nation's economy cannot expand further. At this point, the economy is said to have reached its peak. When business activity declines from its peak, the economy is contracting. Economists call mild short-term contractions recessions. Longer, more severe contractions are depressions. When business activity stops declining and levels off, the cycle makes a trough. According to the U.S. Department of Commerce, the economy is in a recession when a decline in real output of goods and services, the GDP, continues for 2 or more consecutive quarters. It defines a depression as a decrease in GDP for 6 consecutive quarters. The 4 stages of the business cycle. A graph of the business cycle with real GDP on the vertical axis and time on the horizontal axis. There is an upward sloping wave representing overall economic growth reinforced by a linear upward sloping average line bisecting the wave. The wave is labeled in the 4th stage of the business cycle, a contraction when the wave goes below the average, a recessionary trough when the wave is at its lowest point, an expansion when the wave begins to move toward the average, and a business peak when the wave is at its apex for the cycle. The 4 stages of the business cycle. To determine the economy's overall direction, economists consider many trends in business activity. Expansions are characterized by increasing consumer demand for goods and services, possibly leading to an increasing rate of inflation, and increasing industrial production, generally leading to a decreasing unemployment rate as hiring accelerates, falling inventories, rising stock markets, rising property values, and increasing GDP. Peaks are characterized by a decrease to the GDP growth rate, a decrease to the unemployment rate, but a slowdown in hiring, a slower rate of growth in consumer spending and business investment, and an increase to the inflation rate. Contractions/recessions in the business cycle tend to be characterized by rising numbers of bankruptcies and bond defaults, decreasing working hours and increasing unemployment rate, decreasing consumer spending, home construction, and business investment, falling stock markets, a decrease to the inflation rate, rising inventories, a sign of slackening consumer demand, and a negative growth rate for the GDP. Troughs tend to be characterized by a change from negative to positive GDP growth rate, a high unemployment rate and increasing use of overtime and temporary workers, a possible increase in spending on consumer durable goods and housing, and a moderate or decreasing inflation rate. Practice question. If the Consumer Price Index, CPI, is down but consumer demand is up, the economy is likely in which stage of the business cycle? A. Trough to expansion. B. Peak to contraction. C. Recovery to trough. D. Contraction to trough. The answer is A. As prices trend downward and consumer demand increases, the economy is recovering from a trough, the bottom, to expansion, choice A, as demand continues to increase. Assuming supply remains constant, upward pressure will be put on prices through the expansion to the peak. Analysts will frequently make investment decisions based upon where we are in the business cycle. Certain industries outperform while others underperform at different points in the cycle. Following are several examples. Cyclical industries. Cyclical industries are highly sensitive to business cycles and inflation trends. Most cyclical industries produce durable goods such as heavy machinery and automobiles, as well as raw materials such as steel. During recessions, the demand for durable goods declines as manufacturers postpone investments in new capital goods and consumers postpone purchases of automobiles. On the other hand, countercyclical industries tend to turn down as the economy heats up and arise when the economy turns down. Gold mining has historically been a countercyclical industry. Growth industries. Most industries pass through 4 phases during their existence: introduction, growth, maturity, and decline. An industry is considered in its growth phase if the industry is growing faster than the economy as a whole because of technological changes, new products, or changing consumer tastes. Social media and bioengineering are examples of current growth industries. Because many growth companies retain nearly all of their earnings to finance their business expansion, growth stocks usually pay little or no dividends. Defensive industries. Defensive industries are least affected by normal business cycles. Companies in defensive industries generally produce non-durable consumer goods such as food, pharmaceuticals, tobacco, and energy. Public consumption of such goods remains fairly steady throughout the business cycle. During recessions and bear markets, stocks in defensive industries generally decline less than stocks in other industries. During expansions and bull markets, defensive stocks may advance less. Investments in defensive industries tend to involve less risk and consequently lower investment returns. Those using sector rotation will rotate into defensive issues when it appears the business cycle is headed into the contraction phase. Practice question. Let's make sure you understand these terms. An investor fears a coming recession. She would probably invest in A. Biotech, B. Steel producers, C. Drug companies, D. Home builders. The answer is C. In a recessionary period, business activity slows, so one should take a defensive position. Drug companies, pharmaceuticals, tend to have steady earnings, even in bad economic times. After all, those taking needed prescription drugs will not stop. Even OTC drugs like headache remedies and antacids will continue to be sold, some say even more in a downturn. People generally don't buy a new home when things slow down, nor do they buy new cars. Much of the steel produced goes into the manufacturing of autos. Biotech companies will find that funding for experimental treatments dries up. Practice question. When the business cycle is in the recovery stage, what type of industry tends to perform the best? A. Countercyclical. B. Cyclical. C. Defensive. D. Growth. The answer is B. In general cyclical industries, those that follow the cycle tend to be the best performers during expansion, recovery. Countercyclical industries would tend to go in the opposite direction, and defensive industries are billed as such because they tend to be stable regardless of where we are in the business cycle. Most economists would agree that growth industries react later as the recovery gets closer to the peak. Learning Objective 6 bits. Identify the 3 types of yield curves and how they reflect interest rates. Although interest rates in general reflect investor expectations about inflation, short-term rates reflect the policy decisions of the Federal Reserve Board, FRB, as it implements the nation's monetary policy. Interest rates. An interest rate is the cost of borrowing money. The rate a borrower pays for funds is determined by the supply and demand for loanable funds, the credit quality of the borrower, and the length of time for which money is borrowed. In addition, the cost of funds is influenced by factors not related to the borrower, such as current and expected inflation. When a company borrows money by issuing bonds, the bonds have a fixed interest rate or coupon payment. As interest rates fluctuate, the price of the bonds in the secondary market also fluctuates. When interest rates increase, bond prices decrease. When interest rates decrease, bond prices increase. Thus, there is an inverse relationship between interest rates and bond prices. Nominal interest rates. The nominal rate of interest is the actual rate of interest a borrower pays on the borrowed money. If inflation is expected, it is likely that interest rates are going to increase. That means that new loans, for example, bonds, will carry a nominal rate higher than the bonds currently available. As a result, as interest rates rise, market forces will lead the price of those older, lower interest rate bonds to decline. That is because an investor's rate of return needs to be equivalent to current market conditions. Example. Although covered in Unit 2, here is a refresher. A bond has a nominal yield of 5%. That means it is paying 5% interest annually on the loan or $50 on each $1,000 bond. If interest rates rise to 7%, where a newly issued bond is paying $70 per year, would you pay $1,000 to buy the bond paying $50 per year? Probably not. To make the old bond attractive to investors, the price will have to decline. In this case, it might sell for approximately $700. Why? Because receiving $50 per year, the loan rate is a fixed percentage of the $1,000 loan. On an investment of $700, give you a return of just a bit over 7%. 50 divided by 700 equals 7.14%. Yield curve analysis. An important tool in gauging investor sentiment toward future interest rates is analyzing the yield curve. Plotted on a graph, the difference between short and long-term interest rates normally reflects an upward sloping line known as the yield curve. When it is an upward sloping curve, it is a positive or normal yield curve. Long-term interest rates are normally higher than short-term rates for a number of reasons. Lenders must be compensated for the time value of money, reduced buying power of money resulting from inflation, increased risk of default over long periods, and loss of liquidity associated with long-term investments. The yield curve is also a reflection of investor expectations about inflation. If investors expect high inflation rates, they will require higher rates of return to compensate for the reduction in purchasing power over time. Take note. When the yield curve is normal, long-term interest rates are higher than short-term interest rates. On a graph, the normal yield curve is upward sloping. A graph showing a normal positive yield curve. The vertical axis is yield and the horizontal axis is years to maturity. The sloped line representing the yield curve rises steeply, thus starting at 0 years to maturity for several years until it begins to taper to an almost horizontal line by the end of the graph. Years to maturity. In unusual circumstances, the yield curve can be inverted or downward sloping. An inverted or negative yield curve can be the result of high current demand for money relative to the available supply. Short-term interest rates tend to be more sensitive to Fed policy than long-term rates. An inverted yield curve may occur because of a sharp increase in short-term rates. Therefore, when you notice a negative yield curve, you can expect that interest rates have rapidly risen and, according to most analysts, they will soon retreat. A graph showing an inverted, negative yield curve. The vertical axis is yield and the horizontal axis is years to maturity. The sloped line representing the yield curve declines steeply, thus starting at 0 years to maturity for several years until it begins to taper to an almost horizontal line by the end of the graph. When short-term and long-term rates are the same, it is called a flat yield curve. Test topic alert. You will need to be able to recognize the different yield curves from their shape. A normal, positive curve slopes upward. An inverted, negative curve slopes downward. And there is such a thing as a flat yield curve, which, as the name implies, is level throughout all of the maturities. Take note. The shape of the yield curve varies with changes in the economic cycle. A normal or ascending yield curve occurs during periods of economic expansion. It generally predicts that interest rates will rise in the future. A flat yield curve occurs when no change in interest rates is expected. An inverted or descending yield curve occurs when the Federal Reserve Board has tightened credit in an overheating economy. It predicts that rates will fall in the future. Yield curves for issuers with different risk levels can be compared to make economic predictions. Yield spread, credit spread. It should be obvious that the greater the risk, the higher the yield on the bond. Many analysts compare the difference between yields on bonds with the same maturity but different quality ratings to get a sense of the market sentiment. One common measurement is the difference in yields between treasuries and corporate bonds. This difference is called the yield spread and tends to widen when economic conditions sour and narrow when they get better. Yield spread can also be used between issues of the same issuer. For example, one of the most popular measurements of attitudes regarding future economic conditions is the yield spread between the 2-year Treasury note and the 10-year Treasury note. When investors are feeling optimistic about the economy, the yield spread narrows. When pessimistic, the yield spread widens. Example. How is the yield spread predictive? If the yield spread between corporate bonds and government bonds is widening, a recession is expected. Investors have chosen the safety of government bonds over higher corporate yields, which occurs when the economy slows down. If the yield spread between corporate bonds and government bonds is narrowing, an economic expansion is expected, and so investors are willing to take risks. They will sell government bonds to buy higher-yielding corporates. Test topic alert. When constructing a yield curve, the method is to use bonds of a single issuer over varying maturities. Specifically, most rely on the curve drawn when plotting yields on U.S. Treasury securities, starting with the 91-day T-bill and ending with anything from the 10-year note to the 30-year bond. Practice question. A bond analyst is plotting a yield curve and notices that short-term maturities have higher yields than intermediate and long-term maturities. This is an example of A, an inverted yield curve, B, a positive yield curve, C, a normal yield curve, D, an algorithmic yield curve. The answer is A, an inverted or negative yield curve is one that results when debts with short-term maturities has higher yields than those with maturities that are longer. A positive or normal yield curve results when the yields increase as maturities do. Knowledge Check 6.1. Question 1. The business cycle includes all of the following classifications except A. Expansion, B. Peak, C. Trough, D. Waves. The correct answer is D. Throughout modern history, periods of economic expansion have been followed by periods of contraction in a pattern referred to as the business cycle or economic cycle. Business cycles go through 4 stages: expansion, peak, contraction, and trough. Question 2. An upward sloping yield curve represents which of the following? A. Time value of money, B. Increased risk of default over time, C. Inflation expectations, D. All of the above. The correct answer is D. The time value of money is reflected in the upward sloping yield curve. Longer-term rates require higher rates to compensate for loss of current buying power and liquidity. Longer-term funds bear a higher risk of default than do shorter-term funds and, as a result, command higher rates. Increasing inflation expectations cause the yield curve to slope upward to compensate lenders for the loss of value through inflation. Lesson 6.2. Practical Economics for Investors. Learning Objective 6C. Identify fundamental economic principles, including the difference between monetary and fiscal policy. The economic climate has an enormous effect on the conditions of individual companies, and therefore the securities markets. In addition to a company's earnings and business prospects, any changes in government policy, business cycles, money supply, and Federal Reserve Board (FRB) actions affect securities prices and trading and the markets at large. In today's global economy, economic conditions abroad can influence the conditions domestically and in turn will also impact our securities markets. This unit will explore some of these factors. Fiscal policy refers to a government's use of spending and taxation to influence economic activity. The budget is said to be balanced when tax revenues equal government expenditures. A budget surplus occurs when government tax revenues exceed expenditures, and a budget deficit occurs when government expenditures exceed tax revenues. Monetary policy refers to the central bank's actions that affect the quantity of money and credit in an economy in order to influence economic activity. Monetary policy is said to be expansionary or accommodative or easy when the central bank increases the quantity of money and credit in an economy. Conversely, when the central bank is reducing the quantity of money and credit in an economy, the monetary policy is said to be contractionary or restrictive or tight. Monetary policy is under the control of the Federal Reserve Board, the Fed. Take note. It is important for you to know that the fiscal policy of the United States is determined by the President and Congress through the process of budgeting and taxation. The budget is presented by the President and usually after some negotiation, approved by Congress. The final step is the signature of the President. Monetary policy is determined by the Board of Governors of the Federal Reserve System. Unlike monetary policy, the Federal Reserve has nothing to do with fiscal policy. Major schools of economics. Keynesian economics. Named after the economist John Maynard Keynes, pronounced Keynes, Keynesian economists recognize the importance of government intervention. In 1936, Keynes published the General Theory of Employment, Interest, and Money, in which he revolutionized the way economists think about macroeconomics. He laid out how and why recessions happen and what must be done to recover from them. His strategy for recovery from a recession was for governments to run deficits to stimulate demand and employment. In other words, he suggested lower levels of taxation and more government spending. Classical and supply-side economics. Classical economists favor a school of thought referred to as supply-side economics. The most notable feature of this idea is the belief that lower taxes and less government regulation benefits consumers through a greater supply of goods and services at lower costs. Supply-side economics holds that supply creates demand by providing jobs and wages. The prices of goods of which there is excess supply will fall, and the prices of goods in demand will rise. Monetarist theory. Monetarists, such as the late Milton Friedman, believe that the quantity of money or money supply determines overall price levels and economic activity. Too many dollars chasing too few goods leads to inflation, and too few dollars chasing too many goods leads to deflation. One of the principal roles of the Federal Reserve Board is monitoring the money supply and making adjustments when necessary. Tools of the Federal Reserve Board. Because the Federal Reserve Board, the Fed, determines how much money is available for businesses and consumers to spend. Its decisions are critical to the U.S. economy. There are three primary tools employed to affect the money supply. Changes in reserve requirements. By raising the amount of funds commercial banks must leave on deposit with the Fed, the amount of money available for these banks to lend out is decreased. This shrinkage of the money supply generally translates into higher interest rates. The reverse is true when reserve requirements are eased. Changes in the discount rate. This is the rate the Fed charges member banks when lending them money. Higher rates discourage borrowing, reducing the money supply, with lower rates having an opposite effect. Open market operations. The Fed buys and sells U.S. Treasury securities in the open market under the direction of the Federal Open Market Committee, FOMC. When treasuries are purchased, it adds to the money supply. This is because the FOMC is purchasing these securities from commercial banks, causing the banks to have greater reserves. When the FOMC sells treasuries, the money supply is reduced because funds are pulled out of the bank's reserves to pay for those securities. This is the most actively used Fed tool. There is a fourth item that, although not set by the Fed, is highly influenced by their actions. That item is the federal funds rate. The federal funds rate is the rate banks that are members of the Federal Reserve System charge each other for overnight loans of $1 million or more. The rate is considered a barometer of the direction of short-term interest rates. The federal funds rate is listed in daily newspapers and is the most volatile rate. It can fluctuate drastically under certain market conditions. Take note. The Federal Reserve Board establishes the discount rate. The discount rate, unlike the federal funds rate, is a managed rate. It is one of the tools of monetary policy. In contrast, the federal funds rate is a market rate determined by the demand for bank reserves on the part of deposit-based financial institutions. One final rate to discuss is the prime rate. The prime rate is the most preferential interest rate on corporate loans at large U.S. money center commercial banks. Each bank sets its own prime rate, with larger banks generally setting the rate that other banks follow. Banks lower their prime rates when the Fed eases the money supply and raise rates when the Fed contracts the money supply. Practice question. Which of the following statements regarding significant interest rates in the U.S. economy is not true? A. The federal funds rate is the rate the Federal Reserve charges for overnight loans to member commercial banks. B. The prime rate is the interest rate that large U.S. money center commercial banks charge their most creditworthy corporate borrowers. C. The discount rate is the rate the New York Federal Reserve Bank charges for short-term loans to member banks. D. The most active tool used by the Fed is the buying and selling of Treasury securities by the FOMC. The answer is A. The federal funds rate is the rate that member banks charge each other for overnight loans of $1 million or more. It is not the rate that the Federal Reserve charges member banks for overnight loans. Test topic alert. Although the Fed's actions certainly impact all interest rates, you'll need to know that the Fed does not set the prime rate that is done by the major commercial banks. Test topic alert. Know the fundamentals of fiscal and monetary policy. Fiscal policy. Actions of Congress and the President and government spending and taxation. Monetary policy. Policy of the Federal Reserve Board, FRB. Discount rate set by the Fed. Reserve requirement, most drastic, and open market operations, most frequently used. Definition. Balance of payments. The balance of payments measures all the nation's import and export transactions with those of other countries for the year. The balance of payments account contains all payments and liabilities to foreigners, debits, and all payments and obligations, credits received from foreigners. Test topic alert. When you receive interest on your bank account, what happens to that account? It's simple. Your balance is credited, it goes up. When foreign money is received here, such as interest received on money loaned to foreign business enterprises, there is a credit to the foreign account balance of the United States. Conversely, a debit reduction to the foreign account balance of the United States occurs when money leaves our shores, such as loans made to foreign governments or dividends paid on foreign investment in the United States. Take note. If the U.S. dollar weakens, meaning it buys less of a foreign currency, such as Japanese yen, it makes U.S. exports more competitive in foreign markets. Conversely, if the U.S. dollar strengthens and buys more yen per dollar, it makes U.S. exports less competitive in foreign markets. Test topic alert. One way an investor can protect against a weakening U.S. dollar is to invest in foreign securities. In Unit 1, we discussed the American Depositary Receipt, ADR, the simplest way to invest in individual foreign securities. Balance of trade. The largest component of a country's balance of payments is usually its balance of trade, that is, comparing the country's exports to its imports. Trade deficit. A trade deficit is an excess of one country's imports over its exports and is reported as part of the balance of payments figures. Over time, an excessive trade deficit can lead to the devaluation of a country's currency because the country will be converting or selling its currency to obtain foreign currency to pay for its increasing imports. Trade surplus. The opposite of a trade deficit, a trade surplus is an excess of one country's exports over its imports and is reported as part of the balance of payments figures. Over time, an excessive trade surplus can lead to the strengthening of a country's currency. Example. On the U.S. credit side are sales of American products to foreign countries. On the debit side are American purchases of foreign goods that cause American dollars to flow out of the country. When debits exceed credits, A deficit in the balance of payments occurs. When credits exceed debits, a surplus exists. Balance of trade. Debit items. Imports. U.S. spending abroad. U.S. investments abroad. U.S. bank loans abroad. U.S. foreign aid and credit items. Exports. Foreign spending in the United States and foreign investments in the United States. Example. If the dollar value of French perfume imported into the U.S. is greater than the dollar value of Kentucky bourbon exported to France, the difference results in a negative trade balance, creating a debit to the U.S. trade account and a credit to France's. We think the following chart will help you solidify the concepts. When the U.S. dollar is weak, exports or money flowing in increases. Imports or money flowing out decreases. Trade, surplus, more money flowing in than out. Preference, exporters and producers. When the U.S. dollar is strong, exports or money flowing in decreases. Imports or money flowing out increases. Trade, deficit, more money flowing out than in. Preference, importers and consumers. Analytical methodology. There are two popular methods used by analysts to help them determine where the best investment opportunities lie. Top-down analysis. If we were to draw a picture of top-down analysis, it would look like an inverted isosceles triangle, broad on top and narrow on the bottom. The analyst starts with the broadest measure of the overall economy and then successively narrows it down to finally select the company or companies that best fit the objectives. Bottom-up analysis. This is the direct opposite of top-down. In this case, we merely start at the bottom, the point, of the triangle with the specific company and work our way up through the industry and then the economy. This analyst starts with the narrowest indicator and then steadily broadens the search. Learning Objective 6. Differentiate between inflation and deflation and how they are affected by the major economic indicators. Inflation. Inflation is a general increase in prices as measured by an index such as the Consumer Price Index, CPI, described in detail shortly. Mild inflation can encourage economic growth because gradually increasing prices tend to stimulate business investments. High inflation reduces a dollar's buying power, which can reduce demand for goods and services. A term that may appear on your exam is inflation inertia. This is the concept that the rate of inflation does not immediately react to unexpected changes in economic conditions. Rather, it lags behind, sometimes for several quarters, before there is an effect. Sometimes the term inertial rate of inflation or inertial inflation is used. This is the persistent rate of inflation that continues at the same rate until an economic shock leads to a change. One of the results of this is that prices rarely go down. After all, what company wants to lower the prices of its goods or services, and how many workers are willing to accept wage cuts? So, prices generally continue to advance, hopefully at a slow rate. Test topic alert. Because inflation is a global issue, not just confined to the United States and our dollar, a universal definition would be a decrease in the value of the monetary unit. Inflation is caused by excessive demand and monetary expansion. Excessive demand occurs when aggregate demand exceeds the aggregate supply and prices rise. Monetary expansion is a rapid increase in a nation's money stock in excess of the nation's growth rate. Increased inflation drives interest rates higher and drives bond prices lower. Decreases in the inflation rate have the opposite effect. Bond yields decline and bond prices rise, as you will learn shortly. Take note. An increase in real income means the percentage increase in income is greater than the rate of inflation. Buying power has increased. Deflation. Though rare, deflation is a general decline in prices. Deflation usually occurs during severe recessions when unemployment is on the rise. Deflation is caused by conditions opposite those that cause inflation. Basically, when the demand for goods and services is substantially below the supply of those goods or services, prices tend to drift downward, certainly not increase, to encourage an increased demand. One other possible cause of deflation is a severe shrinkage in the money supply. If inflation increases and interest rates go up, then bond prices go down, thus bond yields go up. If inflation decreases and interest rates go down, then bond prices go up, thus bond yields go down. Test topic alert. It is not unusual to experience deflation during recessionary periods. At those times, investors tend to flee to safe havens such as U.S. government securities because, unlike stocks, real estate, and commodities, treasuries will likely not only hold their value but may even show some capital appreciation. Practice question. The contraction phase of the business cycle is least likely accompanied by decreasing A. Consumer spending, B. Economic output, C. Inflation pressure, D. Unemployment. The answer is D. An economic contraction is likely to feature increasing unemployment, A. Decreasing employment, along with decreasing consumer spending, declining economic output, and decreasing inflation pressure. Statistical indicators. Certain statistical indicators are used to measure the economic health of a country at a given time. Some of the primary indicators used are discussed below. Gross domestic product, GDP. In Learning Objective 6A, we defined gross domestic product and how it is affected by the business cycle. Let's take a deeper dive into the subject. Gross domestic product, GDP, expresses the total value of all final goods and services produced within the United States during the year. GDP includes personal consumption, by far the largest component, government spending, gross private investment, foreign investment, and the total value of net exports. If imports exceed exports, that negatively affects GDP and that net amount is subtracted. The GDP measures a country's output produced within its borders regardless of who generated it. When the GDP is negative, it is generally a sign of deflation. Practice question. A U.S.-based firm assembles electronic equipment using parts imported from Singapore. Its income statement looks like this. Sales, $60 million. Wages, $30 million. Parts, $16 million. Expenses, $46 million. Net income, $14 million. What is this firm's contribution to the U.S. GDP? A. $14 million. B. $30 million. C. $44 million. D. $60 million. The answer is C. The question is how we measure this firm's contribution to U.S. output. At first glance, the answer would seem to be $60 million, the total value of its sales. However, $16 million of this was produced somewhere else, so it shouldn't be counted as part of the firm's or the United States output. Thus, the correct answer is $44 million, the amount of value the firm has added to the imported parts. Test topic alert. The exam may want you to know that net exports will lead to an increase in GDP. Employment indicators. That unemployment level is a key indicator of a country's economic health and bears a relationship to inflation. The two most common employment indicators are the average weekly initial claims for unemployment compensation and the average work week in manufacturing. Both measures serve to predict the direction of economic activity. Many economists believe an unemployment level of about 4% reflects full employment, the point at which wage pressures do not create undue inflation. Consumer Price Index, CPI. The Consumer Price Index, CPI, is a measure of the general retail price level. By comparing the current cost of buying a basket of goods with the cost of buying the same basket a year ago, we can get an indication of changes in the cost of living. In doing so, the CPI figure attempts to measure the rate of increase or decrease in a broad range of prices, such as food, housing, transportation, medical care, clothing, electricity, entertainment, and services. The CPI is published on a monthly basis by the Bureau of Labor Statistics, BLS, and is the most commonly used measurement of the rate of inflation. Take note. The index for all items, less food and energy, is often unofficially referred to as the core CPI, a term created by the media and not the Bureau of Labor Statistics. The reasoning behind excluding food and energy prices when computing core inflation is because of their high short-term volatility. Barometers of economic activity. Certain aspects of economic activity serve as barometers or indicators of business cycle phases. There are three broad categories of economic indicators: leading, coincident, and lagging. These indicators are published on a monthly basis by the Conference Board, a non-governmental, not-for-profit research organization. Leading indicators. Leading indicators are economic activities that tend to turn down before the beginning of a recession or turn up before the beginning of a business expansion. These indicators are used by economists to predict the future direction of economic activity 4 to 6 months hence. The leading economic indicators include the following: money supply, building permits, housing starts, average weekly initial claims for unemployment insurance, average weekly working hours, manufacturing, manufacturers' new orders for consumer goods, manufacturers' new orders for non-defense capital goods, index of supplier deliveries vendor performance, interest rate spread between 10-year Treasury bonds and the federal funds rate, stock prices, for example, S&P 500, and index of consumer expectations. Not all leading indicators move in tandem. Positive changes in a majority of leading indicators point to increased spending, production, and employment. This will generally result in an increase to the rate of inflation. Negative changes in a majority of indicators can forecast a recession. Coincident or current indicators. Coincident or current indicators are economic measurements that change directly and simultaneously with the business cycle. Widely used coincident indicators include the following: non-agricultural employment, personal income minus Social Security, veteran benefits and welfare payments, industrial production, and manufacturing and trade sales in constant dollars. Lagging indicators. Lagging indicators are measurements that change 4 to 6 months after the economy has begun a new trend and serve to confirm the new trend. Lagging indicators help analysts differentiate long-term trends from short-term reversals that occur in any trend. Lagging indicators include the following: average duration of unemployment, ratio of consumer installment credit to personal income, ratio of manufacturing and trade inventories to sales, average prime rate, change in the CPI for services, total amount of commercial and industrial loans outstanding, and change in the index of labor cost per unit of output, manufacturing. Take note. Simply stated, these indicators attempt to tell us where we're going leading, where we are coincident, and where we've been lagging. As an IAR, we suspect you'd be most interested in knowing where we're going, so you pay most attention, as everyone else does, to the leading indicators. Practice question. Core inflation is best described as an inflation rate. A. For producers' raw materials. B. The central bank views as acceptable. C. That excludes certain volatile goods prices. D. That represents a market basket of consumer items. The answer is C. Core inflation is measured using a price index that excludes food and energy prices. Knowledge check 6.2. Question 1. The U.S. balance of payments deficit would decrease in all the following scenarios except: A. A decrease in purchases of U.S. securities by foreign investors. B. A decrease in imports of foreign goods into the United States. C. An increase in exports of domestic goods from the United States. D. A decrease in dividend payments by U.S. companies to foreign investors. The correct answer is A. A deficit in the balance of payments occurs when more money is flowing out of the country than in. When foreign investors decrease their purchases of U.S. securities, the flow of money coming into the United States decreases. This adds to the deficit rather than decreasing it. Question 2. The Conference Board has released information indicating an increase in the Help Wanted Index. Most analysts would take this as a sign of: A. An impending recession. B. Likely wage inflation in the future. C. An increase in manufacturing inventories. D. A rising trade deficit. The correct answer is B. An increase in the Help Wanted Index signifies that employers are hiring businesses good. Competition for qualified workers will usually result in paying higher wages, and that will translate to higher prices for goods and services, inflation.
Unit 7, Financial Reporting. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 7A. Recognize the relationship between assets, liabilities, and owner's equity. Learning Objective 7B. Identify the effects on the balance sheet from certain corporate actions. Learning Objective 7C. Recognize income statement items. Learning Objective 7D. Identify the use of the statement of cash flows. Learning Objective 7E. Distinguish between the different forms used in SEC reporting. Your exam will include approximately 4 questions from the topics covered in Unit 7. Introduction. This unit deals with the methods used by publicly traded companies to report their financial results. Just as a credit card company evaluates your financial condition when determining if you are worthy of their credit card and the amount of your credit limit, analysts view the company's financial statement to determine the strength of the issuer and growth and or income opportunities for investors. Lesson 7.1. The use of financial statements. Learning Objective 7A. Recognize the relationship between assets, liabilities, and owner's equity. A corporation's financial statements provide a fundamental analyst with the information needed to assess that corporation's profitability, liquidity, financial strength, ability of cash flow to meet debt payments, and operating efficiency. By examining how certain numbers from one statement relate to prior statements and how the resulting ratios relate to the company's competitors, the analyst can determine how financially viable the company is. Publicly traded companies issue quarterly and annual financial reports to the SEC. A company's balance sheet and income statement are included in these reports. Balance sheet. The balance sheet provides a snapshot of a company's financial position at a specific point in time. It identifies the value of the company's assets, what it owns, and its liabilities, what it owes. The difference between these two figures is the corporation's owner's equity or net worth. The balance sheet equation is assets minus liabilities equals owner's equity, or assets equals liabilities plus owner's equity. The balance sheet gets its name from the fact that its two sides must balance. The balance sheet equation mathematically expresses the relationship between the two sides of the balance sheet. Simply stated, everything that is owned, assets, minus everything that is owed, liabilities, is equal to the net worth, owner's or shareholder's equity, of the entity. Assets. Assets appear on the balance sheet in order of liquidity, which is the ease with which they can be turned into cash. Assets that are most readily turned into cash are listed first, followed by less liquid assets. Balance sheets commonly identify three types of assets: current assets, cash and assets easily turned into cash; fixed assets, physical assets that could eventually be sold; and other assets, usually intangible and only of value to the corporation that owns them. Current assets. Current assets include all cash and other items expected to be converted into cash within the next 12 months, including the following. Cash and equivalents include cash and short-term safe investments, such as money market instruments that can be readily sold, as well as other marketable securities. Accounts receivable include amounts due from customers for goods delivered or services rendered, reduced by the allowance for bad debts. Inventory is the cost of raw materials, work in process, and finished goods ready for sale. Prepaid expenses are items that a company has already paid for, but has not yet benefited from, such as prepaid advertising, rents, insurance, and operating supplies. Fixed assets. Fixed assets are property, plant, and equipment. Unlike current assets, they are not easily converted into cash. Fixed assets, such as factories, have limited useful lives because wear and tear eventually reduce their value. For this reason, their cost can be depreciated over time and deducted from taxable income in annual installments to compensate for loss in value. They are shown at original cost, less the accumulated depreciation. This value may be more, less, or about the same as the current market value. Other assets. Intangible assets are non-physical properties, such as formulas, brand names, contract rights, and trademarks. Goodwill, also an intangible asset, reflects the corporation's reputation and relationship with its clients. The value of these assets may be written down against income through a process known as amortization, very similar to depreciation. Take note. Although intangible assets may have great value to the corporation owning them, they generally carry little value to other entities. Liabilities. Total liabilities on a balance sheet represent all financial claims by creditors against the corporation's assets. Balance sheets usually include two main types of liabilities: current liabilities and long-term liabilities. Current liabilities. Current liabilities are corporate debt obligations due for payment within the next 12 months. These include the following: accounts payable amounts owed to suppliers of materials and other business costs; accrued wages payable, unpaid wages, salaries, commissions, and interest. Current long-term debt, any portion of long-term debt due within 12 months. Notes payable to balance due on equipment purchased on credit or cash borrowed. Accrued taxes, unpaid federal, state, and local taxes. Take note. In Unit 20, we will discuss the various financial statement ratios. At this time, we want to define one term related to our current topic. A corporation's working capital is the difference between its current assets and its current liabilities. Hopefully, that is a positive number. Long-term liabilities. Long-term debts are financial obligations due for payment more than 12 months in the future. Examples would include bonds and mortgages. Take note. Long-term debts include mortgages on real property, long-term promissory notes, and outstanding corporate bonds. Test topic alert. Under current accounting practice, deferred tax credits are treated as a liability. Sample balance sheet. Assets. Current assets. Cash and equivalents, $5 million. Accounts receivable, $15 million. Inventory, $19 million. Prepaid expenses, $1 million. Total current assets, $40 million. Fixed assets. Buildings, furniture, and fixtures at cost less $10 million. Accumulated depreciation, $40 million. Land, $15 million. Total fixed assets, $55 million. Other assets, goodwill and intangible assets, $5 million. Total assets, $100 million. Liabilities and net worth. Current liabilities. Accounts payable, $5 million. Accrued wages payable, $4 million. Accrued taxes payable, $1 million. Total current liabilities, $10 million. Long-term liabilities, 8% 20-year convertible debentures, $50 million. Total liabilities, $60 million. Net worth. Preferred stock $100 par, $5 non-cumulative convertible 200,000 shares issued, $20 million. Common stock $1 par, 1 million shares, $1 million. Capital in excess of par, $4 million. Retained earnings, $15 million. Total net worth, $40 million. Total liabilities and net worth, $100 million. Shareholder equity. Shareholder equity, also called net worth or owner's equity, is the stockholder claims on a company's assets after all of its creditors have been paid. Shareholder equity equals total assets less total liabilities. On a balance sheet, 3 types of shareholder equity are identified: capital stock at par, capital in excess of par, and retained earnings. Capital stock at par. Capital stock includes preferred and common stock listed at par value. Par value is the dollar value per share assigned when a corporation's owners, the stockholders first, contributed capital. Par value of common stock is an arbitrary value with no relationship to market price. As you saw in Unit 1, it plays an important role with preferred stock. Capital in excess of par. Capital in excess of par, often called additional paid-in capital, capital surplus, or paid-in surplus, is the amount of money over par value that a company received when issuing its common stock. For example, if the par value was $1 per share and the stock was issued at $5 per share, there is a paid-in surplus of $4 per share. Retained earnings. Retained earnings, sometimes called earned surplus or accumulated earnings, are profits that have not been paid out in dividends. Retained earnings represent the total of all earnings held since the corporation was formed, less dividends paid to stockholders. Operating losses in any year reduce the retained earnings from prior years. Test topic alert. Treasury stock is stock that has been issued and then reacquired by the issuing corporation. Those shares are no longer considered outstanding in the hands of the public because they are, so to speak, held in the corporation's treasury. When a company has done this, the cost of those reacquired shares is shown in the owner's equity portion of the balance sheet as a negative number. This has the effect of reducing the company's net worth. Capital structure. A company's capitalization is the combined sum of its long-term debt and equity securities. The capital structure is the relative amounts of debt and equity that compose a company's capitalization. Some companies finance their businesses with a large proportion of borrowed funds. Others finance growth with retained earnings from normal operations and little or no debt. Looking at the balance sheet, a corporation builds its capital structure with equity and debt, including the following 4 elements: long-term debt, capital stock, common and preferred, capital in excess of par, and retained earnings, earned surplus. Example. See the following table for reference and explanation of the following terms. The total capitalization on the sample balance sheet is $90 million, $50 million in long-term debt, $20 million in preferred stock, and $20 million in common shareholders' equity. Remember, capital stock plus capital in excess of par plus retained earnings equals shareholders' equity, net worth. Capitalization table. Long-term debt, $50 million. Preferred stock, 1 million shares at $20 par value, $20 million. Common stock, 1 million shares at $1 par value, $1 million. Capital surplus, common stock issue price $4 per share, $4 million. Retained earnings, $15 million. Total equity capital, $40 million. Total capitalization, long-term debt plus equity, $90 million. Learning Objective 7b. Identify the effects on the balance sheet from certain corporate actions. If a company changes its capitalization by issuing stock or bonds, the effects will show up on the balance sheet. Issuing securities. The example balance sheet indicates the company issued 1 million shares of $1 par common stock. If it issues another 1 million shares, the net worth, shareholders' equity, will increase by the additional capital raised, and the amount of cash on the asset side of the balance sheet will increase. Convertible securities. When an investor converts a convertible debt security into shares of common stock, the amount of liabilities decreases and the owner's equity increases. The changes are on the same side of the balance sheet, so there is no change to the assets. Bond redemption. When bonds are redeemed, that is, the debt is repaid, liabilities on the balance sheet are reduced. The offsetting change would be a decrease in cash on the asset side of the balance sheet. The company would have less debt outstanding, but it would also have less cash. The balance sheet balances, therefore, because the current asset, cash, was used to redeem the long-term liability bond, working capital is reduced. However, because there would no longer be semi-annual interest payments due on the debt, the future effect of the retirement of the bonds would be to increase the company's cash flow. Dividends. When a cash dividend on the company's stock is declared, retained earnings are lowered and current liabilities are increased. The declaration of a cash dividend establishes a current liability until it is paid. Once paid, it reduces cash and current assets and also reduces current liabilities. Stock splits. A stock split does not affect shareholders' equity. On the balance sheet, only the par value per share and number of shares outstanding change. Financial leverage. Financial leverage is a company's ability to use long-term debt to increase its return on equity. A company with a high ratio of long-term debt to equity is said to be highly leveraged. Stockholders benefit from leverage if the return on borrowed money exceeds the debt service costs. But leverage is risky because excessive increases in debt raise the possibility of default in a business downturn. In general, industrial companies with debt-to-equity ratios of 50% or higher are considered highly leveraged. However, utilities, with their relatively stable earnings and cash flows, can be more highly leveraged without subjecting stockholders to undue risk. If a company is highly leveraged, it is also affected more by changes in interest rates. Practice question. As a result of corporate transactions, a company's assets remain the same and its owner's equity decreases. Which of the following statements is true? A. Prepaid expenses decrease. B. Total liabilities increase. C. Accrued expenses decrease. D. Net worth increases. The answer is B. Sometimes questions are best answered by analyzing the question before we even look at the answer choices. We are told in the question that assets have remained the same, but somehow the net worth, owner's equity, has gone down. If the balance sheet formula is assets, liabilities equals net worth, then somehow the liabilities must have increased. That seems to make choice B a straightforward answer, but let's just check the others to be sure. Prepaid expenses are an asset, it can't be choice A, because we know assets haven't changed. Choice D is so simple that students sometimes choose it because they think there is a trick somewhere. No trick here if owner's equity goes down. That is the net worth, so we can't choose net worth increases. Finally, accrued expenses are a liability, so if they decrease, net worth goes up, not down. If you take these questions step by step, they tend to be very logical. Practice question. Which of the following corporate actions will lead to an increase in a company's owner's equity? A. Issuing $10 million of 6% $100 par preferred stock. B. Issuing $10 million of 4% debentures. C. Payment of a cash dividend to common shareholders. D. Redemption of outstanding debt securities at a price in excess of par value. The answer is A. Stock represents equity in a corporation. Issuing additional stock is a straightforward method of increasing net worth, owner's equity. Issuing a debt security brings in cash, but that is offset by the new debt. Payment of a cash dividend reduces cash on hand, but reduces the declared dividend current liability by an equal amount. Eliminating debt is good, but when done so at a price in excess of the par. Take note. The balance sheet reports what resources, assets, a company owns and how it has funded them. How the firm has financed the assets is revealed by the capital structure, for example, long-term debt and owner's equity, preferred stock, common stock, and retained earnings. Learning Objective 7C. Recognize income statement items. Income statement. The income statement, sometimes referred to as the profit and loss, or P&L statement, summarizes a company's revenues, sales, and expenses for a fiscal period, usually quarterly, year-to-date, or the full year. It compares revenue against costs and expenses during the period. Fundamental analysts use the income statement to judge the efficiency and profitability of a company's operation. Just as with the balance sheet, technical analysts generally ignore this information. It is not relevant to their charting schemes. Components of the income statement. The various operating and non-operating expenses on the income statement are discussed below. Revenues indicate the firm's total sales during the period, the money that came in. The cost of goods sold, COGS, is the cost of labor, material, and production, including depreciation on assets employed in production, used to create finished goods. Subtracting COGS from revenues shows the gross operating profit or gross margin. This gross margin is usually divided by the net sales or revenues and is shown as a percentage, sometimes referred to as the margin of profit. Pre-tax margin is determined by subtracting COGS and other operating costs, rent, and utilities from sales to arrive at net operating profit. The resulting figure is earnings before interest and taxes, EBIT. Interest payments on a corporation's debt are not considered an operating expense. However, interest payments reduce the corporation's taxable income. Pre-tax income, the amount of taxable income, is operating income less interest payment expenses. If dividends are paid to stockholders, they are paid out of net income after taxes have been paid. After dividends have been paid, the remaining income is added to retained earnings and is available to invest in the business. Test topic alert. Please note the three terms above that we have put in boldface for you. Revenue or sales, cost of goods sold, and pre-tax income are the three primary components of an income statement. Think of it simply like this. The income statement shows 1. What came in, 2. What went out, and 3. How much is left before taxes. Take note. Interest payments reduce a corporation's taxable income, whereas dividend payments to stockholders are paid from after-tax dollars, because they are taxable as income to accounting for depreciation. As mentioned earlier when reviewing the balance sheet, fixed assets are shown at their cost minus accumulated depreciation. For these assets, which wear out over a period of time, tax law requires that the loss of value be deducted over the asset's useful life, longer for some assets and shorter for others. You won't have to know depreciation schedules. On the income statement, the allowable portion for the year is shown as an expense and for our purposes will generally be part of COGS. Remember, if the company uses accelerated depreciation, the expenses will be higher in the early years, resulting in lower pre-tax income and lower income taxes, but higher income later on. Fiscal year accounting. Many business entities prefer to end their accounting year on a date other than December 31, calendar year accounting. Any 12-month period used by a business that ends other than on December 31 is known as a fiscal year. The term fiscal is generally defined as something that pertains to financial matters. This term will be used many times when referring to required filings by investment advisors. Example. The following table should help you see some of the differences between balance sheet and income statement items. Balance sheet. Current liabilities, revenues, net worth, retained earnings, and cash. Income statement. Cost of goods sold, COGS, net income, and interest paid. Accounting fundamentals. In addition to the information thus far presented, there are two additional accounting concepts you may be required to understand. Audited versus unaudited financial statements. Businesses must know their financial position at all times. With today's technologies, it is much easier than only a few decades ago, when all bookkeeping was done manually. It is rare to find a business that does not produce financial information at least monthly, and many do so even more frequently. These financial reports are generally done by in-house staff, and even when done by an outside accounting firm, they are considered unaudited. That is, specific care has not been taken to examine every item. For normal operating purposes, these unaudited statements do the job. However, for formal reporting to the SEC or other regulators and to shareholders, an audited report is required. In an audited report, an independent, and independence is critical. Auditor, most commonly a representative, or in the case of a large entity, a number of representatives of a CPA firm, spends many hours poring over the books and records to verify and count everything. Take note. GAAP means Generally Accepted Accounting Principles. That is the standard used for audited financial reports. Test topic alert. Part of the audit is the auditor's opinion. The best is an unqualified opinion. That means the auditor has no qualms about certifying the audit. On the other hand, a qualified opinion means the auditor has some reservations about the accuracy or completeness of the information contained in the report. Cash versus accrual accounting. Smaller business enterprises tend to use the cash method of accounting, while larger ones base their financial reporting on the accrual method. How do these two methods differ? Primarily, it is the timing of when revenue and expenses are recognized. In the cash method, everything is as received, while in the accrual it is when booked. Let's look at an example. Example. ABC Comfort Systems sells home heating and air conditioning systems. They install a system in a home for $3,000 in May, and because they offered 90 days same as cash terms, they receive the payment in August. Under the cash method, the $3,000 would not be entered on their books until actually received in August. Under the accrual method, the $3,000 would be recorded when the sale took place in May. Footnotes. Footnotes to the financial statements identify significant financial and management issues that may affect the company's overall performance, such as accounting methods used, extraordinary items, accounting for inventory, FIFO or LIFO, pending litigation, and management philosophy. Typically, a company separately discloses details about its long-term debt in the footnotes. These disclosures are useful for determining the timing and amount of future cash outflows. The disclosures usually include a discussion of the nature of the liabilities, maturity dates, stated and effective interest rates, call provisions and conversion privileges, restrictions imposed by creditors, assets pledged as security, and the amount of debt maturing in each of the next 5 years. Also disclosed in the footnotes would be off-the-books financing arrangements, such as debt guarantees. Test topic alert. Footnotes are generally found on the bottom of the financial statements and can be several pages long. Here is an example of how you might be asked about footnotes on your exam. Practice question. Potential litigation for patent infringement would appear on a corporation's A balance sheet as a deferred asset. B footnotes. C income statement as an expense. D statement of potential litigation. The answer is B. The footnotes to the financial statements carry information such as potential legal actions, accounting methods used, and off-book debt. Knowledge Check 7.1. Question 1. A company has filed for an initial public offering for its $10 par common stock. The IPO is priced at $35 per share. Where on the balance sheet is the extra $25 per share recorded? A. Capital surplus. B. Retained earnings. C. Distributed dividends. D. Paid in earnings. The correct answer is A. Capital surplus, is the amount of premium paid by shareholders above par value. It may also be called paid in capital or paid in surplus, but it is not paid in earnings. Question 2. A corporation calls in $5 million of its outstanding 6% bonds. The call price is $103. The effect on the balance sheet is all of the following except A. Current assets decrease. B. Current liabilities decrease. C. Long-term liabilities decrease. D. Owner's equity decreases. The correct answer is B. There is no change to current liabilities. Cash is used to pay for the called bonds. That reduces current assets. Those bonds, a long-term liability, are no longer on the books, so the long-term liabilities decrease. Because the company had to pay $5,150,000 to eliminate $5 million in debt, the net worth drops by that extra $150,000. Question 3. When a corporation's accounting year ends on a date other than December 31, the company is using A. Fiscal year. B. A non-calendar year. C. A Gregorian year. D. A lunar year. The correct answer is A. Fiscal year accounting refers to any entity ending its accounting year on a date other than December 31. The largest user of a fiscal year is the U.S. government. For accounting purposes, the government's year begins on October 1 and ends September 30. Lesson 7.2. Cash flow accounting. Learning Objective 7D. Identify the use of the statement of cash flows. The cash flow statement reports a business's sources and uses of cash in the beginning and ending values for cash and cash equivalents each year. There are 3 components generating cash flow. operating activities, investing activities, and financing activities. Test topic alert. Most financial professionals add revenues and expenses that do not involve cash inflows or outflows, for example, cost allocations such as depreciation and amortization, back to the company's net income to determine the cash flow. As described previously, the cash flow statement will also reflect money from operations, financing, and investing, but not accounting changes. Cash flow from operating activities. Operating activities, all transactions and events that normally enter into the determination of operating income, include cash receipts, money coming in from selling goods or providing services, as well as income from items such as interest and dividends. Operating activities also include cash payments, money going out, such as cost of inventory, payroll, taxes, interest, utilities, and rent. The net amount of cash provided or used by operating activities is the key figure on a statement of cash flows. Even though it would seem that interest and dividends would belong in investing activities, the accounting gurus put them here. Example. Sometimes using some numbers makes this concept much easier. If you take a look at the income statement we reviewed a few pages ago, you will see that this company's net income, bottom line, to use the vernacular, was $2,250,000. Among the $6 million in expenses deducted from the total revenues was $500,000 of depreciation. However, the company never wrote a check for that money. It is the amount of the original cost that it is allowed to write off as an expense each year as the fixed assets wear out. So not only does the company have the net income remaining after all expenses and taxes, but it actually had another $500,000 in funds it could use, giving the company a total cash flow of $2,750,000. Cash flow from investing activities. Investing activities include transactions and events involving the purchase and sale of securities, land, buildings, equipment, and other assets, not generally held for resale as a product of the business. It also covers the making and collecting of loans. Investing activities are not classified as operating activities because they have an indirect relationship to the central, ongoing operation of the business, usually the sale of goods or services. Cash flow from financing activities. All financing activities deal with the flow of cash to or from the business owners, equity financing, and creditors, debt financing. For example, cash proceeds from issuing stock or bonds would be classified under financing activities. Likewise, payments to repurchase stock, treasury stock, or to retire bonds and the payment of dividends are financing activities as well. Test topic alert. Cash flow from operations will primarily use items from the income statement, while cash flow from financing activities will use balance sheet items. Make sure you know which one the question is asking about. For example, liquidating an outstanding bond issue, paying off the debt, will have a profound impact on cash flow, and that uses information from the balance sheet, cash for the payoff, and no more debt remaining. Knowledge check 7.2. Question 1. All of the following are measurements of cash flow except A. Cash flow from financing activities. B. Cash flow from investing activities. C. Cash flow from operating activities. D. Cash flow from sales activities. The correct answer is D. Although sales, revenues, are a critical component of cash flow, there is no measurement using that term. Sales revenues are included in cash flow from operating activities. Question 2. Dividends received on investments held by a corporation are part of cash flow from which activities? A. Financing. B. Investing. C. Operating. D. Sales. The correct answer is C. Even though one would think this would be part of investing activities, the accounting industry puts them into operating activities. Lesson 7.3. SEC Reporting. Learning Objective 7E. Distinguish between the different forms used in SEC reporting. As we will learn in the next unit, in many cases, a security must be registered with the Securities and Exchange Commission, SEC, before being offered to the public. The registration rules are found in the Securities Act of 1933. Once registered, publicly traded corporations are required to periodically report to the SEC as specified in the Securities Exchange Act of 1934. One of the best sources of financial information is found in the reports required to be filed with the SEC by publicly traded companies. This information is available online at the SEC's website. The location is at EDGAR, which stands for Electronic Data Gathering, Analysis, and Retrieval of SEC Filings. Among those filings, there are generally 3 that are used by fundamental analysts. Form 8 Key. This form is used to report newsworthy events to the SEC, thereby making them available to the public. Included are items such as change in management, change in the company's name, mergers or acquisitions, bankruptcy filings, and major new product introductions or sale of a product line. A Form 8 even has to be filed when a member of the board of directors resigns over a disagreement. The 8K is filed within 4 business days of the occurrence. This form is used only by domestic issuers. Foreign issuers are exempt. Although ADRs are registered with the SEC, they too are exempt because the underlying security is a foreign issue. Test topic alert. One thing that would not trigger a Form 8K is the relocation of a wholly owned subsidiary. However, sale of that subsidiary would require a filing, and that, like any other Form 8K filing, must be done within 4 business days of the event. Form 10K. Most domestic public issuers must file an annual report to the SEC on Form 10K. This report is a comprehensive overview of the company's business and financial condition, and includes financial statements that have been audited by an independent accountant. Do not confuse this with the annual report to shareholders, which also contains an audited statement. The Form 10K will generally contain more detailed financial information than the annual report, while the annual report will have much more detail about the company itself and its future plans. The filing deadlines depend upon the company's public float and are not testable information. Form 10T. Because 1 year between filings is a long time and a lot can happen quickly, we also have Form 10Q, which is filed quarterly, Q for quarterly. It contains unaudited financial statements, and it must be filed after each of the first 3 fiscal quarters of the year. Note 10K is filed at the end of the 4th quarter. That information is taken care of by the filing of the 10K. Annual reports. When it comes to publicly traded companies in general, all shareholders must receive a copy of the issuer's annual report. For those too lazy to access EDGAR, this is the most detailed information they can get on the company's financial position. Unlike the Form 10K, this is usually a professionally prepared piece that is just as much used for marketing purposes as it is for providing information. There is usually a welcoming letter from the CEO and/or chairman of the board, and it is generally loaded with beautiful pictures of smiling people, employees and customers, and the company's facilities. New plans for products and programs are discussed, and voting proxies are included. Test topic alert. SEC rules state that a company may provide shareholders with a copy of the Form 10K instead of sending an annual report. Knowledge Check 7.3. Question 1. A publicly traded corporation keeps its books on a calendar year basis. An investor wanting the most up-to-date financial information in late August would view the company's A. June 30 Form 8K, B. June 30 Form 10Q, C. December 31 Form 10K, D. July 31 Form 10T. The correct answer is B. Form 10Q is prepared every quarter. Because this company operates on a calendar year basis, those quarters end in March, June, September, and December. In August, the most recent information would be from the June 30 Form 10T. Question 2. A member of the L.E.M Corporation's board of directors has just resigned after a dispute with the board chair. This would be reported to the public on A. Form 8K, B. Form 10K, C. Form 10Q, D. Form D. The correct answer is A. Form 8K, is the form used to report newsworthy events to the SEC, thereby making them available to the public. Resignation of a board member over a dispute is considered newsworthy.
Unit 8. Regulation of securities and their issuers. Learning objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 8A. Identify instruments that are defined as securities under the Uniform Securities Act. Learning Objective 8B. Identify those who issue securities. Learning Objective 8C. Recognize the securities exempt from registration under the Uniform Securities Act and the Securities Act of 1933. Learning Objective 8D. Recall the exempt transactions under the Uniform Securities Act and the Securities Act of 1933. Learning Objective 8E. Recollect the procedures for registering non-exempt securities under the Securities Act of 1933. Learning Objective 8F. Recollect the procedures for registering non-exempt securities under the Uniform Securities Act. Learning Objective 8G. Identify the methods of state registration of securities, including the anti-fraud provisions of the Uniform Securities Act. Your exam will include approximately 2 questions from the topics covered in Unit 8. Introduction. Before we can get started teaching about the rules and regulations, there are a few things we need to know. Because so much of the course deals with laws and regulations, it is necessary to know what laws are involved. When it comes to regulation of securities on the federal level, it will be largely the Securities Act of 1933. On the state level, it will be the Uniform Securities Act. When it comes to the regulation of investment advisors, on the federal level, there is the Investment Advisors Act of 1940. On the state level, it is the Uniform Securities Act, USA. When it comes to broker-dealers and their agents on the federal level, it is the Securities Exchange Act of 1934, and once again, on the state level, the USA. This exam is the property of NASA, the North American Securities Administrators Association, the group of state, provincial, and Mexican regulators. Although the exam will ask about state and federal law, if it doesn't specify, the default choice is always state law. Let's investigate that law a bit. Lesson 8.1. What are securities and who issues them? Learning Objective 8A. Identify instruments that are defined as securities under the Uniform Securities Act. The Uniform Securities Act of 1956, USA. The USA is model state securities legislation. With the enactment of numerous state securities laws, commonly referred to as blue sky laws, the need for uniformity in securities laws among the states arose. In 1956, the original Uniform Securities Act was drafted as model legislation for the separate states to adopt. As model legislation, the USA is not actual legislation. The USA is a template or guide that each state uses in drafting its securities legislation. The securities laws of most states follow the USA very closely and, in many cases, almost exactly. Take note. The term state means any of the 50 states, any territory or possession of the United States, such as American Samoa, Guam, and the Virgin Islands, the District of Columbia, and Puerto Rico. Test topic alert. The exam will test your knowledge of the Uniform Securities Act, not the specifics of your state's securities legislation. The USA is periodically updated to adjust to developments in the securities markets through the passage of model rules. You will be tested on the 1956 version of the USA used by the North American Securities Administrators Association, NASA, the advisory body of state securities regulators responsible for the content of the exam. The exam requires that you not only know what the USA says, but also are able to apply the law to concrete situations. General knowledge of the law is not enough to pass the exam. You will be asked to apply the law to situations that may arise in the course of business. Definition: Administrator. Possibly the most used term in the exam is administrator. Who or what is this? Although some states may use other terms to describe this position, the exam will only use the word administrator to refer to the office or agency that has the complete responsibility for administering the securities laws of the state. Therefore, the administrator has jurisdiction over almost all securities activity that emanates from his state, as well as that received in his state. The administrator has jurisdiction over the registration of securities professionals and securities. She has the power to make rules and issue orders. She can deny, suspend, or revoke registrations. Yes, there are some limitations on the administrator's powers, and those will be covered in this course, but overall, this is one very powerful person. There are 2 other terms that will be covered in great detail in following units, but in the event you are not familiar with them, we'll define broker-dealer and agent. Broker-dealers, BDs, are in the business of buying and selling securities for their customers, investors, and for their own accounts. Agents, commonly referred to as registered representatives or the old-fashioned term, stockbrokers, are the individuals who represent broker-dealers in dealing with customers. The BDs are the entity the agents work for. In Unit 11, you'll get the entire story. This unit discusses the procedures for the registration of securities as well as their exemptions from registration. For a securities transaction to be lawful under the Uniform Securities Act, USA, the security itself must be registered unless it or the transaction is exempt from registration requirements. In addition, we'll also review some of the SEC's regulations dealing with this subject as found in the Securities Act of 1933. Perhaps the most important term in the USA is the term security. Why is it so important? The reason is simple. The USA applies only to those financial instruments that are securities. The purchase, sale, or issuance of anything that is not a security is not covered by the Act. The definition of a security, however, is complex. Over the years, courts have determined case by case what constitutes a security. The U.S. Supreme Court, in the Howey decision, defined the primary characteristics of what constitutes a security by concluding that an investment contract is a security. For an instrument to be a security, the court held it must constitute 1. An investment of money, 2. In a common enterprise, 3. With the expectation of profits, 4. To be derived primarily from the efforts of a person other than the investor. A common enterprise means an enterprise in which the fortunes of the investor are interwoven with those of the person offering the investment, a third party, or other investors. The USA provides a comprehensive list of more than a dozen financial instruments, many of which you've never heard of, that are securities under the Act and therefore covered by its provisions. Rather than waste your time with the list, we've included it after the practice question. Please focus on the 6 items that are not securities, and you'll get any question you are given correct. The following 6 items are not securities under the Act. An insurance or endowment policy or annuity contract under which an insurance company promises to pay a fixed sum of money either in a lump sum or periodically. This is basically any product from a life insurance company that does not use the word variable. Interest in a retirement plan, such as an IRA or 401k plan. Collectibles. Commodities such as precious metals and grains, including futures and forward contracts. Condominiums used as a personal residence, and currency. Test topic alert. The exam will want you to know what is and what is not a security. We suggest that you concentrate on learning the 6 that are not securities because they are much easier to remember, and you will still be able to answer the questions correctly. Let's try a question so that you can see what we mean. Practice question. Which list of instruments below is not composed of securities? A. Stock, treasury stock, rights, warrants, and transferable shares. B. Voting trust certificates and interests in oil and gas drilling programs. C. Commodity futures contracts and fixed payment life insurance contracts. D. Options on securities and interests in multilevel distributorship arrangements. The answer is C. Commodity futures contracts and fixed payment life insurance contracts are included in our list of 6 items that are not securities. Practice question. Which of the following is defined as a security under the Uniform Securities Act? A. A guaranteed, lump sum payment to a beneficiary under a modified endowment policy. B. Fixed, guaranteed payments made for life or for a specified period under an annuity contract. C. Commodity futures contracts. D. An investment contract. The answer is D. An investment contract is defined as a security under the Uniform Securities Act. In fact, the term is often used as a synonym for a security. A guaranteed, lump sum payment to a beneficiary is an endowment policy excluded from the definition of a security. Fixed, guaranteed payments made for life or for a specified period are fixed annuity contracts not defined as securities. Commodity futures contracts and the commodities themselves are not securities. It is much easier to remember what is not a security than what is. Securities under the Uniform Securities Act. The USA does not define the term securities but provides a comprehensive list of financial instruments that are securities under the Act and therefore are covered by its provisions. Under the Uniform Securities Act, among the many items included in the definition of security are any stock, bond, debenture, evidence of indebtedness such as a promissory note, collateral trust certificate, pre-organization certificate or subscription, investment contract, voting trust certificate, certificate of deposit for a security, ADARS, not a bank CD, certificate of interest or participation in an oil, gas, or mining title or lease, or in payments out of production under such a title or lease. Put, call, straddle, option, or privilege on a security. Any interest or instrument commonly known as a security, or warrant or right to subscribe to or purchase any of the above. Non-security investments. Although collectibles, fixed annuities, precious metals, grains, real estate, and currencies can be attractive investments, they are not securities. Because these items are not securities, their sale is not regulated by state securities law. Furthermore, if a registered agent commits fraud in the sale of any of these items, he has not committed a violation of any state securities law. He has violated the anti-fraud provisions of another act prohibiting fraudulent commercial transactions. An individual's direct ownership of an automobile is not a security, it is just ownership of a car. However, if that individual makes an investment of money in the stock of an automobile manufacturer with the expectation of making money due to the efforts of the company's management skill, he has purchased a security. In the same manner, if a condominium is purchased in a resort area with the goal of placing it into a rental pool and renting it out most of the year, and it is used only for personal vacation time, the condo is considered a security because there is a profit motive, typically reliant on the efforts of a third party, the rental agent. On the other hand, if the individual has chosen to live in the condominium as a personal residence, it is a home, not a security. Example: annuities with fixed payouts are not securities, but variable annuities are because they are dependent on the investment performance of securities within the annuity. Learning objective 8 bits. Identify those who issue securities. Issuer. An issuer is any person who issues, distributes, or proposes to issue a security. The most common issuers of securities are companies or governments, federal, state, and municipal governments, and their agencies and subdivisions. If an issuer is non-exempt, not exempt from registering its securities, it must generally register its securities in the states where they will be sold under one of the registration methods described in this unit. Test topic alert. This is very strange wording, but it might well appear on your exam. Under the Uniform Securities Act, with respect to certificates of interest, participation in oil, gas, or mining titles or leases, or in payments out of production under such titles or leases, there is not considered to be any issuer. Issuer transaction. An issuer transaction is one in which the proceeds of the sale go to the issuer. All newly issued securities, such as an initial public offering, IPO, are issuer transactions. In other words, when a company raises money by issuing securities to investors, the proceeds from the sale go to the company itself. Example: State X issues bonds as a way of borrowing money so that the state government can function. The state is the issuer of those bonds. Typically, they will be purchased by a client of a broker-dealer whose account is handled by an agent of the firm. This would be an issuer transaction because the proceeds of the sale of the bonds would go to State X, the issuer. Non-issuer transaction. A non-issuer transaction is one in which the proceeds of the sales do not go, directly or indirectly, to the entity that originally offered the securities to the public. The most common instance of this is everyday trading on exchanges such as the New York Stock Exchange or NASDAQ. In a non-issuer transaction, the proceeds of the sale go to the investor who sold the shares. Because the shares are not new, we refer to this as secondary trading. Example: using our previous example, if the investor who purchased those State X bonds decided to sell them, she would contact her agent at the brokerage firm where she has an account. The agent would then arrange for a sale to an interested buyer. In this case, because the proceeds of the bond sale would go to the investor, this is a non-issuer transaction or secondary transaction. Like when you sell your old car, it is a second-hand sale. The manufacturer received the money when the product was initially sold primary, and you receive the money now secondary. Initial or primary offering. An issuer transaction involving new securities is called a primary offering. If it is the first time an issuer distributes securities to the public, it is called an initial public offering, IPO. All primary offerings are issuer transactions because the issuer, the company, receives the proceeds from the investor investing in the company. Example: the first time that a BC Shoe Co. issued shares to the public, a BC Shoe engaged in an IPO or an initial primary offering because it received the proceeds from distributing its shares to the public. After a BC Shoe went public, subsequent transactions between investors through agents of broker-dealers were non-issuer secondary transactions. Can an issuer have more than one primary offering? Yes, it happens with mutual funds every day. As you learned in Unit 3, open-end investment companies are constantly issuing new shares. They have a primary every day. However, they, like any other issuer, can only have one IPO. Whenever a corporation wishes to raise additional equity capital, it can issue additional new shares. These shares generally come from the authorized but unissued shares. There are several terms used for these additional primary offerings, such as follow-on offering or additional primary offering, APO. The easiest way to identify a primary offering is to follow the money. If the funds wind up in the coffers of the issuer, it is probably a primary offering or a primary distribution. Knowledge Check 8.1. Question 1. Which of the following is included in the Uniform Security Act's definition of a security? A. an individual's vested interest in his 401k plan. B. Fixed, guaranteed annuity payments made for life or for a specified period. C. Commodity futures contracts. D. A U.S. Treasury bond. The correct answer is D. Any bond, regardless of the nature of the issuer, is considered a security. The physical commodity and futures contracts on commodities are included in the list of non-security investments. Retirement plans and fixed annuities are not securities. Question 2. A primary transaction is A. The first transaction between two parties in the over-the-counter market. B. A sale between investors of securities traded on the New York Stock Exchange. C. A new offering of an issuer sold to investors. D. When the proceeds of the sale go to the selling party. The correct answer is C. A primary transaction is a new offering of securities by an issuer sold to investors. The key is that the proceeds of the sale go to the issuer. Transactions between two investors in the over-the-counter market are called secondary transactions, the market between investors. A sale between investors of securities traded on the New York Stock Exchange is another example of a secondary transaction. In both of those cases, the proceeds of the sale go to the selling party, but that party is not the issuer. Lesson 8.2. Exempt securities under state and federal law. Learning Objective 8C. Recognize the securities exempt from registration under the Uniform Securities Act and the Securities Act of 1933. Later in this unit, we are going to cover the registration of securities. Before doing that, it is important to learn that not all securities must register. Some, primarily because of the nature of the issuer, are granted an exemption from registration. Those are known as exempt securities. Those are the subject of this lesson. In other cases, the nature of the way in which the security is bought or sold results in an exemption from registration. We call those exempt transactions, and they are the subject of the next lesson. Exemptions from registration under the Uniform Securities Act. Under the Uniform Securities Act, the exemptions discussed in this learning objective refer to an exemption from the Act's registration and sales literature filing requirements. In certain situations, the USA exempts both securities and transactions. A security, a transaction, or both can be exempt. An exempt security retains its exemption when initially issued and in subsequent trading. However, justification as an exempt transaction must be established before each transaction. The USA provides for a number of categories of exempt securities and even more categories of exempt transactions. Those securities that are non-exempt must register unless sold in exempt transactions. A special category of securities, federal covered securities, discussed later in this LO, do not register with the administrator but may, especially in the case of investment companies, have to file notice with the administrator. As mentioned above, an exempt security retains its exemption at its initial issue and in subsequent trading. An exemption for a transaction, on the other hand, must be established with each transaction. Provided it is in the public interest, the state administrator can deny, suspend, or revoke any securities transaction exemption other than that of a federal covered security. This action may be taken with or without prior notice, summarily. Take note. A security is exempt because of the nature of the issuer, not the purchaser. Exempt securities under the Uniform Securities Act include the following: U.S. and Canadian government and municipal securities. These include securities issued, insured, or guaranteed by the United States or Canada, by a state or province, or by their political subdivisions, states or provinces, cities, counties, etc. Foreign government securities. These include securities issued, insured, or guaranteed by a foreign government with which the United States maintains diplomatic relations. However, unlike U.S. or Canadian issues, political subdivisions are not included unless guaranteed by the sovereign government. Depository institutions. These include securities that are issued, guaranteed by, or are a direct obligation of a depository institution. The USA divides them into the following categories. 1. Any security issued by and representing an interest in or a debt of or guaranteed by any bank organized under the laws of the United States or any of any state. 2. Any security issued by and representing an interest in or a debt of or guaranteed by any federal savings and loan association or any building and loan or similar association organized under the laws of any state and authorized to do business in this state. And 3. Any security issued or guaranteed by any federal credit union or any credit union, industrial loan association, or similar association organized and supervised under the laws of this state. Please note that for categories 2 and 3, if the institution is not federally chartered, then it must be authorized to do business in the state under the supervision of a regulator in that state. Insurance company securities. These include securities issued, insured, or guaranteed by an insurance company authorized to do business in the state. Insurance company securities refer to the stocks or bonds issued by insurance companies, not the variable life policies and variable annuities sold by the companies. Public utility and common carrier securities. These include any security issued or guaranteed by a public utility or public utility holding company, or an equipment trust certificate issued by a railroad or other common carrier, regulated in respect to rates by federal or state authority, or regulated in respect to issuance or guarantee of the security by a governmental authority of the United States, any state, Canada, or any Canadian province. Securities issued by nonprofit organizations. These include securities issued by religious, educational, fraternal, charitable, social, athletic, reformatory, or trade associations. Nonprofit is the key word. Securities of employee benefit plans. This includes any investment contract issued by an employee stock purchase, savings, pension, or profit-sharing plan. Certain money market instruments. Commercial paper and bankers' acceptances are the two most common examples. Take note. The 5 items listed with an asterisk are the only cases where an individual representing the issuer in the sale of its securities is excluded from the definition of an agent. This concept will be explained in Learning Objective 11. D. Take note. A promissory note, commercial paper, that matures within 9 months is issued in denominations of at least $50,000 and receives one of the 3 highest ratings by a nationally recognized rating agency is exempt from registration requirements. Please note that this is the only case where a securities rating is part of the registration or exemption under the Uniform Securities Act. Exemption for federal covered securities. The National Securities Markets Improvement Act of 1996, NSMIO, brought 2 significant changes to the industry. The first was the creation of the federal covered security. We'll get to that in a moment. The other part of the law effectively divided the responsibility for regulating investment advisors between the states and the SEC by creating the category of registration known as a federal covered advisor. We'll get into that in the next unit. Of importance to this unit is the term federal covered security, a security that is exempt from registration on the state level. State securities registration requirements were preempted with respect to federal covered securities. However, states may require notice filings consisting of filing fees and copies of documents filed with the Securities and Exchange Commission, SEC, primarily in the case of registered investment companies, for example, mutual funds. The major categories of federal covered securities, as defined in the NSMIO, which therefore cannot be regulated by state securities administrators except for violating anti-fraud provisions, include securities issued by an open-end or closed-end investment company, unit investment trust, or face amount certificate company that is registered under the Investment Company Act of 1940. Securities listed on the New York Stock Exchange that NYSE American LLC, formerly known as the American Stock Exchange, MXD, the NASDAQ stock market, and not tested, several other U.S. exchanges. In addition, any security equal in seniority, rights, or warrants, or senior to these securities, bonds and preferred stock, is also considered federal covered. Securities offered pursuant to the provisions of Rule 506(b) or 506(c) of Regulation D under the Securities Act of 1933, qualifying under the private placement transaction exemption, and most securities exempt from registration under the Securities Act of 1933. You do not have to know the exceptions other than the one we're going to describe below. If the federal government says the security does not have to register, no state can overstep that. Municipal bonds are included in the list of securities exempt from registration under federal and state law. However, under the NSMIO, if the municipal issuer is located in the state in which the securities are being offered, that security is not considered a federal covered security. Example: a bond issued by the City of Columbus, is a federal covered security everywhere but in the state of Ohio. The effect of this is that no state regulator can enforce any of their rules against the bond. But in the state of Ohio, even though the security is exempt under Ohio's securities laws, the administrator could request that the issuer, the city, furnish certain details about the issue. This Columbus O bond is still exempt from registration under both state and federal law, but in Ohio, it is not known as a federal covered security. Everywhere else, it is. Take note. It is important to note that registering a security with the SEC does not automatically make it federal covered. Yes, that is true of investment companies and those securities listed on certain stock exchanges and the NASDAQ stock market, but there are tens of thousands of stocks registered with the SEC that trade in the over-the-counter market. For example, OTC Markets Group, and they are not federal covered. Furthermore, a security does not have to be registered with the SEC to be included in the definition of federal covered security. For example, U.S. government and municipal securities are exempt from registration with the SEC and are included in NISMU's list of federal covered securities. Take note. Although investment company securities such as mutual funds are federal covered securities, the Uniform Securities Act allows states to impose filing fees on them under a process called notice filing, as described in Learning Objective 8G. Practice question. Which of the following securities is not exempt from the registration and advertising requirements of the Uniform Securities Act? A. Shares of Commonwealth Edison, a regulated public utility holding company. B. Securities issued by the nonprofit Carnegie Endowment for Peace. C. Securities issued by a bank that is a member of the Federal Reserve System. D. Variable annuity contracts issued by Metrodential Insurance Company, licensed to do business in the state. The answer is D. Variable annuities, whose performance depends on the securities in a segregated fund, are non-exempt, which means they are covered by the Act and have to register. Shares in public utilities, charitable foundations, and banking institutions that are members of the Federal Reserve System are included in our list of exempt securities. Exempted securities under the Securities Act of 1933. The exemptions under federal law are similar to those under state law, but there are some significant differences. As a NASA exam, the exam will focus on the state laws, but you should be familiar with the federal ones as well. The Securities Act of 1933 makes it unlawful to sell or deliver a security through any instrument of interstate commerce unless a registration statement is in effect. However, certain securities are exempted from the registration requirements of the Act. The following issues qualify as exempted securities. Any security issued or guaranteed by the United States, any state, or any political subdivision of a state. All federal government issues and municipal securities are exempted securities. Note that Canadian securities are not included in this exemption. NASA membership includes Canadian administrators. Any commercial paper that has a maturity at the time of issuance of no more than 9 months, 270 days, with the stipulation that the proceeds are to be used by the issuer to increase working capital and not for the purchase of fixed assets. There is no minimum denomination or rating requirements similar to that found in the Uniform Securities Act. Any security issued by a person organized and operated exclusively for religious, educational, benevolent, fraternal, or charitable purposes and not for pecuniary profit. Any interest in a railroad equipment trust. For purposes of the law, interest in a railroad equipment trust means any interest in an equipment trust, lease, or other similar arrangement entered into, guaranteed by, or for the benefit of a regulated common carrier to finance the acquisition of rolling stock, including motive power. Any security issued by a federal or state bank, savings and loan association, building and loan association, or similar institution. Take note. The exemption described for banks does not apply to bank holding companies. Most of the large U.S. banks today are owned by holding companies. Rule 147 Exemption. Any security issued under this rule qualifies as an exempt security under federal law, but is not exempt under the Uniform Securities Act and will probably have to register with the state. This exemption from federal registration applies to any security offered and sold only to persons resident within a single state, where the issuer of such security is a person whose principal place of business is located within such state. Principal place of business means the location from which the officers, partners, or managers of the issuer primarily direct, control, and coordinate the activities of the issuer. The Rule 147 exemption is available only if the entire issue is offered and sold exclusively to residents of a single state. If any sales take place to non-residents, the entire issue loses its exemption. The purpose of this exemption is to allow issuers to raise money on a local basis, provided the business is operating primarily within that state. The following conditions must be met in order to have a distribution qualify as an intrastate offering exempt from federal registration. The securities must be offered or sold exclusively to persons who have their principal residence within the state where the issuer's principal place of business is located. For 6 months from the date of the sale by the issuer to that purchaser, resales of any part of the issue by that person will be made only to persons resident within the same state. The issuer must have a reasonable belief that the investor is a resident of the state. It is required that issuers obtain a written representation from each purchaser as to residency. The issuer must place a prominent legend on the certificate disclosing to offerees and investors the limits on resales, among other things. A minimum of one of the following conditions must be met. At least 80% of the issuer's gross revenue must be derived from operations within the state. At least 80% of the proceeds of the offering must be used for business purposes within the state. At least 80% of the issuer's assets must be located within the state. A majority of the issuer's employees must be located in the state. Rule 147A. Rule 147A has the same requirements as the Rule 147 exemption, except issuers may be incorporated or organized outside of the state in which they make the offering under Rule 147A, provided their principal place of business is in the state. For example, the corporation could be incorporated in Delaware but have its principal place of business in Idaho, and issuers relying on Rule 147 may make offers available to out-of-state residents such as general solicitation or general advertising on the internet or other means, so long as sales are made only to in-state residents, while amended Rule 147 requires that issuers make offers and sales only to in-state residents. Example. So, to summarize, here are the most testable changes. The residency rule for issuers only requires one of the 3 80% conditions, or the fourth a majority of the employees are located in the state. The resale restriction is 6 months from the date of purchase by the investor. The rules refer to the term principal place of business to mean the location from which the officers, partners, or managers of the issuer primarily direct, control, and coordinate the activities of the issuer. This must always be in the state. Only Rule 147 permits an issuer to be incorporated in a state other than the state of residency, for example, be incorporated in State A and have its principal place of business in State B. Only Rule 147 permits an issuer to make offers out of state, but all purchasers are still required to be in-state residents. Practice question. Both Rule 147 and Rule 147 require that the issuer meet residency requirements. Meeting which of the following is not one of those requirements? A. At least 80% of the issuer's assets are located in the state. B. At least 80% of the issuer's gross revenue must be derived from operations within the state. C. At least 80% of the proceeds of the offering must be used for business purposes within the state. D. At least 80% of the issuer's employees must be located in the state. The answer is D. The requirement is that a majority of the issuer's employees are located in the state, not at least 80%. Knowledge Check 8.2. Question 1. Which of the following securities is not exempt from the registration and sales literature filing requirements of the Uniform Securities Act? A. Shares of investment companies registered under the Investment Company Act of 1940. B. Shares sold on the NASDAQ stock market. C. AAA-rated promissory notes of $100,000 that mature in 300 days. D. Bonds issued by Saskatchewan, Canada. The correct answer is C. In order to be exempt, promissory notes cannot have a maturity beyond 270 days. Registered investment companies, think mutual funds, are federal covered securities, as are shares of companies listed on the NASDAQ stock market. Any security issued by a state or Canadian province and their subdivisions is an exempt security. Question 2. 4 months ago, one of your clients purchased 100 shares of stock that was sold under a Rule 147 exemption. He has just called to inform you that he has sold those shares to his neighbor at a nice profit. Under the provisions of the Rule 147 resale restrictions, A. The client had to wait at least 6 months from the date of the last sale by the issuer of any part of the issue. B. The resale restrictions now pass to the buyer. C. The resale restrictions only apply to residents of another state. D. The resale must be made through the broker-dealer who made the original sale. The correct answer is C. although the rule has a 6-month resale restriction that only applies to sales made to residents of other states. It is not a problem if you resell in a much shorter time to your neighbor. Underwriter transactions. These include transactions between an issuer and broker-dealers performing in the capacity of an underwriter, such as a firm commitment underwriting, as well as those between underwriters themselves as when functioning as members of a selling syndicate. Bankruptcy, guardian, or conservator transactions. Transactions by an executor, administrator, sheriff, marshal, receiver, guardian, or trustee in bankruptcy are exempt transactions. Please note that a custodian under UVMA or UTMA is not included in this list and that the only trustee is one in bankruptcy. Institutional investor transactions. These are primarily transactions with financial institutions such as banks, insurance companies, and investment companies, and there is no minimum order size used to define these trades. Limited offering transactions. These include any offering, called a private placement, directed at not more than 10 persons, called offerees, other than institutional investors during the previous 12 consecutive months, provided that the seller reasonably believes that all of the non-institutional buyers are purchasing for investment purposes only. No commissions or other remuneration is paid for soliciting non-institutional investors, and no general solicitation or advertising is used. Unlike federal law, where the private placement rule restricts the number of purchasers, the USA restricts the number of offers that may be made. The number 10 is the figure that will be tested. But an administrator may want to reduce it, for example, for uranium stocks or oil royalties, or increase it for a closely held corporation that wants to solicit 20 or 30 friends and relatives of the owners for additional capital. As we continue to learn, the administrator has a great deal of power. Pre-organization certificates. An offer or sale of a pre-organization certificate or subscription is exempt if no commission or other remuneration is paid or given directly or indirectly for soliciting any subscriber. The number of subscribers does not exceed 10, and no payment is made by any subscriber. You have probably never heard of a pre-organization certificate or subscription, so a little explanation is in order. A new corporation cannot receive a charter unless its documents of incorporation provide evidence that minimum funding is assured. Because the purpose of these pre-organization certificates is to enable a new enterprise to obtain the minimum amount of capital required by the corporation law of the state. The USA places a limitation on the number of subscribers rather than the number of offerees, as in the private placement exemption above. Hence, there may be a publicly advertised offering of pre-organization subscriptions. But there may be no payment until effective registration unless another exemption is available. This tool itself simply postpones registration. It does not excuse registration altogether. Transactions with existing security holders. A transaction made under an offer to existing security holders of the issuer, including persons who are holders of convertible securities, rights, or warrants, is exempt as long as no commission or other form of remuneration is paid directly or indirectly for soliciting that security holder. Non-issuer transactions by pledgees. A non-issuer transaction executed by a bona fide pledgee, the one who received the security as collateral for a loan, as long as it was not for the purpose of evading the act, is an exempt transaction. For example, you pledged stock as collateral for a loan and defaulted on your obligation. The lender will sell your stock to try to recoup his loss, and under the USA, this is considered an exempt transaction. Take note. Some students find it helpful to remember that an exempt security is a noun, while an exempt transaction is a verb, hence the word action. Practice question. Which of the following are exempt transactions? Roman numeral 1. A non-issuer transaction with a bank in a NASDAQ capital market security. Roman numeral 2. An unsolicited request from an existing client to purchase a non-exempt security. Roman numeral 3. The sale of an unregistered security in a private, non-publicly advertised transaction to 10 non-institutional purchasers over a period not exceeding 12 months. Roman numeral 4. The sale of unlisted securities by a trustee in bankruptcy. A1 and 2. B1, 2, and 3. C1, 2, and 4. D1, 2, IUA, and 4. The answer is C. Choice IUI is not an exempt transaction because the private placement exemption is limited to 10 offerees, not 10 purchasers. All of the others are included in our list of exempt transactions. Try to follow this next point because it is a bit tricky. The administrator may, by rule or order, deny or revoke the registration exemption of any security issued by any person organized and operated not for private profit, but exclusively for religious, educational, benevolent, charitable, fraternal, social, athletic, or reformatory purposes, or as a chamber of commerce or trade or professional association, your basic nonprofit exemption, and any investment contract issued in connection with an employee's stock purchase, savings, pension, profit sharing, or similar benefit plan. Please note that a few pages ago, we gave you a list of 9 different exempt securities, from U.S. and Canadian government issues through certain money market instruments. However, the administrator can only deny exemption to the 2 specified above. On the other hand, with the exception of those involving federal covered securities, the administrator may deny any exempt transaction. That means that, for example, just because an agent solicited a transaction with an insurance company of a security that was not federal covered, the administrator has the power, if he feels it is justified, to consider that transaction non-exempt. Under the USA, the burden of providing an exemption or an exception from a definition falls upon the person claiming it. Take note. There are only 2 securities exemptions that the administrator may revoke, while all exempt transactions, other than in certain federal covered securities, may be revoked. Before we summarize, let's try a practice question. Practice question. Under the Uniform Securities Act, which of the following persons is responsible for proving that a securities issue is exempt from registration? A. Underwriter. B. The person requesting the exemption. C. State administrator. D. There is no need to prove eligibility for an exemption. The answer is B. The burden of proof for claiming eligibility for an exemption falls to the person claiming the exemption. In the event the registration statement was filed by someone other than the issuer, such as selling stockholders or a broker-dealer, that person must prove the claim. An exempt transaction is exempt from the regulatory control of the state administrator because of the manner in which a sale is made or because of the person to whom the sale is made. A transaction is an action and must be judged by the merits of each instance. Example: an agent can sell a security that is not exempt from registration in the state if the purchaser of the security is a bank or other institutional buyer. Why is that so? Because the sale of securities to certain financial institutions is an exempt transaction, as will be enumerated shortly. The sale can be made without registration. This means that the securities sold in exempt transactions do not have to be registered in the state. If that same non-exempt security was not sold in an exempt transaction, such as to an individual investor, it would have to be registered in the state. Summary of exemptions from registration under the Uniform Securities Act. Let's start our summary with a key statement from the USA. It is unlawful for any person to offer or sell any security in this state unless 1. It is registered under this act, or 2. The security or transaction is exempted under this act, or 3. It is a federal covered security. We must point out that these exemptions apply to the security or transaction only, not to the securities professional. So if a security is exempt, such as a government security, it can be sold in this state without any registration. But the person who sells it must be properly registered in this state, unless that person qualifies for an exemption. We'll get into this in full detail in Unit 11. Lesson 8.3. Exempt transactions under state and federal law. Learning Objective 8D. Recall the exempt transactions under the Uniform Securities Act and the Securities Act of 1933. Exempt transactions under the Uniform Securities Act. Before a security can be sold in a state, it must be registered unless exempt from registration or traded in an exempt transaction. This section covers exemptions for transactions that take place in a state. There are many different types of exempt transactions. We begin by focusing on those most likely to be on your exam and finish with several others. Isolated non-issuer transactions. Isolated non-issuer transactions include secondary, non-issuer, transactions that occur infrequently, very few transactions per year. The exact number varies by state. However, these usually do not involve securities professionals. In the same manner that individuals placing a for sale by owner sign on their front lawns do not need a real estate license, one individual selling stock to another in a one-on-one transaction is engaging in a transaction exempt from the oversight of the administrator because the issuer is not receiving any of the proceeds and the parties involved are not trading as part of a regular practice. Unsolicited brokerage transactions. These include transactions initiated by the client, not the agent. This is probably the most common of the exempt transactions. If a client calls a registered agent and requests that the agent buy or sell a security, the transaction is an unsolicited brokerage transaction exempt from state registration. But the administrator may by rule require that the customer acknowledge upon a specified form that the sale was unsolicited and that a signed copy of the form be kept by the broker-dealer for a specified period. Underwriter transactions. These include transactions between an issuer and broker-dealers performing in the capacity of an underwriter, such as a firm commitment underwriting, as well as those between underwriters themselves as when functioning as members of a selling syndicate. Bankruptcy, guardian, or conservator transactions. Transactions by an executor, administrator, sheriff, marshal, receiver, guardian, or trustee in bankruptcy are exempt transactions. Please note that a custodian under UGMA or UTMA is not included in this list and that the only trustee is one in bankruptcy. Institutional investor transactions. These are primarily transactions with financial institutions such as banks, insurance companies, and investment companies, and there is no minimum order size used to define these trades. Limited offering transactions. These include any offering, called a private placement, directed at not more than 10 persons, called offerees, other than institutional investors during the previous 12 consecutive months, provided that the seller reasonably believes that all of the non-institutional buyers are purchasing for investment purposes only. No commissions or other remuneration is paid for soliciting non-institutional investors, and no general solicitation or advertising is used. Unlike federal law, where the private placement rule restricts the number of purchasers, the USA restricts the number of offers that may be made. The number 10 is the figure that will be tested, but an administrator may want to reduce it, for example, for uranium stocks or oil royalties, or increase it for a closely held corporation that wants to solicit 20 or 30 friends and relatives of the owners for additional capital. As we continue to learn, the administrator has a great deal of power. Pre-organization certificates. An offer or sale of a pre-organization certificate or subscription is exempt if no commission or other remuneration is paid or given directly or indirectly for soliciting any subscriber, the number of subscribers does not exceed 10, and no payment is made by any subscriber. You have probably never heard of a pre-organization certificate or subscription, so a little explanation is in order. A new corporation cannot receive a charter unless its documents of incorporation provide evidence that minimum funding is assured. Because the purpose of these pre-organization certificates is to enable a new enterprise to obtain the minimum amount of capital required by the corporation law of the state, the USA places a limitation on the number of subscribers rather than the number of offerees, as in the private placement exemption above. Hence, there may be a publicly advertised offering of pre-organization subscriptions. But there may be no payment until effective registration unless another exemption is available. This tool itself simply postpones registration. It does not excuse registration altogether. Transactions with existing security holders. A transaction made under an offer to existing security holders of the issuer, including persons who are holders of convertible securities, rights, or warrants, is exempt as long as no commission or other form of remuneration is paid directly or indirectly for soliciting that security holder. Non-issuer transactions by pledgees. A non-issuer transaction executed by a bona fide pledgee, the one who received the security as collateral for a loan, as long as it was not for the purpose of evading the act, is an exempt transaction. For example, you pledged stock as collateral for a loan and defaulted on your obligation. The lender will sell your stock to try to recoup his loss, and under the USA, this is considered an exempt transaction. Take note. Some students find it helpful to remember that an exempt security is a noun, while an exempt transaction is a verb, hence the word action. Practice question. Which of the following are exempt transactions? Roman numeral 1. A non-issuer transaction with a bank in a NASDAQ capital market security. Roman numeral 2. An unsolicited request from an existing client to purchase a non-exempt security. Roman numeral 3. The sale of an unregistered security in a private, non-publicly advertised transaction to 10 non-institutional purchasers over a period not exceeding 12 months. Roman numeral 4. The sale of unlisted securities by a trustee in bankruptcy. A1 and 2. B1, 2, and 3. C1, 2, and 4. D1, 2, IEA, and 4. The answer is C. Choice IOI is not an exempt transaction because the private placement exemption is limited to 10 offerees, not 10 purchasers. All of the others are included in our list of exempt transactions. Try to follow this next point because it is a bit tricky. The administrator may, by rule or order, deny or revoke the registration exemption of any security issued by any person organized and operated not for private profit, but exclusively for religious, educational, benevolent, charitable, fraternal, social, athletic, or reformatory purposes, or as a chamber of commerce or trade or professional association, your basic nonprofit exemption, and any investment contract issued in connection with an employee's stock purchase, savings, pension, profit sharing, or similar benefit plan. Please note that a few pages ago, we gave you a list of 9 different exempt securities, from U.S. and Canadian government issues through certain money market instruments. However, the administrator can only deny exemption to the 2 specified above. On the other hand, with the exception of those involving federal covered securities, the administrator may deny any exempt transaction. That means that, for example, just because an agent solicited a transaction with an insurance company of a security that was not federal covered, the administrator has the power, if he feels it is justified, to consider that transaction non-exempt. Under the USA, the burden of providing an exemption or an exception from a definition falls upon the person claiming it. Take note. There are only 2 securities exemptions that the administrator may revoke, while all exempt transactions, other than in certain federal covered securities, may be revoked. Before we summarize, let's try a practice question. Practice question. Under the Uniform Securities Act, which of the following persons is responsible for proving that a securities issue is exempt from registration? A. Underwriter. B. The person requesting the exemption. C. State administrator. D. There is no need to prove eligibility for an exemption. The answer is B. The burden of proof for claiming eligibility for an exemption falls to the person claiming the exemption. In the event the registration statement was filed by someone other than the issuer, such as selling stockholders or a broker-dealer, that person must prove the claim. An exempt transaction is exempt from the regulatory control of the state administrator because of the manner in which a sale is made or because of the person to whom the sale is made. A transaction is an action and must be judged by the merits of each instance. Example: an agent can sell a security that is not exempt from registration in the state if the purchaser of the security is a bank or other institutional buyer. Why is that so? Because the sale of securities to certain financial institutions is an exempt transaction, as will be enumerated shortly. The sale can be made without registration. This means that the securities sold in exempt transactions do not have to be registered in the state. If that same non-exempt security was not sold in an exempt transaction, such as to an individual investor, it would have to be registered in the state. Summary of exemptions from registration under the Uniform Securities Act. Let's start our summary with a key statement from the USA. It is unlawful for any person to offer or sell any security in this state unless 1. It is registered under this act, or 2. The security or transaction is exempted under this act, or 3. It is a federal covered security. We must point out that these exemptions apply to the security or transaction only, not to the securities professional. So if a security is exempt, such as a government security, it can be sold in this state without any registration. But the person who sells it must be properly registered in this state, unless that person qualifies for an exemption. We'll get into this in full detail in Unit 11. Exempt transactions under the Securities Act of 1933. Unlike the USA, there are only 2 exempt transactions that might be tested, and they are transactions by any person other than an issuer, underwriter, or dealer, basically private transactions between individuals, and transactions by an issuer that do not involve a public offering, private placement under Regulation D. In a major effort aimed at facilitating the capital formation needs of small businesses, the SEC adopted Regulation D, the private placement exempt transaction. Securities offered and sold in compliance with Regulation D are exempt from registration with the SEC and, as was listed earlier, are considered federal covered securities exempt from registration on the state level as well. Our primary concern is with SEC Rule 506, a private placement where there is no dollar limit on the amount sold. The Jumpstart Our Business Startups Act of 2012, or JOBS Act, made several important changes to Rule 506 of Regulation D. Rule 506 consists of two sections, 506(b) and 506(c). A company seeking to raise capital through a private placement under Rule 506(b) can sell the offering to an unlimited number of accredited investors, defined below, and up to 35 non-accredited investors. In addition, no advertising may be done on behalf of the offering. On the other hand, Section 506(c) permits the offering to be advertised. There are two primary and interrelated requirements in order to do this. All purchasers are accredited investors, or the issuer reasonably believes that they are accredited investors. The issuer takes reasonable steps to verify that all purchasers are accredited investors, which could include reviewing documentation such as W-2s, tax returns, bank and brokerage statements, credit reports, and the like. An issuer can elect to make a typical Rule 506 offering without general solicitation or advertising under Section 506(b) in order to include up to 35 non-accredited investors in the offering or to avoid the heightened verification procedures. The Jobs Act also included a provision that an issuer is disqualified from using Rule 506 under their bad actor provisions. Simply put, if the issuer or other relevant persons, such as underwriters, directors, officers, or significant shareholders of the issuer, have been convicted of securities fraud or certain other securities violations, an offering under Rule 506 may not take place. SEC Rule 501 Accredited Investors. SEC Rule 501 classifies an accredited investor for the purposes of Regulation D into several categories. Investors are considered to be accredited under the rule only if the issuer or any person acting on the issuer's behalf has reasonable grounds to believe, and does believe after reasonable inquiry, that the investors are included in one of the categories in the definition. The separate categories of accredited investors under Regulation D include a bank, an insurance company, or a registered investment company, an employee benefit plan if a bank, an insurance company, or a registered investment advisor makes the investment decisions, or if the plan has total assets in excess of $5 million. A charitable organization, corporation, LLC, or partnership with assets exceeding $5 million. Directors, executive officers, and general partners of the issuer. Any natural person whose individual net worth or joint net worth with that person's spouse or spousal equivalent, excluding the net equity in his primary residence, exceeds $1 million at the time of his purchase. Any natural person who had an individual income in excess of $200,000 in each of the 2 most recent years or joint income with that person's spouse or spousal equivalent in excess of $300,000 in each of those years and has a reasonable expectation of reaching the same income level in the current year. Entities made up of accredited investors. Individuals who are qualified as licensed general securities representatives, Series 7. Licensed investment advisor representatives, Series 65, and licensed private securities offerings representatives, Series 82. Please note that NASA has stated a person seeking accredited investor status by passing the Series 65 exam would also need to be licensed as an investment advisor representative in her state and would need to comply with all state-specific licensing requirements, for example, paying dues, etc. So it is more than just passing the exam. Regardless of the license, one must have met all of the licensing requirements. Individual investors who are knowledgeable employees of private funds. This would include directors and certain executive officers of the private fund, or of an affiliated person of the private fund that manages the investment activities of the private fund. However, they are only accredited investors for the purpose of investing in offerings by the private fund and other private funds managed by their employer. They cannot use their status as a knowledgeable employee to qualify as an accredited investor to invest in 3 categories of investment advisors. Those registered with the SEC, those registered in any state, and exempt reporting advisors. Limited liability companies, LLCs, with assets of more than $5 million, and almost any entity with investments of more than $5 million. The term accredited investor applies only to private placements. A favorite phrase of the regulators is eligibility does not equal suitability. Therefore, just because one meets the financial requirements of an accredited investor does not mean that suitability standards are ignored. Test topic alert. Can assets in an account or property held jointly with another person who is not the purchaser's spouse be included in determining whether the purchaser satisfies the net worth test in Rule 501? The answer is yes. Assets in an account or property held jointly with a person who is not the purchaser's spouse may be included in the calculation for the net worth test, but only to the extent of his or her percentage ownership of the account or property. Form D. What is Form D, and when does it have to be filed? Under Rule 503 of Regulation D, an issuer that is issuing securities in reliance on Regulation D must file Form D electronically with the SEC no later than 15 days after the first sale of securities in the offering. Knowledge Check 8.3. Question 1. All of the following describe exempt transactions except A. ABC, a broker-dealer, purchases securities from XYZ Corporation as part of an underwriting commitment. B. First National Bank sells its entire publicly traded bond portfolio to Amalgamated National Bank. C. Amalgamated National Bank sells its publicly traded bond portfolio to ABC Insurance Company. D. Joan Smith, an employee of Amalgamated National Bank, buys securities recommended by her agent at ABC Securities Corporation, a registered broker-dealer. The correct answer is D. The purchase of securities from a broker-dealer by an employee of a bank is a non-exempt transaction. It is the sale of a security by a broker-dealer to a member of the public and is therefore not exempt. Transactions between broker-dealers and issuers as part of an underwriting commitment. Transactions between banks and transactions between banks and insurance companies are exempt because they are transactions between financial institutions. Exempt transactions are most often identified by whom a transaction is with rather than what type of security is involved. Question 2. As defined in the Uniform Securities Act, each of the following would be considered an exempt transaction except A. A trustee of a corporation in bankruptcy liquidates securities to satisfy debt holders. B. An offer of a securities investment is directed to 10 individuals in the state during a period of 12 consecutive months. C. An agent solicits insurance companies to purchase shares of non-exempt securities. D. Pre-organization certificates are subscribed to by 9 investors in the state, earning the agent a modest commission. The correct answer is D. The 9 investors are within the required 10, but in order for a pre-organization certificate to be an exempt transaction, there can be no payment of funds or commissions. Transactions by fiduciaries, such as a trustee in bankruptcy, the only trustee who qualifies, and transactions with institutions, such as insurance companies, are exempt. The private placement exemption applies as long as there are no more than 10 offers to individual, retail, purchasers within 12 consecutive months. Lesson 8.4. Registration of securities under federal law. Learning Objective 8E. Recollect the procedures for registering non-exempt securities under the Securities Act of 1933. The Securities Act of 1933, also called the Paper Act, the Truth in Securities Act, and the Prospectus Act, regulates the issuing of corporate securities sold to the public. Unless the security or transaction is exempt, the Act requires securities issuers to make full disclosure of all material information in their registration materials in order for investors to make fully informed investment decisions. Just like the rules under state law, if the security is not exempt, a non-exempt security, or the transaction is not exempt, a non-exempt transaction, then the security must be registered with the SEC. Issuer information must be disclosed to the Securities and Exchange Commission, SEC, in a registration statement and published in a prospectus. In addition, the Act prohibits fraudulent activity in connection with the sale, underwriting, and distribution of securities. The Act provides for both civil and criminal penalties for violations of its provisions. Even though registration under the Uniform Securities Act, the law that deals with regulation by the states, will be covered directly after this, where appropriate, mention will be made of the similarities and differences between certain federal and state definitions. Definition: Prospectus. A prospectus is any notice, circular, letter, or communication, written or broadcast by radio or television, that offers any security for sale or confirms the sale of a security. A tombstone advertisement, one that simply identifies the security, the price, and the underwriters, is not considered a prospectus nor an offering of the subject security. The term prospectus does not include oral communications. As mentioned earlier, an issuer is any person who issues or proposes to issue any security. Most issuers are businesses, and the term issuer would also apply to a government entity. When in Learning Objective 11, we describe the exclusion from the definition of agent for an individual who represents the issuer in the sale of its security, we state that this is not the usual method of distributing a new issue, but it is used by small firms who wish to reduce the cost. In almost all cases, securities are distributed by a broker-dealer or network of BDs, acting as underwriters of the issue. The term underwriter is defined as any person, usually a broker-dealer, who has purchased a security from an issuer with a view to the distribution of the security, or participates or has a direct or indirect participation in that distribution. Take note that SEC does not approve securities registered with it, does not pass on the investment merit of any security, and never guarantees the accuracy of statements in a registration statement and prospectus. In its review process, the SEC merely attempts to make certain that all pertinent information is fully disclosed in the registration statement and prospectus by requiring that the issuer file a registration statement with the SEC before securities are offered or sold in interstate commerce. A prospectus that meets the requirements of the Act be provided to prospective buyers, and the registration statement. An issuer must file a registration statement with the SEC disclosing material information about the issue. The registration statement must be signed by the principal executive officer, usually designated the CEO, the principal financial officer, usually designated the CFO, and a majority of the board of directors. All of the signers are subject to criminal and civil penalties for willful omissions and misstatements of material facts. The information required in the registration statement may be summarized as follows: purpose of issue, public offering price, anticipated range, underwriters' commissions or discounts, promotion expenses, expected use of the net proceeds of the issue to the company, balance sheet, earnings statements for the last 3 years, names, addresses, and bios of officers, directors, stockholders owning more than 10% of the outstanding stock, control persons, and underwriters of the issue, copy of underwriting agreements, and copies of articles of incorporation. The cooling-off period. After the issuer files a registration statement with the SEC, a 20-day cooling-off period begins. After the issuer, with the underwriter's assistance, files with the SEC for registration of the securities, the cooling-off period begins before the registration becomes effective. The registration can become effective as early as 20 calendar days after the date that SEC has received it. In practice, however, the cooling-off period is seldom the minimum 20 days. The SEC usually takes longer to clear registration statements. The 3 phases of an underwriting. Prior to the filing of the registration statement, no sales can be solicited and no prospectus can circulate. Issuer files registration statement with the SEC. Cooling-off period, where no one can solicit sales during the cooling-off period, but indications of interest can be solicited with a red herring. Effective date offering period may begin. Sales can now be solicited, but the firm must use a final prospectus. The cooling-off period can last several months because of the time it takes to make additions and corrections. Preliminary, red herring, prospectus. The preliminary prospectus must be made available to any prospective purchaser who expresses interest in the security from the time the issue is filed with the SEC until it becomes publicly available for sale, which is the effective date, the previously described cooling-off period. A red herring is used to acquaint investors with essential facts concerning the new issue. It is also used to solicit indications of buyer interest. However, it cannot be used as a confirmation of sale, in place of a registration statement, or to declare the final public offering price. However, along with stating the expected number of shares to be sold, a bona fide estimate of the price range per share is required to be included. Under no circumstances may a broker-dealer or one of its agents accept money or orders prior to the effective date. All the agent can do is ask the client for a non-binding indication of interest as to whether she might be interested in the security once the registration is declared effective. The term red herring was given to the preliminary prospectus because the front page contains the following statement printed in red ink. A registration statement relating to these securities has been filed with the Securities and Exchange Commission but has not yet become effective. Information contained herein is subject to completion or amendment. These securities may not be sold, nor may offers to buy be accepted prior to the time the registration statement becomes effective. No person connected with the offering is allowed to make marks on a preliminary prospectus under any circumstances. They cannot write short summaries or reviews on the preliminary prospectus. The preliminary prospectus must be given to customers without any alterations because, as stated above, information is subject to change. Take note. 2 items missing from the preliminary prospectus, red herring, are the public offering price, expected range must be shown, and the effective date. Test topic alert. During the cooling-off period, underwriters may not take orders or distribute sales literature or advertising material. However, they may take indications of interest, distribute preliminary prospectuses, or publish tombstone advertisements to provide information about the potential availability of the securities. The final effective prospectus. A registration statement is normally a very long and complex document for an investor to read. The Act requires the preparation of a shorter document called a prospectus. The prospectus summarizes the information contained in the registration statement. It must contain all the material facts in the registration statement, but in shorter form. The prospectus must be given to every person who purchases no later than with confirmation of the sale. The purpose of a prospectus is to provide the investor with adequate information to analyze the investment merits of the security. Even if an investor does not intend to read a prospectus, it still must be given to him. It is unlawful for a company to sell securities before the effective date of the registration statement. Effective date of the registration statement. On the date a registration statement becomes effective, securities may be sold to the public by broker-dealers and their agents. A copy of the final effective prospectus must be delivered to each purchaser. This is normally accomplished by including the prospectus along with a confirmation of the trade, although it would certainly be permitted to deliver it earlier. Additional sales literature may be used by the firm as long as the sales literature is preceded or accompanied by a prospectus. Just as with a preliminary prospectus, no markings of any kind may be placed on the prospectus. No areas of special interest may be highlighted or have attention drawn to them by any other method. Money may be accepted by the broker-dealer from customers at this time. Knowledge Check 8.4. Question 1. Which of the following describe indications of interest secured during the 20-day cooling-off period? Roman numeral 1. Binding on the customer. Roman numeral 2. Non-binding on the customer. Roman numeral 3. Binding on the broker-dealer. Roman numeral 4. Non-binding on the broker-dealer. A. 1 and 3. B. 1 and 4. C. 2 and 3. D. 2 and 4. The correct answer is D. Indications of interest are not binding on either party. Question 2. Charlotte is an agent of Gibraltar Securities. Her most active customer told Charlotte that he is thinking about buying 10,000 shares of a retailer's stock for which Gibraltar will be participating in the underwriting syndicate. The SEC release date for the stock is anticipated within 10 business days. What may Charlotte send to the client today? A. The preliminary prospectus and a reprint of a popular advertisement placed by the issuing corporation. B. The preliminary prospectus. C. An order request. D. The final prospectus. The correct answer is C. Because a security is in registration until released by the SEC for public sale, only the unadulterated prospectus may be sent to parties indicating interest in purchasing the stock. Orders may not be accepted for a security while in registration. Because the final prospectus is indeed an offering document, it may not be presented until the SEC has released the security for public sale, made the security effective. Lesson 8.5. Registration of securities under state law. Learning Objective 8F. Recollect the procedures for registering non-exempt securities under the Uniform Securities Act. State law under the Uniform Securities Act requires disclosures similar to those under federal law. Depending on the nature of the issuer and / or the type of transaction, a security may or may not have to register under state and / or federal law. The following is a key statement regarding state law. Under the Uniform Securities Act, it is unlawful for any person to offer or sell an unregistered security in a state unless 1. It is registered under the Act. 2. The security or transaction is exempted from registration under the Act. Or 3. It is a federal covered security. If the security or transaction is not exempt or is not a federal covered security as defined by the National Securities Markets Improvement Act, it must be registered in the state or it cannot be lawfully sold in the state. The first step in the registration procedure is for the issuer or its representative to complete a registration application and file it with the state securities administrator. The person registering the securities is known as the registrant. There are some provisions applicable to all registrations regardless of the method used. The exam will want you to know these well. Filing the registration statement. State administrators require every issuer to supply the following information on their applications. Amount of securities to be issued in the state. States in which the securities are to be offered, but not the amounts offered in those other states. Any adverse order or judgment concerning the offering by regulatory authorities, court, or the SEC. Anticipated effective date and anticipated use of the proceeds. Why are we raising this money? When filing the registration statement with the administrator, an applicant may include documents that have been filed with the administrator within the last 5 years, provided the information is current and accurate. The administrator may, by rule or order, permit the omission of any information it considers unnecessary. Test topic alert. Although most registration statements are filed by the issuer, the exam may require you to know that they may also be filed by any selling stockholder, such as an insider making a large block sale, or by a broker-dealer. Filing fee. The issuer, or any other person on whose behalf the offering is to be made, must pay a filing fee, as determined by the administrator, when filing the registration. The filing fees are often based on a percentage of the total offering price. If the registration is withdrawn, or if the administrator issues a stop order before the registration is effective, the administrator may retain a portion of the fee and refund the remainder to the applicant. Take note. A stop order is used to deny effectiveness to, or suspend or revoke the effectiveness of, any registration statement. This applies only to securities, not professionals such as broker-dealers, agents, investment advisors, and investment advisor representatives. Ongoing reports. The administrator may require the person who filed the registration statement to file reports to keep the information contained in the registration statement current and to inform the administrator of the progress of the offering. Test topic alert. These reports cannot be required more often than quarterly. Special subscription form. The administrator may also require, as a condition of registration, that the issue be sold only on a form specified by the administrator and that a copy of the form or subscription contract be filed with the administrator or preserved for up to 3 years. Learning Objective 8G. Identify the methods of state registration of securities, including the anti-fraud provisions of the Uniform Securities Act. State registration methods. The USA provides 2 methods for securities issuers to register their securities in a state, plus a special method for certain federal covered securities. They are notice filing, coordination, and qualification. Registration by notice filing. As previously mentioned, the National Securities Markets Improvement Act of 1996, NSMIU, designated certain securities as federal covered and therefore removed from the jurisdiction of the state regulatory authorities. Although the states are preempted from requiring registration for federal covered securities, status as a federal covered security is not preemption of the licensing or anti-fraud laws. Any person who sells a federal covered security must be licensed as a broker-dealer or agent, unless otherwise exempted, and must also comply with the anti-fraud provisions of state laws. The Uniform Securities Act gives the administrator the authority to require notice filings with respect to federal covered securities, generally investment companies registered with the SEC under the Investment Company Act of 1940. So, what is this notice filing? Primarily, it is an opportunity for the states to collect revenue in the form of filing fees because unlike with the 2 actual methods of registration we are going to discuss, the administrator has limited powers to review any documentation filed with her department. The fees for notice filing are generally lower than for the 2 forms of registration. Under the notice filing procedure, state administrators may require the issuer of certain federal covered securities to file the following documents as a condition for sale of their securities in the state. Documents filed along with their registration statements filed with the SEC. Documents filed as amendments to the initial federal registration statement. A report as to the value of such securities offered in the state. Consent to service of process. Test topic alert. Keep in mind the distinction between federal covered securities and SEC registered securities. As stated earlier, SEC registered does not mean federal covered. Many are and many aren't, and federal covered also includes those exempt from SEC registration, such as Treasury and municipal securities. Test topic alert. Before the initial offer of any federal covered security in a state, the administrator, by rule or order, may require the filing of all documents that are part of a federal registration statement filed with the U.S. Securities and Exchange Commission under the Securities Act of 1933, together with a consent to service of process signed by the issuer. However, unless there is an appearance of fraud, the administrator does not have the power, because of lack of jurisdiction, to prevent the sale of a federal covered security in his state. Test topic alert. Even though an issuer of a federal covered security, think about a Fortune 500 company listed on the NYSE, may not have to notice file, that does not mean that the company can make misrepresentations during an offer made in any state. To do so would violate the anti-fraud provisions of the USA. Registration by coordination. The most common form of registration for those securities that are not federal covered, typically securities traded on one of the facilities of the OTC markets group, such as the pink market, is coordination. A security may be registered by coordination if a registration statement has been filed under the Securities Act of 1933 in connection with the same offering. In coordinating a federal registration with state registration, issuers must supply the following records in addition to the consent to service of process. Copies of the latest form of the prospectus filed under the Securities Act of 1933, if the administrator requires it. A copy of articles of incorporation and bylaws, a copy of the underwriting agreement, or a specimen copy of the certificate. If the administrator requests, copies of any other information filed by the issuer under the Securities Act of 1933. Each amendment to the federal prospectus promptly after it is filed with the SEC. Effective date. Registration by coordination becomes effective at the same time the federal registration becomes effective, provided no stop orders have been issued by the administrator and no proceedings are pending against the issuer. The registration has been on file for at least the minimum number of days specified by the administrator, a number that currently ranges from 10 to 20 days, depending on the state. And a statement of the maximum and minimum offering prices and underwriting discounts have been on file for 2 business days. Registration by coordination is by far the most frequently used method and, from a practical standpoint, is the only sensible way to register a multistate offering. Registration by qualification. Any security can be registered by qualification. Registration by qualification requires a registrant to supply any information required by the state securities administrator. Securities not eligible for registration by another method must be registered by qualification. In general, securities that will be sold only in one state, interstate, will be registered by qualification. To register by qualification, an issuer must supply a consent to service of process and the following information: name, address, form of organization, description of property, and nature of business. Name and address of any person owning 10% or more of the outstanding shares of any class of equity security of the issuer. Estimated proceeds and the use to which the proceeds will be put. Type and amount of securities offered, offering price, and selling and underwriting costs. Copy of any prospectus, pamphlet, circular, or sales literature to be used in the offering. And a specimen copy of the security certificate. The administrator may require additional information by rule or order. The administrator may require that a prospectus be sent to purchasers before the sale and that newly established companies register their securities for the first time in a state by qualification. Take note. As we've noted previously, in order to register, even by notice filing, there must be a consent to service of process filed with the administrator. However, a person, remember the broad definition, who has filed such a consent in connection with a previous registration or notice filing need not file another. A practical effect of this is if you leave the firm you are registering with, you've probably already filed the consent to service of process to get this far, and register with another firm, you do not have to file a new consent, the old one remains on file. Or, if a company decides to raise additional capital by issuing more stock, a new consent is not required. Effective date. Unlike coordination, where the effective date is triggered by SEC acceptance of the registration, a registration by qualification becomes effective whenever the state administrator so orders. Regardless of the method used, every registration statement is effective for 1 year from its effective date. One interesting facet of the law is that the registration may continue in effect past the first anniversary if there are still some unsold shares remaining, as long as they are still being offered at the original public offering price by either the issuer or the underwriter. Although the above rule applies to all methods of registration, as a practical matter, it would rarely apply other than in a security registered by qualification. Those registered by coordination are also obviously registered with the SEC and therefore are sold by the major investment banking houses. Unless the issue is a real dog, it will sell out rather quickly. Even those that are not popular are usually completely subscribed to in a week or two. On the other hand, what if the issue, regardless of the method of registration, is in very high demand? Is it possible to increase the number of shares in the offering without having to file a new registration statement? Yes. A registration statement may be amended after its effective date so as to increase the securities specified to be offered and sold if two conditions are met. The public offering price is not changed from the amount stated in the original registration statement, and the underwriter's discounts and commissions are not changed from the respective amounts stated in the original registration statement. Escrow. As a condition of registration under coordination or qualification, the administrator may require that a security be placed in escrow if the security is issued within the past 3 years to a promoter at a price substantially different than the offering price, or to any person for a consideration other than cash. In addition, the administrator may require that the proceeds from the sale of the registered security in this state be impounded until the issuer receives a specified amount from the sale of the security either in this state or elsewhere. There have been many instances where companies were unable to raise their targeted goal and just took the money and ran. This impound or escrow lessens the likelihood that this will happen. Test topic alert. A registration statement may be amended after its effective date to change the number of shares to be offered and sold if the public offering price and underwriters' discounts and commissions are unchanged. Practice questions. Question 1. KPCO Dividend Yield Fund, a closed-end investment company registered under the Investment Company Act of 1940, wishes to commence offering its shares in states A, B, C, and D. It could be required to A. Coordinate its federal registration with each of the 4 states. B. Notice file. C. Register by qualification in each of the states. D. Do none of these because investment companies registered under the Investment Company Act of 1940 are federal covered securities and are exempt from registration. The answer is B. Although these are federal covered securities and exempt from traditional registration, as a registered investment company, you can expect that it will be required to engage in a notice filing. Question 2. Registration is effective when ordered by the administrator in the case of registration. By A. Coordination. B. Integration. C. Notice filing. D. Qualification. The answer is D. Registration by qualification is the only registration method where the administrator sets the effective date. The effective date under registration by coordination is set by the SEC, and notice filing is merely the filing of certain documents by certain federal covered securities. Question 3. In general, registration statements for securities under the Uniform Securities Act are effective for A. A period determined by the administrator for each issue. B. 1 year from the effective date. C. 1 year from the date of issue. D. 1 year from the previous January 1. The answer is B. On the state level, securities registration statements are generally effective for 1 year from the effective date. However, the effective date may be extended for a longer period during which the security is being offered or distributed in a non-exempt transaction by the issuer or other person on whose behalf the offering is being made, or by any underwriter who is still offering part of an unsold allotment or subscription taken by him as a participant in the distribution. Anti-fraud provisions of the Uniform Securities Act. Under all regulatory bodies, in order for an action to be fraudulent, it must be committed willfully and knowingly. There is no such thing as accidental fraud. Although the SEC has anti-fraud statutes as well, the exam will focus on those of the Uniform Securities Act. The applicability of the anti-fraud provisions is almost universal. For example, here is a statement about investment advisors. It is unlawful for any person who receives, directly or indirectly, any consideration from another person for advising the other person as to the value of securities or their purchase or sale, whether through the issuance of analyses or reports or otherwise. 1. To employ any device, scheme, or artifice to defraud the other person. 2. To engage in any act, practice, or course of business which operates or would operate as a fraud or deceit upon the other person, and for broker-dealers. It is unlawful for any person, in connection with the offer, sale, or purchase of any security, directly or indirectly, 1. To employ any device, scheme, or artifice to defraud, 2. To make any untrue statement of a material fact, or to omit to state a material fact necessary in order to make the statements made, in the light of the circumstances under which they are made, not misleading, or 3. To engage in any act, practice, or course of business which operates or would operate as a fraud or deceit upon any person, and for securities. The anti-fraud provisions apply regardless of whether the security is registered, exempted, or sold in violation of the registration requirements. What these statements indicate that no securities professional and no security is exempt from the anti-fraud rules. But what if the person is excluded from the definition of, say, an investment advisor? Or what if the investment is excluded from the definition of a security? What then? The distinction between exemptions and exceptions or exclusions from definitions is important in view of the fact that an exempt security is not exempt from the anti-fraud provisions of the Uniform Securities Act. As we covered earlier in this unit, the typical life insurance policy or fixed annuity is not a security and is not covered under the anti-fraud statutes of the Uniform Securities Act. On the other hand, we know that securities issued by insurance companies are exempted from registration under the conditions of the Act. Even though these securities are exempt from registration and the filing of advertising and sales literature with the administrator, they are still subject to the anti-fraud provisions. Therefore, one could be charged with fraudulent behavior in the sale of stock in an insurance company or any other exempt security. In the next unit, we will learn about investment advisors, including those who are excluded from the definition. As an example, one of the exclusions applies to engineers whose advice is incidental to their profession. Could that engineer ever be charged with violating the anti-fraud provisions regarding investment advice? Yes, just because a person is not an investment advisor doesn't mean that fraudulent advice can be given. Using the same logic, a federal covered investment advisor, although not registered in any state, can be charged by the state administrator when there is an alleged violation of the anti-fraud provisions of the USA. Is there ever a time when the anti-fraud provisions do not apply? Yes, they do not apply to an investment that is excluded from the definition of a security. An example of this would be a rare coin dealer who falsifies the dates on coins sold to a client. That certainly is fraud, but it doesn't come under the USA's anti-fraud provisions because rare coins are not securities. Another example is the sale of a fixed annuity. It is not a security, so the anti-fraud provisions of the Uniform Securities Act do not apply. Of course, the state insurance department would have something to say about any fraudulent activity with insurance products, but if they were not securities, the USA provisions don't apply. Knowledge Check 8.5. Question 1. A registration statement for an offering to be made in a state could be filed by all the following except A. The issuer, B. An institution holding a large block of the shares, C. A broker-dealer, D. The state administrator. The correct answer is D. The administrator receives the filing but does not make it. Question 2. In general, registration statements for securities under the Uniform Securities Act are effective for A. A period determined by the administrator for each issue, B. 1 year from the effective date, C. 1 year from the date of issue, D. 1 year from the previous January 1. The correct answer is B. Securities registration statements are effective for 1 year from the effective date. The date of issue is when the actual shares are issued. That is usually a short time after the effective date.
Unit 9. Regulation of investment advisors including state-registered and federal-covered advisors. Learning objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 9A. Define investment advisor, including the impact of SEC Release ID 1092 on the definition of investment advisors and their activities. Learning Objective 9B. Identify exclusions and exemptions under the Investment Advisors Act of 1940 and the Uniform Securities Act. Learning Objective 9C. Identify the exempt reporting advisor and private fund advisor exemptions. Learning Objective 9D. Recall the effects of the Dodd-Frank Act on the investment advisor registration process. Learning Objective 9E. Identify the registration process for an investment advisor, including the use of the Form ADV. Learning Objective 9F. Recognize the financial requirements to register as an investment advisor. Learning Objective 9G. Recall the investment advisor books and record-keeping requirements under state and federal law. Learning Objective 9H. Recognize that investment advisor representatives must be adequately supervised. Your exam will include approximately 6 questions from the topics covered in Unit 9. Introduction. State securities administrators regulate persons engaged in securities transactions that occurred in their states similarly to the way they regulate the securities involved in those transactions. Investment advisors are defined by federal and state securities laws. A person that performs the functions of an investment advisor, as the term is defined in the Uniform Securities Act or the Investment Advisors Act of 1940 and more fully described in SEC Release IA 1092, is by definition an investment advisor. Investment advisors must conduct business within the regulatory framework prescribed in federal and state securities laws. Investment advisors are represented by individuals known as investment advisor representatives, IARs. This exam qualifies you for that role. There is more information about IARs in Unit 10. Lesson 9.1. Who is an investment advisor? Learning Objective 9A. Define investment advisor, including the impact of SEC Release IA 1092 on the definition of investment advisors and their activities. The definition of investment advisor, IA, is virtually identical under state law, the Uniform Securities Act, and federal law, the Investment Advisors Act of 1940. Here is how it is worded in the Uniform Securities Act. Investment advisor means any person who, for compensation, engages in the business of advising others, either directly or through publications or writings, as to the value of securities or as to the advisability of investing in purchasing or selling securities, or who, for compensation, and as a part of a regular business, issues or promulgates analyses or reports concerning securities. Definition: person. As defined in the Uniform Securities Act, person means an individual, a natural person, a corporation, a partnership, an association, a joint stock company, a trust where the interests of the beneficiaries are evidenced by a security, an unincorporated organization, a government or a political subdivision of a government. For test purposes, it is easiest to remember the 3 non-persons. They are 1. A minor, 2. A deceased individual, and 3. An individual declared mentally incompetent by the courts. Practice question. A person is basically anyone that can open an account. The test would be looking for you to choose an answer to a question such as this. Which of the following is included in the definition of a person? A. A minor. B. The National Hockey League. C. A deceased person. D. A person whom the courts have declared to be mentally incompetent. The answer is B. Ought to think of the NHL as a person, but they would be included in the USA's definition. That is why such questions are much easier if you just remember the 3 non-persons. The definition of investment advisor is sometimes referred to as the 3-prong test. That is, as long as the person involved. 1. Gives advice to others on securities. 2. Does so as part of a regular business activity. And 3. Receives compensation for performing this activity. Let's examine each of those. Giving advice to others on securities. Persons will meet the first prong of the test if they provide advice to others about specific securities, such as stocks, bonds, mutual funds, or limited partnerships, as well how to allocate assets among a group of securities. Even indirect advice can be included. Examples of this could be: why should you invest in securities as compared to non-securities investments, such as insured bank CDs or rental property? Or, the advice can be in written or oral form. That is, it can be part of a printed or online report or advice given on a phone call. The regulators, both state and federal, have stated that advice on many other types of investments is not advice about securities. Some of the specifically mentioned non-securities investments include commodities, collectibles such as coins or stamps, precious metals such as gold and silver, and real estate. Take note. The list of what is a security and what is not a security was covered in detail in Unit 8. Learning Objective 1A. Practice question. A person giving advice on which of the following investments would be deemed to be giving advice on securities? A. Gold. B. Common stock. C. Rental real estate. D. Rare stamps. The answer is B. Common stock is a security. The others are considered non-securities. In the business of providing advice. A person is in the business of providing advice, and meets the second prong defining one as an investment advisor if he gives advice on a regular basis, such that it constitutes a business activity conducted with some regularity. Although the frequency of the activity is a factor, it is not the only determinant in whether one is giving advice. Furthermore, providing advice does not have to be the person's principal activity, and advertises investment advisory services and presents himself to the public as an investment advisor or as one who provides investment advice. Compensation. A person who receives any economic benefit as a result of providing investment advice meets the third prong. Compensation includes advisory fees, commissions, or other types of fees relating to the service rendered and can be directly or indirectly paid. Example: when a person designs a comprehensive financial plan for an individual, but does not charge a fee for that design, electing to be compensated solely through commissions received on the sale of insurance policies sold as part of the plan, that is considered compensation. Even though that compensation is indirect, it meets the release's definition of compensation for investment advice. Investment counsel. One of the terms that may appear on the exam is investment counsel. Questions dealing with this topic require the student to know that there are two criteria specified in the Investment Advisors Act of 1940 that must be met in order to use the term to describe the nature of the IA's business. They are as follows. The IA's principal business must be giving investment advice. This basically excludes financial planners and others for whom investment advice is only a part of what they do. The IA must provide investment supervisory services. This one is a bit harder for most to understand, so here are some details as issued by the SEC. Continuous and regular supervisory or management services. General criteria. You provide continuous and regular supervisory or management services with respect to an account if A. You have discretionary authority over and provide ongoing supervisory or management services with respect to the account, or B. You do not have discretionary authority over the account, but you have ongoing responsibility to select or make recommendations, based upon the needs of the client, as to specific securities or other investments the account may purchase or sell, and if such recommendations are accepted by the client, you are responsible for arranging or effecting the purchase or sale. You do not provide continuous and regular supervisory or management services for an account if you A. Provide market timing recommendations, I to buy or sell, but have no ongoing management responsibilities. B. Provide only impersonal investment advice, for example, market newsletters. C. Make an initial asset allocation, without continuous and regular monitoring and reallocation, or D. Provide advice on an intermittent or periodic basis, such as upon client request, in response to a market event, or on a specific date, for example, the account is reviewed and adjusted quarterly. Practice question. Which of the following investment advisors would be permitted to use the term investment counsel? A is certified financial planner, CFP, offering a wide range of services to her clients, including tax planning, estate planning, and insurance planning, as well as investment advice. B, a professional providing a market timing service with an annual subscription fee of $495. This service attempts to maximize profits by suggesting entry and exit points for over 100 listed stocks. C, a firm whose exclusive business is placing their clients' assets into model portfolios, which are monitored on a daily basis. D, all of these. The answer is C. In order to use the term investment counsel, two criteria must be met. The principal business must be giving investment advice, and the advisor must provide investment supervisory services. Running model portfolios for clients with daily monitoring would meet both requirements. The financial planner is not principally in the business of offering investment advice, because she describes her service as offering a wide range of services, of which advice is only one part. The exam frequently uses that wording to indicate that advice is not the principal activity. While the market timing publisher's principal business activity may be offering advice, nothing about the description indicates that individual client accounts are being monitored. SEC Release IA 1092. As a result of the proliferation of persons offering investment advice in the 1980s, Congress directed the SEC to define the activities that would subject a person to the 1940 Investment Advisors Act. The SEC did so in SEC Release IA 1092 in October of 1987. SEC Release IA 1092 interprets the definition of investment advisor under the Investment Advisors Act of 1940 to include financial planners, pension consultants, and others who offer investment advice as part of their financial practices. Much of the release was a repetition of existing law, such as the three prongs. The biggest impact was the expansion of the definition. Let's look at those who are directly affected. Financial planners. Financial planners who make recommendations regarding a person's financial resources or perform analyses that concern securities are investment advisors, if such services are performed as part of a business and for compensation. Under this interpretation, the SEC holds that there is no such thing as a comprehensive financial plan that does not involve securities. Pension consultants. Consultants who advise employee benefit plans on how to fund their plans with securities are also considered investment advisors by the SEC. In addition, the SEC considers pension consultants who advise employee benefit plans on the selection, performance, and retention of investment managers to be investment advisors. Sports and entertainment representatives. Persons who provide financially related services to entertainers and athletes that include advice related to investing, tax planning, budgeting, and money management are also investment advisors. As earnings for these celebrities continue to climb, more and more of them use personal managers to handle all of their finances, and those individuals or firms are generally going to be considered investment advisors. Take note. A sports agent who secures a favorable contract for a football player and receives a commission of 10% of the player's salary is not necessarily an investment advisor. However, if the sports agent advises the football player to invest his money in specific securities, the agent is then in the business of offering investment advice and would then be subject to the Investment Advisors Act of 1940 or the Uniform Securities Act. Knowledge Check 9.1. 1. Under SEC Release ID 1092, which of the following is most likely to meet the definition of an investment advisor? A. A person who sells long-term care insurance. B. A person who advises businesses on the best locations for their stores. C. A person who assists pension plans in the selection of portfolio managers. D. A person who manages portfolios of investment-grade coins. The correct answer is C. This is the role of a pension consultant. Unless the insurance has a securities aspect, selling it would not be considered investment advice. Real estate and coins are not securities. 2. Under the Uniform Securities Act, the term person would not refer to which of the following? 8. A deceased individual. B. A subdivision of a government. C. An unincorporated amateur athletic club. D. A nonprofit, charitable corporation. The correct answer is A. There are 3 specific non-persons on this exam. They are 1. A deceased individual, 2. An individual declared mentally incompetent, and 3. A minor. A person can be almost any entity, including a corporation, a partnership, an unincorporated association, a subdivision of a government, a trust that issues shares of ownership, such as a unit investment trust, or a natural person, an individual. Lesson 9.2. Who is not an investment advisor? Learning Objective 9b. Identify exclusions and exemptions under the Investment Advisors Act of 1940 and the Uniform Securities Act. Because terminology is critical to jurisdiction, it is important to know the difference between excluded from a definition and exempt from a provision. Exclusion means excluded from or not included in a definition. For example, if a person is excluded from the definition of an investment advisor, that person is not subject to provisions of state or federal law that refer to investment advisors. There are a number of exclusions from the investment advisor definition available to persons who might well satisfy all 3 prongs of the definition, but because of the provisions of the law, are specifically not defined as investment advisors. An excluded person is not subject to any provisions of the Investment Advisors Act or the Uniform Securities Act, other than anti-fraud statutes. Exemption means not being subject to the registration provisions of the acts even though that person meets the definition. For example, a person defined as an investment advisor can be exempt from state registration requirements as an investment advisor because that person enjoys an exemption from state registration under the Uniform Securities Act. An example we'll cover shortly is the case of an investment advisor with no place of business in the state whose only clients in the state are institutions. Definition: Federal Covered Investment Advisor. The National Securities Markets Improvements Act of 1996, discussed in Learning Objective 9D, created the term Federal Covered Investment Advisor. These are investment advisors who are solely under federal jurisdiction and are specifically excluded from the definition of investment advisor in the Uniform Securities Act. Because they are not defined as investment advisors under state law, they do not register on the state level. A significant portion of the law and the exam deals with those who either are excluded from the definition or are investment advisors, but exempt from registering as such. Let's begin with those who are excluded from the definition. Exclusions. Although the definition of an investment advisor is broad, certain exclusions apply. Under state law, the Uniform Securities Act, there are 7 primary exclusions from the definition of an investment advisor. 1. Any bank and bank holding company, savings institution, or trust company is excluded. This exclusion is generally limited to U.S. banks and bank holding companies. The exclusion is unavailable to credit unions and investment advisor subsidiaries of banks or bank holding companies. Definition: bank holding company. A holding company is organized to invest in and manage other corporations. Control can occur through the ownership of 50% or more of the voting rights or through the exercise of a dominant influence. It is sometimes referred to as the parent organization. A bank holding company is a holding company whose primary asset is a commercial bank. Most of the large U.S. banks today are owned by holding companies. 2. Any lawyer, accountant, teacher, or engineer whose advice is solely incidental to the practice of their profession is excluded. This exclusion is not available to any of these who have established a separate advisory business. Also, the exclusion would not be available to any of these who hold themselves out as offering investment advice. We like to refer to this as the late exclusion. Example: when referring to the late exclusion, it is important to understand the meaning of incidental. A lawyer advising clients to carefully invest a settlement from a legal case is not giving investment advice unless charging a separate fee for helping set up the portfolio. An accountant is not giving investment advice when suggesting to a wealthy client that investing in tax-exempt municipal bonds might be a wise idea unless charging a separate fee to help select the bonds. 3. Any broker-dealer whose performance of such services is solely incidental to the conduct of its business as a broker-dealer and who receives no special compensation, such as when offering wrap fee programs, is excluded. The exclusion also applies to registered representatives, agents of broker-dealers. Definition: wrap fee program. Any advisory program under which a specified fee or fees not based directly upon transactions in a client's account is charged for investment advisory services, which may include portfolio management or advice concerning the selection of other investment advisors and the execution of client transactions. The exclusion from the definition of investment advisor available under both state and federal law to broker-dealers is not in effect for those offering wrap fee programs. The exam may ask about these programs this way: which 2 of the following are services provided in a wrap fee program? The correct choice would be investment advisory and brokerage execution, transactions for a single wrapped fee. Don't choose financial planning and recommendations. Take note: special compensation for investment advice is compensation to the broker-dealer or salesperson in excess of that which they would be paid for providing a brokerage or dealer service alone. Consequently, special compensation exists where there is a clearly definable charge for investment advice. 4. Publishers may qualify for an exclusion from the definition, but they must meet certain criteria. Excluded from the definition of investment advisor would be a publisher of any bona fide newspaper, news magazine, or business or financial publication of general and regular circulation. 2. To qualify for this exclusion, the publication must be 1. Of a general and impersonal nature, in that the advice provided is not adapted to any specific portfolio or any client's particular needs. 2. Bona fide or genuine, in that it contains disinterested commentary and analysis as opposed to promotional material. And 3. Of general and regular circulation, in that it is not timed to specific market activity or events affecting or having the ability to affect the securities industry. For example, newspapers of general circulation would be eligible for the exclusion. Test topic alert. An investment newsletter is being published for a subscription fee. Rather than being published on a regular basis, weekly, monthly, quarterly, and so forth, issues are released in response to market events. How do the laws view this publisher? If the publication is issued from time to time in response to episodic market events, the exclusion is lost. 5. Certain individuals who are employed by investment advisors, investment advisor representatives, described in detail in Unit 10, Learning Objective 10A. 6. Any person who is a federal covered advisor is excluded from the definition. 7. Any other person the administrator specifies is excluded. The exclusions under federal law, the Investment Advisors Act of 1940, are almost the same, except for the final three above. Instead, the Federal Act excludes any person whose advice, analyses, or reports are related only to securities that are direct obligations of or obligations guaranteed by the United States or by certain U.S. government-sponsored corporations designated by the Secretary of the Treasury, for example. Fannie Mae, Ginnie Mae is excluded. Take note. For purposes of the exclusion, under both state and federal law, the term bank does not include a savings and loan association or a foreign bank, but it does include a savings institution. Because understanding these exclusions is so important, let's look at an example. Practice question. The Uniform Securities Act excludes certain persons from the definition of an investment advisor if their performance of advisory services is solely incidental to their professions. This exclusion would apply to all of the following except A. An accountant, B. An economist, C. An electrical engineer, D. A college professor teaching a course on economics. The answer is B. As long as the activity is incidental to the professional practice and no separate fee for the advice is charged, the Act specifically excludes accountants, lawyers, any professional engineer, aeronautical, civil, mechanical, or other, and teachers. Economists are not included in this listing. Most economists are not teachers. Exemptions. When it comes to exemptions, state and federal laws have established rules whereby a person, although meeting the definition of an investment advisor, is not required to register as such. That person is considered to be exempt from registration. Because the state and federal exemptions are not as similar as the exclusions, let's take them separately, starting with the exemptions available under the Investment Advisors Act of 1940 federal law. Federal law exemptions. The Investment Advisors Act of 1940 exempts the following persons who, even though defined as investment advisors, are exempt from the registration requirements of the Act. Intrastate advisors, only within one state. Investment advisors, other than an investment advisor who acts as an investment advisor to any private fund, defined at Learning Objective 3D, and again in Learning Objective 9C, whose clients are residents of the state in which the advisor has its principal office and only place of business, and who do not give advice dealing with securities listed on any national exchange, for example, New York Stock Exchange, are exempt. For example, an advisor would be exempted under this provision if all of its clients were Georgia residents, its only places of business were in Georgia, and it did not give advice on securities listed on any national exchange. Advisors to insurance companies. Advisors whose only clients are insurance companies are exempt. Test topic alert. Please be careful on this one. The exam frequently asks if the exemption applies when the only clients are banks. As we'll learn shortly, that exemption applies under state law, but not under federal law. State law exemptions. In the same manner as the federal law, the Uniform Securities Act exempts from registration certain persons who, although they fall within the definition of an investment advisor, do not have to register as such in the state. Investment advisors exempt from registration with the state administrator are those who have no place of business in the state but are registered in another state, provided their only clients in the state are broker-dealers registered under the Act, other investment advisors, institutional investors, existing clients who are not residents but are temporarily in the state, limited to 5 or fewer clients, other than those listed above, resident in the state during the preceding 12 months, called the de minimis exemption, or any others the administrator exempts by rule or order. Definition: institution. The term institution would include banks, trust companies, savings and loan associations, insurance companies, investment companies, for example, mutual funds, employee benefit plans with assets of not less than $1 million, $1 million, and defined previously. The Act generally affords less protection to institutional investors owing to their supposed greater investment sophistication. Definition: retail client. As you can tell by now, terminology is very important on this exam. A few questions use the term retail client instead of non-institutional client. Look for it and remember that retail clients need far more protection than institutional ones. If the question refers to an individual, including a trust or an estate, that will always be a retail client. Take note. This exemption applies to investment advisors who are registered in at least one state, but have clients in another state where the investment advisor, IA, does not maintain a place of business. Test topic alert. One of the bullet points above grants an exemption to those investment advisors who have no place of business in the state but are licensed in a state where they have a place of business and offer and sell securities in the state only with persons in the state who are existing customers and who are not residents of the state but are just there temporarily. This is sometimes referred to as the snowbird exemption because it is frequently used to deal with existing clients who winter in warmer climates. There is no time limit to define temporary. Some people spend 3 to 4 months staying warm. But if the client should change legal residence to that state, the investment advisor has 30 days to register in that state or discontinue doing business with that client, unless qualifying for the de minimis exemption. It is similar to the common experience of moving from one state to another. When you do that, you generally have 30 days to get new license tags for your car and a new driver's license. Test topic alert. Because these exemptions all apply when the investment advisor does not have a place of business in the state, it is relevant to understand that an investment advisor or one of its representatives who advertises to the public, in any way, the availability of meeting with prospective clients in a hotel, country club, seminar, or any other location in the state is considered to have a place of business in the state. However, an investment advisor or one of its representatives who contacts existing clients who happen to be in the state and notifies them that he will be passing through the state and will be available to meet with them in his hotel room, is not considered to have a place of business in the state because the announcement is being made only to existing clients and not to the public. Example: an investment advisor registered in State A, with no business locations in any other state, has, over the preceding 12 months, directed investment advice to 5 individual investors residing in State B. Is the investment advisor required to register in State B? The answer is no. Registration is not required because the investment advisor does not have a place of business in State B and directs business to 5 or fewer individual residents of the state during the previous 12 months. If the firm had a place of business in State B, registration would be required in that state, even if it had only one client. Also, registration would be required if business had been transacted with 6 or more individual residents, retail clients, of State B during the previous 12 months. What if the IA gave investment advice to 6 banks, 6 insurance companies, and 6 other investment advisors instead of the individuals? Again, the answer would be no registration. As long as the investment advisor has no place of business in the state and limits its clientele to institutions, broker-dealers, large employee benefit plans, or other investment advisors, it qualifies for this exemption. Learning Objective 9C. Identify the exempt reporting advisor and private fund advisor exemptions. We just listed a number of exemptions under federal and state law. Here is another one that applies to both, with only a slight difference between them. Private fund advisors. We introduced you to private funds in Unit 3 of this course. Here we'll go into a bit more of the legal details. Title IV of the Dodd-Frank Act of 2010, known as the Private Fund Investment Advisors Registration Act of 2010, contains a comprehensive overhaul of the registration process for investment advisors. The bill provided for the following new exemptions from registration under the Advisors Act. An exemption for advisors solely to private funds. This exemption applies as long as that investment advisor's total assets under management AUM in the United States, without regard to the number or type of private funds, is less than $150 million, the private fund advisor exemption. An exemption for certain non-U.S. advisors with no place of business in the United States and minimal assets under management, less than $25 million, attributable to U.S. clients and investors, the foreign private advisor exemption. An exemption for advisors solely to venture capital funds, the venture capital fund exception. Test topic alert. Recall that at Learning Objective 3, we mentioned that hedge fund managers generally register with the SEC even though the funds do not. Definition of a private fund. As previously covered in Unit 3, Section 402 of the Dodd-Frank Act defines a private fund as an issuer that would be an investment company, as defined in Section 3 of the Investment Company Act of 1940, but for Section 3C.1 or 3C.7 of that Act. In more straightforward terms, a 3C.1 issuer is one whose outstanding securities are beneficially owned by not more than 100 persons, and which is not making and does not presently propose to make a public offering of its securities. With no more than 100 shareholders and no public offering, the term private fund seems quite logical. For this exemption, the only status requirement for shareholders is that they are accredited investors. A 3C7 issuer is one whose outstanding securities are owned exclusively by persons who, at the time of acquisition of such securities, are qualified purchasers, at least $5 million in investments for individuals and generally $25 million in investments for business entities, and who is not making, and does not at that time propose to make, a public offering of such securities. In this case, the lack of a public offering is logically private, and the fact that the invested wealth requirement limits the potential universe of investors is a factor as well. Unlike the 3C1 issuer, there is no statutory limit to the number of investors. The point is, regardless of how it's defined, if one is an advisor solely to private funds, it is possible to qualify for an exemption from registration with the SEC. As described previously, there is an exemption from registration for certain private funds and venture capital funds. However, even though exempt from registration, if designated as an exempt reporting advisor (ERA), they are required to complete and electronically file reports using the IARD system on certain items set forth in Form ADV, which will be made publicly available on the SEC's website. Take note. There is a special reporting form for certain private fund advisors. This is an easy one to remember because it is Form PF, Private Fund, which advisors are required to file Form PF. Any person registered with the SEC as an investment advisor who manages one or more private funds and had at least $150 million in private fund assets under management as of the last day of its most recently completed fiscal year is required to file Form PF. Well, what about state law? Their model rule closely parallels the federal exemption, with two differences. Private fund advisor exemption under state law. NASA's model rule for the registration exemption for investment advisors to private funds is almost identical to the federal exemption described previously. Here are the two differences that might be testable. If qualifying for the exemption as a 3C1 issuer, no more than 100 investors, NASA's model rule requires that all investors be qualified clients. A qualified client is a person that has at least $1.1 million in assets under management with the investment advisor immediately after entering into the advisory contract, AUM test, or has a net worth, in the case of a natural person client, together with assets held jointly with a spouse, that the investment advisor reasonably believes is in excess of $2.2 million immediately prior to entering into the advisory contract net worth test. As a reminder, the value of a natural person's primary residence must not be included in net worth. Remember, value of primary residence means the fair market value of a person's primary residence, minus the amount of debt secured by the property up to its fair market value, net equity. Note that qualified for NASA is significantly less than qualified under federal law. Neither the private fund advisor nor any of its advisory affiliates are subject to the bad actor provisions. Those provisions disqualify anyone who has certain criminal convictions, generally felonies, certain SEC disciplinary orders or suspension or expulsion from membership in a self-regulatory organization, such as FINRA. Exemption for foreign private advisors. A foreign private advisor is defined in the Dodd-Frank Act as any investment advisor that has no place of business in the United States, has in total fewer than 15 clients and investors in the United States in private funds advised by the advisor, has aggregate assets under management attributable to clients in the United States and investors in the United States in private funds advised by the advisor of less than $25 million, and does not hold itself out to the public in the United States as an investment advisor or act as an investment advisor to an investment company registered under the Investment Company Act of 1940. Exemption for investment advisors to venture capital funds. The rules define a venture capital fund as a private fund that has limited leverage, does not, except in certain limited circumstances, offer its investors redemption rights or other similar liquidity rights, represents itself as a venture capital fund to investors, and is not registered under the Investment Company Act of 1940. What really are venture capital funds? What is venture capital? You are probably familiar with the term startup company. At one point in time, well-known firms like Google, Facebook, and Netflix were young and in need of additional capital to expand and grow. Venture capitalists are investors who are willing to take a chance on a new venture, recognizing that there is the high potential for loss, as well as potential for gain that can, in some cases, be very high. A venture capital fund is a pooled investment, where venture capitalists invest their money and pay an advisor to select opportunities meeting their objectives. If the conditions listed above are met, that investment advisor is exempt from registration under federal and state law. Here is a helpful summary chart. Maximum assets under management. Private fund advisor, $150 million. Venture capital fund advisor, unlimited. Permitted clients. Private fund advisor, private funds only. Venture capital fund advisor, private funds only. Permitted investment strategies, private fund advisor, any. Venture capital fund advisor, venture capital only. Required to register with the SEC. Private fund advisor, no. Venture capital fund advisor, no. Please note that these exemptions are granted on the basis of whom you advise, not on what types of securities are the subject of your advice. Note also that exclusion means exclusion from a definition, whereas exemption means not subject to registration. All of the cases mentioned here involve investment advisors. It's just that they qualify for an exemption from registration under federal law. Practice question. Who of the following would not seek an exemption from registration under the Investment Advisors Act of 1940? A. A person whose only advisory clients are insurance companies. B. A person whose only offices are in a single state, whose only clients are residents of that state, and who does not render advice on securities traded on a national exchange. C. A person who only gives advice to venture capital funds. D. An accountant whose advice is incidental to her accounting business, and for which no separate fee is charged. The answer is D. This is tricky, as is the exam. The accountant is excluded from the definition. Therefore, there is no reason for her to look for an exemption. Anyone who is excluded is automatically exempt from registration. The other three choices meet the definition of investment advisors and qualify for one of the exemptions described above. Knowledge check 9.2. Question 1. A state-registered investment advisor would not qualify for the de minimis exemption if, over a 12-month period, it had A. 5 retail clients, B. 5 or fewer retail clients, C. Fewer than 6 retail clients, D. 6 or fewer retail clients. The correct answer is D, because the maximum is 5 retail clients in a 12-month period. The choice with 6 clients or fewer is over the limit. Notice that fewer than 6 and 5 or fewer mean the same thing. Question 2. Section 402 of the Dodd-Frank Act defines a private fund as an issuer that would be an investment company, as defined in Section 3 of the Investment Company Act of 1940, but for Section 3C.1 or 3C.7 of that Act. Section 3C.1 places a limit on beneficial ownership of shares to not more than A. 10 persons, B. 35 persons, C. 100 persons, D. 500 persons. The correct answer is C. Section 3C.1 limits the number of investors to a maximum of 100. Section 3C.7 does not have a numerical limit on investors, but it does have more stringent financial requirements. Lesson 9.3. Registering as an investment advisor. Learning Objective 9D. Recall the effects of the Dodd-Frank Act on the investment advisor registration process. Registration requirements for investment advisors. At this point, we know who is an investment advisor, who is excluded from the definition, and who, although defined as an investment advisor, is exempt from registration. If the person is not excluded and not exempt, then registration is required. In 1996, a major change to the registration requirements took place with the passage of the National Securities Markets Improvement Act, NSMIO. Up until that time, investment advisors registered with both the federal agency, the SEC, and the appropriate states. However, the NSMIO bifurcated, split in two. Those requirements by declaring that investment advisors would register with the SEC or the states, but not both. They did this by creating a new definition, Federal Covered Investment Advisor, which is sometimes just referred to as a covered advisor on the exam. Federal Covered Investment Advisor. What makes someone a Federal Covered Investment Advisor? In most cases, they are larger firms and are registered with the SEC. Here are the 3 most tested categories. Those registered with the SEC because they are eligible: $100 million in assets under management, or required to register with the SEC because they meet the minimum threshold of assets under management, currently $110 million. Those under contract to manage an investment company registered under the Investment Company Act of 1940, for example, a mutual fund, regardless of the amount of assets under management. Those not registered with the SEC because they are excluded from the definition of an investment advisor by the Investment Advisors Act of 1940. The most tested example of this case is the investment advisor whose advice is limited solely to securities issued by the U.S. government or one of its agencies. Take note. Because so much of this exam deals with interpreting the laws, it is sometimes necessary to review some legal concepts with you. For example, if a person is excluded from the definition of investment advisor under the Investment Advisors Act of 1940, the states, under the NISMU, cannot define such person as an investment advisor because federal law excludes that person from the definition. In other words, if the separate states could define those persons who were excluded from the federal definition as investment advisors, the federal law would have no meaning. Take note. In 2012, the SEC came out with a new metric, regulatory assets under management, or AUM. Is this simply a new name for AUM? No, it is a somewhat different measurement and can be more or less than the investment advisor's AUM. Although that is the number determining SEC eligibility, we have never heard of RAUM appearing on the exam. We use AUM in our text and QBank questions, and will continue to do so unless students tell us that NASA has decided to use RAUM. Dodd-Frank and assets under management. As stated previously, the NISMU eliminated state registration requirements for federal covered advisors, largely based upon assets under management, AUM. Dodd-Frank has created 3 thresholds, one for the large advisor, one for the mid-size advisor, and, logically, one for the small advisor. Let's examine each of these, their requirements and their exceptions, if any. Large investment advisors. Large advisors, those advisors with at least $100 million or more in assets under management, are eligible for SEC registration. Once AUM reaches $110 million, registration with the SEC is mandatory. Unless covered by one of the exemptions mentioned previously, all large IAs must register with the SEC. State registration is not required because the federal law preempts state registration. Small investment advisors. This category includes advisors with assets under management of less than $25 million. Unless the investment advisor is an advisor to an investment company registered under the Investment Company Act of 1940, registration with the SEC is prohibited, and unless exempted under state rules, registration with the state is required. However, if the advisor were required to register in 15 or more states, the prohibition would be lifted and registration with the SEC would be permitted instead. Mid-size advisors. This category includes those with AUM of at least $25 million, but not $100 million. Generally, these advisors are prohibited from SEC registration and must register with the state. However, there are more extensive exceptions than exist with the small advisors. Just as with any other category, those who are advisors to investment companies registered under the Investment Company Act of 1940 register with the SEC. That is true regardless of their size. There are several other ways for a mid-size firm to qualify for SEC registration. A mid-size advisor is not prohibited from registering with the SEC. If the advisor is not required to be registered as an investment advisor with the Securities Administrator of the state in which it maintains its principal office and place of business. If registered, the advisor would not be subject to examination as an investment advisor by that Securities Administrator. If the advisor is required to register in 15 or more states, or the advisor elects to take advantage of the buffer described following. Take note. The law, and often the exam, phrases things in a negative context. As stated above, we have listed 4 cases where a mid-size investment advisor is not prohibited from registration with the SEC. Put into simple language, that means they are eligible to register with the SEC if they desire, but not required to do so. Other exceptions under Dodd-Frank. The SEC is permitted to grant exceptions to advisors from the prohibition on commission registration, including small and mid-size advisors, if the application of the prohibition from registration would be unfair, a burden on interstate commerce, or otherwise inconsistent with the purposes of the Act. Under this authority, they have adopted several exemptions from the prohibition on registration, including pension consultants providing advisory services to employee benefit plans having at least $200 million of assets who may register with the SEC, even though the consultant does not itself have those assets under management. The SEC picked that number to ensure that, in order to register with the SEC if desired, the consultant's activities are significant enough to have an effect on national markets. Those mid-size advisors with at least $100 million, but less than $110 million in AUM, who elect to register with the SEC rather than the states. This buffer will be described below. Investment advisors expecting to be eligible for SEC registration within 120 days of filing the application for registration on Form ADV, and the $10 million and $20 million buffers. The numbers work like this. A state-registered advisor, once it has assets under management of at least $100 million, subject to certain exceptions previously mentioned. Everyone needs at least $100 million to initiate registration with the SEC, may choose to remain state-registered or may register with the SEC. Once AUM reach $110 million, registration with the SEC is mandatory. They can no longer stay state-registered. That is the $10 million buffer. The SEC recognized that market conditions, or obtaining or losing clients, can cause AUM to fluctuate, so they established a $20 million buffer to keep advisors from having to switch back and forth. Once registered with the SEC, an investment advisor need not withdraw its SEC registration unless it has less than $90 million in assets under management. Having become SEC registered, the IA can remain so as long as AUM remains at or above the $90 million level. Likewise, those investment advisors registered at the state level can choose to remain there until they reach the $110 million level. This buffer is designed to avoid the expense and hassle involved in potentially annual changes to where the investment advisor is registered. Time for measuring AUM. These numbers are based on the AUM reported on the IA's annual updating amendment. The effect of this is that a federal covered advisor's AUM could drop below $90 million during the year without triggering the need to change to state registration, just as long as the annual update showed at least the minimum $90 million required. Of course, the same would be true of a state-registered IA, whose AUM peaked above $110 million during the year, but then fell at the time of the update. If, at the time of filing the annual updating amendment to the Form ADV by an SEC-registered IA, the reported AUM is less than $90 million, it is necessary for the investment advisor to withdraw its SEC registration and register with the appropriate states within 180 days. On the other hand, if a state-registered advisor's reported AUM exceeds $110 million, registration with the SEC must take place within 90 days. Take note. The buffer works because the measurement is made only once per year at the time of the filing of the firm's annual updating amendment. Remember these three relevant times. 1. When a state-registered IA reports AUM at $110 million or more on the annual updating amendment, the IA must withdraw from the states and register with the SEC within 90 days. 2. When a new investment advisor files for registration, if that IA believes that it will have at least $100 million in AUM within the first 120 days, it is eligible to register with the SEC, even if their AUM is way below that on day one. This is very common when a large BD decides to open an IA and knows that they'll have billions of dollars in a short time. 3. When an SEC-registered IA reports less than $90 million in AUM on the annual updating amendment, the IA must withdraw its registration with the SEC and register in the appropriate states within 180 days. Why is the time allowed in number 3 twice as long as in number 1? Because it takes much less time to register with one agency, the SEC, than to register potentially with a number of states. Take note. As a general rule, the SEC or federal rules involve bigger numbers than the state rules, that is, large investment advisors must register with the SEC, whereas small investment advisor managing $110 million or more is large and requires SEC registration. $100 million but not $110 million requires SEC or state registration. $25 but not $100 million is mid-size and requires state registration. Less than $25 million is a small advisor and requires state registration. Test topic alert. An investment advisor registered under state law whose assets reach $110 million under management, has 90 days to register with the SEC. A federal covered investment advisor whose assets under management fall below $90 million no longer qualifies for SEC registration and has 180 days to register with the states. Learning Objective 9E: Identify the registration process for an investment advisor, including the use of the Form ADV. How does registration take place? With only a few differences, the procedures for registering as an investment advisor are the same, whether registering with the SEC or with the states. Those differences will be pointed out as we go along. Investment advisor registration process. To register with the state securities administrator, a person must submit an application, provide a consent to service a process, pay filing fees, post a bond if required by the administrator, and take and pass an examination if required by the administrator. The examination may be written, oral, or both. Registration is accomplished using Form ADV. Form ADV consists of Part 1A and Part 1B, and Part 2A and Part 2B. Investment advisors use Form ADV to register with the Securities and Exchange Commission, register with one or more state securities authorities, or amend those registrations. Filing in almost all cases is done through the IRD. The Investment Advisor Registration Depository, IRD, is an electronic filing system that facilitates investment advisor registration, regulatory review, and the public disclosure information of investment advisor firms. Form ADV. Form ADV contains 4 parts. Part 1 asks a number of questions about the investment advisor, its business practices, the persons who own and control the firm, and if the firm is involved in any other activities, such as being a broker-dealer. All advisors registering with the SEC or any of the state securities authorities must complete Part 1A. Part 1A also contains several supplemental schedules. These include Schedule A, which asks for information about the direct owners and executive officers, control persons, and disclosure reporting pages, or DRPs, which are schedules that ask for details about disciplinary events involving the advisor or advisory affiliates. Part 1B asks additional questions required by state securities authorities. Investment advisors applying for registration with or who are already registered with the SEC do not have to complete Part 1B. Part 2A requires advisors to create narrative brochures containing information about the advisory firm. The requirements in Part 2A apply to all investment advisors registered with or applying for registration with the SEC or the states. Part 2B requires advisors to create brochure supplements containing information about certain supervised persons. The requirements in Part 2B apply to all investment advisors registered with or applying for registration with the SEC or the states. It may help you remember that the A in Part 2A tells us that that part is for the advisor and the B in Part 2 is about the bodies, the people who work there. We will cover the brochures and brochure supplements in greater detail later in Unit 13. Test Topic Alert. Control means the power, directly or indirectly, to direct the management or policies of an investment advisor, whether through ownership of securities, by contract or otherwise. Under the Investment Advisors Act of 1940, as well as NASA's Model Rule, each of the firm's officers, partners, or directors exercising executive responsibility, or persons having similar status or functions, is presumed to control the firm. A person is presumed to control an IA organized as a corporation if the person directly or indirectly has the right to vote 25% or more of a class of the corporation's voting securities. A person is presumed to control one that is a partnership if the person has the right to receive upon dissolution, or has contributed 25% or more of the capital of the partnership. Please note that this is a different percentage from the definition of control person under the Securities Exchange Act of 1934, where having more than 10% of the voting power makes one a control person. Remember that a control person is defined 3 different ways. The Exchange Act requires more than 10%, the Investment Company Act, Unit 3, requires more than 25%, and the Advisors Act and the USA require 25%, or the application for registration as an investment advisor is on Form ADV. Part 1 contains information about the IA, including location of principal office, location of books and records, if not at the principal office, form of business organization, sole proprietorship, partnership, corporation, LLC, etc., method of business. Other business activities, broker-dealer, registered representative agent of a BD, maintaining custody of customer assets or exercising discretion. Details relating to all control persons, officers, directors, partners, etc. Disciplinary history, and, for state-registered IAs, states in which the IA intends to register or is already registered. Take note. Should any of the above information change, prompt notification must be given to the appropriate regulator. Part 1B asks additional questions required by state securities authorities. Federal covered advisors do not complete Part 1B. Part 2A is known as the Investment Advisor's Brochure and tends to focus on customer-related information, such as compensation arrangements, fees, commissions, hourly charge, types of clients, individuals, institutions, pension plans, type of investments, equities, corporate debt, municipal securities, U.S. Treasuries, investment companies, types of strategies employed, buy and hold, value growth, methods of analysis used, technical, fundamental, educational and business background of those who render advice, and an audited balance sheet if a federal covered or state-registered advisor requires or solicits substantial prepayment of fees, defined shortly, or if a state-registered advisor maintains custody, discussed in Unit 14. The brochure is arranged in a narrative form using plain English. Part 2B requires advisors to create brochure supplements containing information about certain supervised persons. Together, Part 2A and Part 2B are delivered to the client as described later in this unit. State-registered advisors file both Part 1 and Part 2 with the administrator of each state in which they are registering. Practice question. If a prospective client wanted to know what type of investment strategies are employed by an investment advisor, the information would be found in the advisor's A. Form ADV Part 1A, B. Form ADV Part 1B, C. Form ADV Part 2A, D. Form ADV Part 2B. The answer is C. Form ADV Part 2A contains information of most use to clients, such as the type of strategies employed by the advisor. Part 1A contains information needed by the regulators. Part 1B is only for state-registered IAs. Part 2B contains information dealing with those individuals in the firm who manage accounts. Test topic alert. Although there are no minimum educational or experience requirements, there is a specific area on Form ADV Part 2B where state-registered advisors must identify each of the principal executive officers and management persons and describe their formal education and business background. If this information has been supplied elsewhere in Form ADV, it is not necessary to repeat it in response to this question. Updating Form ADV. Formal renewal of the investment advisor's registration is through the filing of the Annual Updating Amendment. Form ADV must be updated each year by filing an Annual Updating Amendment within 90 days after the end of the advisor's fiscal year. This Annual Updating Amendment is used to update the responses to all items on the ADV. Of critical importance is the verification of assets under management AUM, ensuring that the advisor is eligible to continue being registered with the SEC. One of the requirements relating to the brochure described in Part 2 is that submission must be made of a summary of material changes either in the brochure, cover page or the page immediately thereafter, or as an exhibit to the brochure. Amendments for material changes. In addition to the Annual Updating Amendment, the IA must amend Form ADV by filing additional amendments if information relating to any of the following changes or becomes inaccurate in any way. Change of the registrant's name. Change in the principal business location. Change in the location of books and records, if they are kept somewhere other than at the principal location. Change to the contact person preparing the form. Change in organizational structure, such as from partnership to corporation. Inaccuracy of information provided in the brochure. Change to any of the questions regarding disciplinary actions. Change in policy regarding custody of the customer funds and or securities. Fees. In addition to the initial registration, there is a requirement for annual renewal. There are fees for the initial filing and renewals. If an investment advisor changes its form of business organization, for example, from a sole proprietorship to a corporation, a new ADV but no fees would be required. Test topic alert. Under both federal and state law, a successor firm registers by filing a new application, ADV Parts 1 and 2, and in the case of the SEC, paying the appropriate fee or under the USA, without paying an additional fee. Please note the difference: one case involves a fee while the other does not. Notice filing. While on the topic of fees, it is important to recognize what happened to state revenues after the passage of the NISMEO. Prior to that time, investment advisors registered on both levels, and that meant, in many cases, registering with 20, 30, or more states, with each state collecting a nice fee. When state lobbyists realized that the NISMEO, by excluding federal covered advisors from the definition, meant that those advisors would no longer have to register, they implored Congress to put some condition into the act that would help recover some of that lost revenue. That is how notice filing came about. Instead of registering with the states, covered advisors pay state filing fees and give notice to the administrator. The procedure followed is called notice filing. As part of the notice filing, the administrator can require a federal covered advisor to file a copy of whatever has been filed with the SEC and, of course, pay a filing fee. If a federal covered advisor only deals with institutions, other IAs, other BDs, and so forth, notice filing is not required. This is a similar concept to the USA not requiring registration of state-registered advisors who have no place of business in the state and deal with this same group of clients. We have not heard of this ever being asked on the exam, but you never know what NASA has up their sleeve. Provide a consent to service a process. New applicants for registration must provide the administrator of every state in which they intend to register with a consent to service a process. The consent to service a process appoints the administrator as the applicant's attorney to receive and process non-criminal securities-related complaints against the applicant. Under the consent to service a process, all legal documents, for example, subpoenas or warrants, received by the administrator have the same legal effect as if they had been served personally on the applicant. Take note. The consent to service a process is submitted with the initial application and remains in force permanently. It does not need to be supplied with each renewal of a registration. Effective date of registration and renewals. Assuming there are no irregularities in the application, registration with the SEC takes effect on the 45th day after filing of a complete application, and as with all securities professionals, at noon of the 30th day in the case of state-registered investment advisors. Test topic alert. One of the most common questions asked on the exam is the renewal date for the state registration of investment advisors and the other securities professionals' investment advisor representatives, broker-dealers, and agents. That renewal date is December 31. One of the tricks the exam likes to play is asking about a person who registers in November. When does that registration come up for renewal? Well, even if it is only a month or so later, every registration of a securities professional comes up for renewal on the next December 31, so your first year is always a short one. Test topic alert. Although withdrawal of registration normally takes 30 days, the administrator has the power to shorten that period, in effect permitting a rush order. Test topic alert. Although successful completion of the Series 65 examination may satisfy a portion of the requirements of a particular state, it does not convey the right to transact business prior to being granted a license or registration by that state. Test topic alert. While registration as an IAR is pending, the individual may not take part in any activity that would require registration. Clerical work, filing customer records, or assisting internally with research would be permitted. Just as the exam may ask about registering, it may ask about leaving the business. Form ADVW. If an advisor no longer desires to engage in the business, application to withdraw registration is accomplished by filing Form ADVW. Form ADVW must be filed in order to withdraw the registration voluntarily. Should there be any legal proceedings in progress, the withdrawal will be held up until resolution of the issue. Otherwise, each Form ADVW filed by an SEC-registered advisor is effective upon acceptance by the IRD. However, the investment advisor's registration will continue for a period of 60 days after acceptance solely for the purpose of commencing a proceeding against the firm. In the case of a state-registered advisor, withdrawal is effective 30 days after filing, but the administrator retains jurisdiction over the former registrant for a period of 1 year. In Unit 12, we'll discuss the conditions under which a registration may be canceled by the administrator. Exempt reporting advisors, ERAs. As described previously, there is an exemption from registration for certain private funds and venture capital funds. However, even though exempt from registration, if designated as exempt reporting advisors, ERAs, They are required to complete and electronically file reports using the Investment Advisor Registration Depository (IARD) system on certain amended items set forth in Form ADV Part 1, which will be made publicly available on the SEC's website. Test Topic Alert. Exempt Reporting Advisors (ERAs) file Form ADV Part 1. They don't answer all of the questions, but do not have to prepare a Form ADV Part 2. Knowledge Check 9.3. Question 1. In the absence of any other possible exemption, registration with the SEC would be prohibited for which of the following investment advisors? A. A pension consultant managing $150 million. B. The investment advisor under contract to an open-end investment company with $18 million in assets. C. An investment advisor whose assets under management are $103 million. D. An investment advisor who would be required to register in 17 states. The correct answer is A. Dodd-Frank removed the prohibition against registering with the SEC for those who would otherwise be required to register in 15 or more states. It does the same for pension consultants advising more than $200 million, not $150 million. With AUM between $100 million and just under $110 million, an IA can choose to register with the SEC or the states. Any investment advisor under contract to an investment company registered under the Investment Company Act of 1940 is considered a federal covered IA and must register with the SEC. Question 2. In which of the following cases is it necessary to submit a new Form ADV rather than an amended one? A. A successor firm. B. A change to the location of the firm's principal office. C. A change in the structure of the firm from a partnership to a corporation. D. The firm changes its fee structure. The correct answer is A. In almost every instance, changes require the filing of an amended ADV. When the change is material, the filing is done promptly. In other cases, it is done within 90 days of the end of the advisor's fiscal year. When there is a successor firm, it is treated as a new entity requiring a new Form ADV Part 1 and Part 2. Lesson 9.4. Financial and Record-Keeping Requirements for Investment Advisors. Learning Objective 9F. Recognize the financial requirements to register as an investment advisor. Under the Investment Advisors Act of 1940, there are no specific financial requirements, such as a minimum net worth. However, as we will see, there are financial disclosures that must be made to clients under certain conditions. Investment advisor financial requirements. Under the Uniform Securities Act, the administrator may, by rule or order, establish minimum financial requirements for an investment advisor registered in the state. We will begin with some requirements that apply to both federal covered and state-registered investment advisors. Substantial prepayment of fees. Both state and federal law offer extra protection to those clients of investment advisors who have made substantial advance payment of fees for services to be rendered in the future. The term used is substantial prepayment of fees. In the case of a federal covered advisor, it is considered substantial that the IA collects prepayments of $1,200 per client, 6 months or more in advance. Under the USA, it is more than $500, and again 6 months or more in advance. Test Topic Alert. Under the USA, when an investment advisor accepts prepayments of fees of more than $500 for a contract period of 6 months or more, it is known as a substantial prepayment. However, under the Investment Advisors Act of 1940, it does not become a substantial prepayment until it exceeds $1,200. Practice question. Which of the following would NASA consider to be a substantial prepayment of fees? A. $500 covering the next 6 months. B. $800 covering the entire contract year. C. $800 covering the next calendar quarter. D. $5,000 covering the next month. The answer is B. NASA, state law, defines a substantial prepayment of fees to be more than $500 6 or more months in advance. While $800 and $5,000 are certainly more than $500, they cover a shorter period than 6 months. Disclosure of financial impairment. Any investment advisor that has discretionary authority or custody of client funds or securities, or requires or solicits substantial prepayment of fees, must disclose any financial condition that is reasonably likely to impair its ability to meet contractual commitments to its clients. As an example, the SEC has indicated that disclosure may be required of any arbitration award sufficiently large that payment of it would create such a financial condition. Here is the way it is stated in Form ADV Part 2. If you have discretionary authority or custody of client funds or securities, or you require or solicit prepayment of more than $1,200 in fees per client, 6 months or more in advance, you must disclose any financial condition that is reasonably likely to impair your ability to meet contractual commitments to clients. Test Topic Alert. The administrator may require an advisor who has custody of client funds or securities, or has discretion over a client's account to post a surety bond or maintain a minimum net worth. The requirement is higher for custody than for discretion. Typically, the net worth required of investment advisors with discretionary authority is $10,000, and that for those taking custody, whether or not they are exercising discretion, is $35,000. If the advisor is using a surety bond instead, the requirement in either case is $35,000. An advisor who does not exercise discretion and does not maintain custody but does accept prepayment of fees of more than $500 6 or more months in advance must maintain a positive net worth at all times. Definition: surety bond. A surety bond is usually issued by an insurance company, the surety, who guarantees payment of a specified sum to an injured party, either the client or the administrator, when the securities professional causes damages by her actions or fails to perform. Test Topic Alert. Because the Uniform Securities Act is only a template, some states have higher net worth or bonding requirements. The exam may want you to know that if a state-registered IA meets the net worth or surety bonding requirements of the state where its principal office is located, that is sufficient in any other state in which it may be registered. Definition: principal office. We've used this term several times, and it is an important one to know. Both state and federal law define this as the executive office of the investment advisor from which the officers, partners, or managers of the investment advisor direct, control, and coordinate the activities of the investment advisor. Practice question. Mammon Money Managers (MMM) has its principal office in State A and is also registered in States B, C, and D. MEM exercises discretion in client accounts. As a result, MMM would have to meet the net worth or bonding requirements of A, the SEC, B, State A, C, the state with the highest requirement, D, each state. The answer is B. A state-registered investment advisor need only meet the financial requirements of the state in which its principal office is located. These two requirements are meaningless here because this is a state-registered firm. Test Topic Alert. One of the effects of the NISMU is to limit the powers of an administrator over a federal covered advisor. Section 222 of the Investment Advisors Act of 1940 states that when it comes to federal covered advisors, any financial or bonding requirements, as well as rules relating to record keeping, are solely under federal jurisdiction. Test Topic Alert. The proper term to use when referring to the financial requirements of an investment advisor is net worth, while for broker-dealers it is net capital. However, we have heard from a number of students that NASA might be using net capital where they should be using net worth in questions about IAs. So if you won't get the question right, answer it the way they give it to you. You will see several examples of this in our practice questions. Failure to maintain minimum net worth. The USA specifies the action to be taken by a registered investment advisor whose net worth falls below the required minimum. By the close of business on the next business day, the advisor must notify the administrator that the investment advisor's net worth is less than the minimum required. After sending that notice, the advisor must file a financial report with the administrator by the close of business on the next business day. One more item that must be included in the report is the number of client accounts. When the advisor's net worth is below the minimum requirement, the advisor must obtain a bond in an amount of the net worth deficiency rounded up to the nearest $5,000. Example. A state-registered investment advisor discovers on Monday that its net worth is below the minimum requirement. No later than the close of business on Tuesday, notice must be sent to the administrator of the state in which the investment advisor has its principal office. Then, no later than the close of business on Wednesday, the investment advisor must file a detailed report with the administrator of its financial condition. Included in the report must be a statement as to the number of client accounts. Example. An investment advisor who maintains custody of customer funds and securities discovers that its net worth is only $23,000. Even though the advisor only needs a net worth of $35,000, this would require immediate surety bonding in the amount of $15,000 because it must be rounded up to the nearest $5,000. Computing net worth. At Unit 7, Learning Objective 7A, we learned about computing net worth from a corporate balance sheet. For NASA purposes, the term net worth is the excess of assets over liabilities, assets minus liabilities. However, NASA does not permit the investment advisor to include the following as assets: goodwill and all other assets of an intangible nature: home furnishings, automobiles, and any other personal items not readily marketable in the case of an individual, advances or loans to stockholders and officers in the case of a corporation, and advances or loans to partners in the case of a partnership. However, furniture used in the office, such as a sofa in the reception room or bookcases in the company research library, are considered assets for the purpose of the computation. Learning Objective 9G. Recall the investment advisor books and record-keeping requirements under state and federal law. Books and records. Once registered, there are a number of post-registration activities required, such as record-keeping, annual filings, and other reports. The Uniform Securities Act virtually duplicates the first 12 items of the record-keeping requirements of the Investment Advisors Act of 1940 listed below. The Investment Advisors Act requires every advisor, other than ones specifically exempted from registration, to make, keep, and preserve such records, and for such periods as the SEC may prescribe as necessary or appropriate in the public interest, or for the protection of investors. By rule, the SEC has set forth various record-keeping requirements for investment advisors. Moreover, the Act makes it unlawful for any person to willfully make any untrue statement of a material fact in any report filed with the SEC, or to willfully omit to state in a report any material fact required to be stated therein. The SEC and the states require investment advisors to maintain the following books and records: a journal, including cash receipts and disbursement records, general and auxiliary ledgers reflecting asset, liability, reserve, capital, income, and a memorandum of each order given by the advisor for the purchase or sale of any security, or any instruction received by the advisor from the client concerning the purchase, sale, receipt, or delivery of a security, and of any modification or cancellation of any such order or instruction. All checkbooks, bank statements, canceled checks, and cash reconciliations, all bills or statements, or copies thereof, paid or unpaid, and all trial balances, financial statements, and internal audit working papers. Originals of all written communications received and copies of all written communications sent by the advisor related to any recommendation or advice given or proposed to be given, any receipt, disbursement, or delivery of funds or securities, or the placing or execution of any order to purchase or sell any security, provided, however, that if the investment advisor sends any notice, circular, or other advertisement offering any report, analysis, publication, or other investment advisory service to more than 10 persons, the investment advisor shall not be required to keep a record of the names and addresses of the persons to whom it was sent, except that if the notice, circular, or advertisement is distributed to persons named on any list, the investment advisor shall retain with a copy of the notice, circular, or advertisement a memorandum describing the list and its source, a record of all accounts in which the advisor is vested, with any discretionary power with respect to the funds, securities, or transactions of any client, all powers of attorney and other evidence of the granting of any discretionary authority by any client to the advisor or copies thereof, all written agreements or copies thereof, entered into by the advisor with a client or otherwise relating to its investment advisory business, a file containing a copy of each notice, circular, advertisement, newspaper article, investment letter, bulletin, or other communication, including by electronic media, email, that the investment advisor circulates or distributes, directly or indirectly, to 2 or more persons, other than persons connected with the investment advisor, if the item, including communications by electronic media, recommends the purchase or sale of a specific security and does not state the reasons for the recommendation. The advisor must prepare a memorandum indicating the reasons for that recommendation. A file containing a copy of all written communications received or sent regarding any litigation involving the investment advisor or any investment advisor representative or employee, and regarding any written customer or client complaint. A file containing a copy of each document that pertains to the registrant or its investment advisor representatives. The file should contain, but is not limited to, all applications, amendments, renewal filings, and correspondence. With certain exceptions, a record of all securities transactions in which an investment advisor or any advisory representative has, or by reason of such transaction acquires, any direct or beneficial ownership. In practice, the record-keeping rule has served as a deterrent to the practice of scalping, because it requires all advisory representatives to report all of their security transactions to their affiliated advisory firms on a regular basis. These reports are subject to SEC examination. Scalping is the practice whereby an investment advisor, before the dissemination of a securities recommendation, trades on the anticipated short-run market activity that may result from the recommendation. Time period for maintenance of records. The Investment Advisors Act of 1940, as well as the NASA Model Rule on Investment Advisor Record Keeping, requires that an investment advisor's books and records be maintained in a readily accessible place for 5 years. The 5-year period will run from the end of the fiscal year, during which the last entry was made on the record. During the first 2 years of the 5-year period, the rule requires that the records be maintained in the principal office of the advisor. After this initial 2-year period, the records may be preserved in electronic or microfilm format or any other form of data storage in compliance with the Act. Even though the record-keeping requirements are almost identical, it is important to remember for the test that federal covered advisors only comply with the SEC's requirements, while state-registered advisors need only meet the requirements of the state where their principal office is located. Under both federal and state requirements, partnership articles and any amendments thereto, articles of incorporation, charters, minute books, and stock certificate books of the investment advisor and of any predecessor must be maintained in the principal office of the investment advisor and preserved until at least 3 years after termination of the enterprise. Test Topic Alert. A few pages ago, we gave you a test topic alert that emphasized that as long as state-registered investment advisors meet the net worth or surety bond requirements of their home state, that is sufficient for any state in which they are registered. The same is true regarding record-keeping requirements, and the proof is in the following statement, copied from Form ADV. 2. State-Registered Investment Advisor Affidavit. If you are subject to state regulation by signing this Form ADV, you represent that you are in compliance with the registration requirements of the state in which you maintain your principal place of business, and are in compliance with the bonding, capital, and record-keeping requirements of that state. Storage requirements. The records required may be maintained and preserved for the required time by an investment advisor on paper or hard copy form, as those records are kept in their original form. Micrographic media, including microfilm, microfiche, or any similar medium, or electronic storage media, including any digital, computer disk, storage medium or system, as long as the investment advisor establishes and maintains procedures to maintain and preserve the records, so as to reasonably safeguard them from loss, alteration, or destruction. To limit access to the records to properly authorized personnel and the administrator, and to reasonably ensure that any reproduction of a non-electronic original record on electronic storage media is complete, true, and legible when retrieved. In all cases, the investment advisor must arrange and index the records in a way that permits easy location, access, and retrieval of any particular record, and provide the administrator with the means to access, view, and print the records. Practice question. Under the Investment Advisors Act of 1940, all of the following are true regarding advisor record keeping except A. The IA must keep records of transactions made for its own account, as well as the account of investment advisor representatives to lessen the likelihood of scalping. B. Computer-generated records may be stored in that format. C. Client account records must be maintained, including a list of recommendations made. D. Records must be maintained for a period of 2 years from the end of the fiscal year in which the last entry was made. The answer is D. This is the exception, because the records must be kept for 5 years. Nothing in the question asked about the 2-year requirement in the office. The 5-year requirement is that records be easily accessible whether in the office or not. Test Topic Alert. You'll need to remember that the record retention requirement for investment advisors is 5 years from the end of the year in which the record was originally generated. Learning Objective 9H. Recognize that investment advisor representatives must be adequately supervised. Each registered investment advisor must adopt and implement written policies and procedures designed to prevent violation of the federal and state securities laws. Review those policies and procedures annually for their adequacy and the effectiveness of their implementation, and designate a Chief Compliance Officer, CCO, to be responsible for administering the policies and procedures. An advisor's Chief Compliance Officer should be competent and knowledgeable regarding the Advisors Act and the USA, and should be empowered with full responsibility and authority to develop and enforce appropriate policies and procedures for the firm. Thus, the compliance officer should have a position of sufficient seniority and authority within the organization to compel others to adhere to the compliance policies and procedures. In fact, the CTO's identity must be disclosed on Form ADV. In keeping with the times, one of the areas that must be covered in these written procedures deals with physical security and cybersecurity. An investment advisor must establish, implement, update, and enforce written physical security and cybersecurity policies and procedures, reasonably designed to ensure the confidentiality, integrity, and availability of physical and electronic records and information. The policies and procedures must be tailored to the investment advisor's business model, taking into account the size of the firm, types of services provided, and the number of locations of the investment advisor. We'll have more to say about this topic in Unit 14. The role of the CCO is particularly important when it comes to ensuring supervision of those individuals referred to as supervised persons. Failure to supervise can lead to suspension or revocation of the investment advisor's registration. Definition: supervised person. A supervised person is any of the IA's officers, partners, directors, or other persons occupying a similar status or performing similar functions, or employees, or any other person who provides investment advice on the investment advisors. Although many supervised persons fall within the definition of investment advisor, they meet the three-pronged test. The SEC and the states do not require those individuals to register as investment advisors with the regulators. Instead, the advisory firm must register. The advisor's registration covers its employees and other persons under its control, provided that their advisory activities are undertaken on the investment advisor's behalf. In most cases, these individuals must register as investment advisor representatives and come under the advisor's supervisory jurisdiction. This is particularly true in the case of financial planners who have elected to operate as independent contractors, not employees of investment advisory firms. Regardless, they are required to be registered as investment advisor representatives of the firm and must be placed under the same level of supervisory scrutiny as employees. Their business cards may contain the name of their separate planning entity, but must also disclose the name of the entity registered as the investment advisor. Do not confuse this with a similar term defined in the Advisors Act: person associated with an investment advisor. A person associated with an investment advisor is any partner, officer, or director of such investment advisor, or any person performing similar functions, or any person directly or indirectly controlling or controlled by such investment advisor, including any employee of such investment advisor, except that for persons associated with an investment advisor whose functions are clerical or ministerial, shall not be included in the meaning of such term. What is the difference? Supervised person includes every employee, while associated person excludes clerical and administrative employees. Knowledge Check 9.4. Question 1. An investment advisor registered in state G is obligated to maintain certain books and records as specified by the Uniform Securities Act. Which of the following statements regarding advisor record keeping is not true? A. Records originally created on computer may be stored in electronic media. B. Records are subject to surprise audits by the state G administrator. C. Written records may be reduced to microfilm. D. Records must be kept for 6 years. The correct answer is D. Records of an investment advisor must be maintained for 5 years. Records are subject to surprise audits by the state administrator. Written records may be reduced to microfilm, and records originally created on a company's computer may be stored in electronic media. Question 2. Defalcator Investment Advisors (DIA) is registered in states AK, and our disclosure of financial impairment is required in all of the following circumstances except: A. DIA maintains custody of customer funds and securities. B. DIA requires a quarterly prepayment of fees in the amount of $800. C. DIA requires an annual prepayment of fees in the amount of $600. D. DIA exercises discretion over customer advisory accounts. The correct answer is B. Disclosure of financial impairment is necessary whenever the IA exercises discretion or maintains custody. A substantial prepayment of fees will also trigger the disclosure. For state-registered IAs, that is more than $500 6 or more months in advance. Although the $800 per payment is certainly more than $500, it is for 3 months, not 6 months or more. Question 3. Amr is the proprietor of Best Financial Planning Incorporated, BFPI. He is licensed as an investment advisor representative with Fortune awaits you, that A. An investment advisor registered in several states. Supervision over Amir's advisory activity is the responsibility of A. Amr personally as the sole proprietor of BFPI. B. BFPI. C. FAI. D. The administrator of the state in which BFPI maintains its principal office. The correct answer is C. As is the case with many independent financial planners, they have their own planning business but are licensed with a separate investment advisory firm. That firm is where the responsibility lies for the actions of any of their IARs.
Unit 10. Regulation of Investment Advisor Representatives. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 10. Define an investment advisor representative. Learning Objective 10. Identify exclusions and exemptions from the definition of investment advisor representative under the Uniform Securities Act. Learning Objective 10. Describe the investment advisor representative registration process, required post-registration filings, and business activities. Your exam will include approximately 4 questions from the topics covered in Unit 10. Introduction. In Unit 9, we defined an investment advisor and determined who was excluded from the definition or exempt from registration, and, if required to register, with whom and how. In this unit, we will cover those individuals who represent investment advisors. Investment advisor representatives. One important regulatory note is that unlike investment advisors who register either on a federal or a state level, registration requirements of representatives only come under the jurisdiction of the states. That is why this is a NASA exam rather than one sponsored by FINRA or the SEC. Lesson 10.1. Who is an investment advisor representative? Learning Objective 10. Define an investment advisor representative. Let's begin by looking at the final word in the phrase investment advisor representative, representative. Representatives always represent someone else. In this case, these are individuals who represent an investment advisory firm. As defined in the law, an investment advisor representative, IAR, is any partner, officer, director, or an individual occupying a similar status or performing similar functions, or other individual employed by or associated with an investment advisor and is registered or required to be registered under the Uniform Securities Act. Remember, IARs register only with the states. An individual meets the definition of an IAR by doing any of the following. Makes any recommendations or otherwise renders advice regarding securities. Manages accounts or portfolios of clients. Determines which recommendation or advice regarding securities should be given. Solicits, offers, or negotiates for the sale of or sells investment advisory services. Supervises employees who perform any of the foregoing. Example. An individual employed by an investment advisor who manages investment portfolios for clients is considered an investment advisor representative. So is the individual who supervises that person. Under state law, there is no distinct registration for supervisory persons as there is under FINRA's rules for broker-dealers. Even the CEO is registered as an IAR. Take note. The use of the term individual here is important. Only an individual or a natural person can be an investment advisor representative. The investment advisory firm is the legal person, entity, that the IAR, natural person, represents in performing the above-listed functions. Take note. An individual may act as both an investment advisor and an investment advisor representative. This is typically the case when the business is organized as a sole proprietorship. However, an individual who acts solely as an investment advisor representative is excluded from the definition of investment advisor. Learning Objective 10. Identify exclusions and exemptions from the definition of investment advisor representative under the Uniform Securities Act. Just as with investment advisors, the laws provide for exclusions for the definition and exemptions for those who are defined as IARs. Exclusions from the definition of investment advisor representative. Certain employees of investment advisory firms are excluded from the term investment advisor representative, provided their activities are confined to clerical or administrative duties or those activities that are solely incidental to the investment advisory services offered, such as mailing out a research report to an advisory client when directed by an IAR. Should the investment advisory employee step over the line, as the saying goes, and perform any activity that makes one an IAR, the employee would then have to register as an investment advisor representative. In addition, an individual is not an investment advisor representative if the person does not on a regular basis solicit, meet with, or otherwise communicate with clients of the investment advisor or provides only impersonal investment advice. Let's define that last term because you're going to see it a number of times in this course. Impersonal investment advice means investment advisory services provided by means of written material or oral statements that do not purport to meet the objectives or needs of specific individuals or accounts. Practice question. Which of the following individuals would be defined as an investment advisor representative? A. Melinda, one of the firm's research analysts who has no contact with public clients. B. Johnny, an employee who makes cold calls soliciting for new advisory clients. C. Mel, who prepares client account statements. D. Jane, who is the firm's VP of HR services. The answer is B. One of the functions that makes a supervised person an IAR is soliciting for new business. Research personnel are not considered IARs unless they have client relationships. Mel's job is purely clerical, and even though Jane is a vice president, the HR department is far removed from anything to do with giving investment advice. Exemptions from registration as an investment advisor representative. There are 3 different exemptions available for those defined as IARs. 2 of these are for those who represent state-registered IAs, and the other for those who represent federal-covered IAs. If the individual represents a state-registered advisor, there is a de minimis exemption. Just as is the case with investment advisors, if an IAR does not maintain a place of business in the state, and, during the preceding 12-month period, has had no more than 5 retail clients, registration in the state is not required. The previously mentioned snowbird exemption also applies to these IARs. If the individual represents a federal-covered investment advisor, there is a special exemption under Section 203 of the 1940 Act. Keeping it simple, it states that for those performing as IARs for covered advisors, IAR registration is required only in those states where that individual has a place of business. Place of business of an investment advisor representative means an office at which the investment advisor representative regularly provides investment advisory services or solicits, meets with, or otherwise communicates with clients, and any other location that is held out to the general public as a location at which the investment advisor representative provides investment advisory services or solicits, meets with, or otherwise communicates with clients. Practice questions. Question 1. Under the Uniform Securities Act, which of the following is not required to register as an investment advisor representative? A. A director of a state-registered investment advisory firm who determines specific recommendations for clients. B. An associate in an SEC-registered investment advisory firm who has a place of business in the state and manages the account of only one individual client. C. A clerk employed by a state-registered investment advisory firm. D. A vice president of a state-registered investment advisory firm who supervises employees who solicit clients for the firm. The answer is C. Clerical and ministerial administrative personnel are specifically excluded from the definition of investment advisor representative. Specifically included in the definition are directors, officers, partners, associates, and employees of state-registered advisors who carry out investment advisory or solicitation functions or who supervise those functions. Also included in the definition are persons who perform similar functions for SEC-registered advisors and who have a place of business in the state. Once there is a place of business in the state, the de minimis rule no longer applies. Question 2. Which of the following individuals would be required to register with the administrator of a state? A. Walter, who represents a state-registered advisor, has no place of business in the state and only serves existing clients who vacation in the state. B. May, who represents a covered advisor, has no place of business in the state and has 38 clients who reside in the state. C. Aliza, who represents a state-registered advisor, has no place of business in the state and had fewer than 6 individual clients who were residents of the state during the past 12 months. D. Joe, who represents a covered advisor, has a place of business in the state and had 4 retail clients who were residents of the state during the past 12 months? The answer is D. Once an IAR maintains a place of business in a state, they must register in that state regardless of the number of clients, such as the case with Joe. Walter need not register because he qualifies for the snowbird exemption. May qualifies for the exemption as an IAR of a federal covered investment advisor. She is only required to register in those states where she maintains a place of business. Eliza qualifies for the de minimis exemption. Fewer than 6 is the same as 5 or fewer. Important note, even if May's employer had a place of business in the state, she would not have to register because she, the IAR, doesn't. Of course, her employer, being federal covered, doesn't register in any states. Knowledge check 10.1. 1. Which of the following would be permitted to register as an investment advisor representative? A. A corporation. B. An individual. C. A partnership. D. All of these. The correct answer is B. Only individuals, natural persons, are eligible to register as IARs. If the question simply asked about registering as an investment advisor, the correct answer would have been all of the above. 2. An individual representing a state-registered investment advisor would not qualify for the de minimis exemption in a state if, over a 12-month period, she had A. 5 retail clients, B. 5 or fewer retail clients, C. Fewer than 6 retail clients, D. 6 or fewer retail clients. The correct answer is D. Because the maximum is 5 retail clients in a 12-month period, choice D with 6 clients is over the limit. Notice that fewer than 6 and 5 or fewer mean the same thing. Lesson 10.2. Registration and post-registration requirements of investment advisor representatives. Learning Objective 10. Describe the investment advisor representative registration process, required post-registration filings, and business activities. IAR registration process. As we learned with investment advisors, if you are not excluded from the definition of investment advisor representative, or if you don't qualify for one of the exemptions, then you have to register. And, as pointed out earlier, it is only on the state level that an IAR registers, so we don't have the issue of comparing state and federal law as we do with IS. Unless properly registered, it is unlawful for any registered investment advisor to engage the services of an individual as an investment advisor representative if that individual is required to register. This is true whether the investment advisor is state-registered or federal covered. All IARs must be registered in at least one state. They have to have a place of business somewhere, right? Registration is accomplished by filing a Form U-4. A Form E-10 can be used in certain cases, but that is unlikely to be tested through FINRA's CRD, Central Registration Depository. Most of you have already completed that form, so you know it asks about your personal history and details. One of the most important parts is the DRPs, the disclosure reporting pages. It is on these pages that the applicant discloses past disciplinary events. Form U-4 requires disclosing if you have ever been convicted or even just charged. An arrest without a charge is not reportable, with no time limit, for any felony or securities-related misdemeanors. In Unit 12, we'll discuss how those can affect the application. Another important part of Form U-4 is the consent to service of process, mentioned earlier in Unit 9 in conjunction with the registration of an IA. One other requirement: the reason you are reading this book, you must pass an exam, either the Series 65 or, if appropriate, the Series 66. Please refer to the introduction for a list of the professional designations for which a waiver from taking the Series 65 exam is available. Automatic registration of certain individuals. Here is an important item dealing with registration that is frequently tested. The Uniform Securities Act states, registration of an investment advisor automatically constitutes registration of any investment advisor representative who is a partner, officer, or director, or a person occupying a similar status or performing similar functions. It isn't only the title that determines your registration, it is also the function performed. Note that the rule quoted above states that the IAR is a partner, officer, or director of the investment advisor. Doesn't that mean they are already registered? What is the purpose of automatic registration to someone already registered? When a state-registered IA expands its business so that registration is required in another state or states, the application process is basically the same as their initial state registration. That is, a Form ADV is filed. That filing includes the names and other pertinent information about all of the partners, officers, or directors who are already acting as I-8Rs. Therefore, when the firm's registration becomes effective in that new state, those individuals included in the filing are granted automatic registration. They don't have to file an individual Form U-4. Please note that it is not any IAR, but only those listed or, as the rule states, those occupying a similar status, etc., who receive this treatment. Any of the firm's other existing I-8Rs who will need to be registered in the new state must file an amended Form U-4 with the administrator and wait for their supervisor to tell them that the firm has received the word that their registration is effective with that state. Practice question. When an investment advisor registers in a new state, which of the following are automatically registered as I-8Rs? A. Any employee who is functioning as an I-8R in at least one state. B. Officers, partners, and directors of the firm who are functioning as I-8Rs. C. Clerical employees stuffing the envelopes with research reports. D. Any employee who will be soliciting clients for the advisor. The answer is B. As we just stated, the automatic registration provision applies to those officers, partners, and directors of the IA who are already I-8Rs in at least one state. Important note: for those of you who have taken a FINRA exam, you know there is a supervisory level of registration, registered principal. No such gradations apply under NASA rules. So, no matter how high-ranking the officer of the investment advisory firm, that individual registers as an IAR. Therefore, anytime you see reference made to your supervisor, remember that person is an IAR just like you. Testing. Unless a waiver is granted, see Introduction, passing the Series 65 exam is a requirement for registration as an investment advisor representative. We do expect you to pass, but if an applicant is not successful on the first or second attempt, there is a 30-day waiting period before the exam may be retaken. After the third and subsequent attempts, the waiting period is 180 days. Now that you know how to register, what about termination procedures? IAR termination procedures. If an investment advisor representative terminates employment with an investment advisor, notification requirements depend on how the investment advisor is registered. If the investment advisor is a state-registered advisor, the firm must notify the administrator. If the investment advisor is a federal-covered advisor, the investment advisor representative must notify the administrator. All notifications must be made promptly. A clue that might help is to visualize the I in IAR as the number 1 to remember that only one person gives notification. What is the story if the IAR leaves one firm to go to another? Practice question. Zach is an IAR with Unicorn Investment Advisors, UIA. An investment advisor registered in State W. Zach has accepted an employment offer from Elite Research Associates, ERA, an investment advisor also registered in State DOI. What are the notification requirements to the State GO administrator? A. Zach is the only person who notifies the administrator. B. UIA is the only person who notifies the administrator. C. ERA is the only person who notifies the administrator. D. UIA and ERA notify the administrator. The answer is D. This is a bit sneaky. We just told you to remember the I in IAR resembles the number 1, so only one person must notify. We've also stated that if the IAR represents a state-registered investment advisor, it is the IA who does the notification. In this specific instance, because 2 IA firms are involved, each of them must notify the administrator. UIA that Zach is no longer under their control and ERA that Zach now is. This is just an example of how every rule has an exception. Financial requirements of I-8Rs. Unlike an investment advisor, there are no financial requirements, no net worth or bonding requirements to register as an investment advisor representative. The fact that the I-8R applicant must be solvent, not adjudicated bankrupt, is not considered a financial requirement. Record-keeping requirements of I-8Rs. Unlike an investment advisor, there are no ongoing record-keeping requirements for I-8Rs. Annual renewal on December 31 requires the payment of fees. If there are any material changes, especially of a disciplinary nature, the individual's Form U-4 must be updated within 30 days. Test topic alert. If there should be a change to any material information in Form U-4, for example, change of permanent address or change to military status, an amendment must be filed within 30 days. Practice question. When an investment advisor representative's permanent residence address changes, updates must be made to the information on file with the regulatory bodies. The proper procedure to be followed is A. File a Form U-4 within 30 days. B. File a Form U-4 within 45 days. C. File a Form U-5 within 30 days. D. File a Form U-5 within 45 days. The answer is A. Amendments are made to Form U-4 and must be filed within 30 days. Form U-5 is for terminations. Knowledge Check 10.2. Question 1. Registration of an investment advisor automatically confers registration on A. Officers of the firm who are functioning as I-8Rs. B. Partners of the firm who are functioning as I-8Rs. C. Directors of the firm who are functioning as I-8Rs. D. All of the above. The correct answer is D. Section 202 of the Uniform Securities Act states that registration of an investment advisor automatically constitutes registration of any investment advisor representative who is a partner, officer, or director, or a person occupying a similar status or performing similar functions. Question 2. Angelo is registered as an agent for Rentable Investment Brokers, RIBE. The firm has just registered as an investment advisor in order to offer wrap fee programs to its customers. If Angelo wishes to offer this program to his clients, he will have to apply for registration as an investment advisor representative on an amended A. Form ADV, B. Form BD, C. Form U-4, D. Form U-5. The correct answer is C. Even though Angelo has already filed a Form U-4 when he became an agent, he now must file another Form U-4 amending the original application to indicate this new requested registration. Form U-5 is for termination, and the ADV and BD are for the firms, not individuals. Unit 11. Regulation of broker-dealers and their agents. Learning objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 11. A. Define a broker-dealer. Learning Objective 11. B. Identify broker-dealer exclusions and exemptions under the Securities Exchange Act of 1934 and the Uniform Securities Act. Learning Objective 11. C. Define an agent. Learning Objective 11. D. Identify agent exclusions and exemptions under the Uniform Securities Act. Learning Objective 11. E. Describe the initial and post-registration requirements of the Securities Exchange Act of 1934 and the Uniform Securities Act regarding broker-dealers. Learning Objective 11. Describe the initial and post-registration requirements of the Securities Exchange Act of 1934 and the Uniform Securities Act regarding agents. Your exam will include approximately 4 questions from the topics covered in Unit 11. Introduction. We have already discussed 2 of the 4 securities professionals covered under the Uniform Securities Act and federal law, investment advisors, and those who represent them, investment advisor representatives. This unit will cover the other 2, broker-dealers and those who represent them, agents. Lesson 11.1. Who is and who is not a broker-dealer? Learning Objective 11. A. Define a broker-dealer. When describing the exclusions from the definition of an investment advisor, Unit 9, Learning Objective 9A, we gave a brief definition of a broker-dealer, BD. Let's get into more detail. A broker-dealer is defined in the Securities Exchange Act of 1934, the federal law regulating broker-dealers and their representatives, and in the USA as any person. Think back to the broad definition we gave you at the beginning of Unit 9. Engaged in the business of effecting transactions in securities for the accounts of others or for its own account. Any person, for example, a securities firm, even one organized as a sole proprietorship, with an established place of business, an office in the state that is in the business of buying and selling securities for the accounts of others, customers, and or for its own proprietary account, is defined as a broker-dealer. In other words, broker-dealers are firms for which agents, registered representatives, work. They are firms that engage in securities transactions, such as sales and trading. When acting on behalf of their customers, that is, buying and selling securities for their clients' accounts, broker-dealers act in an agency capacity. When broker-dealers buy and sell securities for their own accounts, called proprietary accounts, they act in a principal capacity as dealers. We'll cover their activity in this regard in Unit 23. Take note. Individuals who buy and sell securities for their own accounts are not broker-dealers because they are engaged in personal investment activity, not the business of buying and selling securities for others. They are individual investors, not securities dealers. Test topic alert. One of the roles of a broker-dealer is underwriting, distributing shares of new securities for issuers. When they do that, they generally earn a spread, the difference between the public offering price and what they pay the issuer, or receive a commission on the sales, which they then use to pay their agents who actually made the sales to the clients. Previously, in Unit 8, we covered the registration and issuance of securities. Learning Objective 11. B. Identify broker-dealer exclusions and exemptions under the Securities Exchange Act of 1934 and the Uniform Securities Act. Exclusions from the definition of broker-dealer. Broker-dealers are firms that buy and sell securities for others or themselves as a business. There are, however, many persons, legal and natural, that affect securities transactions that are excluded from the definition of broker-dealer for purposes of state regulation. Persons excluded from the definition of broker-dealer are agents, those individuals who represent broker-dealers; issuers, those entities such as corporations and governments who raise money by issuing securities; and banks, savings institutions, and trust companies. Today, most banks and other financial institutions engage in securities activities through broker-dealer subsidiaries of the bank holding company. The broker-dealer subsidiaries of banks are, as a result, not excluded from the definition of a broker-dealer and therefore subject to the same securities regulations as other broker-dealers. Keep in mind that formation of these subsidiaries eliminates the need for the bank holding companies to register as broker-dealers. Their broker-dealer subsidiaries must, of course, register. Broker-dealers with no place of business in the state. This exclusion is very much like the one offered to investment advisors. States exclude from the definition of broker-dealer those broker-dealers that have no place of business in the state and deal exclusively with the issuers of the securities involved in the transactions, other broker-dealers, and other financial institutions, such as banks, savings and loan associations, trust companies, insurance companies, investment companies, or employee benefit plans with assets of not less than $1 million. $1 million. Have no place of business in the state, but are licensed in a state where they have a place of business, and offer and sell securities in the state only with persons in the state who are existing customers and who are not residents of the state, or qualify under the snowbird rule similar to the rule for investment advisors and their representatives. The USA also allows broker-dealers and their agents to do business with existing customers who are temporarily in a state to avoid unnecessary multiple registrations. Example: as long as your client has not changed their state of residence, there is no time limit. Many people, after a couple of years in the workforce, decide to get an MBA. If they go out of state to a resident program for a year or two, that does not mean they've changed their state of residence, but merely that they are not commuter students. Only when official residency is changed, new driver's license or voter registration, does the 30-day rule apply. Test topic alert. Unlike investment advisors and their IARs, there is no de minimis exemption for broker-dealers. That is, even if the BD does not maintain a place of business in the state. A single retail client means registration is required. State exemptions from registration as a broker-dealer. Obviously, there was no internet when the Uniform Securities Act was written in 1956. As with other changes in the way we do business, NASA has written model rules to update the regulatory scheme. A firm's website, considered advertising, can be seen everywhere. Does that mean the firm has a place of business in the state? Without getting too technical, there are several requirements to ensure that the person is not deemed to be in the state. The communication clearly states that the person may only do business in this state if properly registered or exempt from registration. Any follow-up individualized responses with prospects in this state that involve either the affecting or attempting to affect transactions in securities, or the rendering of personalized investment advice for compensation, as may be, will not be made without compliance with state broker-dealer, investment advisor, agent or IA representative registration requirements, or an applicable exemption or exclusion. The site may only make available general information, not specific advice or recommendations. In the case of an agent or IAR, the affiliation with the broker-dealer or investment advisor of the agent or IAR is prominently disclosed within the communication. The broker-dealer or investment advisor with whom the agent or IAR is associated retains responsibility for reviewing and approving the content of any internet communication by an agent or IAR. The broker-dealer or investment advisor with whom the agent or IAR is associated first authorizes the distribution of information on the particular products and services through the internet communication, and, in disseminating information through the internet communication, the agent or IAR acts within the scope of the authority granted by the broker-dealer or investment advisor. What this basically means is that if you just generally advertise on the internet, you don't have to be registered in the state. However, if you follow up with advice, IAR, or offer securities, agent, you either have to register or find some kind of exemption. Test topic alert. The exam focuses more on the exclusions from the definition of broker-dealer than on the definition itself. Know these exclusions well. Example. This is an example of the exclusion from the definition of broker-dealer. First Securities Corporation, FSC, is a broker-dealer registered in State A, the location of its only office. One of their agents contacts a client who is currently on vacation in State B and recommends the purchase of XYZ common stock. The client agrees and purchases 100 shares of XYZ. Neither the broker-dealer nor the agent is registered in State B. Is this a problem? What if the client enjoys being in State B to the extent that it becomes his permanent residence? When a broker-dealer has no place of business in a state and deals with an existing client who is temporarily in that state, the USA does not define that entity as a broker-dealer in the state. Therefore, FSC would not be required to register in State B, and neither would any of its agents. Things change, however, if the client becomes a resident of State B. Once that client's residence has officially changed, the relationship can only continue for a maximum of 30 days. After that, both FSC and the agent would have to register in State B if they wanted to keep the client. Let's take the example one step further. First Securities Corporation, FSC, is a broker-dealer registered in State A, the location of its principal office. They have begun doing business in State B with the First Fidelity Bank and Trust Company and open a small branch office in State B to service the account. Which of the following statements is correct? A. FSC does not need to register in State B because its only client is an institution. B. FSC needs to register in State B because it has a place of business in the state. C. Broker-dealers are only required to register in the state where their principal office is located. D. FSC would have to register in State B even if it didn't have a place of business there. We learned that the USA excludes from the definition of broker-dealer a firm with no place of business in a state whose only clients are, among others, institutions such as banks. That exclusion only applies when there is no place of business in the state. Opening a small branch in State B voids that exclusion, so B is the correct answer. Even if there is no place of business in the state, if they have a single individual, called a retail client on the exam, who resides in the state, then registration is always required. Federal exemptions from registration as a broker-dealer. A broker-dealer that conducts all of its business in one state is exempt from registration with the SEC. The exception provided for intrastate broker-dealer activity is very narrow. To qualify, all aspects of all transactions must be done within the borders of one state. This means that without SEC registration, a broker-dealer cannot participate in any transaction executed on a national securities exchange. Intrastate broker-dealers register with the state in which they are located. This chart should help. The you here does not mean individuals like yourself, it is referring to the brokerage firm. Under the USA, you are a broker-dealer if 1. You have a place of business in the state regardless of the nature of your clients, or 2. You have even one retail client in the state. Under the USA, you are not a broker-dealer if 1. You have no place of business in the state, and 2. Your only clients are other BDs, institutions, and issuers of the security involved in the transaction, or 3. You are registered in a state where you do maintain a place of business and only do business in this state with existing clients who are not residents of the state. Snowbirds. Knowledge Check 11.1. Question 1. Under the Uniform Securities Act, a broker-dealer is defined as any person who A. buys securities, B. sells securities, C. is in the business of effecting securities transactions for its own account or for the accounts of others, D. is registered with the SEC. The correct answer is C. A broker-dealer is any person engaged in the business of effecting securities transactions for the accounts of others, broker, or for its own account, dealer. Question 2. A broker-dealer, having no place of business in the state, would be exempt from registration under the Uniform Securities Act if its only clients were Roman numeral 1. Banks or other financial institutions. Roman numeral 2. Investment companies. Roman numeral 3. Accredited investors. A. 1 and 2. B. 1 and 3. C. 2 and 3. D. 1, 2, and 3. The correct answer is A. Do not be misled by the term accredited investor. It has absolutely no meaning other than when referring to a private placement of securities under the Securities Act of 1933. This term will appear frequently on the exam out of context, i.e. unrelated to private placements. Whenever it does, you can make the question easier by replacing the term with the phrase ordinary public investor who needs all of the protection available under the law. As long as the broker-dealer has no place of business in the state, it is exempt from registration if its only clients are institutional investors, such as banks, insurance companies, investment companies, other investment advisors, broker-dealers, $1 million or larger employee benefit plans, college endowment funds, and governmental units. Lesson 11.2. Who is and who is not an agent? Learning Objective 11. C. Define an agent. Agent means any individual other than a broker-dealer who represents a broker-dealer or issuer in effecting or attempting to effect purchases or sales of securities. As agents, they act, usually on a commission basis, on behalf of others. Other than on this exam, agents are often referred to as registered representatives, whether they sell registered securities or securities exempt from registration. The use of the term individual here is important. Only an individual, a natural person, can be an agent. A corporation, such as a brokerage firm, is not a natural person, it is a legal entity. The brokerage firm is the legal person, legal entity, that the agent, natural person, represents in securities transactions. Take note. As just mentioned, agent is the term used under state law, and that, or broker-dealer agent, is the only term that will be used on the exam. However, unlike investment advisor representatives who register solely on a state level, almost all agents representing broker-dealers register on both the state and federal level by taking both a NASA-sponsored exam and a FINRA exam. Definition: associated person. A person associated with a broker-dealer is any partner, officer, or director of the broker-dealer, or any individual performing similar functions, or any person directly or indirectly controlling or controlled by the broker-dealer, including any employees of the broker-dealer, except that any person associated with a broker or dealer whose functions are solely clerical or ministerial shall not be included in the meaning of the term. Test topic alert. Even outside directors or partners whose only connection to the firm is the contribution of capital are considered associated persons of the broker-dealer. If that is their only function, they are not required to register as agents. Learning Objective 11. D. Identify agent exclusions and exemptions under the Uniform Securities Act. Clerical and administrative, sometimes referred to as ministerial, employees of a broker-dealer are generally not included in the definition of agent, and, therefore, are not required to be registered. The logic for this exclusion from the definition should be obvious. Clerical and administrative employees do not affect securities transactions with the public. They attend to the administration of the broker-dealer as a business organization. Under these circumstances, they are like clerical employees of any other corporation. A testable fact is that if the broker-dealer they work for wishes to pay their employees, including this group, a year-end bonus based on company profits, not related to any individual sales efforts, it would be allowable and would not require registrations of the clerical personnel. The situation changes when administrative personnel take on securities-related functions. When they do so, they lose their exemption and must register as an agent. Take note. Secretaries and sales assistants are not agents if their activities are confined to administrative activities, including responding to an existing client's request for a quote. However, if secretaries or sales assistants accept customer transactions or take orders over the phone, they are engaging in securities transactions and are subject to registration as agents. Test topic alert. Cold callers working for a broker-dealer would be defined as an agent if they did any more than ask if clients wanted to receive information. For example, if they pre-qualified clients or suggested ways to receive more money for their stocks or bonds, they would be considered agents. As is customary in other industries, broker-dealers frequently hire summer interns. If these interns received any selling-related compensation, such as $10 for each existing client solicited, they would be considered agents and would have to register. Basically, there is no way for an individual to represent a broker-dealer in a securities sales function without being an agent. Exclusions from the definition of agent for personnel representing issuers. In many cases, individuals who represent issuers of securities are agents and therefore must register as such in the states in which they sell the issuer's securities. When does something like this occur? In many cases, a local company is looking to raise some additional capital, something in the range of several $1,000,000. Instead of going through the normal investment banking procedure and paying all of those fees and commissions to the investment bankers, the company, known under the USA as the issuer, either uses its own employees or hires an outside sales force to sell the new securities. In general, these individuals are required to register as agents of the issuer. There is an exception as follows. Individuals are excluded from the definition of agent and therefore are exempt from registration in a state when representing issuers in effecting transactions. In certain exempt securities, listed below, exempt from registration, exempt transactions, or with existing employees, partners, or directors of the issuer if no sales-related commission or other remuneration is paid or given directly or indirectly for soliciting any person in this state. Affecting transactions in exempt securities. Securities exempt from registration are called exempt securities. Although there are almost a dozen different securities that qualify for exemption under the Uniform Securities Act, discussed previously in Unit 8, an individual is excluded from the term agent only when that individual represents an issuer in effecting transactions for the following 5 categories of exempt securities. Any security issued or guaranteed by the United States, any state, any political subdivision of a state, or any agency of one or more of these, or any security issued or guaranteed by Canada, any Canadian province, or any political subdivision of any such province. Securities of foreign governments with which the United States has diplomatic relationships. Any security issued by or guaranteed by any bank organized under the laws of the United States, or any bank, savings institution, or trust company organized and supervised under the laws of any state. Commercial paper rated in the top 3 categories by the major rating agencies with denominations of $50,000 or more with maturities of 9 months or less. Any investment contract issued in connection with an employee's stock purchase, savings, pension, profit sharing, or similar benefit plan. Affecting exempt transactions. An employee of an issuer is not an agent when representing an issuer in exempt transactions. Transactions exempt from registration are called exempt transactions. Some examples are unsolicited brokerage transactions, transactions between the issuer and underwriters, transactions with financial institutions, or private placements. Exempt securities and exempt transactions were covered in thorough detail in Unit 8, so you will probably want to go back and review that information after this. Take note. An employee of an issuer is not an agent when representing an issuer if the issue is exempt from registration, as long as it is one of the 5 exemptions listed above. Alternatively, the employee is not an agent when representing an issuer in exempt transactions, for example, transactions between an underwriter and issuer. An individual employed by a corporation, not a broker-dealer, to sell a new IPO to the public would be considered an agent of the issuer needing registration, even if not paid compensation based on sales. The only exception would be if all transactions were exempt, such as selling the shares only to institutional investors. Take note. Keep in mind that an individual who works for an issuer of securities is excluded from the definition of agent when engaging in transactions with employees involving the issuer's securities, provided that the individual is not compensated for such participation by commissions or other remuneration based either directly or indirectly on the amount of securities sold. In other words, salaried employees engaged in distributing their employer's shares as part of an employee benefit plan would not be required to register as agents because they are, by definition, excluded from the definition. If such employees were compensated on the basis of the number of shares sold, they would be defined as agents and therefore would be subject to registration. Test topic alert. Individuals representing broker-dealers in a sales capacity must register as agents whether they sell registered securities or securities exempt from registration or engage in exempt transactions. Agent exemptions from registration. Just as with broker-dealers, there is no de minimis exemption for agents. If you have a single client in a state, regardless of whether or not you have a place of business there, you are an agent in that state and require registration. There are only two exemptions. First is the snowbird exemption we've discussed several times before. The second is when the firm is excluded from the definition of BD because it has no place of business in the state and only deals with other broker-dealers and institutions. In that case, the BD's employees who service those clients are not considered to be agents in that state. Practice question. Under the Uniform Securities Act, which of the following would be considered an agent? A. An individual employed by a small community bank for the purpose of selling stock in the bank. B. A broker-dealer with a place of business in the state with an extensive retail clientele. C. An individual whose broker-dealer is registered in the state, but her only clients are institutions. D. An individual with no place of business in the state dealing with more than 5 existing clients who are vacationing in the state. The answer is C. Even though the individual's only clients are institutions, the fact that her BD is registered in the state means she must register as well. Yes, transactions with institutions are exempt transactions, but that exemption only applies to individuals selling on behalf of the issuer, not when representing a broker-dealer. Individuals selling the securities of certain exempt issuers, like a bank, are excluded from the definition, as are broker-dealers. If the individual has no place of business in the state and only deals with existing clients, regardless of the number, who are temporarily in the state, that individual is exempt from registration. Remember, we learned earlier in this unit that broker-dealers with no place of business in the state, dealing exclusively with other broker-dealers or institutional clients, are not considered to be BDs in the state, as long as they are properly registered in at least one state, the location of their principal office. Let's apply that to the following situation. A BC Securities is a broker-dealer registered in State A. It has no place of business in State B, but it does effect transactions on behalf of a number of banks and insurance companies located in State B. Therefore, it is not considered a BD in State B and is exempt from registering. Should a BC Securities sell some government securities to these clients, neither a BC nor the agents making the sale are required to be registered. This is not because the government securities are exempt. That just means that they don't have to register with the administrator, but because under the USA, a BC does not meet the definition of a broker-dealer in State B. However, should a BC decide to have any of its agents sell these government bonds to individual, sometimes referred to as retail, clients in State B, then even though the bonds are exempt securities, both ABC and the selling agents must register in that state. The same applies to exempt transactions. One of the most common cases is when a client calls an agent to purchase a security that is not exempt and not registered in the agent's state. But because the transaction has been initiated by the client as an unsolicited trade, it is an exempt transaction and therefore the trade may be made even though the security is not registered. One way the exam will try to trick you is by asking about an individual calling an agent from a state in which the agent is not registered. The broker-dealer is registered in that state, and the individual is a client of the firm, but not of that particular agent. The individual wishes to enter an unsolicited order. Can the agent accept it? No, although the transaction is exempt, which only means that the security does not have to be registered in that state. An agent can only do business with a resident of a state if the agent is properly licensed in that state. In this case, the agent would have to turn the order over to an agent who is licensed in that other state. Knowledge Check 11.2. Question 1. Which of the following persons is defined as an agent by the Uniform Securities Act? A. A silent partner of a broker-dealer whose only relationship to the firm is a contribution of capital. B. The secretary of a branch office sales manager who is in charge of scheduling the manager's interviews with new agents. C. A clerk at a broker-dealer who is authorized to take orders for stock, but not bonds. D. The vice president of diversity training for a broker-dealer who is not authorized to solicit or transact securities business. The correct answer is C. Anyone who solicits or receives an order while representing a broker-dealer is an agent. Silent partners and administrative personnel are not agents under the terms of the USA if they do not solicit or receive orders. As long as the officer has no supervisory role or other active participation in the securities business of the broker-dealer, the USA does not consider this position to require registration as an agent. An example might be the Vice President of Human Resources. Remember, broker-dealers are not agents. Agents represent broker-dealers. If, however, any of these individuals were authorized to accept orders, registration as an agent would be required. Question 2. Under the Uniform Securities Act, the term agent would include an individual who represents the issuer in effecting non-exempt transactions in A. a City of Montreal general obligation bond, B. common stock offered by a commercial bank, C. a New Jersey Turnpike revenue bond, D. commercial paper with a 19-month maturity. The correct answer is D. As long as the individual represents the issuer in a transaction involving specified exempt securities, such as those issued by government or banks, he is not included in the definition of agent, even when the transaction is non-exempt. On the other hand, when the securities themselves are non-exempt and the transactions are non-exempt, the individual is defined as an agent. And, yes, you may see this many negatives in a single question. Notice that a 19-month commercial paper is not an exempt security. It is over 9 months, but the other choices are. Lesson 11.3. Registration and post-registration requirements of broker-dealers and agents. Learning Objective 11. E. Describe the initial and post-registration requirements of the Securities Exchange Act of 1934 and the Uniform Securities Act regarding broker-dealers. Under the USA, if a person is included in the definition of a broker-dealer, that person must register as a broker-dealer in the states where it does business. The USA is clear about broker-dealer registration. It states it is unlawful for any person to transact business in this state as a broker-dealer, unless he is registered under this act. This means every person, legal entity, that falls within the definition of a broker-dealer must register with the administrator of the state. Again, keep in mind that if a person falls under one of the exclusions from the definition, that person or legal entity does not have to register. In most jurisdictions, registration is accomplished by filing the SEC's Form BD modified to meet the needs of the state. If any material information on the BD becomes inaccurate, prompt notice must be given to the administrator. While the exam will focus on state registration requirements, you need to know that almost all broker-dealers register with the SEC. That means that unlike investment advisors who only register with one regulator, you can assume that any broker-dealer referred to in a question, unless something tells you otherwise, registers with the SEC in at least one state. Take note. The automatic registration of officers, etc., that we discussed with regard to investment advisors applies here as well. And, as mentioned before, unlike FINRA, there is no separate principal registration. So these individuals are registered as agents. Submitting an application. All persons must complete and submit an initial application, as well as renewals, to the state securities administrator. For broker-dealers, the application is Form BD. The application must contain whatever information the administrator may require by rule and will include form and place of business, proposed method of doing business, a list of all jurisdictions in which the applicant is registering or already registered, qualifications and business history. Broker-dealers must include the qualifications and history of partners, officers, directors, and other persons with controlling influence over the organization. Court-issued injunctions and administrative orders. Adjudications by the SEC or any securities SRO, self-regulatory organization, such as FINRA, within the past 10 years. Convictions of misdemeanors involving a security or any aspect of the securities business, including charges as well as convictions. Felony convictions, whether securities related or not, including charges as well as convictions. Financial condition and history, but only of the firm no credit reports on the officers, and any current unsatisfied lines and judgments, as well as any declaration of bankruptcy within the past 10 years. The administrator also may require that an applicant publish an announcement of the registration in one or more newspapers in the state. Payment of initial and renewal filing fees. States require filing fees for initial applications as well as for renewal applications. If an application is withdrawn or denied, the administrator is entitled to retain a portion of the fee. Filing fees for broker-dealers, investment advisors, and their representatives need not be identical. As was the case with investment advisors, a registered broker-dealer may file an application for registration of a successor, whether or not the successor is then in existence, for the unexpired portion of the year. There is no filing or registration fee until renewal, December 31, of the firm's license, but the successor firm would have to file a new consent to service of process. As described previously, under normal circumstances, registration becomes effective for all securities professionals at noon of the 30th day after filing. In the case of agents, or I-8Rs, the administrator will notify the employing firm of effectiveness, and they will tell the new registrants when they are good to go. By rule or by order, the administrator may authorize an earlier effective date of licensing. In other words, there could be an occasion where, in effect, a person was the subject of a rush order. Once registered, broker-dealers are subject to numerous administrative requirements to keep their registrations current and in good order. Books and records. Every registered broker-dealer must make and keep such accounts, blotters, records of original entry, correspondence, including emails, memoranda, papers, books, and other records as the state administrator by rule prescribes. All records so required shall be maintained and preserved in an easily accessible place for a period of not less than 3 years from the end of the fiscal year during which the last entry was made on record, the first 2 years in the principal office of the broker-dealer. These records must be current, complete, and accurate. Broker-dealers are obligated to promptly file correcting amendments. State securities administrators cannot impose record-keeping requirements that are in excess of those prescribed by the SEC. Please review Learning Objective 9G to see the allowable methods of record storage. The records broker-dealers are required to maintain are subject to periodic, special, or other examinations by representatives of the administrator of the state where the broker-dealer's principal office is located or of any other state in which the broker-dealer is registered as the administrator deems necessary or appropriate in the public interest. Test Topic Alert. Included in the record-keeping requirements are electronic communications, particularly emails. However, it is not required to maintain emails of a personal nature sent to non-clients. For example, "Honey, I'm stuck at the office and will be late for dinner." Test Topic Alert. Although it is required to keep all records relating to customers, there are no requirements to keep copies of their tax returns. Financial requirements for broker-dealers. The administrator may establish net capital requirements for broker-dealers. Net capital requirements of the states may not exceed those required by federal law in this case, the Securities Exchange Act of 1934. The administrator of a state may require those broker-dealers that have custody of or discretionary authority over clients' funds or securities to post surety bonds. Just as with net capital, the amount of surety bonds required by the states is limited to the amount set by the Securities Exchange Act of 1934. No bond may be required of any broker-dealer whose net capital exceeds the amounts required by the administrator. Stated simply, when it comes to broker-dealers, regardless of how many states in which they are registered, other than enforcing anti-fraud statutes, the administrator has relinquished most control to the SEC. Test Topic Alert. You will have to know that broker-dealers who meet the SEC's net capital or bonding requirements cannot be required to meet higher ones in any state in which they do business. Test Topic Alert. In lieu of a surety bond, the administrator will accept deposits of cash or securities. Learning Objective 11, F. Describe the initial and post-registration requirements of the Securities Exchange Act of 1934 and the Uniform Securities Act regarding agents. Before we continue, there is an important term found in the Securities Exchange Act of 1934 that needs to be defined: statutory disqualification. Because the Exchange Act deals with the registration of persons, the People Act, the SEC sets forth certain actions making a person disqualified under statute, law, from becoming registered or associated with a broker-dealer or investment advisor. The person is subject to a statutory disqualification if that person has been or is expelled or suspended from membership or being associated with a member of any SRO, think FINRA, is subject to an order of the SEC or other appropriate regulatory agency, think the administrator, denying, suspending, or revoking his registration as a broker-dealer, or barring or suspending his association with a broker or dealer. By his conduct while associated with a broker-dealer, has been found to be a cause of any effective suspension, expulsion, or order of the type described in the 2 points above, has been convicted within the past 10 years of a securities violation or a misdemeanor involving finance or dishonesty, bribery, embezzlement, forgery, theft, and so forth, or any felony, is subject to a temporary or permanent injunction from a competent court of jurisdiction prohibiting him from engaging in any phase of the securities business, has willfully violated any federal securities law, or has made a false or misleading statement in any filing with information requested by an SRO, omitting important facts is a cause as well. Take note. Loss of a civil lawsuit, even one involving securities, is not a cause for statutory disqualification. The registration requirements for an agent who is not exempt are similar to those for a broker-dealer. An application, generally Form U-4, must be completed. Two things, however, that are on the agent's application that do not apply to a broker-dealer are disclosing citizenship and employment history. The USA states it is unlawful for any person to transact business in this state as an agent unless he is registered under this act. In other words, an individual may not conduct securities transactions in a state unless that person is properly registered in the state where he conducts business. This is true even when receiving unsolicited orders. If an agent does business in a state, she must be registered in that state, even if there is only one client. This is not like investment advisors and their representatives, who enjoy a de minimis exemption. So, what can an individual who has been hired to become an agent of a broker-dealer do while registration is pending? After all, one does not fill out Form U-4 and become an agent immediately. Permitted activities would be those allowed to any other employee of the broker-dealer who is not required to be registered. That would include clerical functions, such as posting trade details to client accounts, or administrative activities, like assisting with research. As long as it does not involve customer contact relating to selling/offering securities or opening accounts, these newbies can hang around the office and try to make themselves useful. Of course, most of their time should be spent preparing to pass the exam. An agent's registration is not effective during any period when the agent is not associated with a broker-dealer registered in the state. Therefore, if the broker-dealer's registration is terminated, the agent is no longer considered licensed. The terminology depends on the specific state. In some cases, the agent's license is placed in suspense. In other states, it is put on hold or similar language. Whatever the phrase, when the broker-dealer closes up shop, either voluntarily or involuntarily, think revocation of registration by the administrator. The agent cannot function because there is no broker-dealer affiliation. This is also true of an investment advisor representative when the investment advisor's registration is terminated. One place where IARs and agents differ is in their termination notice procedures. When an agent begins or terminates a connection with a broker-dealer or issuer, or begins or terminates those activities that make him an agent, the agent and the broker-dealer or issuer must promptly notify the administrator. 1. IAs register on the federal level, SEC, or state level, never both. 2. IARs only register on the state level. 3. BDs register on the federal level through FINRA and the state level. 4. Agents register on the federal level through FINRA and the state level. Test topic alert. If an agent terminates employment with a broker-dealer, both parties must notify the administrator promptly. If an agent terminates employment with one broker-dealer to join another broker-dealer, all three parties must notify the administrator. One way to remember this is that in the case of an agent, the first letter, A, tells us that all the parties involved must notify the administrator. All notifications must be made promptly. Please note how this differs from the termination of an IAR. Practice question. The City of Chicago issues bonds for the maintenance of local recreational facilities. Purchasers have two choices. They can purchase the bonds directly from the city through Ms. Stith, an employee of the city responsible for selling the bonds, or they can purchase them from Mr. Thompson, an employee of First Allied Securities Corporation. Neither Ms. Stith nor Mr. Thompson charges a commission, although FASC is remunerated with an underwriting fee. It would be correct to state that A. Ms. Stith and Mr. Thompson must be registered as agents. B. Ms. Stith must be registered as an agent, but Mr. Thompson is excluded. C. Mr. Thompson must be registered as an agent, but Ms. Stith is excluded. D. Mr. Thompson and Ms. Stith are excluded from the definition of agent. The answer is C. Any individual selling securities while representing a registered broker-dealer is always defined as an agent, even when the securities are exempt from registration, as are these municipal bonds. When an individual represents the issuer of certain exempt securities, such as municipal bonds, that individual is excluded from the definition of agent and does not register. This means the correct answer is C. It is important to remember the 5 categories of exempt issuers to which this exclusion applies. Exemptions from registration as an agent generally apply to representatives of issuers rather than to representatives of broker-dealers. Financial requirements of agents. There are no financial requirements or net worth requirements to register as an agent. The administrator may, however, require an agent to be bonded, particularly if the agent has discretion over a client's account. Test topic alert. Please note that unlike FINRA registration requirements, individuals applying for registration do not have to submit fingerprints. Multiple registrations. An individual may not act at any one time as an agent for more than one broker-dealer or for more than one issuer, unless the broker-dealers or issuers for whom the agent acts are affiliated by direct or indirect common control or the administrator grants an exception. In the event an agent does wish to affiliate with a second broker-dealer, the agent would have to go through the registration process with the second firm in the same manner as the original application, filing another Form U-4. Limited registration of Canadian broker-dealers and agents. Provided the limited registration requirements noted below are met, a broker-dealer domiciled in Canada that has no office in a given state may effect transactions in securities with or for or attempt to induce the purchase or sale of any security by a person from Canada who is temporarily a resident in this state who is already a client of the broker-dealer, or a person from Canada who is a resident in this state, whose transaction is in a self-directed, tax-advantaged retirement plan in Canada of which the person is the holder or contributor. An agent who will be representing a Canadian broker-dealer who registers under these provisions may effect transactions in securities in this state on the same basis as permitted for the broker-dealer. For the Canadian broker-dealer to register in this fashion, it must file an application in the form required by the jurisdiction where it has its principal office in Canada, register in each of the states where it is serving customers, file a consent to service of process, provide evidence that it is registered in good standing in its home jurisdiction, and be a member of an SRO or stock exchange in Canada. Requirements for agents are the same, except that membership in an SRO or stock exchange is not relevant. However, just as with domestic broker-dealers, if there is no place of business in the state, there are no registration requirements if the only securities transactions are with issuers, other broker-dealers, and institutional clients. Take note. Renewal applications for Canadian broker-dealers and agents who file for limited registration must be filed before December 1 each year. Comparing the 4 securities professionals. In our many years of preparing applicants for this exam, one thing we have observed is that many students do not have a clear idea of the difference between a broker-dealer and an investment advisor, and similarly, between an agent and an investment advisor representative. Perhaps the following will help. Broker-dealer. Primary business function is executing transactions in securities, and compensation is earned in the form of commissions and markdowns. Investment advisor. Primary business function is giving advice. Compensation is earned in the form of fees or other charges, generally based on the amount of assets managed. Agents. Individuals employed by broker-dealers to handle their customer orders to buy or sell securities and separate function from an IAR, although many in large firms wear both hats. IARs. Individuals employed by investment advisors to give advice to their clients. After an IAR advises a client about a specific security, the next step is to contact the broker-dealer where that client maintains a brokerage account to give the buy/sell order to an agent. Knowledge Check 11.3. Question 1. Under the Uniform Securities Act, which of the following statements regarding the registration of a successor firm is true? A. The appropriate filing fee must be included with the application. B. The successor firm must be in existence before the filing of the application. C. The registration of the successor firm will be effective until the December 31 renewal date without payment of a registration fee. D. All of the above. The correct answer is C. No filing fee is necessary nor is it required that the successor firm even be in existence at the time of filing. The registration is effective for the unexpired portion of the year and then must be renewed with a renewal fee each December 31. Question 2. When an agent's permanent residence address changes, updates must be made to the information on file with the regulatory bodies. The proper procedure is to file A. A Form U4 within 30 days. B. A Form U4 within 45 days. C. A Form U5 within 30 days. D. A Form U5 within 45 days. The correct answer is A. Form U4 is most commonly used when registering as an agent of a broker-dealer. Changes to material information, such as one's home address or a bankruptcy filing, are accomplished by filing an amended Form U4 within 30 days. Form U5 is used for terminations or withdrawals. Unit 12. Remedies and Administrative Provisions. Learning Objectives. When you have completed this unit, you will be able to accomplish the following. Learning Objective 12. A. Recognize the jurisdiction and authority of the State Securities Administrator. Learning Objective 12. B. Identify the administrative actions that may be taken by the administrator. Learning Objective 12. C. Recall the reasons for the administrator to deny, suspend, revoke, or cancel registrations. Learning Objective 12. D. Describe the civil rights of recovery for a securities sale or investment advice purchased in violation of the Uniform Securities Act. Learning Objective 12. E. Identify civil and criminal liability and penalties for violations of the Uniform Securities Act. Your exam will include approximately 2 questions from the topics covered in Unit 12. Introduction. This unit addresses the administrative provisions of the Act and the remedies available to the administrator. Under the Uniform Securities Act, the state administrator has jurisdiction over securities transactions that originate in, are directed into, or are accepted in the administrator's state. When a securities transaction falls within the administrator's jurisdiction, the administrator had the power to make rules and orders, conduct investigations and issue subpoenas, issue cease and desist orders, and deny, suspend, or revoke registrations. Both civil liabilities and criminal penalties exist for violating the Act. Lesson 12.1. Authority of the State Securities Administrator. The jurisdiction and powers of the administrator extend to activities related to securities transactions originated in the state, directed to the state, or accepted in the state. Securities transactions involve an offer and a sale, so we need to know what those terms mean, and then we can focus on the administrator's jurisdiction. Take note. The SEC's authority does not extend over state securities regulation, the Uniform Securities Act. Learning Objective 12. A. Recognize the jurisdiction and authority of the State Securities Administrator. Offer or offer to sell. The USA defines offer or offer to sell as every attempt or offer to dispose of or solicitation of an offer to buy a security or interest in a security for value. For test purposes, you should know that any security given or delivered with, or as a bonus on account of, a purchase of securities or anything else, a car, jewelry, and so forth, is considered to constitute part of the subject of the purchase and to have been offered and sold for value. A purported gift of assessable stock is considered to involve an offer and a sale. Assessable stock is stock issued below par for which the issuer or creditors have the right to assess shareholders for the balance of unpaid par, and every sale or offer of a warrant or right to purchase or subscribe to another security of the same or another issuer, as well as every sale or offer of a security which gives the holder a present or future right or privilege to convert into another security of the same or another issuer, is considered to include an offer of the other security. If a car dealer, as an essential part of a car sale, offers $1,000 in corporate bonds as an incentive, this would be considered a bonus under the Act, and therefore this now becomes a securities sale and falls under the jurisdiction of the State Securities Administrator. As a result, to do this, and I know it is hard to believe, the car dealer would have to register with the state as a broker-dealer. Sale or sell. The USA defines sale or sell as every contract of sale, contract to sell, and disposition of a security or interest in a security for value. This means that any transfer of a security in which money or some other valuable consideration is involved is covered by this definition and subject to the Act. Take note. You must be able to distinguish between a sale and an offer to sell. The offer is the attempt, a transaction has not taken place. In a sale, there has been an actual transaction involving money or another form of consideration for value. One must be properly registered to make both the offer and then the sale. Gifts of assessable stock. When assessable stock is given as a gift, the administrator has jurisdiction over the transaction because there is a potential future obligation in that either the issuer or, more likely, creditors can demand payment for the balance of the par value. Take note. If an individual owned assessable stock and felt that the issuer was on the verge of bankruptcy, that person could give the stock as a present. If the bankruptcy occurred, the new owner would then be subject to the assessment. Test topic alert. Assessable stock no longer exists, but the exam may ask about it. Look for this direct quote from the Uniform Securities Act. A purported gift of assessable stock is considered to involve an offer and sale. Exclusions from the definition of sale/sell and offer to sell. The terms sale or sell and offer or offer to sell do not include any. Bona fide pledge or loan, pledging stock as collateral for a loan, such as for a loan at the bank, is not a sale. You expect to get your stock back when the loan is paid off, you haven't sold it. Gift of non-assessable stock. This is the way all stocks are today. Stock dividend, whether the corporation distributing the dividend is the issuer of the stock or not. If nothing of value is given by stockholders for the dividend, and this would include stock splits. Class vote by stockholders, pursuant to the certificate of incorporation or the applicable corporation statute, or a merger, consolidation, reclassification of securities, or sale of corporate assets in consideration of the issuance of securities of another corporation, or act incident to a judicially approved reorganization with which a security is issued in exchange for one or more outstanding securities, claims, or property interest, or partly in such exchange and partly for cash. Test topic alert. Because you have just learned that the gift of non-assessable stock is not considered a sale, you have to be careful not to be tricked by a question on the exam in which shares of non-assessable stock are given free as a bonus with the purchase of something else, for example, a security, a car, a house. This would not be a gift and would, in fact, be an offer or a sale. Legal jurisdiction of the administrator. Under law, for any agent of a state, for example, the administrator, to have authority over an activity such as a sale or offer of securities, he must have legal jurisdiction to act. Jurisdiction under the USA specifically means the legal authority to regulate securities activities that take place in the state. The USA describes activities considered to have taken place in the state as any offer to buy or sell a security, as well as any acceptance of the offer if the offer, originated in the administrator's state, is directed to the administrator's state, or is accepted in the administrator's state. Take note. Because securities transactions often involve several states, more than one administrator may have jurisdiction over a security or a transaction. Practice questions. Let's work through some practice questions to see how this might appear on your exam. Question 1. Jane is an agent registered in states A and B. While sitting in her office in state A, she contacts a client who lives in state B with a recommendation to buy a BC stock. The client agrees to make the purchase. Jurisdiction here would belong to A. The state administrator. B. The state B administrator. C. Both the state A and state B administrators. D. Neither administrator because this is an existing client. The answer is C. In this case, it would be the administrators of both states A and B. Why is that? Remember that the administrator has jurisdiction over any offer that originated in his state. And clearly this offer originated from Jane in state A. Recall that the administrator has jurisdiction over any offer that was accepted in his state. And this client who accepted the offer lives in state B. The status of the client, existing or prospective, does not affect the administrator's jurisdiction. Let's take a look at another possible question. Question 2. Jane has another state A-based client, Sally, who spends the winters in state C, a state where neither Jane nor her broker-dealer have a place of business or any retail clients. Jane sends Sally a research report with a strong buy recommendation for XYZ stock. Sally calls Jane with an order to purchase 100 shares of XYZ. Jurisdiction over this transaction belongs to A. The state administrator. B. The state C administrator. C. Both the state A and state B administrators. D. Both the State A and State C administrators. The answer is D. Just as with the previous question, we have an offer being made from State A, resulting in that administrator having jurisdiction. Although the client lives in State A, the offer was accepted while she was in State C, so the State C administrator has jurisdiction. Although not related to the issue of jurisdiction, for review purposes, we should ask ourselves, can this transaction legally take place? Jane is not registered in State C. How can she make the offer to a client who is there? And how can she and her broker-dealer accept a retail order when neither of them are registered in State C? As noted in Unit 11, a broker-dealer with no place of business in a state who deals with existing clients, such as Sally, who are temporarily in the state, as Sally is not defined as a broker-dealer in that state, and therefore does not register nor do their agents. Take note. The administrator's authority does not stop at the state line. The administrator of any state where the registrant is registered may demand an inspection during reasonable business hours with whatever frequency the administrator deems necessary. Take note. To avoid unnecessary duplication of examinations, the administrator may cooperate with the securities administrators of other states, the SEC, and any national securities exchange or national securities association registered under the Securities Exchange Act of 1934. Publishing and broadcast exceptions to jurisdiction. There are special rules regarding the administrator's jurisdiction over offers made through a TV or radio broadcast or a bona fide newspaper. The administrator would not have jurisdiction if the offer were made under any of the following circumstances: television or radio broadcast that originated outside of the state, bona fide newspaper or periodical published outside of the state newspaper or periodical published inside the state but with more than 2/3, 66%, of its circulation outside the state in the last year. Take note. A bona fide newspaper is a newspaper of general interest and circulation, such as the New York Times. Private investment advisory newsletters, usually distributed by subscription, are not bona fide newspapers and therefore are not included in the publishing exception. Test topic alert. A radio or television program is considered to originate in the state where the microphone or television camera is located. Practice question. Wayne and Grayson Limited is a broker-dealer with offices in Gotham, New Jersey. They place an ad for a new securities issue in the Gotham Gazette. Approximately 55% of the Gazette's readership is in Delaware. Under the Uniform Securities Act, jurisdiction over this ad would lie with A, the administrator of New Jersey, B, the administrator of Delaware, C, the administrators of both New Jersey and Delaware, D, the administrator of neither New Jersey nor Delaware. The answer is A. Although more than half the readers of the Gazette live in Delaware, under the terms of the publishing and broadcasting exemption of the USA, the offer is not made in Delaware because the paper is not published there. Therefore, the administrator of New Jersey has sole jurisdiction over the offering. No dual or multiple jurisdiction applies in this case unless the offer is actually accepted in Delaware. What would the answer be if the question stated that more than 2/3 of the circulation was outside of New Jersey? Once that happens, believe it or not, no state has jurisdiction. Knowledge Check 12.1. Question 1. A state securities administrator has jurisdiction over a securities offering if Roman numeral 1. The security was registered in that state. Roman numeral 2. It originated in that state. Roman numeral 3. It was accepted in that state. Roman numeral 4. The broker-dealer is registered in that state. A. 1 and 2. B. 1 and 4. C. 2 and 3. D. 3 and 4. The correct answer is C. The administrator of this state has jurisdiction over an offer to buy or sell as follows. An offer to sell or to buy is made in this state, whether or not either party is then present in this state, when the offer originates from this state. An offer to buy or to sell is accepted in this state when acceptance is communicated to the offeror in the state. The security may be registered in dozens of states, including this state, or the security might be exempt from registration. That means it would not be registered in this state. However, the administrator has jurisdiction only when the offer is made or accepted in this state. Likewise, the broker-dealer may be registered in many states, but unless the BD is involved in an offer or acceptance in this state, this state's administrator does not have jurisdiction. Question 2. An administrator has jurisdiction over an offer to sell securities if it was made in a newspaper published within the state with no more than A. 1/3 of its circulation outside the state, B. 1/2 of its circulation outside the state, C. 2/3 of its circulation outside the state, D. 90% of its circulation outside the state. The correct answer is C. A state administrator has jurisdiction over a securities offering made in a bona fide newspaper published within the state with no more than 2/3 of its circulation outside the state. Lesson 12.2 Administrative Actions. Learning Objective 12. B. Identify the administrative actions that may be taken by the administrator. The USA not only establishes the jurisdiction of the administrator, but also outlines the powers or the actions that the administrator can take within its jurisdiction. The four broad powers the administrator has to enforce and administer the act in his state are to make, amend, or rescind rules and orders and require the use of specific forms, conduct investigations and issue subpoenas, issue cease and desist orders and seek injunctions, and deny, suspend, cancel, or revoke registrations and licenses. Because the administrator has the power to enforce the act for the benefit of the public, the administrator, as well as his employees, has an obligation not to use the office for personal gain. Administrators are, as a result, prohibited from using for their own benefit any information derived from their official duties that has not been made public. Rules, orders, and forms. To enforce the USA, the administrator has the authority to make, amend, or rescind rules, forms, and orders necessary to administer the act. The administrator may also issue interpretive letters. The USA requires that all rules and forms be published. Rules and orders of the administrator have the same authority as provisions of the act itself, but these rules and orders are not part of the USA itself. The difference between a rule and an order is that a rule applies to everyone, whereas an order applies to a specific instance. Example: the administrator may decide to issue a rule requiring all agents to pay an annual registration fee of $250. This rule applies to everyone. Or the administrator may find that a specific agent has violated a provision of the law and order a 30-day suspension. This order applies only to that particular agent. Although the administrator had the power to make and amend rules for compliance with her state's blue sky law, she does not have the power to alter the law itself. The composition or content of state securities law is the responsibility of the state legislature, not of administrative agencies. Rules for administration and compliance with the law are the responsibility of the securities administrator. Example: rules and orders of the administrator. Situation: the administrator of State R requires by rule that all companies registering their securities in State R must supply financial statements in a specific form and with content prescribed by the administrator. However, the administrator does not publish the rule because the rule is too long and complex. Analysis: the USA allows state administrators to issue rules and orders in carrying out their regulatory functions, and the State R administrator acted properly in designing the form and content for financial reports. However, it is required by the USA that administrators publish all rules and orders. The administrator, despite the latitude given him in administering the USA, cannot suspend any provision of the USA itself. The State R administrator acted within his authority in designing the forms, but acted without authority, that is, he violated the USA by suspending the requirement that all rules and orders be published. Conduct investigations and issue subpoenas. The administrator has broad discretionary authority to conduct investigations and issue subpoenas. These investigations may be made in public or in private and may occur within or outside of the administrator's state. Normally, these investigations are open to the public, but when, in the opinion of the administrator and with the consent of all parties, it is felt that a private investigation is more appropriate, that investigation will be conducted without public scrutiny. In conducting an investigation, the administrator or any officer designated by him has the power to require statements in writing, under oath, as to all matters relating to the issue under investigation, publish and make public the facts and circumstances concerning the issue to be investigated, subpoena witnesses and compel their attendance and testimony, and take evidence and require the production of books, papers, correspondence, and any other documents deemed relevant. Test topic alert. If the administrator of State A wishes to investigate a BD registered in State A, but whose principal office is located in State B, does he need the approval of the State B administrator? No. When can he go in? the administrator can go in during normal business hours and doesn't need to make an appointment. So, what happens if a person who is the subject of an investigation refuses to furnish the required evidence or just ignores the subpoena? After all, the administrator is not a police officer, he doesn't wear a badge, and cannot arrest anyone. There is a legal term that describes this type of disobedience. That term is contumacy, and here's what the USA says about that. In case of contumacy by or refusal to obey a subpoena issued to any person, the administrator may apply to the appropriate court in his state and ask for help. Upon application by the administrator, the court can issue an order to the person requiring him to appear before the administrator or the officer designated by him to produce documentary evidence if so ordered or to give evidence touching the matter under investigation or in question. Failure to obey the order of the court may be punished by the court as a contempt of court. Contempt of court can, of course, lead to jail time. Take note. In addition to having the power to conduct investigations, the administrator may enforce subpoenas issued by administrators in other states on the same basis, as if the alleged offense took place in the administrator's state. However, the administrator may issue and apply to enforce subpoenas in his state at the request of a securities agency or administrator of another state only if the activities constituting an alleged violation for which the information is sought would be a violation of the USA if the activities had occurred in his state. Issue cease and desist orders. Whenever it appears to the administrator that any person has engaged or is about to engage in any act or practice constituting a violation of any provision of this act or any rule or order hereunder, she may in her discretion bring either or both of the following remedies. Issue a cease and desist order, with or without a prior hearing, against the person or persons engaged in the prohibited activities, directing them to cease and desist from further illegal activity. Or, bring an action in the appropriate court to obtain enforcement of the order through the issuance of a temporary or permanent injunction. If necessary, the court may appoint. The administrator is granted this power to prevent potential violations before they occur. It is sometimes said that the administrator can act when she smells the smoke, even without seeing the fire. Sometimes a tipster or whistleblower will divulge information to the administrator that might be relevant to a serious infraction. To prevent any further damage to investors, a cease and desist order can be entered. Although the administrator has the power to issue cease and desist orders, she does not have the legal power to compel compliance with the order. To compel compliance in the face of a person's resistance, the administrator must apply to a court of competent jurisdiction for an injunction. Only the courts can compel compliance by issuing injunctions and imposing penalties for violation of them. You will need to know that enjoined is the legal term that is used to refer to a person who is the subject of an injunction. Take note. Cease and desist orders are not the same as stop orders. Cease and desist orders are directed to persons, requiring them to cease activities. Stop orders are directed to applications regarding registration of a security. Example: cease and desist orders. Situation: Ms. Thomas is registered to conduct business in State C and makes plans to sell a security within the next few days. The administrator considers this security ineligible for sale in the state. The administrator orders Ms. Thomas to stop her sales procedures immediately. Analysis: The administrator of State C issued a cease and desist order to Ms. Thomas because there was insufficient time to conduct a public hearing before the sale to determine whether the security was eligible for sale in the state. Summary powers. Another of the powers of the administrator is known as acting summarily. This means that she may order, without having to go through the hearing process, a postponement or suspension of a registration pending final determination of any proceeding based upon actions described above. Once the summary order is entered, the administrator will promptly notify the applicant or registrant, as well as the employer or prospective employer if the applicant or registrant is an agent or investment advisor representative, that it has been entered and of the reasons for it. If the applicant wishes a hearing, a written request must be made, and within 15 days after the receipt of the written request, the matter will be set down for hearing. If no hearing is requested and none is ordered by the administrator, the order will remain in effect until it is modified or vacated by the administrator. Final orders. A final order is one that ends litigation, usually. Under the Uniform Securities Act, it is when the administrator, or a court, renders a judgment in an action, guilty or innocent. Regardless of whether we're referring to persons, exemptions, or registration, as stated previously and repeated because it is likely to be on the exam. Other than when the administrator has acted summarily as described above, no final order may be issued without the administrator giving appropriate prior notice to the affected persons, granting an opportunity for a hearing, and learning objective 12. C. Recall the reasons for the administrator to deny, suspend, revoke, or cancel registrations. The administrator has the power to deny, suspend, cancel, or revoke the registration of broker-dealers, investment advisors, and their representatives, as well as the registration of securities issues. Broker-dealers, advisors, and their representatives. To justify a denial, revocation, or suspension of the license of a securities professional, the administrator must find that the order is in the public interest and also find that the applicant or registrant, or in the case of a broker-dealer or investment advisor, any partner, officer, or director, or any person occupying a similar status or performing similar functions, has filed an incomplete, false, or misleading registration application, has willfully violated the USA, has been disqualified from membership in any domestic or foreign securities or commodities regulatory body due to a conviction of a securities-related misdemeanor as a result of action brought within the last 10 years, has been convicted of any felony within the last 10 years, has been enjoined by law from engaging in the securities business, is subject to another administrator's denial, revocation, or suspension, is engaged in dishonest or unethical securities practices, is insolvent, only true in the case of state-registered advisors, is the subject of an adjudication that the broker-dealer has willfully violated the Securities Act of 1933, the Securities Exchange Act of 1934, the Investment Advisors Act of 1940, the Investment Company Act of 1940, or the Commodities Exchange Act, has, in the case of a broker-dealer or investment advisor, been found guilty on the charge of failure to supervise, has failed to pay application filing fees, or is not qualified on the basis of training, lack of experience, and knowledge of the securities business. Test topic alert. Because of a lack of uniformity in state criminal laws, it can happen that a person is convicted of a misdemeanor in one state and then moves to a state where that same crime is a felony. If the person were to then apply for registration, the administrator must consider the crime under the statutes of the state where it occurred, not his own. In other words, the administrator may only consider what is on the person's record. Test topic alert. If a person is subject to a disqualification by any SRO, even the NASD, before it became FINRA, for something that was not a violation of the Uniform Securities Act, that would still be a cause for denial. Test topic alert. Denial is generally limited to convictions for any felony or investment-related misdemeanors within the past 10 years. However, as pointed out in a previous unit, these convictions, and even just being charged, must always be disclosed on the application for registration. There is no time limit. Take note. The public's best interest is not reason enough for the denial, suspension, or revocation of a registration. There must be a further reason, as described previously. Other than when acting summarily, no order to deny, suspend, or revoke may be entered without appropriate prior notice to the applicant or registrant, as well as the employer or prospective employer if the applicant or registrant is an agent or investment advisor representative, opportunity for hearing, and written findings of fact and conclusions of law. The administrator may not suspend or revoke a registration on the basis of facts that were known to the administrator at the time the registration became effective, unless the proceedings are initiated within 90 days. Lack of qualification. An administrator may not base a denial of a person's registration solely on her lack of experience. However, the administrator may consider that registration as a broker-dealer does not necessarily qualify one for a license as an investment advisor and may restrict that applicant's registration as a broker-dealer conditional upon its not functioning as an investment advisor. To better understand these 2 points, let's look at the wording in the Act itself. 1. The administrator may not enter an order denying registration solely on the basis of lack of experience if the applicant or registrant is qualified by training or knowledge or both. Obviously, a new applicant for registration as an agent or IAR is not going to have any experience selling securities. So the Act says that this lack of experience by itself is not enough to deny the registration as long as the administrator feels assured that the individual will receive adequate training and/or has the requisite knowledge. One could suppose that passing this exam demonstrates the necessary knowledge. 2. The administrator may consider that an investment advisor is not necessarily qualified solely on the basis of experience as a broker-dealer or agent. When she finds that an applicant for initial or renewal registration as a broker-dealer is not qualified as an investment advisor, she may, by order, condition the applicant's registration as a broker-dealer upon the firm's agreeing to not engage in business in this state as an investment advisor. In this case, the act is dealing with a person who has experience, albeit not necessarily in the giving of advice. Just because a person has been a broker-dealer or an agent for a broker-dealer does not mean that the person is qualified to be an investment advisor. So the registration will be limited to acting only in the stated capacity as long as one does not cross over the line and give investment advice. Securities issues. As is the case with a securities professional, a securities administrator may deny, suspend, cancel, or revoke a securities registration if the order is in the public's interest and the securities registrant files a misleading or incomplete registration statement, is engaged in an offering that is fraudulent or made on unfair, unjust, or inequitable terms, charges offering fees that are excessive or unreasonable, has a control person convicted of a securities-related crime, is subject to a court injunction, is engaged in a method of business that is illegal, or is subject to an administrative stop order of any other state. In addition, the administrator may deny a registration if the applicant fails to pay the filing fee. When the fee is paid, the denial order will be removed, provided the applicant is in compliance with all registration procedures. Test topic alert. When the conditions that led to the issuance of the stop order have changed for the better, the legal term, remember, this is a law exam, used to describe the lifting of the stop order is vacated. For example, the order has been vacated. Practice questions. It is important that you be able to recognize the difference between a cease and desist order and a stop order. Look at the following example questions. Question 1. An agent of a broker-dealer solicits clients to purchase unregistered promissory notes. The agent claims that promissory notes are not securities and therefore do not need to be registered. The administrator disagrees with that position and would issue A. A cease and desist order against the agent. B. A cease and desist order against the issuer of the note. C. A stop order against the agent. D. A stop order against the issuer. The answer is A, unless we had reason to believe that the issuer was the one claiming that its notes were not securities. The only person guilty here is the agent. Stopping the agent from continuing to solicit the purchase of unregistered securities is done by issuing a cease and desist order. Alternatively, if the question went like this, Question 2. Palterer Products, Incorporated, PPI, headquartered in State J, has sent an announcement to a number of broker-dealers in the state promoting their 8% promissory notes as a high-interest non-security alternative to a bank CD. The compliance officer of your firm forwards this to the State J administrator. What action would the administrator likely take? A. Issue a cease and desist order against the compliance officer with or without a hearing. B. Issue a cease and desist order against PPI with or without a hearing. C. Issue a stop order against the compliance officer after giving an opportunity for a hearing. D. Issue a stop order against PPI after giving an opportunity for a hearing. The answer is D. Promissory notes are securities, and therefore PPI must stop soliciting the sale of them as non-securities. The method of doing so is through the issue of a stop order. No order would be forthcoming against the compliance officer. She was only doing her job correctly. Remember, cease and desist orders are against registered securities professionals and stop orders against issuers. Finally, the cease and desist order can be issued with or without a hearing and the stop order only after a hearing. Non-punitive terminations of registration. A registration can be terminated even if there has not been a violation of the USA. A request for withdrawal and lack of qualification are both reasons for cancellation. Withdrawal. A person may request on his own initiative a withdrawal of a registration. The withdrawal is effective 30 days after the administrator receives it, provided no revocation or suspension proceedings are in process against the person making the request. In that event, the administrator may institute a revocation or suspension proceeding within 1 year after a withdrawal becomes effective. Cancellation. If an administrator finds that an applicant or a registrant no longer exists or has ceased to transact business, the administrator may cancel the registration. Test topic alert. For any of the 4 securities professionals, the administrator retains jurisdiction for a period of 1 year after the effective date of withdrawal of registration. That means that an action can commence for a violation discovered during that period. Note that FINRA has the same rule, but their jurisdiction lasts for 2 years. Test topic alert. You may encounter this type of question regarding cancellation. What will the administrator do if mailings to a registrant were returned with no forwarding address? The answer is cancel the registration. The administrator may also cancel a registration if a person is declared mentally incompetent. Test topic alert. Be familiar with the distinctions between cancellation and denial, suspension, and revocation. Cancellation does not result from violations or a failure to follow the provisions of the Act. Cancellation occurs as the result of death, dissolution, or mental incompetency. Test topic alert. Because an agent's, or IAR's, registration is dependent on being associated with the registered individual is placed into suspense or some other term with essentially the same effect. When the period of suspension of the firm is over, registration of the individuals is reactivated. If the firm's registration has been revoked, then the individual will have to find a new affiliation or the license will be canceled. Individual agents, or IARs, who withdraw their registrations must re-affiliate within 2 years or they will be required to retake the exam to requalify. Knowledge Check 12.2. Question 1. Which of the following accurately describes a cease and desist order as authorized by the Uniform Securities Act? A. An order that a federal agency issued to a brokerage firm to stop an advertising campaign. B. An administrator's order to refrain from a practice of business she believes to be unfair. C. A court-issued order requiring a business to stop an unfair practice. D. An order from one brokerage firm to another to refrain from unfair business practices. The correct answer is B. A cease and desist order is a directive from an administrative agency to immediately stop a particular action. Administrators may issue cease and desist orders with or without a prior hearing. Brokerage houses cannot issue cease and desist orders to each other. Question 2. The administrator may cancel the registration of an advisor if A. Mail is returned with notification that the forwarding notice has expired. B. The advisor is not in the business any longer. C. A court has declared the advisor to be mentally incompetent. D. Any of the above. The correct answer is D. You must know the difference between cancellation of a registration, which requires no hearing, and revocation, which does. Cancellation is non-punitive. The registrant is not guilty of a violation.